Let's begin CMA Inter exclusive marathons for June 24 or December 24 exams. This video, this introduction of mine is going to be a common intro for all the CMA marathons. So here I just want to give a couple of instructions. Please kindly watch these instructions and then only start watching from the respective timestamp. Don't hurry up. I know you are thinking to skip this introduction and want to directly go and watch. Please have patience. If you want to succeed in life, you have to follow certain instructions. That instructions I'm going to give you. The first and foremost instruction, kindly watch these marathons at standard speed. Don't increase the playback speed. Please, when you are listening to the class, your purpose is not to finish the class. The purpose is to absorb something, to get something, to connect with the subject, to absorb something. Absorption is important. When you listen to the class at standard speed, you require very, very, very less time for revision. When you listen to the class at higher playback speed, you require lots of time for revision. Getting it? And when you listen the class at higher standards, higher playback speed, generally you will not get that command on the subject. Getting it? That's it. Now we are going to upload for all the CMA Inter, all the 8 subjects related marathons. So we will be uploading it from 11th of May onwards. Will be uploading for June exams. Even for December students also can absolutely use these marathons. So until May end, we will be keep on uploading whenever one marathon is completed, we'll be keep on regularly uploading. So P5, our faculty Subramaniam sir will take this marathon, law, and Radhika Gelot from Pune. So she'll be handling industrial and commercial laws. Company law and ethics, Subramaniam sir will handle. And P6, financial accounting will be by Sai Babu sir. By the way, you can just open our YouTube channel, caramharsha. Inside that playlist you open, you see the playlist, first playlist, CMA Inter June 24 marathons or strategies. So CMA Inter playlist you will find like this. So inside this preparation strategies, 3/4 preparation strategies. What is 3/4? Very simple. A student need not study 100% of the entire syllabus to qualify. In order to get 50, 55 plus, if you are very good at 3/4 of the syllabus, that's more than enough. So for every subject, the faculty has given guidance on which 3/4 syllabus you must be very strong at. So you watch that, you will understand. So, and coming to, by the way, in this marathon, we have used materials, right? These materials that we used in this marathon can be downloaded from Open Srestha CMA website. Inside the CMA Inter, you open PDF resources. Just click on the PDF resources, open CMA Inter. So below group 1, you just see here. So law, taxation related, accounts related, tax related, and cost accounting, everything, even marathon notes and all also. If at all we have a marathon notes, that also we will insert here. You will find it here. Getting it? So there you can download the materials. Financial accounting by Sai Babu sir, direct taxes by Bhaskar sir, IDT by Pavan sir, cost accounting by Ganesh BHARADWAJ sir, and the same Ganesh BHARADWAJ sir will handle management accounting as well. Paper 11 part A, financial management by Funny sir, analytics by Mahmood sir, P10 auditing by Mahmood sir, corporate accounting by Sai Babu sir of our Srestha faculty, and operational management by Subramaniam sir, who is actually handling corporate law, and strategic management by Harish Krishnan sir. We will be uploading all these marathons as and when completed, and we try our level best to upload all these marathons, within this May month itself. Getting it? So make use of it. And even RTP videos also we will be uploading very soon for each subject. So just make use of these resources and do well in the exams. And while you're listening, just post your appreciation, whatever. After watching the marathon, please post your appreciation, whatever, as a comments, and like this video, especially importantly, because it will recommend to other CMS students as well. All the very best. Thank you. Continue watching, by the way.
Hey folks, welcome you all to a new video. This is CA Ganesh BHARADWAJ. So in this video, we will be getting started with CMA Inter Paper 8 Cost Accounting Revision Marathon Series. Right now, this revision marathon is mainly exclusively for CMA students, mainly for the ones who are going to appear in their June 2024 exams, as well as for the ones who are going to appear in their December 2024 exams. Clear with this, guys? So now this revision marathon is going to be in 3 parts. So part 1 will be having 4 chapters: marginal costing, budgets and budgetary control, overheads, cost bookkeeping. These are the 4 chapters which we'll be covering in part 1, which will be somewhere around 12 hours approximately. Just the part 1, it will be for about 12 hours. Then we'll be moving on to part 2, where in part 2 we will be seeing job costing, batch costing, contract costing, operating costing. Basically, this operating costing is also known as service costing. These are the different methods of costing. This part 2 will be for somewhere around 5.5 to 6 hours approximately. And then finally, part 3, we will be having cost sheet, direct expenses, standard costing, and cost accounting standards. These chapters put together will be somewhere around 3 to 4 hours overall, right? And overall, this entire revision marathon put together is going to be for a duration of about 20 hours. All the chapters that we are going to cover put together. Now, sir, are we covering all the chapters? Now, in our regular batch, obviously, every single chapter is being covered. Now, in this marathon, I have handpicked these 12 chapters and I wanted to cover it properly, right? There are a few chapters like chapter number 1, the introduction to cost accounting, then chapter like process costing, joint and byproduct, your employee cost and material cost. These are basically the chapters which we are not covering in marathon, right? Because right now I didn't want to do some dilution where dilution cannot be made. As in, these chapters can be condensed and properly presented, right? Whereas, for example, pick a chapter like process costing, it cannot be properly condensed and presented in a marathon revision. So what I did was I just handpicked these chapters, and for sure these chapters itself put together will be covering easily about 80 to 90 percentage of your overall exam in terms of marks, right? Because obviously in exam you also have choice questions, so the exam gets printed for more than 100 marks, right? So easily about 80 to 90 marks coverage is there in this particular marathon. That is number 1. Number 2, guys, that I wanted to tell you, now in our regular batch, right, we have recordings that are exclusively made for CMA, right? So we don't mix the recordings of CA Inter and give it for CMA students. Our regular lectures are exclusively done for CMA students separately and CA students separately. This is how we conduct our regular lectures. For the purpose of marathon, for the purpose of this revision, so what we are doing is part 1 and part 2 alone, we are taking it from our CA Inter revision lectures, because concept wise everything is the same. Clear with this? And in a revision batch, in a revision marathon, the overall objective is to touch upon all the aspects and make sure that you are able to recollect everything. Now, our CA Inter recordings that have the same common syllabus is actually being taken here for a simple reason that the recordings have come out really well and it is equally applicable for you. So we don't want to give you something that is not applicable for you. Whatever is relevant, that is what we have given in part 1 and part 2. Part 3, we are exclusively recording it for your CMA Inter, because if you see here, there are some changes in cost sheet and all of that. Standard costing, cost accounting standard is an exclusive chapter that is present only for CMA Inter students and all of this. That is the reason where we can't actually use the common recording. We are exclusively going to do it for the purpose of CMA Inter students, for the purpose of revision. Anyways, you all know that our regular lectures are completely exclusively done for CMA. Not even a single minute of recording is taken from CA Inter. Our regular lectures are exclusively done because for the purpose of we have given a commitment that the entire study note, institute study note, or the CMA Institute study material is getting covered in our regular lectures. So yes, so for that reason we are exclusively making our recordings for CMA Inter students. But for the purpose of revision marathon, this is what we had planned for. So part 1 and part 2 will be common recordings for CA Inter, which we are actually giving it to you for CMA Inter students. These are very valuable content because it has come out really well, right? And it has helped many students in terms of recollecting all the important concepts. Are you clear with this, guys? Right? And part 3 we will be exclusively making for CMA Inter students, right, from the perspective of CMA. So everything is equally applicable for you also. So please do not worry. Whatever you are going to watch right now is 100% applicable for CMA Inter students. Only that we are giving to you. Clear for this, guys? So this is one very important thing that I wanted to tell you guys. And one more thing, a common doubt that generally students have, I generally clarify this at the introduction level itself. Sir, is it enough if I watch the revision marathon? Now, then why do we have something called as regular? Regular lectures are not replaceable at all. A revision marathon is, as the name suggests, it is a revision. It helps you revise. So the prerequisite to actually watch the revision marathon is that you should have ideally covered the syllabus once. It is not that you should have watched my lectures. You could have watched any other faculty's lecture, or you could have even done a self-study. No matter what, it is preferable that you at least cover the entire syllabus once, so that now if you watch this revision marathon and if you revise it along with me, you will be able to figure out things in a very clarity manner. You can actually do it with much clarity, and this will help you to step up your preparation in your exams. Are you clear with this? So these are a few things that I wanted to share with you before we get started with our revision marathon, right? So on that note, let us get started with the first chapter in our revision marathon. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and now we are in the day 2 or the part 2 of this costing revision series. Now, in this part 2, we are going to learn 2 chapters. We are going to basically revise 2 chapters. One is marginal costing, the other one is process costing. These two are supposedly the most important chapters, or 2 of the most important chapters in our entire syllabus, costing syllabus. And out of this, marginal costing is slightly the biggest chapter of all. So that's why I am starting off this day with marginal costing, so that let's finish it off properly and then we'll move on to the next one. Clear? So that is going to be the agenda for this part 2 of this costing revision series. Now, this particular part 2 itself is going to contribute somewhere around 20 to 25 marks in your exams, right? Now, the most important part that we are going to do here is, as I told you guys earlier in the day 1 as well, marginal costing is the biggest of all chapters in our regular batch. I think about 25 hours approximately, if I'm not wrong. So here in this revision batch, obviously we can't cover all those, the entire number of sums that we did and all in our regular batch, and of course we can't completely do all the concepts. But yes, I have designed this particular revision module in such a way that we are going to touch upon all the important concepts. Predominantly all the concepts will be covered in this particular chapter, right? So the coverage will be as follows. I have just branched this chapter into 3. The first one is the basics, right? And then we have the cost volume profit analysis. I will tell you what all fits into this category. And then finally we have a particular segment called as absorption costing versus marginal costing. So I have just classified this chapter into 3 for the purpose of revision, so that it will be easy for us to recapitulate the entire discussion, right? Clear with this? Fine. So in this CVP analysis, right? CVP stands for cost volume profit analysis. It's another name for marginal costing. So we will be learning about the concepts of contribution, PV ratio, break-even point, cash break-even point, margin of safety, the CVP pairs, or as I call it, CVP jodis, right? Or the CVP couples, whatever it is. Then the break-even chart, the profit volume chart, sales mix, merger of plants, sensitivity analysis, indifference point, shutdown point, and key factor analysis. That's your limiting factor analysis. So we will be touching upon all these areas, and of course we will also be doing some numerical problems. This is what I've planned, and this will be done in such a way that it's going to be a very effective revision, because as of now I've not done a revision, or my revision video on marginal costing is not there anywhere on YouTube. So I thought, let me give a very holistic coverage of this entire chapter, despite the fact that it's going to be a revision, but let's revise almost the entire chapter. This is going to be the objective. So my humble request to you guys is, please participate then and there. Use the chat box and just participate. It's going to enhance your learning experience for sure. Catch up running notes. And for those who are going to watch this later on a recorded mode, right? You also participate as if I'm standing in front of you and doing this revision, so that it will definitely enhance your learning experience. Clear with this, guys, right? And trust me, this revision is definitely going to step up your preparation with respect to this particular chapters that we're going to do today for sure, right? That to that extent I can definitely give you a commitment. Now shall we get started, guys? Shall we get started? Right, fine. Now this chapter, marginal costing, first let us get started with the basics. And for the purpose of getting into the basics of this chapter, let me take a numerical example. Now let us say that the selling price is rupees 10 per unit, the variable cost is rupees 6 per unit, the fixed cost is rupees 10,000, right, in total, and the sales volume, let us say is 6,000 units. Let us say is 6,000 units, right? Now with this, let us try to prepare a marginal costing income statement, right? Let us revise what is the concept of PV ratio, a concept called as break-even point, a concept called as margin of safety, and of course we will also try to calculate the profit. These are the 5 things that we are going to see using this particular example. By the way, before you start any chapter, you should know what is the objective that that particular chapter is going to help us achieve. This chapter completely revolves around the objective of decision making, which means this chapter needs to be looked at from the perspective of variable cost and fixed cost. So in this chapter, the cost classification will be from the perspective of variable cost and fixed cost. Clear with this, guys? Right. And there is only one concept in this entire chapter that deals with the objective of stock valuation and profit computation. That is the segment C of this particular chapter, which is absorption costing versus marginal costing. That is the only segment in this chapter that deals with stock valuation and profit computation. What it is, I will be doing it. I will walk you through at the time when we are entering into the segment C. But till then, predominantly about 95% of this chapter, all the other concepts of this chapter revolves around the concept of division making, wherein the cost classification will be strictly from the perspective of fixed cost and variable cost. Clear with this, guys? Now, how does the marginal costing income statement looks like? So the first one is the marginal costing income statement, right? So the marginal costing income statement goes as follows. First, you'll be having sales minus variable cost, gives you something called as contribution, minus fixed costs, finally gives you something called as profit. Now we all know that variable cost makes sense only when it is represented on a per unit level, whereas fixed cost makes sense only when it is represented in total. Why? Because that is the cost behavior pattern of variable and fixed cost. Variable cost, an example would be your material cost, correct? So only if I produce the next unit, this variable cost will be incurred, whereas that is not the case with fixed cost. An example of fixed cost could be your factory rent, right? So in your fixed cost, irrespective of your output level, this 10,000 rupees will always be incurred. You cannot do anything about it. Clear with this, guys? Clear with this, guys? So marginal costing income statement says that it is better if you present your income statement as sales minus variable cost, that gives you something called as contribution, minus fixed cost, that gives you something called as profit. Sir, why, sir? Rather, I could say sales minus total cost. When I say total cost, it's variable plus fixed, directly gives me profit. Why are you having one speed breaker in between called as contribution, and from there once again you're reducing fixed cost and arriving at a profit? This manner of presentation will enhance your level of decision making. Sir, how? Fine. First, let me just walk you through the statement, and once we are through with this, we will be having a lot of clarity as to how this helps us in our decision making objective. Now first, guys, now in this case, every time I sell a unit, what is the revenue that I get? I get 10 rupees, right? And every time I sell a unit, I also incur 6 rupees variably, which can be tracked on a per unit level. Correct? So every time I sell a unit, I earn 10 rupees. And every time I sell a unit, I need to spend 6 rupees. So technically speaking, this 4 rupees is my variable profit. I can track this profit on a per unit level. Correct? Now, is this my final profit? No. Why? Because my fixed cost is yet to be adjusted. So the variable profit is only called as contribution. Clear with this, guys, right? Why is it called as contribution? Wait, I will come to that. The name, the reason for the name, the logic for the name. Now, in this case, you tell me the company has sold 6,000 units. Each of the unit has given them a revenue of 10 rupees. So basically the sales is going to be 6,000 units into 10 rupees. That's going to be 60,000, right? Now the variable cost will be, they have sold 6,000 units and each of the unit had a variable cost of 6 rupees. That's going to be 36,000, right? Now, if you do this, you get a variable profit of how much? You can even calculate this, 6,000 units into 4, that gives you 24,000. Now, how much is your fixed cost? Your fixed cost is going to be 10,000 rupees. So technically you are left with a profit of how much? 14,000 rupees. Now, sir, why is this variable profit called as contribution? Simple. Now, I earn a variable profit of 24,000 rupees, that is called as contribution, right? Now, from this contribution, first I try to recover whatever fixed cost I have actually incurred, and whatever is earned over and above recovering my fixed cost is called as my profit. Or in other words, this variable profit contributes first towards recovery of my fixed cost and then towards generating my profit. Since it contributes towards two things, that is recovery of fixed cost and the generation of profit, they are using the word called as contribution. Are you clear with this? Right? This is the reason why instead of using the word variable profit, they are using the word contribution. Clear with this, guys? Clear with this, guys? Now, using this marginal costing income statement only, the other concepts like PV ratio, break-even point, margin of safety, and all of these are actually developed, and these are actually very much useful for us to take meaningful decisions. We will be seeing that. First, are you guys clear with the marginal costing income statement right now? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, this is the most important thing that you need to know throughout the chapter, because for every single sum that you are going to do, this marginal costing income statement is the base from which you need to enter into any kind of numerical problems in this chapter. Clear with this, guys? And are you all able to understand the logic for this income statement? Right? Fine. So now let's move on to the second one, B. Let's move on to the second one, B. Now, what have they asked for? They've asked for the PV ratio. Now, here we have sales minus variable cost gives you contribution, right? Now, on a per unit level, what is the sale? Or in other words, my selling price is 10 rupees. And on a per unit level, what is my variable cost? My variable cost is 6 rupees. And on a per unit level, what is the contribution, also known as the variable profit, to put it in layman words? So that is going to be 4 rupees, correct? Now, in terms of total value, that is for 6,000 units, what is going to be my total sales? My total sales is going to be 60,000 rupees. My total variable cost is going to be 36,000 rupees. And my total contribution is going to be 24,000 rupees. Agreeing with me on this or not? Guys, yes? Right? Now, what did I do? Very simple. On a per unit level, I generate a revenue of 10 rupees. I incur a variable cost of 6 and I make a variable profit known as contribution. From now on, I will be using the word only as contribution. I earn a contribution of 4 rupees. Now, for any kind of output level, I just need to multiply each of these three figures with the volume, in this case 6,000. So for any volume level, I can find out the total sales, the total variable cost and total contribution. Agreeing with me on this, guys, right? Now, if I say that if I want to express all these things as a percentage by keeping my sales as 100, right? That is, if I want to express my variable cost as a percentage of my sales. Now, variable cost expressed as a percentage of sales is how much, right? If I generate a revenue of 10 rupees, I know that I will be incurring a variable cost of 6 rupees. Or in other words, can I say my variable cost ratio is 60 percentage? Agreeing with me on this or not? That is, every time you generate a revenue of 100 rupees, 60 rupees is your variable cost, correct? Yes. So the variable cost can be represented both on a per unit level as well as a percentage expression. Agreeing with me on this? Similarly, contribution also move proportionately only. So can I say every time I generate sales worth 10 rupees, I am earning a contribution of 4 rupees. Or in other words, contribution can also be expressed as a percentage of sales. Now that percentage in this case is going to be how much? 40%. Agreeing with me on this or not? Right? This 60 percentage is called as VC ratio, variable cost ratio, and this 40 percentage is called as PV ratio, profit volume ratio. Are you clear with this? Sir, how is this profit? I told you contribution is nothing but variable profit. Are you clear with this, guys? So when they say PV ratio, it is nothing but contribution expressed as a percentage of sale. Are you clear with this, guys? Yes, you guys are all clear with this, right? Fine. So now, why do we use this expression? If I want, I can track my variable profit on a per unit level, or if I want, I can track my variable profit, that is my contribution, as a percentage level. Every time I sell a unit, I will earn 4 rupees of contribution. Or I can say, if I generate sales worth 100 rupees, I will make a variable profit of 40 rupees. Correct? Suppose they are saying, this year I'm planning to earn generate a revenue of 1 lakh rupees. In that case, 1 lakh into 40%. So 40,000 rupees is going to be your contribution. Directly we can arrive at the figures. Are you clear with this? So if the sales is given in the units, you can multiply it with contribution per unit to arrive at the total contribution. Or if the sale is expressed in value, you multiply that with PV ratio to arrive at the same contribution value. Are you clear with this, guys? These are all multiple ways of doing it. These are all multiple ways of arriving at the figures. Are you all clear with this? Are you all clear with this? Right? Next. So now your PV ratio is done. Your PV ratio is done. Now let's move on to the next one. So what is the other one? Yes, your break-even point. So now the next concept is called as break-even point. Now what do you mean by a break-even point? The break-even point is a point where I exactly make a profit of 0. That is, it is a point of sale at which there is no profit, no loss. Are you clear with this, guys? It is a point of sale where there is no profit, no loss, right? Now in this case, in our example, when will we be having a no profit, no loss? Can I say when my sales, total sales is exactly equal to my total cost, there will be a no profit, no loss. Agreeing with me on this? Agreeing with me on this, right? Or can I say when my contribution is just sufficient to recover my fixed cost, that is when my profit will be 0. Agreeing with me on this or not? Guys, are you all clear with this? That is, when I earn a contribution that is exactly sufficient to recover my entire fixed cost, right? Then the point of sale at which my contribution is equal to my fixed cost is called as my break-even point. Now this contribution should not be more than your fixed cost. In that case, you will be starting to earn a profit. It should also not be less than your fixed cost. That will be a loss scenario. Your contribution earned should be exactly equal to the fixed cost. The point of sale at which my contribution is exactly equal to my fixed cost is called as my break-even point. Are you clear with this, guys? Are you clear with this? Now, guys, please do not mug up any formulas, right? Mark my words, there is not even a single formula that needs to be mugged up here. Everything is absolutely logical. Spend some little time and you are done. That's about it, right? So now in this case of break-even point, I told you it is a point of sale, right, where my contribution is equal to what? My contribution is equal to fixed cost, right? So it is a point of what? It is a point of sale. So how many units should I sell so that my profit is equal to 0? So we need to find that sales units only. So how do we do it? Can I say the number of units? So the sales units I don't know what it is, I need to find out, into the contribution per unit which we got here. The contribution per unit is how much? 4, right? Should be equal to the total fixed cost. In our case, what is the total fixed cost? 10,000 rupees. Correct, guys? Yes. So now, can I say the required sales units to exactly earn a 0 profit or 0 loss is going to be rupees 10,000 upon 4. This is nothing but how much? 2,500 units. Agreeing with me on this. So if I exactly sell 2,500 units, right, I will reach a break-even point. That is, there will neither be a profit nor will there be a loss. My contribution will be exactly sufficient to recover my fixed cost. Are you all clear with this, guys? Or in other words, this is nothing but fixed cost divided by contribution per unit. That is, I need to earn a contribution that is equal to my fixed cost, and every unit gives me a contribution of 4 rupees. So how many units should I sell to recover my entire fixed cost? That is the meaning of this. Are you clear with this, guys? Are you clear with this, guys? Right? Now, another way of doing it is, I told you, contribution can also be calculated by saying that it is nothing but sales in value into PV ratio. Correct? No? So sales can be expressed in units, or sales can also be expressed in value. Sales in units into contribution per unit gives you the total contribution. Similarly, sales in value into PV ratio also gives me what? The contribution value only. Right? Can I say sales in value into PVR should be equal to my fixed cost? Right? So now sales in value into, what's my PV ratio here? My PV ratio is 40%. So can I say into 40% should be equal to rupees 10,000, or the sales, required sales in value should be equal to rupees 10,000 divided by 40%. So how much is that? 10,000 divided by 0.4, that gives you, yes, 25,000 rupees. Are you clear with this? Or in other words, if you directly want to calculate the break-even point in value, see, break-even point is nothing but a point of sale. And whenever they are mentioning about a sale, it can either be expressed in units or can be expressed in value. So if you want to calculate the break-even point in value, you can use directly the formula fixed cost divided by PV ratio. Are you clear with this, guys? Are you clear with this? Or there is one more way of doing. We found out the break-even point in units, correct? 2,500 units, right? And every unit actually has a selling price of 10 rupees. So 2,500 units into 10 rupees. This way also you can find out 25,000 rupees. So basically break-even point, remember, can be expressed as can be expressed in units, or it can also be expressed in values. Are you clear with this, guys? So now the break-even point formula, to put it short, if you want to express in units, it's going to be fixed cost divided by contribution per unit. If you want to express in value, it's going to be fixed cost divided by PV ratio. Are you clear with this, guys? Are you all clear with this? Always remember, if you want to find out something in units, use contribution per unit. If you want to find out the same in value, instead of contribution per unit, use PV ratio. As simple as that. Clear with this, guys? Clear with this, guys? This is one trick that you can use in marginal costing, a very logical trick as well. Clear with this, guys? So now, can I say that in our case, what was the break-even point in units? 2,500 units, correct? So if I am exactly selling 2,500 units, now there will be 0 profit or 0 loss. Correct, guys? No profit, no loss. Suppose I start selling more than 2,500 units, this will be a profitable situation for me. Suppose I am not even able to reach 2,500 units, this is a loss situation for me. That is, at this point of time, my contribution earned will not even be sufficient enough to recover my fixed cost, and I will end up reporting what? A loss. Are you clear with this, guys? So the break-even point is a parameter. Any businessman will first calculate the break-even point, and he will say, now, when am I going to achieve this? I need to first achieve this 2,500, and after that, whatever sale I make, that will only go on to generate my profit. Are you clear with this, guys? Are you all able to understand this? That is the concept of break-even point. Now, let us move on to the next concept called as margin of safety. Let us move on to the next concept called as margin of safety. Margin of safety. Now, how is it getting calculated? Now, what is this margin of safety? Now, guys, in our example, Now tell me, what is the total number of actual units sold? In our example, the company has sold a total of 6,000 units, right? So the actual sales is how much? 6,000 units. Now we just calculated that the break-even point happens at where? It happens at 2,500 units is what your break-even point is, right? Now margin of safety means the number of units sold in excess of my break-even point. Are you clear with this? So in this case, how many units have I sold in excess of my break-even point? I have sold 3,500 units in excess of my break-even point. This is called as margin of safety. Clear with this, guys? Are you all able to understand? Are you all able to understand? So I have sold 3,500 units over and above my break-even point. This is called as my margin of safety. Sir, why are we using the word margin of safety? Basically, what the businessman will look at is, okay, currently I am selling 6,000 units. I know that my break-even point is 2,500, which means currently I'm in a comfortable position. Now, tomorrow, even if something goes wrong, max I can afford to lose a volume only to the extent of 3,500. If I lose volume beyond 3,500, I will end up in a loss situation. So to that extent of 3,500 units, I have a cushion, right? That is why it's called as margin of safety. Are you clear with this? This is the logic for the word margin of safety. Are you all able to understand this, guys? Right now, how would you calculate margin of safety? First, let me tell you this. Yes, this is nothing but you can take it as the total sales minus break-even point. Right now, have one thing in your mind. Now, in this case, what happens? The company is first, the moment they sell 2,500 units, the entire contribution will go on to recover the full fixed cost. Correct? Suppose they are selling 2,501 unit, right? The contribution generated by that one extra unit will directly go on towards generating profit. In this case, the company's profit will be 4 rupees. Correct? Suppose the company has sold 2,502 units. The company's final profit will be those 2 units into the contribution generated. So, or in other words, margin of safety is nothing but the profit generation sale. Agreeing with me on this? Right? The break-even point is nothing but your total sales that recovers your fixed cost, and your margin of safety is nothing but the total sales that goes on to generate your profit. Are you clear with this? So here the margin of safety can be easily called as your profit generation sales. Now, profit generating sales. Now, you just look at this. Now, I have something called as this entire marginal costing income statement. So, look at this here. I have sales minus variable cost gives me contribution minus fixed cost gives me profit. Correct, guys? Now, look at this. Interesting observation. So, now in this case, what's going to be my total sales value? So, it's 60,000, right? So, my sales is going to be 60,000, right? Then minus my variable cost, which is going to be 36,000, gives me my contribution, which is going to be 24,000, right? Minus fixed cost gives me 10,000, gives me a final profit of how much? 14,000. Correct? Now, can I say, look at this. Can I say this 10,000 rupees of fixed cost was purely recovered by the contribution generated from these 2,500 units? Agreeing with me on this or not? That is nothing but my break-even point. That is, I'm repeating, the fixed cost was completely recovered using the contribution generated by the 2,500 units. Agreeing with me on this or not? Or in other words, can I say the break-even point 2,500 units into the contribution per unit? How much is the contribution per unit? 4 rupees, right? So 2,500 into 4, that's how we got this 10,000. Are you clear with this, guys? Right? Now the overall 6,000 units that I have sold, right, that gave me the overall contribution of 24,000 rupees. 6,000 units into contribution per unit of 4 rupees, that gave me the overall contribution of 24,000 rupees. Agreeing with me on this or not, guys? Yes. Similarly, the profit I am reporting of 14,000 rupees, why? This purely came from the margin of safety units of 3,500. So 3,500 units into the contribution per unit of 4 rupees. That's how I got this 14,000 rupees of profit. Agreeing with me on this, guys? Agreeing with me on this? Or in other words, can I say my contribution is tied to my total sales, my fixed cost is tied to my break-even sales, and my profit is tied to my margin of safety. Agreeing with me, guys? Agreeing with me, guys? So now I'm just writing it down here. I'm just writing it down here. So here, what we will write down is, so the total sales, right, is tied to the contribution. The break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. Are you clear with this? And if the sales, the break-even point and the margin of safety, if they are expressed in units, right, you can multiply these figures with contribution per unit, right? If these are expressed in values, you multiply them with what? You multiply them with PV ratio to arrive at these figures. Are you clear with this, guys? Are you clear with this? That is all about it. That is all about it. So marginal costing is nothing but one vertical statement and one horizontal statement. Remember this fully. Remember this fully. That is, your total sale is made up of break-even point plus margin of safety. Correct? Your total sales is nothing but break-even point plus margin of safety. Always remember, break-even point is a point, right? The balancing figure is my margin of safety. This break-even point will not change unless and until there is a change in my fixed cost or my contribution per unit. This will not change, right? Whatever excess sale that I make, if the number of units that I sell increases, only the balance cushion will increase. The margin of safety will only increase. My break-even point will not change. Clear with this, guys? So the total sale is nothing but break-even point plus margin of safety, right? And my total sales is tied up to my contribution. My break-even point is tied up to my fixed cost, and the margin of safety is tied up to my profit. Are you all clear with this, guys? Right? And margin of safety is nothing but my profit generating sale. This is something that you need to understand. This is something that you need to understand. So here, in order to calculate the margin of safety, you can use multiple formulas. Like, you can use different formulas. Can I say margin of safety is equal to now you have, so we know that it is tied to profit, correct? So just now I told you margin of safety into PV ratio gives you what? It gives you profit, right? Or can I say margin of safety is nothing but profit divided by PV ratio? Guys, correct? Guys, correct? So margin of safety is nothing but profit divided by PV ratio. Or if you want it in units, you can say it is nothing but profit divided by contribution per unit. Are you clear with this? Similarly, I can also say margin of safety is nothing but, it is nothing but the total sales minus break-even sales. Correct? Or it can be in value, or if you want, you can also express it in units. Are you clear with this, guys? Yes, you guys are able to follow this, right? There are so many ways of arriving at your margin of safety, your break-even point. These are all different ways of reaching at the same destination. The problem is, many students think that, these are all formulas to be mugged up. They will say, this is one formula, this is number 2 formula, this is number 3 formula, and they start on a mission to mug up all these things. It doesn't work that way, right? It can clearly not work that way, because this is absolutely logical. You can come up with the formula by yourself if you know the base understanding of this. Clear with this, guys? We just took about half an hour, and this is all about predominant portion of the entire chapter. Right now, we will only be developing and entering into the other advanced areas, keeping this as the base. Are you all clear with this, guys? Are you all clear with this? Now, one last time. So tell me, what is that marginal costing income statement vertically and horizontally? Vertically, it's going to be sales minus variable cost. Come on, guys. Tell. Sales minus variable cost gives you contribution, minus fixed cost gives you what? Your profit. And here on the horizontal side, you will be having the total sales that is broken up into break-even point and margin of safety. And your total sales is tied to your contribution using CPU, your contribution per unit, or PV ratio, as the case may be. Your break-even point is tied to your fixed cost, and your your margin of safety is tied to your profit. As simple as that. And this is about the entire chapter, guys. Right now, if someone is asking you to mug up formulas here, it clearly doesn't work that way. Then you will find marginal costing difficult only. This is all about it. Are you all able to understand this? Right? Shall we proceed into a few numerical problems? Yes. Yes, and of course they've asked for the profit as well. The profit, anyways, we found it. Right? Okay, fine, guys. So now, can you tell me a few formulas as to how do you arrive at profit? Profit is equal to, I can say, total sales minus total cost, or I can also say it is contribution minus fixed cost, correct? Or I can also say it is margin of safety in value into PV ratio, correct? Or I can also say it is margin of safety in units into contribution per unit. There are so many ways in which you can arrive at it. Guys, are you all able to understand this? Right now, these are all different formulas I've seen. Many people, they write it in one full sheet of paper and they start mugging it up. Now, these are something, instead of you're wasting your time in mugging this up, if you spend your time in understanding the logic behind it, you yourself can write all these things by yourself. Clear with this, guys? Don't take the pain of remembering things. If you learn it conceptually, it will stay with you for a lifetime. That's about it. Clear with this, guys? Shall we proceed forward? Shall we proceed forward? Right? These are all like, it need not be, remembered. On the spot, you just visualize the vertical and horizontal statement. Marginal costing is sorted for a lifetime. That's about it. Fine, guys. Now, shall we move on to the numerical part? Okay. So this is what I've just mentioned it here in the book as basics and all. Beyond this itself, we have covered it right now. So you can just go through all these things. And one very important thing, the basic assumptions of this particular chapter. The basic assumptions of this particular chapter is selling price per unit will remain constant, variable cost per unit will remain constant, and the fixed cost in total, not the total cost, the fixed cost in total will also remain constant. Clear with this, guys? So what do you mean by this? What do you mean by this? Let us say I am selling 1 lakh units, right? Now, for this 1 lakh units, for the first 20,000 units, I can't have a different selling price. For the remaining 80,000 units, I can't have a different selling price. No. Right? Sir, in reality, it can happen. Yes, it can happen. What will I do in that case is a subject matter of discussion in CA final. Clear with this? You have a self-paced learning module. There in strategic cost management, we will be seeing. Not here in your intermediate level. That's an advanced level area. Clear with this, guys? In your intermediate level, suppose they have given a particular number of sale units. Right from the first unit till the last unit you are selling, the selling price will be the same. The selling price can change. If at all it changes, it will be changing for the entire 1 lakh units. It will not be partly for some units you will be having one selling price, the remaining units will be having a different selling price. No, that is not a subject matter of discussion in intermediate. Similar is the case for variable cost as well as fixed cost, correct? If at all these changes, we will be seeing a concept called a sensitivity analysis, wherein we will be saying what will happen if there is a change in selling price, variable cost, fixed cost. Yes, but all these changes will be happening right from the first unit till the last unit you sold. Clear with this? It will not be partly for some units and partly for different units. That discussion is there only in your CA final. Are you all able to understand this? Right? This is the basic assumptions on which this entire chapter is being made. Yes, and the uses of marginal costing, of course, it is used for pricing, short-term decision making, and market penetration at a lower price. Now, one more thing, guys. One more thing. I'm not sure if you guys are aware of this. You have two subjects, right? Costing and FM, right? When I say costing, I mean cost and management accounting. Now, costing always focuses on short-term decision making, and financial management always focuses on long-term decision making. Have this very clearly in your mind. The decision making taken by costing is always 100% short-term. Costing will not take long-term decisions. Sir, I want to take long-term decisions, then go refer FM. Clear with this? That's why these two are interconnected. That's the reason why, if you notice, only in FM you have the concept of time value of money, because we are going beyond 1 year. Have you ever seen the concept of time value of money in costing? No, because costing always talks about short-term decision, right? So which is important, sir? Long-term or short-term? Generally, we prefer long-term only. No, it's not like that. When you're starting a company, you start off with a long-term planning by doing capital budgeting and all that, right? But will everything go as per the plan? suddenly something happens, a crisis comes in, you need to take an immediate short-term decision. That's when costing comes into the picture. Now, this is even more critical. Taking a short-term decision is even more critical because given the scenario, you need to know what best needs to be done, right? Concepts like sensitivity analysis, your limiting factor, that is a scarcity of raw material, which I should use these raw material to produce which type of products. That is a short-term decision making. It's not permanent. If it's a long-term decision making, we need to refer FM. Clear with this, guys? So the ground rules are set, the boundaries are very clear. So long-term decision is taken only by FM, the short-term is taken only by costing. This is something that you all need to know. Right, coming up here. So now in your CVP analysis, yes, the contribution, PV ratio, break-even point and all we've seen. Yes, the cash break-even point, I will come to that. The margin of safety, CVP pairs is also done. Now, what we will do is, let's move on to a numerical problem. Let's move on to a numerical problem. 1 second. Let me just see. Okay. Yes, guys. Look at this. Yes, please take this illustration. Please take this illustration. Now, they have given that the selling price is 25, the variable cost is 15, and the fixed cost is 20,000 rupees. Now, wait. They are asking a lot of things like contribution. What will be the profit if they are selling 4,000 units? What is the sales required to earn a profit of 50,000? And all these things are given. Now, guys, 1 minute. The moment you read any question in marginal costing, now don't keep on staring at the question. It will stare back at you, right? There is no point in it. What you need to do is immediately drop the marginal costing income statement, plug the figures there. That will automatically lead you to the solution. Clear with this? In this case, what I will do, sales minus variable cost gives you contribution minus fixed cost gives me profit. I will just plug it. Okay, only the units are given, per unit data is given. So 25 minus 15, the contribution per unit is 10. The fixed cost is given in total as 20,000. Rough work you do and keep, right? This will lead you to the solution. Now, first, what have they asked for? PV ratio. How will you do it? How will you do the PV ratio? It's going to be 10 rupees upon 25 rupees contribution by sales, or say contribution per unit into selling price per unit. Anyways, so 10 upon 25 into 100, that's going to be 40%. Clear with this? Yes. Then what will be the profit if I'm selling 4,000 units? Very simple. The contribution will be 40,000 into, 4,000 units into 10. 40,000. From that 40,000, 20,000 will be reduced for fixed cost. Remaining 20,000 will be my profit. 40,000 minus 20,000 gives me 20,000. Clear with this, guys? Right? That's about the second part. Third part, look at this. Look at this. What is going to be the sales required to earn a profit of 50,000? What they are saying, look, I want to earn a final profit of 50,000, right? What should have been the sales I need to make? Simple. Sales minus variable cost gives me contribution minus fixed cost gives me what? Profit. Now they have said they want to earn a profit of 50,000. This 50,000 will be earned after recovering for my fixed cost of 20,000. Correct? No, guys. Yes. Which means I should have generated a contribution that first recovers the entire fixed cost of 20,000. Plus contributes to a profit of what? 50,000 rupees. So my contribution should be how much? 70,000. Are you clear with this? So to earn a profit of 50,000, I should have generated a contribution of 70,000. Correct? Right? Now for me to generate a contribution of 70,000, how many units should I sell? Very simple. 70,000 divided by the contribution per unit. Every unit gives me a contribution of 10. I need to earn a total contribution of 70,000, which means I need to sell how many units? 70,000 upon 10, 7,000 units. Are you clear with this, guys? Right? Or in other words, how do you do this? The sales required in units is going to be fixed cost plus profit. That is my required contribution divided by what? Divided by, yes, that divided by my contribution per unit. I think there is some mistake here. Just a minute, guys. There's some mistake. Okay, the final answer is correct. Look at this. I will just do it here. It's going to be 20,000 upon 20,000 plus 50,000, which is 70,000 divided by 10. Yes, 7,000 units. I think they have just done a mistake here. So if you want the sales in units, it's going to be fixed cost plus profit divided by contribution per unit. Are you clear with this? So I need to earn a contribution of 70,000 rupees, right? That 70,000 rupees, every unit was going to give me a contribution of 10. which means I can earn the 70,000 rupees only by selling 7,000 units. Clear with this, guys, right? So the required sales is going to be the required contribution divided by contribution per unit. Required contribution is nothing but fixed cost plus profit. Are you clear with this? Similarly, if you want to express this in values, very simple, fixed cost plus profit divided by PV ratio. Or in other words, I know that my PV ratio is 40%, meaning what? If I make sales worth 100 rupees, right, I know that I'm going to earn a contribution of 40 rupees, correct? If this 40 has to be 70,000, right, how much should be my 100? Or in other words, 70,000 divided by 40%. Are you clear with this, guys? So wherever you are using the word contribution per unit, instead if you replace it with your PV ratio, you will be getting the sales in value. In this case, it's going to be how much? 1,75,000. Is this figure right? So it's 7,000 into 25. Yes, it's 1,75,000 or 70,000 divided by 0.4. Are you all able to understand this? Yes. To convert the rupees into units, then divide the sales. Yes, you can do that also. That's what I said. If you want, you can also first find it in units, 7,000 units, multiply it with the selling price of 25 rupees, you will get this 1,75,000. Or directly, if you want, you can say it is nothing but your fixed cost plus profit, the whole divided by PV ratio. Are you clear with this, guys? Now, I have seen many people write all these things as formulas and mugging it up, right? Required sales is equal to fixed cost plus profit divided by PV ratio. Tell 5 times, if not write 100 times imposition, doesn't make sense. You just put it up on a statement, it will lead you to the solution. What is the point in mugging up? You have a lot of other things to remember, right? Don't waste your time here. Clear with this, guys? Spend some extra 2-3 minutes, learn it conceptually, it will stay with you for a lifetime. That's about it, right? Then you have the sales required to earn a profit of 40,000 rupees after tax, okay, when the tax rate is 60%. Now, guys, first let me tell you one thing. This is an exceptional case. Generally, taxes are not even considered in our subject. I told you this, right? But for some reason they have given, I want to earn a profit of 40,000 rupees after tax. They have given that the tax rate is how much? 60%, right? So after tax, they want to earn how much? 40,000. So the tax rate is how much? 60%, which means if you earn 100 rupees, 60 rupees goes by tax, right? And the balance 40 is only left with you, right? This 40% is equal to 40,000. How much is the profit before tax that they want to earn? 40,000 divided by 40%, 1 lakh, right? That's all. Now this 1 lakh is a required profit. To earn a required profit of 1 lakh rupees, how much should be the sales that needs to be made? 1 lakh plus 20,000. 1,20,000 is going to be my required contribution, correct? So that divided by PV ratio or divided by contribution per unit, you will get the required sales in value or in units. Are you clear with this, guys? So that is what they have done. 1,20,000 divided by 0.4. So whatever it is, it's going to be 3 lakh rupees. Yes, fine. Or in other words, it's going to be 1,20,000 divided by, what's the contribution per unit? It is 15, 10 rupees, right? It is 10 rupees. 10 rupees, no? Yes, divided by 10, it's going to be 12,000. Are you clear with this, guys? And that's about it. That's about it. So if you want to express the sales in units, it's going to be 12,000. If it has to be expressed in value, it's going to be 3 lakh rupees. Done, guys. Yes, you guys are clear with this? Fine. The next one. What is the sales required to earn a profit of 25% on sales? Now, wait. What do you do? What do you do here? Don't immediately think what formula I should use. Put up the statement. It will lead you. So sales minus variable costs gives you a contribution minus fixed costs gives you profit, right? So now they have given that. So they have asked us to find out the sales. Let's keep the sales as X, right? So variable costs gives you contribution. So what is the PV ratio, guys? What is the PV ratio? 40%. So can I say if I keep my sales value as X, my contribution will be 0.4x, correct? Because basically my variable cost will be 0.6x, right? X minus 0.6x, it will be 0.4x, right? My fixed cost anyways is sorted. I know my fixed cost is going to be 20,000 rupees, right? This is going to be 20,000 rupees. So what is going to be my profit? They are saying I want to earn a profit of 25% on the sales. So 0.25x, correct? You have framed an equation. So can I say this is nothing but 0.4x minus 20,000 is equal to 0.25x, correct, guys? Or in other words, 0.4x minus 0.25x is equal to 20,000. Now 0.40 minus 0.25, that gives you 0.15, right? So 0.15x is equal to 20,000. X is equal to 20,000 divided by 0.15. So how much is that? 20,000 divided by 0.5. So 1,33,333. Are you clear with this? Or if you want to find it out in units, divided by the selling price, but of course there will be some decimal round off. So this is going to be divided by 25, is it? The selling price is 25. Yes, divided by 25, you get in units of 5,333. Are you clear with this, guys? Are you all able to understand? Very logical. This is why I said spend more time on the concepts. Again and again, I'm telling you, remember the Abraham Lincoln's whatever he said. So if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. Spend more time on conceptual learning. The execution will just take a few minutes. That's about it. Clear with this, guys? Fine. With that, we are done with this particular basic illustration. Now, one more thing. Let's go on and do one question here at the back. Yes, this is a masterpiece question. Just a minute. Please take the first question for practice. I mean, not the practice sum, the classroom discussion question. Please take the first one, guys. Please take the first one. Now, what have they given? Read it carefully. Read it carefully. Look, ideally, this I have numbered it as question number 1, but there are 6 parts in this question, right? Once we finish all the 6 here, your basic concepts are going to be sorted. Sir, in exam, can we solve through the statement without using the formula? Now, which one you're talking about? See, in any of these methods that I told you, this statement is something that will lead you to the solution. When you are writing the solution, of course, you need to write the formula. In this case, if you see, there is not much of a formula, but everywhere else, you look at this, I also used a formula. I just asked you not to mug it up, but in exam, it needs to be written for sure. So here, how do I calculate the required sales to earn a profit? I'm saying it is I backworked and I calculated here. Okay, 70,000 divided by contribution per unit. But I need to mention it in the exam. How did you get the 70,000? It's nothing but 20,000 plus 50,000. That is nothing but fixed cost plus profit divided by contribution per unit. So what I told you is this has to be in your, maybe in your rough, or if you want, you can even put it on paper, not a problem. But definitely using this, you will be able to write the formula on your own. That is what I'm saying. I'm not saying formula is not required. Please don't mistake it as, I'm telling don't write the formula. No, I'm asking you not to mug up the formula. I'm saying you can write it on your own if you do the statement. Are you clear with this? So please write the formula like this, but you can easily do it provided you are having the statement with you. Right. So now let's go on to that first question. Where is it? Okay, yeah. Now, guys, read it carefully. If margin of safety is 2,40,000 and it is being 40% of the total sales and the PV ratio is 30%, calculate the break-even sales, the amount of profit on sales of 9 lakh. This is the question. Now, what have they given here? The margin of safety is 2,40,000. So they are saying the extra sale that they have made over and above the break-even point is 2,40,000. And they are saying this 2,40,000 is 40% of the total sales. So how much is the total sale? 2,40,000 divided by 40 into 100. So the total sale would have been 6 lakhs. Agreeing with me on this? Guys, yes? Hello? Yes? So how much is going to be your break-even point? Break-even point is going to be 6 lakh minus margin of safety of 2.4 lakh. Guys, correct? Guys, correct. Or you can say 6 lakh into 60%. If 40% is my margin of safety, the balance 60% has to be my break-even point. Correct? No? Right? 6 lakh into 0.6, that's going to be 3.6 lakhs. Are you clear with this, guys? Are you clear with this? So my break-even point is going to be how much? The break-even sales is going to be 3.6 lakhs. In this question, break-even point cannot be found in units. Why? Because the per unit data is not given. Have they given us the per unit data? No. They have only given us the values and percentages and the PV ratio. So had they given us the contribution per unit, we could have found out. So in this case, we can only express the PV, your break-even point in terms of values. Next, calculate the amount of profit if my sales is going to be 9 lakhs. Right? So what will be the profit if my sales is going to be 9 lakhs? You can prepare the statement and you can find out. Correct, guys? So PV ratio is how much? 30%. Now, can anyone tell me what is the fixed cost in this question? How much is the fixed cost? How much is the fixed cost? So fixed cost is going to be how much?
1,08,000.
1,08,000. Perfect. How did you get 1,08,000? Very simple. I told you, remember the marginal costing jodis. Break-even point into PV ratio gives you your fixed cost. Correct? Break-even point is a point which generates a contribution that is equal to fixed cost. So the contribution generated at the break-even point is equal to nothing but your fixed cost. Correct? So 3,60,000 into your PV ratio of 30%, that's going to be 1,08,000. So you get a fixed cost of how much? 1,08,000. So now with this you can calculate, you can prepare that entire marginal costing income statement when the sales is going to be 9 lakh. So when the sales is going to be 9 lakh, so 9 lakh into 0.3, it's going to be 2,70,000. That's going to be my contribution minus fixed cost of 1,08,000. I will be getting what? I will be getting a profit of 1,62,000. Correct, guys? Yes. Look at this. This is what they have also mentioned. The break-even point is 3,60,000, and your what is this? The profit. Yes, the profit is going to be 1,62,000. If I'm not wrong. Yes, 1,62,000. Now there is another way of calculating the profit. What is it? Using the concept of margin of safety. Guys, we know profit is equal to margin of safety into PV ratio. Correct, guys? Hello? Hello? Guys, yes? Yes, Prashant? You there? Yes. Right? So, remember the jodis that I told you. Your profit is nothing but, can I say, margin of safety into PV ratio. Correct? Now, when I'm generating sales worth 9 lakh rupees, how much is the margin of safety? 9 lakh minus 3.6 lakh. My 3.6 lakh is my break-even point. Any sale I make over and above this 3.6 lakh is called as my margin of safety. 9 lakh minus 3,60,000 is how much extra sales have I made? 5,40,000. That is the margin of safety. That into 0.3. 30%, that is directly going to give me how much? 1,62,000. This way also I can find out my profit. Look, guys, you can play around with the figures provided you have your horizontal and vertical statements of marginal costing. Clear with this? Are you all able to understand? This is much more easier way of doing it. Clear with this, guys? Right. Let's move on to the next one. X Limited has earned a contribution of 2 lakh rupees and a net profit of 1,50,000 on sales of 8 lakh rupees. What is the margin of safety? Now, if you just read the question, you cannot make out anything. What should you do first? Guys, what should you do first? Put up the statement. Scribble it, it's okay. Right? Put up the statement. It will lead you to the solution. And with that, you write the formulas and present it in the exam. Presentation part, you do it. Not a problem. But how do you know what to do? That can be done only if you prepare the statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? Now, it has earned a contribution of how much? 2 lakh rupees. Okay. And then they have said a net profit is going to be 1,50,000. So, 1,50,000 here. And then what have they said? The sales is going to be 8 lakh rupees. Right? Now, clearly you know what is the PV ratio? 2 lakh upon 8 lakh into 100. It's going to be 25% is my PV ratio. Guys, yes. Now, what have they asked us? What is the margin of safety? What is the margin of safety? One look you can answer. One look you can answer. What are the jodis? Margin of safety is connected to what? Margin of safety is connected to what? It is connected to profit. Correct? So, margin of safety into PV ratio is going to be equal to your profit. Now what happens here? Or can I say margin of safety is equal to profit divided by PV ratio? Yes, profit is 1,50,000. PV ratio is going to be 25%. So my margin of safety is going to be how much? 1,50,000 divided by 0.25 is going to be 6 lakh. Guys, clear with this? Clear with this? That's about it. That's about it. But when you're writing in the exam, you should write this formula for sure. I am not saying don't write the formula. Please don't misunderstand. I am saying, I'm telling you the ways to write the formula by yourself. That's what I'm telling you. Clear with this, guys? Are you all able to follow this? Are you all able to follow this? Right? So first they also calculated the PV ratio. And then margin of safety is equal to profit by PVR. It's 1,50,000 divided by 25%, 6 lakh rupees. Are you all able to understand? Guys, yes, this is actually a beauty provided. You are able to understand the base of marginal costing. Next one. Let's move on to the next one, the third one. The ratio of variable cost to sales is 70%. Wait, they have given the VC ratio. So what is the PV ratio? 30% is the balancing figure. The break-even point occurs at 60% capacity sales, right? Capacity sales means what? The company has some capacity, right? Maximum capacity. We don't know how much that is, but they are saying when I am operating at just 60% of my total capacity, at that point itself, my break-even point happens. Clear with this? Compute how much is that capacity sales, right? And when the fixed costs are 90,000 rupees, also compute the profit at 75% capacity sales. There are two questions here. Number one, first calculate what is the total capacity sales. That's what they're asking. Number two, if the company is operating at 75% capacity sale, how much will be the profit? Two things they are asking us to find out. Now, first, guys, now look at this. In this question, once again, what you need to do here is you need to first put up the marginal costing income statement, right? Now, I'm just doing it in a rough here, but anyways, it's being done. The solution is being done. Now, guys, please participate along with me. Now, first, what have they given? The ratio of variable cost to sales is going to be 70%. It means that my PV ratio is going to be 30%. The break-even point occurs at 60% of the capacity. First, can I calculate the break-even point? Will I be in a position to calculate the break-even point? Yes. How can I calculate the break-even point? Fixed cost I have, PV ratio I have. So now the Jodi's fixed cost is always tied to my break-even point. Correct, right? So break-even point is equal to fixed cost divided by PV ratio. We know that, right? So in this case, my break-even point is going to be how much? 90,000 rupees divided by my PV ratio of 30%. So 90,000 divided by 0.3, that gives me how much? 3 lakh rupees. Done, guys. Yes, it gives me a break-even point of 3 lakh rupees, right? Now they are saying this 3 lakh rupees is equal to 60% of my capacity, which means how much is the company's 100% capacity? So the capacity sales is going to be, if 3 lakh is going to be 60%, how much is going to be 100%, right? So divided by 60 into 100. So I can say that company has an overall capacity to sell, generate revenue worth 5 lakh rupees. Are you getting this, guys? Are you getting this? This capacity sales is not actual sales. They are saying that I have a capacity overall to sell worth 5 lakh rupees. Are you clear with this? Now the second part of the question, compute the profit when the company is operating at 75% capacity. Now the actual sales is going to be how much? 75% of 5 lakhs. How much is that? 3,75,000, correct? When I am operating at 3,75,000, how much is going to be my profit, right? Very simple. I know that my break-even point is how much? 3 lakh rupees. And now my actual sale is how much? 3,75,000. So what is my margin of safety? Margin of safety is going to be 75,000 rupees. Correct, guys? Yes. So margin of safety into PV ratio of 30%. Into PV ratio of 30%. So 75,000 into PV ratio of 30% gives me how much? 22,500. So I would say now 22,500 rupees is going to be my profit when I am operating at a 75% capacity level, which generates a revenue of 3,75,000. Guys, are you clear with this, guys? Any issues here? Or if you want, you can also prepare a marginal costing income statement. But if you do that, you need to calculate the fixed cost. And for you to calculate the fixed cost is given in the question, right? That way also it can be done. So in that case, what will happen? The sales is going to be 3,75,000, right? Into PV ratio. So 3,75,000 into 0.3, that is going to be 1,03,500. That is going to be what? That is going to be your, yes, that is going to be your contribution, right? So 3,75,000 into, one second, into 0.3. Okay, it's 3,12,500 minus 90,000 of fixed cost. You will get the same 22,500 rupees. Guys, are you all able to understand this? Guys, are you all able to understand this? Yes, right? There are multiple routes to the same destination. This is why I said, if you know the vertical and horizontal statements of marginal costing, you can play around with it like a puzzle. Right, guys? Done? Done? Shall we proceed forward? Yes, guys? Yes. Prashant, Ramya, Sheba. Yes, the others also. Priya, Bharat, and the ones online and the ones on YouTube live. Everyone, guys, you there? Shall we proceed forward? Okay, great. Fine. Now let's move on to the next one. So the fourth question, PV ratio of X Limited is 50% and the margin of safety is 40%. Now be very clear. PV ratio is calculated as contribution upon sales into 100. That is vertically. Margin of safety is done horizontally. That is, if out of the total sales made, 40% is margin of safety, right? So don't confuse the two. Place it properly. Calculate the net profit when the sales is going to be 1 lakh rupees. How will you do that? How will you do that? They have said my total sales is 1 lakh. My margin of safety is how much? 40%, which means my margin of safety in value is how much? 4 lakh into 40% 40,000 rupees is my margin of safety. This is nothing but my profit generating sales. So 40,000 into 50 percentage PV ratio is going to give me my profit, because margin of safety into PV ratio is going to be my profit, 20,000 rupees. Guys, are you clear with this, guys? Right?
Yes, sir.
Right? This could all be MCQs. Who knows? Who knows? This could even be MCQs. Ideally speaking, this can be an MCQ question. Clear with this, guys? Let's move on to the next one. Ascertain the profit when the sales is going to be 2 lakh rupees, the fixed cost is 40,000 and the break-even point is 1 lakh 60. So they are asking us to calculate the profit when the sale is 2 lakh, right? The fixed cost is 40,000, break-even point is 160. How will you do that? How will you do that? Can you tell me in this question how much is the PV ratio? Please don't look at the solution. How much is the PV ratio?
25%.
25%. How did you calculate the PV ratio? Now in this question, you need to have some presence of mind. Fixed cost and the break-even point are given, right? Now make use of the marginal costing jodis, right? So your fixed cost divided by PV ratio is equal to break-even point, correct? Or in other words, PV ratio is equal to fixed cost divided by break-even point, correct? No, right? Fixed cost is how much? 40,000. Break-even point is how much? 160,000. So 40,000 divided by 160,000. In this case, my PV ratio is going to be 25%. Correct, guys? Now with this, you can calculate your profit. Sales is 2 lakh. So 2 lakh into 25% gives you how much? A contribution of 50,000. 50,000 minus, yes, the fixed cost of 40,000 rupees. So now you get how much? 10,000 rupees of profit. Guys, are you clear with this, guys? Are you clear with this? Look, this is exactly what I've given here as well. All the solutions are provided. It is not the solution for which you are attending the lecture. It is for the process, the thought process, the way in which the journey is all that is important. Clear with this, guys? This is how you need to look at the questions, and this is how you need to, crack it. Clear with this, guys? Done? Any issues? Shall we proceed forward? Right.
Yes, sir.
The next one. Let's move on to the final one. Ascertain the sales when the fixed cost is 20,000, profit is 10,000 and the break-even sales is 40,000. Look at this. Calculate the sales when my fixed cost is 60,000, profit is 10,000 and the break-even sales is 40,000. Now, one second, I'm just erasing this off. Now, if it is mentioned like this, right? So immediately and all, you cannot, you might not know what to do. That's why I keep on telling you, put it up on a statement that will lead you to the solution. Now look at this. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now what have they said? When the fixed cost is going to be 20,000, right? The profit is going to be how much? 10,000. Okay. Now they have asked us to calculate how, and the break-even sales is 40,000. They have asked us to calculate, find the sales figure. Now tell me, guys, in this position, how much is my contribution? My contribution is going to be profit plus fixed cost, the balancing figure 30,000, right? Now they have given us the break-even sales, right? They have also given us the fixed cost, correct? So with this, I can calculate the PV ratio, fixed cost divided by break-even sales, that is 20,000 divided by 40,000. 50% is my PV ratio, correct? So, or in other words, contribution divided by PV ratio can give me sales. So if I may generate sales worth 100, 50 rupees is going to be my contribution, right? So if 50 is equal to 30,000, how much is going to be my sales? Or in other words, sales into PVR is equal to contribution, correct? Or in other words, sales is equal to contribution divided by PVR. In this case, it's going to be 30,000 divided by 50%. How much you get? That's going to be 60,000 rupees. Are you clear with this, guys? Are you clear with this, guys? Any issues here? And that's about this question as well. Now this is why I keep on hammering on conceptual learning, right? Now, if you were to mug up all these charts, right, you might not even know in which sum you need to use which formula. Did we even go as per the formula? We first saw what was the question, we put it on a statement, it led us to the solution. While presenting, we did the formula, right? This is the right way of learning marginal costing. So marginal costing can either be too easy if you learn it by concept, or it will be extremely difficult if you mug up by formula. There is no middle ground here. It can either be on extremes. You can either fall in one of the category, and the choice is yours. Guys, are you all able to understand this, right? At the time when you're learning the concept, you might have felt, sir, why are you doing all these things for half an hour, 45 minutes in a revision batch? But you just see how quickly we did so many number of numerical problems. Right? Do this for all the subjects. That's what I would suggest, because it is a very smart way of cracking all the papers. Learn things conceptually. it is going to be easy for you in your exam. Your life is going to be simple, first of all. Right, guys? Done? Okay, just a minute. Is there anything else left out? Let me just see. In the basic concepts, is there anything else left out? Okay, break even point is okay. Okay, let us also do this. Okay, there's something called as a break-even chart. That is, they might ask you, rarely test it, but if you were to plot all these things on a chart, how would it look like, right? So this is an example given. Selling price is 25, the variable cost is 10, the fixed cost is going to be 15,000 rupees, right? And they have given that the present sales is 1500 units. Draw the break-even chart and the profit volume chart. Guys, am I being audible? Is it fine? Yes, it's going on fine. Okay, right. Yes. Great. Now again, so here sales minus variable cost gives you contribution minus fixed cost gives you profit. So now here we know that the selling price is 25, variable cost is 10. That gives me a contribution of 15 rupees, and the fixed cost is going to be 15,000 rupees. So now first with this we can calculate the break-even point. What is the break-even point here? Fixed cost divided by contribution per unit. 15,000 upon 15, it's going to be how much? 1,000 units. Correct, guys? It's going to be 1,000 units, right? So now if you were to plot this on a graph, you can see that exactly at 1,000 units, what happens? Okay, so I'll tell you what to do here. So here what happens? Now there will be two lines that you need to draw. One is with respect to the total revenue. The other one is with respect to the total cost. Total revenue will start from the origin. Why? If I'm operating at a volume of 0, my sales will be 0. Correct? Slowly as the number of units increases, what happens? Your revenue will also proportionately increase. Are you clear with this? This is a total cost line. If I am selling 0 units, still I will be incurring fixed cost. So it starts at the fixed cost, and proportionately it will increase from there because of the variable element. Are you clear with this? There will be a point where my total revenue is equal to total cost. That point is called as my break-even point. That is going to be 1,000 units. Less than this point, if I am operating at less than 1,000 units, what will happen is my total cost will be more than my total revenue, and hence it will be a loss situation. Clear with this, right? Now the tables will change automatically. If you are operating above the break-even point, your total revenue will be more than the total cost. That will be a profit situation. Are you clear with this, guys? Right? Now the angle that gets formed here, there is an angle, no? Right? When two lines are intersecting, there is one angle that forms there, no? This angle is called as angle of incidence. Are you clear with this? It is called as angle of incidence. Suppose instead of this, suppose it was like, let's say there are two lines here, right? And these two lines were like this. That is, if the angle of incidence is wide, it means that the gap between my revenue and cost is more, which means that it is reporting a more profit. Are you clear with this? Or in other words, wider the angle of incidence, more will be your profit. Are you clear with this? Because at the end of the day, angle of incidence represents the gap between your total revenue and total cost. If the gap between the revenue and cost is more, it means you have a more margin of profit. Are you clear with this? These all could be tested as conceptual MCQs anywhere. So please catch up running notes. Mark this somewhere. Clear? In your institute study material, it runs into pages, right? I am not saying, there's nothing wrong about it, because if I'm explaining it in a lecture, yes, I can give you an examples and right away do it. If it has to be printed, it needs to run into pages. No other option, right? So this is what I said. This is the reason why I'm saying. In fact, institute has honestly done a very good job with respect to coming up with a good material, because the quality has drastically improved as compared to how it was before. So we need to give the credit where it's due. Yes, there are certain things like sequencing which could have been better, certain quality of examples could have been better, but still the quality of the study material as compared to what it was before has drastically improved. So that needs to be said. Anyways, guys, are you clear with this? This is about the angle of incidence. It is the angle that gets formed between which two lines? Total sales and total cost. Are you clear with this? Right, guys? Fine. That's about it. Now, if you were to plot the profits, the profit line will look like follows. Clear with this? That is, at 0 units, what will be your profit? Your profit will be equal to, you will be having a loss that will be equal to your fixed cost. Correct? I haven't sold anything. My contribution is 0 minus fixed cost gives you a profit of that is equal to a negative profit equal to the fixed cost. Correct? So it starts off here, right? And at any point you calculate one profit, you touch the two lines here, so automatically you will be getting it. And exactly at the break-even point, you can see that it cuts the origin. That is no profit, no loss. Are you clear with this, guys? You just go through it once. If at all there is, they ask something like this, maybe you can handle it. Are you clear with this, guys? And that's about this particular break-even chart. Now, one more thing I think is the cash break-even point. I saw it somewhere. Can anyone help me out? Yes, here we go. Okay. Now, guys, one more thing. What do you mean by a break-even point? Break-even point is a point where my contribution is sufficient enough to recover my fixed cost. That's why we said it is fixed cost divided by contribution per unit. If you want it in value, it's going to be fixed cost by PV ratio. Correct, guys? Now, what do you mean by a cash break-even point? It refers to the point of sale where my contribution just recovers my cash fixed cost. So the formula is going to be cash fixed cost divided by contribution per unit. Sir, can you give us an example? Yes. Now you have fixed cost here, right? Let us say this fixed cost is going to be 1 lakh rupees. Out of this 1 lakh rupees, the cash fixed cost is 80,000. When I say cash fixed cost, it means the amount that I actually pay and incur. Example is going to be factory rent, supervisor salary, any kind of other fixed cost that involves payment of cash, right? And even depreciation, amortization are also fixed costs. Correct? Depreciation is also a fixed cost, right? Let us say depreciation is 20,000 rupees. You tell me, will I pay depreciation to a third party out of my pocket? Will I pay depreciation out of my pocket? I will not pay depreciation out of my pocket. But why I do it is because of matching concept. I use an asset for production. So I have already capitalized it to the extent I am using it. So over a period of time, I am writing it off. So though it is ideally a cost for me from a perspective of, an accrual concept, but what we are doing here is we just want to know. I'm just starting off on a business. Generally, when a person starts off on a business, they will not be too greedy to recover the entire fixed cost. They will say, tell me what is the cash fixed cost. I want to know the point where at least my contribution will recover my cash fixed cost. I don't want to recover my full fixed cost. It's enough if I recover my cash fixed cost. In that case, the cash break-even point will be what? Cash fixed cost divided by what? Contribution per unit. It tells you how many units you should sell so that your contribution exactly recovers the cash fixed cost. Are you clear with this, guys? Now, at a cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? At cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? Tell me, guys. No, there will not be no profit, no loss. No profit, no loss will be there only in break-even point. At the cash break-even point, you have still not recovered 20,000 rupees, no? At the cash break-even point, your loss will be equal to the depreciation amount. Are you clear with this? Are you clear with this, guys? At the cash break-even point, you would not have recovered your non-cash fixed costs. Clear with this? So you still will be reporting a loss. That's fine. But I just want to know the point where I will just be able to recover my cash fixed cost. Clear with this, guys? These could be conceptual level MCQs. So please watch out for these things. Maybe catch up running notes somewhere. Clear with this? Yes, done. And that's about the concept of break-even point and cash break-even point. So now, what are the concepts that we have done here? This is, okay, contribution PV ratio, break-even point, cash break-even point, margin of safety, CVP pairs is also done. This chart is also done. Okay. Okay, now, let us move on to another concept, an interesting concept called as, yes, volume analysis. I think I missed mentioning the name, but the illustration is here. Volume analysis. By the way, guys, honestly tell me, the ones who maybe are attending or may have not attended my regular batch, because in regular batch I list out the learning objectives at the start of every chapter. So how many of you are are seeing that there are so many concepts in marginal costing for the first time. You're seeing that, okay, there are so many concepts in marginal costing, is it? Right? So you guys knew this before, like there are so many concepts in marginal costing, because many students, as I have seen, they know a lot of concepts, but they don't know it by name. Right? So they don't know, oh, this is called as volume analysis, or this is called as sensitivity analysis. Sir, if you give us some, we will be able to answer, but we didn't know that these are the names for this. Okay, so it is better to know it by concept name, so that it will be easy for you to revise towards the end. That is the reason why I'm giving the name. Okay, now look at this volume analysis, what it talks of. It's a very, very favorite area personally for me, because I still remember in my, when I wrote my CA intermediate, right? I didn't learn by all these names and all this. I have classified it only, you know, while I started my teaching thing. So I didn't know this. Actually, this came as the first question of my CA intercosting paper. First question, I was blinking what to do, but again, conceptual learning only helped me. So I just prepared some statement, tried figuring it out, but at the end of the day, fine, I was able to crack it. But again, I'm telling you, this is ideally a concept. After writing the exam only, I got to know that this has a name called volume analysis. Let me tell you what that is. Now, just a minute. I've just coined up an example. 1 second. Okay. Now, I hope you guys are catching up running notes. Are you guys doing it? Yes, good. Now, volume analysis. Guys, in exam, please don't expect the institute to mention the name of the concept and all. It never works that way. You should be able to figure out what concept they are testing in a chapter. Now, let us say, I'm again giving an example. Let us say selling price is 10, variable cost is going to be 6, fixed cost is going to be rupees 10,000. Okay, done. Now, I am preparing a marginal costing income statement for two volume levels, 5,000 units and 7,000 units. Just an example. Now, what's your marginal costing income statement? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, so what's going to be your sales at 50,000 units level? It's going to be 5,000 units level. It's going to be 50,000. Variable cost will be 5,000 into 6. That's going to be 30,000. Your contribution is going to be 20,000 rupees here. Your fixed cost is going to be 10,000 and your profit is going to be 10,000 again. Now, suppose I'm selling 7,000 units. So my sales is going to be 70,000. My variable cost is going to be 7 into 6, 42,000. Right? And my contribution is going to be 28,000. Fixed cost remains to be 10,000. And my profit is going to be how much? My profit is going to be 18,000. Now guys, if you make an observation here, now, can I say that in this case, what happens? Your profit increases by how much? Your profit increases by how much? 8,000 rupees. Your profit increases by how much? 8,000 rupees. Can I say this increase in profit is purely on account of the increase in contribution? The contribution has also increased by 8,000. Why else will my profit increase? There is no change in the fixed cost in between. So if at all my profit is changing, the change in profit is always equal to the change in contribution. Agreeing with me on this? And why is my contribution changing? Because now what am I doing? Instead of selling 5,000 units, I am now selling how many units? 7,000 units. So there has been an increase in the volume by 2,000 units. Agreeing with me on this? Or in other words, can I say that 8,000 rupees, right, is nothing but the contribution generated by this extra 2,000 units? Agreeing with me, guys? Right? Or in other words, can I say the contribution per unit is equal to delta profit divided by delta units. Delta means what? Change. In this case, it is nothing but 8,000 rupees The change in profit is nothing but the change in contribution, and that contribution is pertaining to the change in units, correct? So 8,000 rupees is the contribution pertaining to how many units? 2,000 units. So how much is the contribution per unit? 4 rupees per unit. This way also I can find out. Guys, correct? This is what we found out there itself. 10 minus 6 is 4. Suppose the per unit data and all is not given. Correct? Assume in the question they have just given you sales 5,000 units, 7,000 units. If 5,000 units is sold, the profit is 10,000. If 7,000 units is sold, the profit is 18,000. This is all they have given. Can you find out the PV ratio? Yes. Yes. Just the top figure and the bottom figure they are giving you. Sorry. Can you find out the contribution per unit? Yes. How will you do it? Difference in profit is nothing but the contribution pertaining to the change in units. So my contribution per unit, one more formula is now available. That is nothing but delta profit divided by delta units. Are you clear with this, guys? Right? Suppose you want to calculate the PV ratio. How will you do it? Very simple. PV ratio is equal to delta profit divided by delta sales. Or in other words, can I say this 8,000 rupees is the contribution that got generated from the extra sales of 20,000 rupees. Correct? So can I say that 8,000 upon 20,000 into 100, that's going to be how much? 40%. Are you clear with this, guys? Are you clear with this, guys? Right? This is called as volume analysis. So in your volume analysis, suppose in a sum, if they just give you year 1, year 2, 2 top figures and 2 bottom figures, can you end up calculating the PV ratio or the contribution per unit? Yes. Are you clear with this? Right? Here I will say the PV ratio is the delta profit divided by delta sales. I was earning a negative profit, that is a loss of 15 lakh. It has now become how much? 75 lakh, which means I have earned an extra profit of how much? Extra profit of 90 lakhs. This 90 lakhs is nothing but the contribution generated due to the incremental sale of 150 lakh. So 90 lakhs upon 150 lakhs into 100. In this case, the PV ratio is going to be 60%. Are you clear with this, guys? If they just give you the top and the bottom figures, still you can find out the PV ratios or the contribution per unit. Clear with this, guys? See now how many formulas are there for PV ratio? PV ratio is equal to contribution by sales into 100, correct? Or fixed cost divided by break-even point into 100, or profit divided by margin of safety into 100. Or now we also have one more formula, delta profit divided by delta sales into 100. Clear with this, guys? You need not mug this up. The situation, based on the situation, you yourself can arrive at the formula and write it by yourself. Clear with this, guys? Done? Are you all able to understand this? Yes, you guys are able to follow this? Fine. Shall we move on to the next one? Okay, so what have they asked? Yes, now once you find out the PV ratio, now you can prepare the entire marginal costing income statement. Right? So you know that the sale, take year 1 or year 2, whichever you want. So the sale is 100 lakhs. What will be the contribution? 60% on 100, 60 lakhs. They have given us the profit was how much? The profit was 15 lakhs. So the balancing figure has to be your fixed cost. Are you clear with this? Are you clear with this, guys? Yes, this way you can find out and prepare the rest of the income statement. Now for any output level, you can prepare your income statement. Clear with this, guys? And that is about the concept called as volume analysis. Done with this? Are you all done with this? You guys are clear with this, right? Shall we move on to the next one? Yes, guys? Yes, done. Shall we move on to the next one? Yes, okay. Now, let's move on to the next one, which is called as sales mix, merger of plants, sensitivity analysis, indifference point. Okay, let me take up sensitivity analysis. Okay, sensitivity analysis. Now, what do you mean by sensitivity analysis? First, guys, what do you mean by sensitive? Have you might have seen this advertisement on Colgate sensitive. What do you mean by sensitive? So, while other things remaining constant, an introduction of a change in one variable impacting the others is called as sensitivity. That is, you would have seen advertisements where they will eat one ice cream and they will say like it really becomes very difficult for them to that the way your teeth responds to it, right? That is called as sensitivity. Similarly, even in marginal costing, we are going to see how a change in a variable is going to impact the other components, right? Now, if you see in this chapter as of now, what we have learned, what is marginal costing all about? We are just playing around with four numbers. We are just playing around with four numbers. What are those four numbers? You have selling price per unit, you have variable cost per unit, you have fixed cost in total, and you will be having volume, right? Yes, guys, right? Actually seeing till now, your marginal costing is nothing but we have four input figures. We have four input figures: selling price per unit, variable cost per unit, fixed cost in total, and volume, right? Now, how these four inputs will impact my profit is the study of marginal costing. Correct, guys? To put it in short, right? How these four inputs, change in these four inputs is impacting my profit is what we have been seeing in marginal costing. You take any of the sum, these are all the figures that we have been seeing. So, but what we are doing is, we are seeing how these four figures will impact my profit. So, to understand the study, we are having some tools called as PV ratio, right? You have this break even point and you have this margin of safety. So, to put it short, your marginal costing is nothing but the study of how these four variables impact the profit through the tools called as PV ratio, break even point, and margin of safety. This is all the study of marginal costing. Clear with this, guys? Clear with this? Now, what is sensitivity analysis saying? Now, suppose I am slightly increasing my selling price while keeping the other factors unchanged. How is it going to impact my profit? Or suppose I am slightly decreasing my variable cost while keeping the other three input factors unchanged. How is it going to impact my profit? Right? Or in other words, the sensitivity analysis talks about how a change in one variable while keeping the other constant is going to impact my profit through the PV ratio, break-even point, and margin of safety is called as the study of sensitivity analysis. Clear with this, guys? Clear with this, guys? Right? That is about the concept of sensitivity analysis. Now, how and all we will just be seeing right now. Now, I always get reminded of this sensitivity analysis. The moment I say sensitivity analysis, I get reminded of one student who so in just like how I told you guys that this Colgate sensitive advertisement and all. So by mistake, I thought of that Colgate active salt, that advertisement is there, no? So I told one madam will immediately break open the wall. She will come and she will ask, do you have your toothpaste and all? By mistake, I said that madam was Kajal Agarwal. That guy said, no sir, now it's Samantha. How can you say Kajal Agarwal? No? I said, they evlo highlights ra irukidala idella vittittu idha paakranga nanu. But see, our students are always on the top of all the current affairs. Okay, right. Coming back here, guys. So sensitivity analysis. Now, sensitivity analysis. Now, I told you that it is a study of how a change in one variable is going to impact your profit through these three tools called as PVR, break-even point, and margin of safety. Now, guys, you all participate and I want your interaction on this. Now, what we're going to do here is, first, let me just put it up here. The three tools, PVR, break-even point, and margin of safety. Right? Now, first, let me talk about the selling price. First, let me talk about the selling price. Let us say I am increasing my selling price while the other factors remaining constant. I am just increasing my selling price. Let us take an example. Let's say presently my selling price is 10. Variable cost is going to be 6. My contribution per unit is going to be 4. Right? And let's say the fixed cost is currently going to be 10,000. Correct? Just an example, guys. Right? Now, while other aspects remaining to be constant, and let us say the volume is how much you want the volume? Let's say it's 1 lakh. Okay, right. Now guys, now what happens? Let us say while the other factors remaining constant, I am slightly increasing my selling price. Now what will happen to the PV ratio? Now the selling price alone I am changing. Instead of 10, let us say it becomes 12. Okay, right? So now what? The variable cost continues to remain 6. My contribution becomes how much? 6 rupees now. Correct? Now what happens to my PV ratio? Earlier my PV ratio was 4 upon 10 into 100, 40%. an increase in your selling price while the other things remaining constant will obviously increase your contribution per unit, and hence your PV ratio will also increase. Correct, guys? Right? So obviously my PV ratio will increase. Correct? Right? Now what happens to my break-even point? Earlier every unit was generating 4 rupees, right? Now every unit is generating 6 rupees. So now you tell me, logically speaking, it will take lesser time for me to recover my entire fixed cost. Agreeing with me on this? So obviously my break-even point will go down. Correct? Now I am not changing anything else. The volume also continues to remain the same. Now what happens to your margin of safety? So volume is the same, right? But my break-even point has come down. So now the balancing figure will obviously increase. My margin of safety will increase. And when my margin of safety increases, my profit will increase. Are you clear with this? Because margin of safety after all is nothing but your profit generating sales. Clear with this, guys? Clear with this, guys? Now you are able to understand what is sensitivity analysis. A change in one variable impacting my profit through these three tools is called as sensitivity analysis. Similarly, if I'm reducing my selling price, what will happen? Instead of 10, let us say it is now 8. This continues to be 6. My contribution per unit becomes how much? 2 rupees. So 2 upon 8 into 100, that's going to be how much? 25%. Or in other words, my PV ratio will fall down. Correct? Now, since the contribution per unit has reduced, it takes more time for me to recover my fixed cost. My break-even point will increase. Volume is same. Now, break-even point is more, which means the balancing figure is going to be less. My margin of safety will increase, and when my will decrease, and when my margin of safety decreases, my profit will also decrease. Clear with this, guys? Clear with this, guys? Now, second one. Let's talk about variable costs. Suppose I'm increasing my variable cost. What will happen? So while everything else is constant, let us say I'm keeping everything else is constant. So now selling price is 10, but variable cost, instead of 6 rupees, I'm now making it as 8 rupees. What happens to my contribution? It becomes 2 rupees. Correct? So PV ratio will now obviously fall. Guys, correct? Right? When my PV ratio falls, now what happens? Now every unit recovers only 2 rupees of contribution. It takes more time for me to recover my fixed costs. Break-even point increases, and when my break-even point increases, the balancing figure, margin of safety, will obviously fall down, and hence there will be a fall in my profit. Guys, correct? Right? Similarly, what will happen if you decrease your variable cost? Now what happens here? Now let us say instead of 6 rupees, my variable cost is just 4 rupees. Now what happens? My contribution per unit will increase, right? This increases my PV ratio, right? Now I'm generating more contribution per unit. What happens here is, right now I will be able to recover my entire fixed cost more quickly. Correct? So my break-even point will fall down, and when my break-even point falls down, the balancing figure of margin of safety will be more. An increase in margin of safety will result in a higher profit. Guys, clear with this, guys? Right? Done. Next, third one. What is the third input factor we've got? Fixed cost. Now guys, logically think and tell me, if there is an increase in the fixed cost, how will it impact my PV ratio? What will happen to the PV ratio? If my fixed cost increases, what will happen to my PV ratio? Come on, think and answer. Guys, come on, use the chat box.
Overall profit decreases.
I'm not asking about overall profit. I'm asking about the impact it has on the PVR. Exactly. Very good. Very good. So now here, your PV ratio will not get impacted. PV ratio is dependent on contribution and sales only. If directly you increase your fixed cost, that will not impact my PV ratio. I'm not saying it will not impact your profit. I'm just saying it will not impact your PV ratio. Correct? Now, how will it impact your break-even point? Will it impact your break-even point? Yes, it will. Now you have more fixed cost to recover, right? The contribution per unit is the same. You have more fixed cost to recover. What will happen now? Your break-even point will be more. It will increase. And when your break-even point increases, the balancing figure volume will obviously decrease. Are you clear with this, guys? Right? Suppose I'm decreasing my fixed cost. Once again, no change in my PV ratio, but now I have only lesser fixed cost to recover, which means my break-even point will fall down. The balancing figure, margin of safety, will increase. Guys, clear with this? This will end up in a more profitable situation for me. Are you all able to understand this logically? Right? Now let's go on to the last one, the fourth one, volume. Now tell me, if I increase my volume, what will happen to my PV ratio? What will happen to my PV ratio? If I increase my volume, what will happen to my PV ratio? Again, no impact. You are only increasing your volume. How will it impact my PV ratio? On a per unit level, the selling price and my selling price and my contribution per unit variable costs are all one and the same. So it will not impact your what? It will not impact your PV ratio. What will be the impact on break-even point? What will be the impact on break-even point? Once again, no change. Very good. Why? Because break-even point is about fixed cost upon contribution per unit. Fixed cost is also not changing. My contribution components are also not changing. Now, break-even point is a point. Are you clear with this? That point is fixed. That's about it. Unless and until there is a change in your fixed cost or in your contribution per unit, this will not change. Correct. Now, as there is an increase in volume, now what will happen? Only your margin of safety will increase. Are you clear with this? That's the reason why more the volume, more the profit. Clear with this, guys? Right? Now, similarly, what happens if there is a drop in the volume? Right? Now, your PV ratio, I mean, there will be no impact on the PV ratio. Similarly, no impact on your break-even point. But now, what happens? Your margin of safety drops, and hence your profit will also drop. Are you clear with this, guys? Are you clear with this? This study is called as sensitivity analysis. This study is called as sensitivity analysis. And remember one thing, if you make an observation here, if my PV ratio gets affected, definitely my break-even point and margin of safety will get affected. Correct? If my break-even point gets affected, definitely my margin of safety gets affected, but it need not be the case where my PVR will get affected. That is, if my break-even point is getting affected, definitely my margin of safety will get affected because it's a balancing figure. But it is not necessary to affect my PV ratio. Similarly, if my margin of safety gets affected, it is not necessary that the PV ratio and the break-even point should get affected. Are you clear with this? Are you clear with this? This is the overall conclusion that you can draw from the concept of sensitivity analysis. Are you clear with this, guys? Are you clear with this? Yes, you guys are fine with this? Yes, shall we move on to the next one? Shall we move on to the next one? Right? Yes. Okay, great. 1 second. I have a question here. The change in profit is equal to change. Okay, right. That's a sensitivity analysis as same in financial management. Yes, it is the same. Sensitivity analysis, the concept will always be the same. It depends on which variable and which final effect that you're talking about. In marginal costing, you're talking about the impact these four variables will have on your profit. Yes, in your marginal, in your financial management, in fact, in final and all, we'll be having, even in capital budgeting, we'll be having sensitivity analysis. I think even in intermediate level, to some extent, we have. Yes, the concept of sensitivity analysis is the same, right? The components which you do the sensitivity analysis alone will be different. That's about it. Fine, guys, done. Let's move on to the next one. Right? Any other doubt? Just a minute. Let me just take it up. Okay, fine. Right. Now let's move on to the next one. Now, the next concept is about sales mix and marginal costing. Sales mix and marginal costing. Sales mix and marginal costing. Now guys, what is this? Now, carefully listen. In sensitivity analysis, there is a reason why I did sensitivity analysis first and then I'm moving on to this particular sales mix immediately. In sensitivity analysis, I told you that only 4 components will impact your profit. Correct? Right? That is your selling price, variable cost, fixed cost, and your volume. Correct? These are the 4 components that will impact your profit. Any change in these 4 components alone will actually impact my profit. This is what we saw till now, guys. Yes. Now we will now see there is a 5th component that can also impact your profit, right? Sir, which means till now poi sollitengla, have you lied to us? Not like that, right? It's a gradual learning, that's why. Okay, so there is also a 5th component that impacts your profit, that is called as sales mix. Clear with this? What do you mean by sales mix? Now, let me just take an example to tell you to explain the concept of sales mix and also help you understand how the sales mix is going to impact your profit. Let us take an example of a company called BMW. You guys know BMW? Yes, the automobile company, right? Now, BMW is actually into the business of manufacturing cars, and they also manufacture bikes. Right? So everyone knows that they manufacture cars. Maybe some of you might not know that they manufacture bikes, but yes, they also do. Clear with this. In reality, they also do manufacture bikes. Super bikes they manufacture. It will not be like normal, the price range itself will be high. Fine. Now, what happened was, now BMW, what they are saying, year 1, year 2, right? 2-year data they published. 2-year data they published. In both the years, they didn't change the selling price, they didn't change the variable cost, they didn't change the fixed cost, and in both the years, the total volume was 1 lakh units. They have sold 1 lakh units, right? So as the volume changed, volume also did not change. However, in year 1, the profit was different. In year 2, the profit was different. Why? I'm again telling you, they did not change any of these 4 components. Still, in year 1, the profit reported was different. In year 2, the profit reported was different. Now, what happened was, in year 1, I told you, no? In year 1, I told you that they sold 1 lakh units, right? The breakup was, they sold 60,000 cars, right? And they sold 40,000 bikes. Clear with this, guys? Whereas in year 2, what they did, they sold the same 1 lakh units only, but the internal sales mix or the composition alone changed. They sold 40,000 cars, right? And 60,000 bikes. Are you clear with this? Now you tell me, everything was the same, but the internal composition alone changed. Maybe cars might be having a higher contribution per unit, right? And bikes may be having a lower contribution per unit. In year 1, though the total number of units were the same, but if you see in the internal composition, in year 1, they have sold more of a high profitable product. Whereas in year 2, they have sold only lesser of a high profitable product. Maybe that is the reason why in year 1, the profit reported might have been high, and in year 2, the profit reported might have been less. Are you clear with this? Or in other words, you're not just these 4 factors, one more factor called as sales mix. Sales mix is nothing but the composition of the different products being sold also impacts your profitability, and the study of this is called as sales mix and marginal costing. Clear with this, guys? Right? Now, sir, how is this going to impact our profitability? Now, it is not just that, it is also how do I calculate the break-even point when the company is selling more than one product? These are all a few extra learnings that we are going to do here. Now, guys, remember one thing. This sales mix will be applicable only for companies that deals in more than one product. If the company deals in only a single product, whatever we've seen till now, that alone will stand, right? Over and above all the concepts we have learned, if a company is dealing in more than one product, 2, 3, 4, 100, whatever number of products, in that case, your sales mix concept will come into play. Are you clear with this, right? To understand the concept of sales mix better, now let us do a numerical illustration. Let us do a numerical example question. So please take the second question for classroom discussion. Please take the second question for classroom discussion. Here it is. Yes, guys, please take the second question. Shall we get started? Right. Now, the following set of information is presented to you by your client AB Limited, producing 2 products X and Y. So X and Y, they have given that the direct material is 20, direct labor is 6 rupees per unit for X, for Y it's 18 and 4. The fixed expenses during the period is expected to be 1600 rupees. The variable expenses are allocated to the products at the rate of 100% of direct wages. The selling price per unit of X is 40, Y is 30. The proposed sales mix, they are saying, alternate 1. They are planning to sell 100 units of X, 200 units of Y. Alternate 2, 150 each of X and Y. And alternative 3, 200 units of X and 100 units of Y. As a cost accountant, you are required to present the management the following. Number 1, the total contribution and profit from each of the above sales mixes. Then, number 2, the proposed sales mix to earn a profit of 300 rupees and 600 rupees when the total sale of X and Y being 300 units. Calculate the break-even point when the sales mix is 2:1. Recalculate the break-even point when the sales mix is 1:2. Now, this is about the question. Now, first, what we need to do is let us calculate the contribution per unit of each of the two products. Now, if you look at this product X, product Y, they have given the selling price 40 and 30, correct? So this contribution is 40 and 30. From that, reduce all the variable costs. So you have the variable cost here, your direct material, direct wages. Apart from that, there is one direct expense also, which is equal to 100% of direct wages. So here if you see 26, and you also have your direct expenses, which is being given, right, minus 6. So here it's going to be every unit of X generates a contribution of 8. Similarly, every unit of Y generates a contribution of 4 rupees. Clear with this? This is the first step that we have done. That is calculation of what? The contribution that each of the products are generating. Now, what have they asked here? First, what we need to do? We need to calculate, okay, what should be the proposed sales mix to earn? Okay, fine. There are three alternatives given in the question. We need to calculate the profits for each of these three alternatives, right? Now, let us do that. Calculation of profit under different sales mix. Now, suppose scenario 1, 100 units of X is being sold and 200 units of Y is being sold. Now, you tell me guys, what will be the total contribution? 100 into 8, that will be the contribution generated by X. Similarly, 200 into 4, this will be the contribution generated by Y, correct? So, the total contribution generated is going to be 1600 rupees. Now, from this, they have given that overall, the company incurs a fixed cost of 1600 rupees. This 1600 rupees is a fixed cost that is pertaining to both the products put together. Clear with this? It's a common fixed cost. So, from that, you reduce your fixed cost. So, now the profit is going to be 0. The profit will be 0 when I'm selling 100 units of X and 200 units of Y. Suppose in the second situation where I'm selling 150 units of X and your 150 units of Y. In this case, what will be the total contribution, right? So, once again, we've got it here. So, it's going to be 150 into 8 plus 150 into 4, right? That is going to be the total contribution, 1200 plus 600, which is 1800. From there, you reduce your fixed cost, you will end up with a profit of 200 rupees, right? Suppose I'm selling 200 units of X and 100 units of Y. Then multiply the same with the respective contributions per unit, 200 into 8 and 100 into 4, right? You get a total contribution of 2000 rupees. From that, subtract 1600, you will end up with a profit of 400 rupees. Clear with this, guys? If you notice here, in all the three situations, 100 plus 200, I have sold 300 units. 150 plus 150, here also 300 units. 200 plus 100, here also 300 units, right? Overall, the volume has not changed, but a change in the mix results in different profits here. So, if you see in the first scenario, the profit reported was 100 rupees. The second scenario, it was 200. The third scenario was 400. This way, we can clearly see that a change in the sales mix can also impact your profit. Are you clear with this, guys? Are you clear with this, right? Next, what have they asked as the second one? Now, what should be the proposed sales mix to earn a profit of 300 rupees, right? And the second scenario, they've asked to earn a profit of 600 rupees, but they've given one condition. The total sales of X and Y put together should only be 300 units. So, first, let us calculate how many units of X and Y I need to sell in order to earn a profit of 300 rupees. Now, very simple and logical calculation. Let the number of units of X be X. So, which means the number of units of Y is going to be 300 minus X, because they have given us a condition that number of units of X plus number of units of Y has to be 300. So, if you keep this as X, Y has to be 300 minus X, correct? So, now the total contribution will be how much? 8x, that is every unit of X generates a contribution of 8 rupees and every unit of Y generates a contribution of 4. So, 4 into 300 minus X, we are replacing Y as 300 minus X, right? So, this is going to be the total required contribution minus my fixed cost of 1600 should be equal to 300 rupees. With this, we can frame an equation. So, we can arrive at the fact that it is going to be 4x is equal to 700 rupees. So, now how much is my X value is equal to, I think they have done a mistake here. Just a minute, guys. It's going to be 700 divided by 4, right? So, it's going to be 175, right? This is not 1754. Right, it is going to be 175. Are you clear with this? So, now with this, we have calculated that I need to sell 175 units of X. Obviously, Y is going to be 300 minus 175, 125 units. So, when the company sells 175 units of X and 125 units of Y, they will end up making a profit of 300 rupees. Are you clear with this, guys? Are you clear with this? Right? So easily we can find out how many units of X and Y respectively need to be sold in order to earn the required amount of profit. Done? Right? Now moving on to the next one which they have asked for. Suppose the company wants to earn a profit of 600 rupees. How many units of X and Y needs to be sold? Once again, you frame the same equation. 8x plus 4 into 300 minus x minus of the fixed cost of 1600 should give you a profit of 600 rupees. Frame the equation. Now you will get the x value as 250 units. The y value is going to be 300 minus 250. It's going to be 50 units. So when the company sells 250 units of x and 50 units of y, they will end up making a profit of 600 rupees. Are you clear with this? Right? That's about this particular segment. Now coming to the most important part, calculation of the break-even point. This is where this entire the crux of the matter lies here with respect to the calculation of break-even point. When the sales mix is 2:1. Now you tell me what is the issue here. You tell me what is the issue here. Now let me write it up. I have two products, X and Y. Product X generates a contribution of how much? It generates a contribution of 8 rupees, and product Y generates a contribution of 4 rupees, right? And I have a common fixed cost of rupees 1600 to be recovered. Guys, correct now? Yes? Guys, yes, you there? Guys, there?
Yes, sir.
Right. Now, what happens is, generally, we know that your break-even point is nothing but fixed cost divided by contribution per unit. Correct? Now, fixed cost, I know it's 1600. Now, contribution per unit, which one should I take? Should I take 8 or should I take 4 or should I take both? Right? This is where the case becomes little interesting when it comes to your sales mix. Now, basically, you tell me, guys, logically, you tell me, this 1600 rupees of fixed cost is being incurred not only for selling units of X, it is also towards units of Y, correct? Right? And what do you mean by a break-even point? A break-even point is a point of sale where I generate a contribution that is sufficient enough to recover my fixed costs. Now, this 1600 rupees should be recovered not just by any one of the two products. These two products should jointly go on to generate a contribution that is sufficient enough to recover my 1600 rupees. Agreeing with me on this? Agreeing with me on this? So here the contribution per unit is neither X nor Y. It needs to be a weighted contribution per unit. Are you clear with this? What is the meaning of weighted contribution per unit? They have given in this question that the sales will always be in the ratio of 2:1. Correct, guys? It will always be in the ratio of 2:1. Or in other words, every time I sell 3 units, if you see, 2 units will be X, 1 unit will be Y. This is the meaning, no? Guys, correct? Right? Every unit of X generates a contribution of how much? 8 rupee. Every unit of Y generates a contribution of how much? 4 rupees. So if you multiply this here, 8 into 2 is 16, 4 into 1 is 4. Totally, I end up generating a contribution of 20 rupees for every 3 units being sold. So representatively, the contribution per unit is going to be how much? 20 upon 3, it is going to be 6.6666 or 6.67. Are you clear with this, guys? This is the reason why here, when it comes to sales mix, we don't say it's fixed cost by contribution per unit. We use an additional word and call it as fixed cost divided by weighted contribution per unit. Are you clear with this? And how will you calculate the weighted contribution per unit? It is nothing but the contribution of a particular product multiplied by its weights. This calculation, this is nothing but, can I say this is 8 into 2 by 3 plus 4 into 1 by 3. Correct, guys? This is what we did here. Basically, we did 8 into 2 plus 4 into 1, the whole divided by 3. That only we are writing it like this. Or not, this is nothing but the contribution per unit into weights of each of the products. Are you clear with this, guys? If you do this, you get the weighted contribution per unit, and now with this you can calculate the break-even point. How do we do it? Let me just walk you through here. Now in this case, you look at it here. If you see, the weighted contribution per unit is going to be how much? 6.667. correct? Right? So now my break-even point is going to be fixed cost divided by weighted contribution per unit. So now please do not round it off, retain the decimals in your calculator, that is 6.66666666, right? So if you say 1600 divided by 6.66666666, right, you will get exactly 240 units. So what does it mean? I need to sell 240 units, right, to exactly recover my fixed cost. I need to sell 240 units of X or Y or both. I need to sell 240 units of both. So this 240 units of both means in what ratio? The mix is given. So this should always be in the ratio of 2:1. Are you clear with this? So out of this 240, 2/3 will be X units and 1/3 will be Y units. With that, you can calculate how many units of X and how many units of Y needs to be sold. Are you clear with this? Or in other words, in this case, first you calculate the break-even point by taking fixed cost by weighted contribution per unit. You will get the total number of units required to be sold. Multiply this with the mix or the weight of the product. You will get the product-wise break-even point. Are you clear with this? If I sell exactly 160 units of X and 80 units of Y, I will be in a position to break even. Are you clear with this, guys? Are you able to understand? Are you able to understand? Right? So when you have a mix of products, what is the formula to calculate your break-even point? Your break-even point is going to be fixed cost divided by weighted contribution per unit. Clear with this? Suppose you want to calculate the break-even point in values, what will you do? It is going to be fixed cost divided by weighted PV ratio. Are you clear with this? Take the PV ratio of the respective products and multiply it with what? Multiply it with the weights. Are you clear with this? That's called as a weighted PV ratio. Are you all able to understand, guys? Suppose what will happen if the sales mix is changed to 1:2? Once again, calculate the weighted contribution per unit. 8 into 1/3 plus 4 into 2/3. So this is what you get as your weighted contribution per unit. Fixed cost divided by weighted contribution per unit. So now you arrive at 300 units. Are you clear with this? So only if you sell 300 units, you will be able to recover your entire fixed cost. 300 units of what? X or Y or both. 300 units of both, right? Break it up and arrive at each and every component. So which means if I sell 100 units of X and 200 units of Y, I will be able to generate a contribution that exactly recovers my common fixed cost. Are you clear with this, guys? Right? You are all able to understand this. You're all able to understand this. This is how you need to calculate break-even points when a company is dealing in more than one products. Are you clear with this, guys? Right? I think this has been mentioned on the top here as a concept. Let me just walk you through that. Just a second. Where is it? Where is it? Where is it? 1 second. I think it's gone. Just a minute, guys. Yes, look at this. The overall break-even sales is going to be what? If the quantity mix is known, I will say it is sales quantity into your weighted contribution per unit. Or in other words, how do you do it is your fixed cost divided by weighted contribution per unit. If the sales value mix is known, you will divide the same by. You will take the fixed cost divided by weighted PVR. Are you clear with this, guys? Are you clear with this? Right? So the contribution value has to be how much? Quantity, the sales, if it is in units, you multiply it with weighted contribution per unit. If it is in value, multiply it with weighted PVR. Are you clear with this, guys? Right? This is what we have seen in the previous question that we just finished right now. Fine, guys. Done. Right? With that, the second sum is also over. Okay. Done. So now, what are the concepts left out? Okay. Let me also do this merger of plants. Okay, what do you mean by merger of plants? What do you mean by merger of plants? Now, guys, simple. Let's say I have a plant A and I have a plant B. Now I want to combine these two plants. Let us say these two plants are adjacent, right? There is a wall in between. Now I'm just removing the wall and making this into one, right? I'm merging two plants together, right? When I merge two plants, right, how will you apply the concepts of marginal costing? Nothing great, nothing great. You will think that, so this is nothing, sir. Plant 1 plus plant 2 is going to be equal to the merged plant, right? Use the figures and calculate. Prepare an income statement for the combined sales, combined variable cost, combined contribution, combined fixed cost and all. With that, you can do it. Absolutely correct. But in these questions, only one thing needs to be watched out for. Suppose they would have given the volume data and they would have mentioned that the plant A is working at 60% capacity, right? Let us say plant B is working at 80% capacity. Now you should always be careful. What you need to do is convert both the plants into 100% capacity, right? And then you add it up. Clear with this? Because 60% capacity of plant A and 80% capacity of plant B can't be added as such, because presently they are working at the 60% and 80% capacity respectively. When you are merging, what is totally available is 100% capacity. So you convert everything into 100% and then apply the concepts of marginal costing for the merged plant at 100% capacity. Clear with this, guys? An example is given here. Look at this. Company A is presently operating at a capacity of 60%, and at 60% capacity level, they are generating sales of 300 crores or 300 lakhs or whatever it is, right? The VC ratio is 50%, which means the PV ratio is how much? 50%, right? And the fixed cost is 30 crores. Similarly, company B is operating at 90% capacity level with a sales of 540 crores, right? The VC ratio is 70%, which means the PV ratio is 30% and the fixed cost is 75. Now, when I am merging the two, I can't say, okay, company A plus company B, merged plant, sales is going to be 300 plus 540, so it is going to be 840. No, please do not do that. What you need to do, first convert both into 100%, because when two plants are merging, obviously what is getting merged is 100% capacity, right? Once you convert that, then you decide what needs to be your activity level of the merged firm. That is different. But when you are merging, you merge it at 100%. So now this is 300. Convert it into 100%. How will you do that? If 300 is 60, how much is 100, right? So the merged, the sales value at 100% capacity level of A is going to be 500. Similarly, for B, it's going to be 540 divided by 90 into 100. That's going to be 600. Add the two. Now, if I'm merging these two firms, the total capacity sale is going to be how much? 1100. Similarly, they have given that the VC ratio is 50%. So here, obviously, apply this 50% on the 100% capacity level. So 50% of 500 is 250. Here it's going to be 70%. 70% on 600 is going to be 420, right? Add the two, you will get how much? 670, right? Now you get the contribution of the merged firm. Are you clear with this? So now you can say that the merged firm's PV ratio is going to be 430 divided by 1100. It's going to be 39.09%. Are you clear with this, guys? Are you clear with this? Now, fixed cost, don't do the same thing for fixed cost also. Don't say, fixed cost is going to be 30 divided by 60%. No, fixed cost remains constant irrespective of your activity level. So, fixed costs are addable as such. Correct, no, guys? This 30 crores of fixed cost, what they have given here, whether this company operates at 60% capacity or it operates at 100% capacity, it will continue to be 30 only. That is the concept of fixed costs. If you say this is also 30 divided by 60 into 100, then you're treating fixed cost as variable cost. Are you clear with this? So fixed cost can be addable as such because they are not dependent on the capacity or the output level. So now what will I say? The fixed cost of the merged firm is 30 plus 75. How much is this? 105. Are you clear with this? So the break-even point of the merged firm is going to be your 105 crores, the total combined fixed cost divided by the PVR of the merged firm. So now I will say, look, I need to generate sales worth 268.61 lakh rupees in order to break even. Are you clear with this? This is post the merger. Are you clear with this, guys? Right? You guys are able to follow this, right? Next, one more thing. What is the sales required in the merged firm to earn a profit of 20 lakhs? Simple. So the required contribution will now be 20 lakhs plus 105 lakhs, right? So the required contribution divided by, take up the PV ratio of 39.9%, 39.09%, you will get the required sales to earn a profit of 20 lakh rupees. The remaining part are all similar to the basic concepts. The only thing that you need to know here is when you're merging two firms, convert both the firms into 100% capacity and then merge it. Clear with this, guys? Are you all clear with this, right? Yes, please respond, guys. Use the chat box. Are you guys there? The whole point of having a live session is only for that. Done, right? Fine. So sensitivity analysis is also done. Merger of plants is also done. Okay, so now we are left with a few more concepts. Just a minute. Let us just go and take the scoreboard. So this is done. This is also done. Okay, so I think we are just left with 3 more areas in this one, in this particular CVP analysis, and apart from that, we've also got something to do in absorption costing versus marginal costing, right? Done, not a problem. So now guys, can we take a small break now, and we'll just come back and finish off the remaining part of the chapter? Yes, you guys want a break now?
Yes, sir.
Right, okay, it's been about 2 hours plus, so yes, we'll take a break right now. Maybe we'll meet back at so at 10:45 works, right? About 15 minutes break. Okay, great. Now let's move on to the next concept called as indifference point. Right, so now we are left with 3 concepts plus 1, so overall 4 concepts. We'll be doing it right away. So the next one is the concept of indifference point. Just a minute. Right. Now, what is this concept of indifference point all about? I'm using a short form, IDP. Now guys, right now we all have this, you all must be using this Geo SIM, right? But before 2016, that was before when Geo, entered the market with a bank. Now we all had the other players, like there were so many players, like Aircel, Uninor, there were so many players. And there was always one, decision that we all had to take in our real day, everyday life. So that was regarding prepaid versus postpaid. Now we don't have this decision to be taken, because anyways, though we all go for a prepaid plan, it's all unlimited calls and all that. But back then, these guys were looting us literally. They used to charge hefty amount, and they say we are complimentarily giving you 750 MB per month, it seems. So now we use about 2 GB per day. So that's what they used to do quite a while back. That was before 2016 when Jio entered the market. Now guys, using this example of a prepaid versus postpaid SIM, we can understand the concept of indifference point, and let's see what it says. Now, in prepaid SIM, generally what happens is, now they will say per call you need to pay how much? 50 pice. An example I'm saying. They will say per call, or let's say per minute of talk time, you need to pay 50 pice, right? And since we are giving you that SIM card and we are blocking the number for you, that is, they are giving you the mobile number, so the SIM usage charges monthly is going to be 100 rupees. Or in other words, here the variable cost is going to be 50 pice and the fixed cost is going to be 100. Whereas if you go for a postpaid plan, what they will say is, look, it's a postpaid plan. That is, you can talk for how many number of hours you want. It's fine. At the end of the month, we will prepare a bill and we will give you, right? So what happens here is, per minute, they will charge us, let us say 30 pice, right? That's 0.3 rupees. Okay. And they will say monthly rentals for us is going to be 500 rupees. Generally what happens in a postpaid plan, if you see, they will have a monthly fixed charges, right, which is slightly higher, and they will be having a lower cost per every minute of talk time. This is how it used to be. And of course, in the prepaid, if you see, the fixed cost will be less, right? But every time you make a phone call, the charges will be high. Now, you tell me guys, out of prepaid or postpaid, which one is better? Out of prepaid or postpaid, which one is better? Now, there is no one such answer, a flat blanket answer saying always prepaid is better or always postpaid is better. Had that been the case, then there would have been only one plan. They wouldn't be having 2 plans, fully aware of the fact that always one plan is better than the other. Now, sir, how are you saying that, we can't come to a conclusion like that? Because both the alternatives have one disadvantage and one disadvantage. In case of a prepaid plan, the advantage is by way of a lower fixed cost. Whereas in case of a postpaid plan, the advantage is by way of a lower variable cost. Clear with this, guys? So now imagine you are a person who is a missed call party, right? So that is, you will not call anyone. Now suddenly after Jio, everyone started becoming generous. They didn't become generous. That is because of unlimited talk time now being available. But before, let us say you are a missed call party, you don't want to spend much, but you need to have a mobile number for sure. Which one will you prefer? You will only prefer prepaid. Why? Because anyways, you are not going to make much calls, right? You just need to have a number. You will go for that option that gives you a lower fixed cost. Correct, guys? Yes, the reason is that anyway your volume is less. Correct? The number of phone calls you will make is less. If at all once in a while I make a phone call, it is okay. I am ready to pay some 0.5 rupees instead of 30 paise. I am ready to pay 50 paise. That is fine. But I will not be ready to commit a higher fixed cost. 500 rupees and all, I will not be ready. I will obviously go for the option that has a lower fixed cost. Correct? Suppose you are a businessman, you need to make a lot of phone calls necessary. Now, predominantly since your volume is higher, your overall cost will be having more of a variable component. So you will be driven by that alternative that gives you a lower variable cost. So now in this case, it makes sense to go for a postpaid plan. Or in other words, to put it simple, when your volume is less, it is always better to go for that option that has a lower fixed cost. And when your volume is high, it is always preferable to go for that option that has a lower variable cost per unit. But there will be exactly one point where both the alternatives will give you the same result, and that point is called as an indifference point. You are not being different to the both alternatives. It's called as an indifference point. Are you clear with this? Right? Are you clear with this? So the point, again, the point here is what? The point of volume, the point of sale, where both the alternatives will give me the same cost, right, is called as my indifference point. Now, how do you calculate the indifference point? Very simple. I need to find out at what point of volume both the alternatives will give me the same cost. Let the volume be X. We need to calculate X only right now. So, alternative 1's total cost will be how much? 0.5x plus 100, correct? We should be equal to 0.3x plus 500. Yes, guys? Right? So now this is going to be 0.5x minus 0.3x. I am bringing this to the LHS and taking this forward to the RHS is equal to 500 minus 100. Correct? Right? Or in other words, I will take x common out here and say x the whole into 0.5 minus 0.3 is equal to 500 minus 100. Or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 divided by 0.2. How much is 400 divided by 0.2? That is going to be 2000. Are you clear with this? 2000 units, or in this case, I will say 2000 calls. If you are a person who knows that in a month you will definitely make 2000 phone calls, right? If you're exactly making 2000 phone calls, whether you go for a prepaid plan or you go for a postpaid plan, your final bill amount will be the same. But if you are planning to make a number of phone calls which is less than 2000 numbers, which is less than 2000 phone calls, in that case, it is preferable to go for prepaid because it has a lower fixed cost. No, sir, I'm a businessman. I'm going to make more than 2000 calls. Now, predominantly, your total cost will be driven by variable cost. So, you go for that option that gives you a lower variable cost per unit. Are you clear with this? Or in other words, how this indifference point concept helps us is, so there is an indifference point in this case, which is 2000 units. Right? In this case, it's a phone call. Suppose, let's say a company is manufacturing. They have two alternative ways of production. Right? Which alternative should I go for? Using both, let's say machine 1, machine 2, right? One machine has a higher fixed cost, lower variable cost. Another machine has a lower fixed cost, higher variable cost, as the case may be. Now, in this case, which machine should I use for production? First, you calculate the indifference point, right? If your planned volume is less than your indifference point, go for that option that has a lower fixed cost. And if your planned volume is more than your indifference point, go for that option that has a higher, again, talk in terms of advantage. So that has a lower variable cost per unit. Are you clear with this, guys? And at exactly the break-even point, whether I go for alternative 1 or I go for alternative 2, I will end up getting the same result. And this is the concept of indifference point. Clear with this, guys? So how do you calculate indifference point? If you look at this, it is nothing but is nothing but difference in fixed costs divided by difference in variable cost per unit. Are you clear with this, guys? Are you clear with this? So your indifference point formula calculation is going to be difference in fixed cost divided by difference in variable cost per unit. Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this? Now, let me just add up one more, let me just continue with this example. Let me just continue with this example. Let us say we are running a call center. Okay. Let us say we are running a call center. Now, in this call center, so what is the work of a call center? Basically, a bank will hire a call center. They will say in a month, you need to call and disturb so many number of customers. Correct? So that's why we keep getting a lot of phone calls for all these loans, credit cards and all that. Why are they doing? Are they doing it because they like you or they want to talk to you? Absolutely no. They have targets. Correct? So that is the reason why they do it. Now, let us say a bank has approached us. We are running a a call center. They are saying, look, for every call you make, I am going to pay you 1 rupee. For every call you make, I am going to make you 1 rupee. Now you tell me, guys, will the bank be bothered whether I use a prepaid SIM or a postpaid SIM? No. The bank is not going to get bothered whether I use a prepaid SIM or a postpaid SIM. Correct? Now, what happens if I use a prepaid SIM, if I use a postpaid SIM? Right? The scenario will be as follows. The selling price will be 1 rupee. That is from the perspective of the call center. It anyways will get 1 rupee. Correct? No? Whether I use a prepaid SIM or a postpaid SIM, per call I will get 1 rupee. Who will pay me? The bank will pay me. Correct? Right? Minus variable costs. If I use a prepaid SIM, my variable cost is going to be how much? 0.5 rupees. Whereas if I use a postpaid SIM, my variable cost is going to be how much? 0.3 rupees. Correct, guys? Yes. Now, what's going to be my contribution per unit? My contribution per unit or per phone call is going to be 0.5 if I use a prepaid SIM, and it's going to be 0.7 if I use a postpaid SIM. Correct? Now, what will be the fixed cost? The fixed cost will be, if I use a prepaid SIM, it's going to be 100. If I use a postpaid SIM, it's going to be 500. Clear with this, guys? Now, in this case, now, what is the indifference point? Indifference point is the point, right, where both the alternatives will give me the same amount of profit. Correct, guys? Indifference point is that point where both the alternatives will give me the same amount of profit, right? The results could be either calculated as a cost or the results can be calculated from the profit angle. Correct, guys? So now, at what point of sale, or in other words, how many phone calls should I exactly make so that whether I use a prepaid SIM or I use a postpaid SIM, both will give me the same profit. So now I need to calculate the X value, which is nothing but the indifference point. Can I say the profit generated by a prepaid SIM is going to be 0.5x minus 100 rupees. Correct? Yes, guys. Right? Minus 100 rupees. Similarly, this will be equal to the postpaid's profit is going to be 0.7x minus 500 rupees, right? The profit is going to be contribution minus fixed cost. Guys, correct? Or in other words, can I say this is nothing but 0.5? Okay. So let me just bring it up here. So this is going to be 500 minus rupees 100 is going to be equal to 0.7x minus 0.5x. Correct? Right? Or in other words, again, so here I will just take x out in common and say it's 0.7 minus 0.5 is equal to rupees 500 minus rupees 100, or here x is equal to rupees 500 minus rupees 100 divided by 0.7 minus 0.5. So this is going to be rupees 400 divided by 0.2. So how much is 400 divided by 0.2? Once again, that's going to be how much? Same, 2000. Are you clear with this? So exactly if I am planning to make 2000 phone calls, that is at the indifference point of 2000 phone calls, right? Whether I use a prepaid SIM or I use a postpaid SIM, both alternatives will give me the same amount of profit. Clear with this? Suppose I am planning to make a lesser phone call, a lesser number of phone calls, that is if my volume is lesser than the indifference point, then what you need to do, you go for that option that gives you a lower fixed cost. Clear with this? Suppose you are planning for a volume which is more than the indifference point. You go for that option that gives you a higher contribution per unit. Lower variable cost means what? Higher contribution per unit only, no? Are you clear with this, guys? Right? It gives me a higher contribution per unit. Are you clear with this? Or in other words, I can also say that my indifference point calculation is nothing but difference in fixed cost divided by difference in contribution per unit. Agreeing with me on this? Because the difference in contribution per unit is purely nothing but happening because of difference in variable cost per unit only. Are you clear with this? In both the scenarios, the selling price is the same. Still, why am I having a different contribution? It is because of the change in variable cost. So the difference in variable cost is equal to the difference in contribution. Are you clear with this, guys? So in this case, can I say that indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit, or I can also say it is difference in fixed cost divided by difference in contribution per unit. Are you clear with this, guys? Are you all able to understand? Right? Indifference point means what? It is a point of sale, clear, at which two alternatives are giving me the same result. Right? Clear with this, guys? Now, since it is a point of sale, this can also be expressed in value, correct? If I want to express in units, I do it like this. If I want to express in value, what will I do? Instead of variable cost per unit, I will use VC ratio. Instead of contribution per unit in the denominator, I will use PV ratio. That's about it. So it will be difference in fixed cost divided by difference in VC ratio, or it is difference in fixed cost divided by difference in PV ratio. Are you clear with this? Now, what am I going to do? Why do I need an indifference point? Only if you calculate an indifference point, right, you will know when to choose which alternative. If the volume level is going to be lesser than the indifference point, always go for that option that gives you a lower fixed cost. If the desired volume is going to be greater than the indifference point, always go for that option that gives you a lower variable cost, or you can, in other words, you can say a higher contribution per unit. Are you clear with this, guys? Right? In your everyday life, you can use the concepts of indifference point. Now, another real life example for indifference point would be, right, in your everyday life, you can maybe help your parents with this, whether to buy a water can or whether to buy an aqua guard and keep it. If you buy an aqua guard, the fixed cost will be high. You will not be having any variable cost, because anyways you take the water from the tap, correct? Whereas on the contrary, if you are buying a water can, right, the variable cost will be high. Every time you buy a can, you need to pay him 30-40 rupees, whatever it is, right? Whereas the fixed cost might not be much. So now, when will you go for which alternative? Depends on the water consumption in your house. If you are a joint family, it makes sense to buy an aqua guard. If you are a nuclear family, it really makes sense to buy a water can, because the consumption will be relatively less. These kind of practicalities you can apply in your everyday life as well, and that is about the concept of indifference point. Now clearly understand, guys, the concept of indifference point comes into picture only when I am evaluating two different alternatives. Do not mistake your indifference point as break-even point. Break-even point, I need not have two alternatives. Break-even point is given a fact, given a particular product's income earning capacity, like sales, contribution and all. For this, when will I recover my fixed cost? That's all. There is not much of comparison between another alternative. The concept of indifference point will kick in only when I need to evaluate between two alternatives and take the best one out of it. Are you clear with this, guys? Right? Yes, you guys are clear with this. Please use the chat box. Just tell me if you guys are understanding this. We'll proceed to the next one. And let's see, is that about the number of questions we've got here? Yes, I think that's about this particular concept as well. Okay. So now look at this. This is what we have mentioned here. You can just be, you can just go through it once. That's about the concept. It's nothing but your change in fixed cost divided by change in variable cost per unit, or in other words, it's change in fixed cost divided by change in contribution per unit. And if your expected volume is exactly at the indifference point, you can go for any option. Less than your indifference point, you should always go for the lower fixed cost option. If your volume is expected to be greater than the indifference point, go for the option that has a low variable costs, or in other words, I can say a high contribution per unit. Are you clear with this, guys? right? And that's about this particular concept of indifference point. See, this is what they are saying, right? At the indifference point, the two alternatives are better, right? Two alternatives will give you the same result. Below the indifference point, if you see, one alternative is better than the other. Beyond the indifference point, the second alternative is greater than the first one. Clear with this, guys? And that's about the concept of indifference point. And I think, yes, they have given one example as well. Let's quickly do this. Now, let's say I can carry out the production using either using machine 1 or machine 2, right? If I use machine 1, the fixed cost is 1 lakh, but the variable cost is 5 rupees. If I go for machine 2, the fixed cost is 60,000 only, but the variable cost is more, 9. Now, which machine is better? Now, I can't come to a conclusion on the face of it because machine 1 has an advantage of a lower variable cost, whereas a machine 2 has an advantage of a lower fixed cost. Both the alternatives are having one advantage and one disadvantage. Only then, the concept of indifference point will kick in. If let's say only one option has all the advantages, then I need not even take a decision. I will only go for that. Are you clear with this, guys? Right? So now in this case, what happens, right? Find the indifference point and recommend the range of activity where one machine is better than the other and suggest which one to buy if the production is 12,000 units. So now what do? The cost indifference point is going to be the difference in fixed cost divided by difference in variable cost per unit. So here the difference in fixed cost is 40,000, difference in variable cost per unit is 4. So 40,000 by 4, it's going to be 10,000 units. So now what will I do? If my desired volume is exactly 10,000 units, whether I use machine 1 or I use machine 2 for production, it's going to give me the same total amount of cost, correct? If my desired volume is less than 10,000 units level, then here I should go for that alternative that has a lower fixed cost. That is, I will go for machine 2, correct? And if my desired output level is greater than my 10,000 units level, the indifference point, now it makes sense only to go for that option that gives me a lower variable cost per unit. Are you clear with this, guys? This is the reason why if you see startups, what they do is they don't invest huge amount in fixed cost. If you look at small companies which are just starting up, at the beginning stages, they will not buy any office space. They will take it on rent because they don't want to commit a huge fixed amount. The moment they grow big, now they buy multiple properties and keep, because now their volume is increased. They will be heavily driven by variable cost. Now they can't afford a high variable cost. They are fine with a high fixed cost. That's when they will end up buying properties for themselves. Clear with this, guys? These are some real life scenarios where indifference point can also be used. Done, guys? And that's about this particular segment. Look at this. If the expected level is greater than 10,000 units, so you go for what? M1. And if it is less than 10,000 units, go for M2. And exactly at 10,000 units, you use any machine. And to answer the second part of the question, so if my expected volume is 12,000 units, it's beyond 10,000, so I will go for the first machine, right? Go for M1. Clear with this, guys? And that is about the concept called as indifference point. Clear with this? Shall we move on to the next one? Guys? Yes. Okay. Now, next one is a concept called as shutdown point. Now this concept again is an extension of indifference point, but it's slightly different, and let me tell you what it is. So this area is also known as shutdown or continue decision. Shutdown or continue decision. Now, what does this concept talk about? I mean, what are we going to learn in this particular concept? Now, let's say I am running a company and it's super successful. It is super successful, not at all a problem. Suddenly, COVID came. Suddenly, a temporary feature is hindering my business. Okay, a temporary feature is hindering my business. Now, the government has announced a lockdown, let us say for the next 3 months. Okay. Now, what happens? The decision that we are going to take here is there is going to be a temporary downfall in the market, right? A temporary downfall in the market. Now, during this 3 months, I know that before this period, my business is running fine. After this 3 months also, my business is going to run super fine. I don't have a problem with that. But I know that there is going to be a temporary hindrance in my business Now, during this time, I know that the market is going to be dull. The decision that we are going to take here is, should I shut down my business temporarily for the next 3 months, or should I continue? The question is not about a permanent shutdown. We are not taking a long-term decision. If there is a temporary recession in the market, right, does it make sense for me to continue, keep my shop open for those 3 months also, or is it better to keep it shut down? Clear with this, guys. This is the decision that we are going to take here. Now, let me just give you an example. Let us say, example, guys, I am running a physical academy. I am running a physical institute, a physical academy, CA coaching. Example, I'm saying. Now, what happens is, now, during this COVID time, institute cancelled one attempt. You know that, right? I think in 2020, yes, they cancelled one attempt. May attempt was cancelled, I think so. Now, let us say that, okay, I am running a physical academy. I'm being very clear because only that will relate to this example. A physical academy I have where students will come and attend. Now, what happened is, there was this attempt got cancelled by the institute, right? Now, I have to decide whether I need to keep my shop, that is the physical academy, I need to keep it open for the next 6 months or not, because I know that till now many students were coming. Even after the 6 months also many students will come. The question is only about the temporary period of the next 6 months. Should I keep my business open? That is, should I keep my shop open or should I shut it down? Basically meaning what? If I shut down, will there be any benefit and all? I need to analyze. Clear with this. Now, what will be the cost and benefit of shutting down? If I shut down, what will be my benefit and what will be my cost? Now, let us say I am running this academy, I told you, and let us say that I have hired faculties also for other subjects. Example I'm giving you guys, right? Now, what happens? There are two types of fixed costs that I am incurring in this particular business model. One is called as an avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what is an example of avoidable? What is an example of unavoidable? Now, let me say I have taken a place on rent, right? Now, irrespective of whether the next attempt is going to get conducted or temporarily if I shut down or keep it open, definitely I need to pay my landlord. Correct, guys? I need to pay my landlord for sure, right? So let us say I need to pay about 1 lakh rupees every month as a rent. Now that is, rent is an example of unavoidable fixed cost. Are you clear with this? Right? Now I also hired faculties, right? And let us say I am paying the faculties a fixed amount if they conduct one batch. If you take one batch, I will give you so much amount of money, right? Now the faculty fee is an example of avoidable fixed cost. Sir, how is it an example of avoidable fixed cost? Suppose the next batch is getting cancelled, the faculties need not come and take, right? So if they are not coming and taking, I need not obviously pay them. Are you clear with this? Sir, is it a variable cost? No, it doesn't depend on the number of students who enroll. I just pay them a flat fee. Example I'm giving you, right? Now, a faculty fee is an example of avoidable fixed cost, whereas a rent is an example of unavoidable fixed cost. I need not pay the faculty any fee if the batch is not conducted, whereas I need to pay my landlord the rent irrespective of whether the batch is conducted or not. Are you clear with this? Now, in this scenario, what happens is, if I shut down the business, now what will be the benefit for me? I can save the avoidable fixed cost. Correct? No? If I'm shutting down the batch for the next 6 months, if I'm shutting down my business, what happens is the faculty fees need not be paid. Are you clear with this, guys? Right? The faculty fees need not be paid. That is one savings for me, right? Now, what will be the cost? Now, there are two types of costs that I incur. The first one is called as shutdown cost. Now, this shutdown cost is not unavoidable fixed cost. No, because I am shutting down, I will be incurring some extra cost. For example, let us say I have a factory during the COVID time. Many people shut down their factories, correct? Now, you know what? when the machines are being run every day, it is slightly easier to maintain. If the machines are not being run, they require some additional maintenance. A typical example is during COVID time, they had imposed lockdown restrictions, and you guys would have been having your vehicles and all, no? Right? You were supposed to not take your vehicles outside. I don't know whether you did, but yes, we're not supposed to take it. Let's say you never touched your vehicle for about 1 month. So on the 31st day, when the lockdown got lifted, so the first place that you visit is the mechanic shop. Correct? Because when a particular engine is not being used, a machine is not being used, it requires some additional level of maintenance. Had you maintained it properly during those 30 days, maybe then your your vehicle would be working properly. So why am I saying this? When you are shutting down, you need to spend some extra money on maintaining your machines. This otherwise I will not be incurring. Are you clear with this, guys? So if I am shutting down, extra what I will be incurring, the extra cost is shutdown cost. Are you clear with this? And there is also one more thing, the contribution lost on shutdown period demand. On shutdown period demand. On shutdown period demand. What is it? Now, I know that generally every batch, example I'm giving you, 100 students will come and attend face to face if I announce a batch, right? Now, during the COVID time, even if I announce, only 5 people were ready to come. Example I'm saying, suppose I shut down, right? That 5 people's contribution that I will be earning, that also I cannot earn. Correct? No? That is, if I shut down, I will be losing out on the contribution that I could have possibly made during the shutdown period demand. Are you clear with this, guys? Are you clear with this, guys? So basically, there is a cost benefit analysis that needs to be done. If I shut down, the benefit is savings in avoidable fixed costs. That's all. And if I shut down, I need to incur 2 additional costs. One is the shutdown costs. That is the additional cost that I need to exclusively incur if my business being shut down, and the other one is if I'm shutting down, I lose out on the contribution that I can possibly make during the shutdown period demand. Clear with this, guys? Clear with this, guys? Now I need to evaluate this cost and benefit, right? If my benefit is greater than the cost of shutting down, then I will go and happily shut down. If not, then I will continue. Are you clear with this, guys? Right? Now let me just give you an example. Let us say I am just shutting down. Oh, one second. Yeah. So now let us just take an example. Let's say I'm planning to shut down, right? And the benefits and cost details are as under. Let's say the avoidable fixed cost is going to be 1 lakh rupees. This is the amount I will be saving. Okay. And the cost will be, if I shut down, I will be incurring a shutdown cost of 40,000 rupees, right? Of 40,000 rupees. And let us say the contribution lost will be, during the shutdown period, I am expecting my demand to be 3,000 units only, right? And every unit gives me a contribution of 4. Example I'm giving you, right? So now what will be the contribution lost? If I shut down, even these 3,000 units I will not be able to sell. So the contribution loss will be how much? 32,000 rupees. So now you tell me, if I shut down, the benefit is how much? 1 lakh, but I am only losing how much? The cost is going to be 72,000. So I will be having a net benefit of how much? I will be having a net benefit of 28,000. Now in this case, it makes sense to shut down. Correct? I will say, sir, fine, please shut down, because the benefit of shutting down is more than the cost of shutting down. So it's going to be a 28,000 rupees is the net benefit. You do it. Clear with this, guys? Now, same example. Yes, hello.
Yeah. Contribution loss is 3,000 or 8,000? 3,000 into 4 or...
It's 3, I'm sorry, it's 8,000. I'm so sorry. Yes, it's 8,000 into 4. Right, you're right. It's 8,000 into 4. I'm sorry. I just, thanks for telling me that. It's 8,000 units. Okay. So it's 8,000 units into 4, right? So the contribution loss is going to be 32,000 rupees. So assuming that during the shutdown period, the demand is only going to be 8,000 units. Generally, I'm running a business where I'm going to sell 1 lakh units every month. Then I will not be having a question of shutdown and all. Now, because of some temporary phenomenon, during this period, there is going to be 8,000 units of demand only. Now, because of this recession, I am thinking. Clear with this, guys? So yes, I stand corrected. It is 8,000 units is going to be the shutdown period demand with a contribution per unit of 4. So now the contribution loss, if I shut down, I cannot even honor this 8,000 units of sales. So it's going to be 32,000 rupees. Clear with this, guys? Now I am just giving another example with a small change. Now let us say in this scenario, again the avoidable fixed cost is going to be the same 1 lakh rupees, right? And if I shut down, the shutdown cost will continue to be 40,000 rupees. I'm just making one change. During the shutdown period, I am estimating a demand of 20,000 units instead of 8,000. Now I'm expecting a demand of 20,000 units. So now you tell me, so the contribution loss will be how much? 20,000 units into 4, correct? So if I shut down, I'm losing out on 20,000 units of sale, which each of which can generate me a contribution of 4 rupees. So that is going to be how much? 80,000 rupees. Are you clear with this? So now this is going to be how much? I will be losing out 1,20,000, but I will be getting a benefit of 1 lakh rupees. So now tell me, if I shut down, the costs of shutting down is much higher than the cost of the benefits that I get out of shutting down. Here it is going to be a negative 20,000. The net benefit of shutting down is going to be a negative 20,000. Or in other words, in this scenario, it makes sense for me to continue my business, even though there is my business is not up to the mark, I know. But even in this scenario, it makes sense to continue because the benefit of shutting down is less than the cost of shutting down. The costs are more. If I shut down, the costs are more, so it's better to continue. Are you clear with this, guys? Are you clear with this? Or in other words, once again, the hero of this area is what? The demand, the volume. That's why we call this marginal costing as cost volume profit analysis. So, sir, when should I shut down? When should I continue? The decision depends on the shutdown period demand. If you're having a very good demand, right, you can actually, no problem, you can continue. If you're having a very low demand, then you should definitely shut down. But there is an exact point where whether you shut down or you continue, you will be indifferent. That is basically what your benefits will be equal to the cost, correct? No, that point is called as shutdown point. Why do we need to calculate the shutdown point? If your shutdown period demand is expected to be greater than the shutdown point, then it's always better to continue. If your shutdown period demand is less than your shutdown point, then you should always shut down. And at the shutdown point, if you want, you continue, or you don't want, you don't continue. But anyways, it is going to be the same benefit. Are you clear with this, guys? So now, how do I calculate the shutdown point? The shutdown point is a point of the volume or the demand where my benefit is equal to cost. Agreeing with me or not? Or in other words, can I say it is going to be 1 lakh is equal to 40,000 plus 4x. That is, I need to calculate x. X means what? The shutdown point, that is exact demand. Clear with this? The demand, the shutdown period demand, which makes my benefit equal to cost. Here the benefit is 1 lakh. The cost is going to be 40,000. That is your shutdown cost plus your contribution loss of 4x. Clear with this, guys? So now, how do I calculate this? Can I say 4x is equal to 1 lakh minus 40,000, right? Or x is equal to 1 lakh minus 40,000 divided by 4. So how much is this? This is going to be 60,000 divided by 4. That is going to be 15,000 units is my shutdown point. What is the meaning of this? So the shutdown point of 15,000 says that during the next 6 months, right? If I am expecting a demand of less than 15,000 rupees, it is better to shut down. If I am expecting a demand of more than 15,000 rupees, then the market is vibrant. Only then it makes sense to continue. If it is going to be exactly 15,000 rupees, whether I shut down or I continue, I will be getting the same result. Are you clear with this? The formula for shutdown point, hence, is nothing but avoidable fixed costs minus shutdown cost divided by contribution per unit. This is also nothing but difference in fixed cost divided by difference in contribution per unit. So then only one contribution per unit is there, no sir? Because if I shut down, I will not be selling anything. correct? So the contribution of that alternative is 0. This 4 rupees is the contribution that I will be getting only if I continue, right? So it's ideally 4 minus 0. Are you clear with this? So this is actually based on the concept of indifference point, but clearly understand my shutdown point formula is going to be what? Avoidable fixed cost minus shutdown cost, the whole divided by contribution per unit, right? Again, shutdown point is nothing but a demand or a sales volume. If you want to express this in value, shutdown point in rupees is equal to avoidable fixed cost minus shutdown cost divided by what? Divided by PV ratio. Are you clear with this? Wherever demand comes in, whether as sales or as break-even point or as margin of safety or as indifference point or a shutdown point, right? Wherever you are using contribution per unit, replace it with PV ratio to arrive it in value. Are you clear with this, guys? Right? This is the formula which can be logically arrived. It is a point where my benefits is equal to cost. So if your expected volume is greater than shutdown point, please continue your business temporarily only. All these are temporary decisions. If it is going to be if your expected demand is going to be less than your shutdown point, then it makes sense to shut down your business. Are you clear with this, guys? You guys are able to follow this? You guys are able to follow this, right? Fine. And that's what has been mentioned here. Okay. So now, yes, look at this. This is the formula. Avoidable fixed cost minus shutdown cost divided by contribution per unit. Okay. And if your expected sales is going to be less than the shutdown point, you shut down. And if it is going to be greater than the shutdown point, you continue. Clear with this, guys, right? There's one question given here. I think it's just relating to, yes, look at this. The selling price is 20, the variable cost is 14, the fixed overheads is going to be 7,92,000. How many units should be sold to earn a 10% of the takings? Takings means what? Takings means sales. Clear with this? So how many units should be sold here? So now, how do you find this out? It's pretty much simple. So now what you need to do here is, okay, so again, put up the marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? So your sales is going to be, so they've given the selling price, so 20x, variable cost is going to be 14x, so your contribution is going to be 6x, right? Your fixed cost is going to be 7,92,000. So they are expecting a profit of 10% on sales. So 10% on 20x is going to be 2x, correct? So now we have framed an equation. 6x minus 7,92,000 is going to be equal to 2x, or in other words, 6 minus 2, 4x is equal to 7,92,000. X is equal to 792,000 divided by 4. That gives you how much? 1,98,000, right? So you need to sell 1,98,000 units to earn a 10% profit. This is very simple. Now, the second part of the question is relating to shutdown point. Calculate the shutdown point if 30% of the fixed overheads are avoidable and interpret the result. Now, what they are saying, out of a total fixed cost of 7,92,000, 30% of it is going to be avoidable, correct? 30% is going to be avoidable. Clear? Now in this case, what do? Shutdown point, what is the formula? Shutdown point is equal to avoidable fixed cost minus shutdown cost divided by contribution per unit. Now, what's my avoidable fixed cost? Avoidable fixed cost is 30% on 7,92,000. So 792,000 into 0.3. How much is it? 2 lakh. So it's going to be 2,37,600. Now, what many students do and commit a mistake is they take the balance 70% as shutdown cost. No. See, unavoidable fixed cost is not shutdown cost. Shutdown cost means what? Because I'm shutting down, what is the extra cost I incur? In this question, have they given anything? Have they given any shutdown cost? No. Which means in this case, the shutdown cost is 0. Which means I did not spend any extra money because I'm shutting down. Are you clear with this? Right? Divided by the contribution per unit. In this case, the contribution per unit is going to be 6 rupees. So now how much is that going to be? 237,600 divided by 6. It's going to be 39,600 units. Are you clear with this? So if during the shutdown period, you are expecting a demand of less than 39,600, you please go ahead and shut down. The market is not vibrant. It is not feasible for you to run the show, right? If you are expecting a shutdown period demand to be greater than 39,600, then it's always better to continue because the benefits will be, it's better if you continue the business, right? And at the shutdown point, you either shut down or continue, both will give you the same result. Are you clear with this, guys? Right? And that is about the concept of shutdown versus continue decision and the shutdown point area. Clear with this, guys? Any issues? Any problem here? Guys, done? Shall we proceed forward? Shall we proceed forward? Let's move on to the next concept called as key factor analysis. Just a minute. Yes. Now, let's move on to the next concept called as key factor or limiting factor. So, key factor stroke limiting factor analysis. I hope the YouTube live is fine. Guys, can you just respond on the chat box, please? I just want to make sure that the live is functioning fine. Is it? Okay, great. Okay, thanks Aarti, thanks Murthy. Yes, Aishwarya. Fine, great. Okay, guys. Yes, Gokula. Fine. Okay, Anup. Okay, fine. Now looks like it's working fine. Now, guys, coming on to the another important concept here, which is called as key factor or limiting factor. Again, guys, let me give you an example. Please catch up running notes for this. Now, what is this concept all about? Now, let's say a company is in the business of manufacturing two products, A and B, right? The selling price, variable cost, and the contribution per unit details are given as follows. Now, A and B, just a second. Yes. So every unit of A has a selling price of 10, variable cost of 6. So that gives it a contribution of 4 rupees. And let's say product B also has a selling price of 10. The variable cost is only 4 and the fixed cost is going to be, the contribution per unit is going to be 6 rupees, right? Now, you tell me, guys, which of the two products will you manufacture? Which of the two products will you manufacture? Product A or product B? Product A or product B? You will manufacture which of the two products? Product A or product B?
Product B.
Product B. Product B, is it? Okay. Now, I would say, why should I take a decision? Why should I say product B? I want to manufacture both the products. As long as a product is giving me a positive contribution, I will be happy to produce both, no? Who is asking me? So contribution per unit can be more. I will also sell unlimited units of B. I will also sell unlimited units of A. What is the problem? Clear? So practically speaking, who is limiting me on telling that no, only produce B? Right? I'm finding another profitable product. Relatively, it is lesser, right? So what? I can produce both, together, right? So why am I taking this example is when there is no constraint or when there is no scarcity of resources, right? I can go for all the options. I need not say that only one or only two, right? The question of choosing between which one to do happens only when there is some scarcity or there is something that limits my production. Are you clear with this? Suppose I am saying, no, maximum you can produce only 10,000 units, right? Whether A or B, maximum 10,000 units only can be produced. Now you tell me, now I will say, now I want to produce B only more because that gives me a higher contribution per unit. I will go for it. Are you clear with this? Or in other words, only when there is a constraint or a scarcity will there be a question of choosing which one to produce. Are you clear with this? If I don't have a constraint, unlimited capacity I can have, I will try to produce as many number of profitable products as possible. Are you clear with this, guys? Are you clear with this? Right? Yashwant depends on fixed cost. No, it doesn't depend on fixed cost at all. It doesn't depend on fixed cost. Fixed cost is irrelevant for your decision making because whether I produce A or B, my fixed cost will be fixed cost. Correct? In a factory, I'm going to pay a rent. Using the same factory, I can produce A as well as B, right? Now, it has nothing to do with the factory rent, has nothing to do with which product I need to produce. So, fixed cost is completely out of this question, right? Clear with this? Now, so the concept of key factor or limiting factor comes into picture only when there is a constraint. Now, let me just take an example here. Let us say both these products A and B, both of them use a common raw material called as raw material X, and raw material X has an availability of only 10,000 kgs in the market. Or in other words, let's say I have to import a raw material called raw material X. Using this raw material, I can produce both A as well as B. Clear? Both these outputs require the same raw material. Now, the government of India has imposed a restriction saying that, look, you can only import a maximum of 10,000 kgs, right? Now, raw material is a constraint, correct, guys? Right? Raw material is a constraint, correct? Now, what happens? They are also giving me a data that, look, raw material X, for me to produce 1 unit of one unit of product A, it requires 1 kg of raw material X, and every unit of B requires 2 kgs of raw material X. Clear with this, guys? This is what they have given, right? And they have also mentioned the demand details. The demand details in the market, right? Product A has a maximum demand of 2000 units and product B has a total demand of 8000 units. Clear with this, guys? These are the situations, these are the scenarios and constraints that we have got. Now you tell me, right, which product will you be interested in manufacturing? To which product will you give the topmost priority? Tell me, guys, to which product will you give the topmost priority?
Product A, sir.
Which product will you give the topmost priority? Yes. Now, some of you might feel that, sir, then what is the question here? Now, obviously, I will go for product B because it gives me a high contribution per unit. No. The actual answer is you need to give the top priority for product A. And let me tell you why. First of all, find out what is the constraint. Now, I know that there is a market demand of 2000 units of A and 8000 units of B. Suppose if I were to fulfill the entire market demand, tell me what is the total raw material X, quantity of raw material X that I will be needing. So 2000 into 1, right, plus 8000 into 2, 16,000. So if I want to fulfill the entire market demand by producing 2000 units of A and 8000 units of B, the total raw material required will be 2000 into 1 plus 8000 into 2. Agreeing with me? I need 18,000 kgs of raw material X. But how many kgs of raw materials X have I got? Only 10,000 kgs of raw materials X I've got, which means in this case, clearly I know that raw material X is a constraint or it is a limiting factor. What do you mean by a limiting factor? A factor that limits your production. Are you clear with this? Now what I will do, I will not take the decision based on contribution per unit. I will take the decision based on contribution per limiting factor. Sir, what are you saying? So here product A and B are there. The contribution per unit of A and B is going to be rupees 4 and rupees 6 respectively, right? And then they have given that the kgs of raw material required, for every unit of A it's going to be 1 kg, for every unit of B is going to be 2 kgs, right? So contribution per kg of raw material used is going to be rupees 4, and here it's going to be 6 divided by 2, it's going to be rupees 3 per kg. Are you clear with this? Now if you see, the rankings will be, I will give a first rank to product A and a second rank to product B. Sir, why, sir? Now in this case, guys, clearly we established the fact that raw material X is a limiting factor, it is a constraint, correct? Now if you see, no doubt product B has a high contribution, no doubt, per unit. But what happens? It takes 2 kgs of raw material X to generate 6 rupees of contribution. So technically speaking, every time I lift a kg of raw material and use it to produce product B, I earn only 3 rupees. Whereas though product A has a low contribution relatively, it has an advantage by way of a lower consumption. For me to generate this 4 rupees through product A, I only need to use 1 kg of raw material X. So if I lift to 1 kg of product X from my stores and use it for producing product A, then itself I can generate 4 rupees of contribution. Or in other words, every time I use a single kg of raw material for producing A, I earn 4 rupees of contribution. Whereas if I use the same raw material kg for producing B, net off I earn only 3 rupees per kg. Now, since raw material is a constraint factor, I need to use it so judiciously and properly. So I will go based on the contribution per kg of raw material, and that is the concept of limiting factor. Are you clear with this? So step one, what I do is, first I establish the fact that my raw material is a limiting factor. Then step two, what I do, I calculate the contribution per limiting factor and do the rankings. Clear with this, guys? Now I do step three, which is allocation of the limiting factor. Allocation of limiting factor. Sir, how will you allocate the limiting factor? First, you will use the raw materials for producing product A. As many units of product A as possible, you do it. Then if there is any kgs of raw material left out, you use it for producing product B. Are you clear with this? How we do this is, we use this template, rank product units, kgs per unit, kgs and sigma kgs, right? So first rank product is product A. Now in the market, we know that the maximum demand for product A is 2000 units that I just told you, and every unit of product A requires 1 kg of raw material. So now to fulfill the entire market demand for product A, you would have consumed how many kgs? 2000 kgs, right? So now as of now, you've consumed how many kgs? 2000 kgs, that is sigma kgs, that is cumulative kgs. Now you go on to the second rank product, which is B. Now come from the back. After producing product B, that is A as well as B put together, what is the total raw material you would have consumed? 10,000 kgs, because that is the maximum you've got. Out of this 10,000, you've already consumed 2,000, which means only 8,000 kgs of raw material are left for producing what? Product B. Are you clear with this? This is nothing but 10k minus 2k, that is 10,000 minus 2,000. And every kg of every unit of product B requires 2 kgs of raw material, and I have only 8,000 kgs left for the purpose of producing product B. So max, how many units of product B can be produced? So I would say 8,000 kgs are available, and every unit of B requires 2 kgs. Max, I can produce only 4,000 units of product B. Now this is the best possible sales mix that can give you the maximum amount of profit given the limiting factor. Are you clear with this? So if you want to make the maximum profit given the constraint, now what you need to do is, you need to produce 2000 units of A and 4000 units of B. If you deviate from this, definitely your overall profit will be lesser only. Are you clear with this, guys? Are you clear with this? This is the concept of limiting factor. Are you clear with this, guys? Yes, done. Now, shall we quickly do one numerical problem in this regard? I've kept one numerical problem here. So, yes, it's question number 3, I guess. Yes, question number 3. 1 second. Yes, look at this. The following particulars are extracted from the records of a company. So, product A, product B there, right? So, they have given the sales, consumption of material. Every unit of A requires 2 kgs. Every unit of B requires 3 kgs. Material, direct wages, direct expenses, machine hours used is also given. The overhead expense, fixed is unitized and given, right? And variable is given. Now always remember, for the purpose of decision making, the fixed costs are irrelevant. Why? Whether I produce or not, anyways I'm going to incur it, right? Then why would I consider it? Are you clear with this? So fixed costs are not considered for the purpose of decision making. Now the direct wages per hour is going to be 5 rupees. So this is what they have given. Now A, comment on the profitability of each product, assuming that both the products use the same raw material, when A, raw material is in short supply, and B, the production capacity in terms of machine hours is a limiting factor. First, they are just asking you to comment on the profitability. That's all they are asking you. They are not asking you to do the allocation and all. They are just asking you to comment, which means what? When raw material is a limiting factor, what will you do? You will do the rankings based on raw material contribution per kg of raw material, correct? Similarly, when your machine hour is a limiting factor, you will take the decision based on contribution per machine hour. Clear with this, guys? Clear with this, guys? Right? So that is what you need to mention here. First, they have listed out the selling price and the variable costs. Finally, they have arrived at the contribution per unit of A, contribution per unit of B, and as I just told you, fixed cost should be ignored for the purpose of decision making, because as the name suggests, they are fixed. Okay. So based on your decision, this is not going to change. Clear with this, guys, right? Now, ranking of the two products when raw material is a limiting factor. So contribution per unit is given. Contribution per unit is given. Yes.
Expenses are they are 15 rupees and 16 rupees.
Sorry, ma. What is it?
Direct expenses.
Direct expenses.
15 rupees and 16 rupees are they.
Okay, just a minute. I think there has been some. Okay, is this calculation coming out to be correct? 1 second.
No.
No. So then this is not 15 then. Then this has to be, this is 5 ma. I'm sorry, this is, okay, direct expense is 5. Right, this is 5 and this is 6. Sorry, that's a typo error. Thanks for pointing out, that's a typo error. So remove this. They have just done, the calculation is correct, I think. The calculation is correct, no? So it's 10 plus 15 plus 5 plus 15. So it's 30, 40, 45. Yes. Here it's 30, 45 and 51. Correct. Right. So it's, they have just, it's a typo error, but the calculation they have considered only 5 and 6 respectively. Okay. Right. Hope your doubt is solved. Okay. So now, yes, this is what it is, guys. So they have arrived at the contribution per unit. Now, in case your raw material is a limiting factor or a constraint, what do? You take the contribution per unit of both the products divided by the kgs of raw material consumed. You will get the contribution per kg, right? Contribution per kg of raw material. Obviously, based on that, I will give a first rank to product A and a second rank to product B. Are you clear with this, guys? Are you all able to follow this, right? Similarly, suppose in this case, machine hours is a limiting factor. Machine hours is a limiting factor. What will you do? You will take the decision based on contribution per machine hour. So you take the contribution per unit. Every unit requires 3 hours of machine hours and 2 hours of machine hours respectively for A and B. Right? You calculate the contribution per machine hour based on contribution per machine hour. So I will go for product B first, right? And then only if any machine hour is left out, I will use that towards producing product A. Are you clear with this, guys? Are you clear with this, right? That is about this particular, that is about this particular part A. Now, one more thing I want to tell you, guys. One more thing I want to tell you. Limiting factor. So, what could be a limiting factor? Raw material could be a limiting factor. Your direct labor could be a limiting factor. Your units could be a limiting factor. Your machine hours could be a limiting factor. Anything could be a limiting factor. Correct, guys? Guys, yes, you guys are able to follow this, right? Now, if raw material is a limiting factor, we saw in this sum, right? So what happens? I will first give the priority to product A. Anything left out, I will give it to product B. Correct? If machine hours is a limiting factor, I will give the first priority to B. Then anything left out, I will give it to A. Correct? Now, you might be having a doubt, sir, what happens? Can there be two limiting factors parallelly? In real life, that can happen, no? Import restrictions are also there. Local machine hours are also a constraint. Both together can also happen, right? So now, sir, if I do this based on raw material, which is also a constraint, it is asking me to produce product A first. But machine hours is asking me to produce product B first. There is a conflict of ranking. What will I do? In this case, marginal costing cannot be used. In this case, marginal costing cannot be used. Instead, you use a concept called as LPP, linear programming. You guys would have studied in your 12th standard that linear programming, some graphs will be there, shaded region and all. They will say maximize Z is equal to so and so, subject to constraints. They will say 3x plus 5 is less than or equal to so much. 4x plus y is greater than or equal to so much. So you will list the constraints and try to maximize your profit. Using a graphical method or a simplex table, you can arrive at your decision. When you have more than one constraint, that is anyways not there in your syllabus, in your interest syllabus itself, it's not there. It is a subject matter of discussion in CA final. But remember, those LPP which you would have already studied in your class 12th basics, that is your graphs and all. You guys remember that maximize Z is equal to something, subject to constraints and all. They will give you 5x plus 3y is less than or equal to 0, is less than or equal to 5000, something like that. They will list out the constraints, and where x comma y is greater than or equal to 0, they will list out the constraints and they will solve it, right? So basically, to put it short, when you have more than one constraints, marginal costing will not be able to do it. right? It can be done only using something called as linear programming problems, which is a subject matter of discussion in CA final. Just giving you a bird's eye view on that, right? Now, B, they are asking, that is part B of the question. Assuming raw material as a key factor availability and the availability of which is going to be just 10,000 kgs and the maximum sales potential of each of the products is 3,500 units, find out the product mix which will yield the maximum profit. Now what you need to do, you need to do the allocation. So they are saying clearly, assume that raw material alone is a limiting factor, right? In that case, ranking will be what? First I will try to produce A, then any raw material left out I will try to produce B. Correct, guys? So what will I do first? Now allocation of 10,000 kgs of raw materials to maximize the contribution. So first rank product is A. So 3,500 units is the maximum market potential. Every unit of A requires how many kgs? 2 kgs. Yes, it requires 2 kgs of raw material. So for producing A, I would have consumed a total of 7,000 kgs. So sigma kgs, that is as of now the cumulative kg consumed is only going to be 7,000 kgs. Clear with this, guys? Now after producing B also, the total consumption would have been how much? 10,000 kgs. Out of this, I have used 7,000 for A, which means only 3,000 is available for product B. And every unit of product B consumes 3 kgs, which means the maximum possible number of units B that can be produced is 3,000 divided by 3. It is going to be 1,000 units. Are you clear with this, guys? So now this is how I allocate the limiting factor, and when raw material is a constraint and I have only 10,000 kgs of raw material, the best possible mix that can yield my maximum profit is going to be 3,500 units of product A and 1,000 units of product B. So what would be the contribution in that case? 3,500 units into 55 rupees, that gives me 192,500, and 1,000 units into 69 rupees, it's going to give me 69,000. If you add up the two, you get what? 2,61,500. Are you clear with this? This is the maximum possible contribution that you can earn when raw material availability is only 10,000 units. Are you clear with this, guys? And this is the concept of limiting factor analysis. Are you clear with this, guys? You are all clear with this, right? Fine. So in exam, this could be a 10-mark question as well. And one more thing, some students are saying, some students and some even in some YouTube channels, I've seen this. They feel that limiting factor has been removed from our syllabus. Absolutely not. It has not been removed, guys. So what they have done is, in the earlier version of the material, there was one sum that they have removed. They have not removed the concept of limiting factor. That one sum they removed. So many people started creating a buzz saying that, the limiting factor concept itself they have removed from the new syllabus. Absolutely not. It is very much a part of your new syllabus only. Clear with this, guys? So don't fall for it. It is definitely there because it's one of the key aspects of marginal costing. Now, with this, we are done with all the aspects of CVP analysis. We are just left out with marginal versus absorption costing, which we'll be doing right now. Okay. So now all these things are done. Indifference point, shutdown point, and key factor analysis. So now we are left only with the last concept or the segment C of this chapter, which is called as absorption costing versus marginal costing. Now, shall we get started, guys? Yes. Right? Shall we get started? Okay. Now, absorption costing versus marginal costing. Now, what is this concept all about? But before that, let me tell you, this is the only segment in this entire chapter that talks about stock valuation and profit computation, right? Now, guys, absorption costing is nothing but the overage chapter that we saw. Now, what does absorption costing say? Now, as per absorption costing, we have seen that costs can be broadly classified into two: manufacturing costs, right, and non-manufacturing cost. Correct? When I say non-manufacturing costs, I mean your AOH and SOH. Clear? That is all the costs incurred outside the factory. Non-manufacturing cost. Correct? Right? And you have manufacturing costs. Right? Manufacturing costs, I can further split it into four. I can okay, yes, I can further split it into four: direct material, direct labor, direct expense, and production overhead. Right, guys? Yes. So overall, in costing, these are the costs that we consider. Correct, guys? And again, I'm telling you, this segment of discussion talks about what? Stock valuation and profit computation. That's why we are looking at cost from the perspective of your manufacturing, admin, and selling. Clear with this, guys? Now, in your production overheads also, if you see, there could be fixed production overheads, there could be variable production overheads. For example, your power and fuel could be a variable production overheads, whereas a factory rent could be a fixed production overhead. Correct, guys? Correct? Yes, done. Okay. Let me just change the sequence here. I will put it here. I will put this one as variable and I will put this one as fixed. Now what is it? Now a company can follow either marginal costing or absorption costing. A company can either follow marginal costing or absorption costing for the purpose of maintaining their costing records. I'm not talking about decision making, I'm talking about records. Costing records, a company can either follow marginal costing or they can follow absorption costing. Now, what we have seen in absorption costing, all the non-manufacturing costs, that is any cost incurred outside the factory, these are all period costs. These are all period costs. Correct? Period cost means what? Not considered for stock valuation directly. P&L items, they get knocked off against your revenue, so they are not used for stock valuation. Correct? Yes, guys. And what does our absorption costing says? So stocks, every unit should be valued at full manufacturing cost. Correct? No? Right? That is, to value every unit of a product, it should be valued at the prime cost components, direct material, labor, overheads, and your entire production overheads, that is variable as well as fixed production overheads. Correct, guys? Yes, this is what our absorption costing says. Now, what our marginal costing says is, look, we are also saying any cost incurred outside the factory should not be considered for your stock valuation. So they are all period costs, no problem. But they are saying every unit should be valued at variable manufacturing cost. That is, marginal costing is also saying use direct material, direct labor, direct expense, and also variable production overheads. So these four are always product costs. They are always product cost, whether I follow marginal costing or I follow absorption costing. Clear with this? But what marginal costing says is, look, fixed production overheads. First of all, marginal costing says over your fixed cost itself should never be unitized, right? Fixed cost doesn't make sense if it is unitized. Marginal costing says just because that fixed cost is incurred inside a factory, please do not consider it for the purpose of stock valuation and all. So what your marginal costing says is, wait, fixed production overheads will never form part of your product cost. That is, treat your fixed production overheads as period cost. Who says this? Marginal costing. Whereas absorption costing says, no, even fixed production cost will be considered as a part of your product cost. So here the issue arises only with respect to the fixed production overheads, right? Wherein the absorption costing says that it needs to be considered as a product cost. It needs to be considered as what? As a product cost. Whereas my marginal costing says, no, anything which is fixed, irrespective of the location, is always treated as a period cost. So now marginal costing treats this as a period cost. Are you clear with this, guys? Are you clear with this? So remember this, marginal costing and absorption costing, both of them are agreeing on this area, right? And both of them are agreeing on this area also, right? Both the methods or both the techniques of costing say any non-manufacturing costs are always period costs, right? And the prime cost components and even the production overheads, variable production overheads, are always product costs. The issue arises only with respect to fixed production overheads, where marginal costing says we will not unitize anything that is fixed. So even the fixed production overheads should not be unitized and should not be considered as a part of your stock valuation. Clear with this, guys? So anything that is fixed production overheads, you directly take it to your P&L. Don't take it to my trading account. Clear with this, guys? Don't consider it for stock valuation. Whereas absorption costing says, no, I will value the stock at full manufacturing cost. Clear with this, guys? Are you clear with this, right? This is the only difference. So look at this. Absorption costing says product cost is going to be direct material, direct labor, direct expense, and my production overheads. Production overheads means what? Full production overheads, variable and fixed. Marginal costing says every unit should be valued at material, labor, direct expense, and only the variable component of production overheads, which means what? The fixed component of production overheads should never enter into my stock valuation as per marginal costing. Clear with this, guys? Right? Now, in both these, so in case of absorption costing, what is a period cost? Only the non-manufacturing cost, that is my AOH and SOH. Whereas in my marginal costing, what happens is not just my admin and selling overheads, but even my fixed production overheads is also forming part of what? It is also forming part of my period cost. Are you clear with this, guys? Are you clear with this? So in marginal costing, the fixed production overheads and admin and selling, not fixed, even if it is a variable. See, guys, admin and selling, even though they are variable, they are also treated as period only, even under marginal costing. See, your AOH and SOH, whether they are fixed or variable, I don't mind, right? They are incurred outside the factory. Both the methods say that they should not be considered for the purpose of stock valuation. So the only difference is happening with respect to the fixed production overheads. Are you clear with this? The fixed production overheads is not considered as a product cost under marginal costing, whereas it is considered as a product cost under absorption costing. Are you clear with this, guys? Then the fixed production overheads are charged as product cost under what? Under absorption costing, whereas the fixed overheads are not charged the products. They are always taken as a period cost on actual basis. Now let me tell you one thing. Now look at this, guys. AOH and SOH are there, right? Whether they are variable or they are fixed. Now, whether they are variable or they are fixed, they are incurred outside the factory, right? They are always period cost under both the techniques of costing. Clear with this, guys? Don't think that in marginal costing, if it is variable, I will always treat it as a product cost. No, I'm being very clear. Marginal costing considers only variable manufacturing cost, which means what? The cost needs to be variable and it needs to be incurred inside a factory. Clear with this, guys? So don't say that all variable costs are considered as a product cost under marginal costing. No, if it is a variable cost incurred outside the factory, marginal costing also says don't include it. Are you clear with this? In fact, marginal costing is being extremely cautious, extremely conservative. Here you are taking the full manufacturing cost. I am only taking the variable manufacturing cost. So clearly, I am avoiding the fixed production overheads. Are you clear with this, guys? Basically, what marginal costing says is, if a cost is fixed, right, irrespective of its location, that is whether it is incurred in the factory or if it is incurred outside the factory, fixed, whenever the word fixed comes, it should not be unitized and it should not be considered for the purpose of stock valuation. Clear with this, guys? Clear with this, guys, right? This is similar to that, the dialogue that we have in a movie. Nanbanla eduma nalla nanban ketta nanban, nanbanale nallavan dhaan. Something like that. Marginal costing says, right, fixed la enga product or period. Fixed nale period dhaan. So whenever fixed comes in, marginal costing says it's always a period cost. Do not unitize it, right? Because it really doesn't make sense if you unitize a fixed cost and push it into the product. Clear with this, guys? Are you all able to understand this? Yes, that is what our marginal costing says. Clear with this, guys? Now, based on this, of course, there is one major difference again. In your absorption costing, you have all the procedures of absorption. That is, first, we need to calculate the absorption rate, charge it off with the products, compare it with the actual, and at the end of the year, you need to calculate the under or over absorption. Are you clear with this? Whereas, if you're following your marginal costing approach, there is no concept of absorption only. Why? Because I've made life simple. Your fixed production overhead should not be unitized. Just now we saw. Then where is the question of absorption? Sir, variable production overhead is there, no, sir? Yes, but it is variable, no? So, as and when the product comes out of the machine, I will know how much it has actually gone into it. Are you clear with this, guys? Are you clear with this? Yes, you guys are understanding this. There is no concept of absorption when it comes to what? When it comes to your marginal costing. Whereas, since we are doing it under absorption costing, in this case, at the end of the year, I need to do that rectification entry of under or over absorption. Are you all clear with this? Are you all clear with this? Now, with this, let us go and do a numerical problem. Take question number 4. Please take question number 4. A very, very good example. It's a masterpiece. Mark this sum as important because, again, this sum is there in CA final as well. The exact sum, because in marginal versus absorption costing, this is all the concept is. Fine. This is all the concept is. Of course, there are some advanced level as well, but yes, this is a common example which is used in both inter and final. So in your final self-study, self-paced modules, you can also find the same example maybe. Right, now look at this. From the following data, compute the profit under marginal costing and absorption costing and reconcile the differences in profit. Now what they have given, the selling price is 8, variable cost is 4, and fixed cost per unit is 2. Right, now be very careful here. What they have said is, if I am using absorption costing, right, every unit will be valued at 6 rupees, 4 plus 2. Correct, guys? Full manufacturing cost. If I am using marginal costing, every unit will be valued only at 4 rupees. Are you clear with this? Are you clear with this? Right? Now, the normal volume of production is 26,000 units per quarter. So per quarter, the normal volume is 26,000 rupees, right? Now, so with this, you can clearly make out, so 2 rupees is the fixed cost they have given. 2 into 26, it's going to be how much? 52,000 rupees is the fixed cost per quarter. Are you clear with this? So the fixed cost planned per quarter is 52,000 rupees. This will be needing for marginal costing approach. Why? Because marginal costing says fixed cost doesn't make sense if it is represented on a per unit level. Convert it into total value and remove it. That's all. Contribution minus fixed cost. Bulk figure only. No per unit and all. Clear with this, guys? No. The opening and closing stocks consisting of both fixed goods and equivalent units of WAP are as under. So they have given it here. Quarter wise, they have given us how much is the opening stock, how much is the production, how much is the closing stock, and how much is the sales and closing stock. Quarter wise data is given. Clear with this, guys? Clear with this, guys? Now, they have asked us to prepare a quarter wise profitability statement under marginal costing and under absorption costing. Yes, shall we get started with this? Shall we get started with this? Right? Done? Shall we do this, guys? Right. Now, first, let us do it under the marginal costing income statement. Now, marginal costing income statement, how it looks like, we all know. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Right? But till now, we didn't see any kind of stock adjustments and all. So, when stock comes in, how do you prepare? The base is the same, but there are some extra things that need to be taken care of for your stock adjustment. Right? So first, what do you have? The sales figure. The sales figure will be what? The respective month's sales units, the respective quarter sales units multiplied by the selling price. So you will be having the sales value. Correct, guys? Yes. So from my sales, right, I need to reduce the variable cost. When I say variable cost, not the entire variable cost, the variable cost incurred in respect of units sold. Matching concept only, no? Guys, correct? So sales minus variable cost gives me contribution, correct? But what variable cost will I reduce? Variable cost incurred in respect of units sold only. Clear with this? How will I arrive at the variable cost of goods sold? Very simple. Opening stock plus my variable cost of production minus closing stock. If you look at this, this is my FG, right? If I want to calculate the value of my cost of goods sold, say opening stock plus the current period cost of production minus closing stock. If I adjust for these three, only then I will get my cost of goods sold, correct? But remember, we are in marginal costing area, so which means all these units are only valued at variable manufacturing cost. Hence, I use the word opening stock plus variable cost of production minus closing stock. So, variable cost of production means what? Every unit is valued at 4 rupees. Are you clear with this? Are you clear with this? Sir, are you ignoring this 2 rupees, sir? No. 2 into 26, I take it as 52,000. 52,000 will come and hit in bulk. After my contribution, I have minus fixed cost. There I will adjust. I will not unitize it, because if I unitize it, a part of it will enter into the stock valuation and escape to the next year. That I don't want to do. Are you clear with this, guys? Right? So now what happens? The respective number of units are there. So here, opening stock, quarter wise, it's there. So whatever is the number of opening stocks, right, multiply that with 4. Opening stocks are also valued at 4 rupees. Even if there is a closing stock, that is also valued at 4 rupees only. All the units are valued at 4 rupees only. So here, if you see the production and all, so 4 into 26,000, that gives you how much? 1,04,000, right? Here into 30,000 gives you how much? 1,20,000. Then into 24,000 gives you 96, and into 30,000 gives you 1,20,000. Basically what you do, opening stock plus variable cost of production minus closing stock. If you do quarter wise, you get what? Variable cost of goods sold. Are you clear with this, guys? Variable cost of goods sold. Are you clear with this? So now sales minus my variable cost of goods sold. Sir, it gives me contribution. I call it as gross contribution. Why, sir, is it gross contribution? It is not net contribution, because now we have only considered the variable manufacturing cost. There could also be some variable cost on the selling side and the admin side, correct? No? Even AOH and SOH could be having some variable component. That's why I'm calling this as gross contribution. From here, I will subtract the variable admin and selling. Right? In this question, it is not there, but I am preparing the format and I'm giving you. Clear with this, guys? If there is a variable admin and selling, remove that also, you get the net contribution. Are you clear with this, guys? Are you all able to understand this? You will get the net contribution. Clear with this, guys? Now, from here, reduce the fixed cost. Sir, what fixed cost, sir? Whether it's going to be POH, or is it going to be AOH, or is it going to be SOH? I am not bothered. Fixed means period, always. Right? Irrespective of the location, take all the fixed costs and knock it off here. Are you clear with this, guys? Are you clear with this? In our case, quarter wise, it's going to be 52,000. AOH and SOH data is not given. If that is given, you can also add it up here. Clear with this, guys? You reduce that also, you will end up with a quarter wise profit, which is being reported as 52,000, 44,000, 60,000 and 76,000. Clear with this, guys? Clear with this? This is the way to do it. Are you all able to understand this? Are you all able to understand this? Right? Right? Now, suppose we are doing the same question under the absorption costing system. Now, what do? Under absorption costing system, every unit is valued at full manufacturing cost. That is 6 rupees fully. Right, guys? Basically, this is nothing but this 2 rupees is nothing but the absorption rate. Correct? No? Yes, they would have used the absorption rate and arrived at the fixed cost per unit level. Clear with this, guys? So now, what would have happened? So you have the same sales figure. Now here, what will I do? From sales, I reduce my cost of goods sold. How do you do that? Opening stock plus the full cost of production minus closing stock. Here, I value all the units at 6 rupees. Are you clear with this? So multiply the respective units with 6 rupees. You will get what? You will get what? You will get sales minus cost of goods sold gives you your gross profit. This is like your trading account. Are you clear with this? From your gross profit, you reduce your selling and admin. Selling and admin, whether it is variable or fixed, both will come. Variable and fixed, both will come. Here, we are following absorption costing system. We don't bifurcate variable separately, fixed separately and all, arrive at contribution. No. So, after gross profit, right, all the variable and your fixed selling and admin overheads will be coming here, right? And one more adjustment is required, which again many students miss, is under or over absorption. Sir, in this question, will there be an under or over absorption? Yes, of course there will be. Of course there will be. Now, look at this. In this question, what have they given? The absorption rate of fixed overheads is how much? 2 rupees. Correct, no? 2 rupees per unit, right? So which means 2 into 26,000 is going to be 52,000 rupees was the budgeted fixed overheads. Correct, guys? Budgeted fixed overheads. Now, in the question, have they given how much was the actual fixed overheads? It is not given in the question. If nothing is given in the question, you can take that as the actual fixed overheads. Also, you can assume that budgeted fixed overheads is equal to actual fixed overheads. Clear with this, guys? Right? Now, when budgeted fixed overheads is equal to actual fixed overheads, will there be an under or over absorption? Will there be an under or over absorption? Guys, will there be an under or over absorption? Yes, there could be, because under or over absorption is a comparison between absorbed overheads and my actual overheads. It is not between budget and actuals. Are you clear with this? Now, in this case, can you calculate the absorbed overheads? Yes. Every unit I absorbed 2 rupees, and month wise I know actual number of units of production is 26,000, 30,000, 24,000 and 30,000 respectively. Correct, guys? So now what will I do? I will calculate under or over absorption. Actual overheads is 52, 52, 52, 52. Absorbed overheads will be month-wise units produced, the quarter-wise units produced into 2 rupees. So I will be getting the figures respectively. So now for first quarter, there is no under or over absorption. Second quarter, what has happened? Actual overheads is 52, but I have accounted how much? 60,000. So now what has happened here? There is going to be an 8,000 rupees of over absorption. Are you clear with this? Which means what? I have accounted for 60,000 rupees of overheads. Ideally, I should have accounted for only how much? 52,000. So now what should I do? I should add back 8,000 rupees to my profit. I have already accounted for more cost. Reduce your cost. If you reduce your cost, your profit will increase. So add back this 8,000 in Q2. Are you clear with this? In Q2, I added back. Now what happens here in Q3? You should have accounted for 52. Till now, you have only accounted for 48. So now you go and further include a cost of 4,000. If you further include a cost of 4,000, your profit will reduce by 4,000 now. That's why they have put it within the bracket. Clear with this, guys? And in the fourth quarter, you should have accounted for 52,000. That's your actual, but you have absorbed 60,000. You have considered a cost of 60,000 rupees. So now what has happened here? Now you have over absorbed. You have already accounted for a more cost of 8,000. Now reduce your cost by 8,000. Or in other words, a reduction in cost will only increase your profit. Your profit should stand increased by 8,000 rupees. Are you clear with this, guys? Are you clear with this? So now, having considered all these things, now you find out that your overall profit under your absorption costing system is going to be 52,000, 56,000, 52,000 and 72,000. Are you clear with this, guys? Any problem here? Any issues here? Right? Now comes the most interesting part of this entire discussion. That's the final part of it. Now the profit under absorption costing is 52, 56, 52 and 72. Right? Now, what is the profit under marginal costing system? It is 52,000, then 44,000, then 60,000 and 76,000. Right? Now what happened? Why is there a difference in profit reported under the absorption costing system and the profit reported under the marginal costing system? Can anyone tell me? Why is there a difference between the profit reported under the marginal costing system and under the absorption costing system? Can anyone tell me, guys? Can anyone tell me why is this happening? Yes, Ramya, can you tell me? Yes, Bharat, anyone? Tell me, guys. Yes, you can even use the chat box. Come on, tell me. Why is there a difference in profit reported under the marginal costing and the profit reported under the absorption costing? In both the methodologies, the units sold, everything, units produced, stocks, everything was the same, right? Cost also didn't change. But what happened here? What happened here? Now, some of you might be thinking it is because of under or over absorption. Under or over absorption? Absolutely not. Yes, very good, right? So yes, it is because of the fixed cost. Now let me come to it. If some of you are thinking it's because of under or over absorption, it is not right, because in marginal costing, what we do, we have no concept of absorption, right? Directly, whatever is the actual fixed cost, that hits my P&L, correct? In absorption costing, what we do, we first absorb something, right? That is different from actual, but at the end of the year, we match it with the actual by doing an under or over absorption. So technically speaking, even in absorption costing, finally the fixed overheads that has entered into my profit and loss statement is also actuals here. Are you clear with this? So it is not the under or over absorption that causes the difference in profit. Then what is the reason for the difference? The reason for the difference between the profit reported under marginal costing and absorption costing is wholly and solely the fixed cost lying inside my net stocks. The fixed cost lying inside my net stock. So what do you mean by that? Now, you see here, always absorption costing, right? In our example, values every unit of stock at 6 rupees, whereas marginal costing values every unit of stock at just 4 rupees. Correct, guys? Right? Now, what happens is, right? Let us say I am having a closing stock. I am having a closing stock here, right? In a particular question, I'm having a closing stock. Now, what happens? This closing stock, let us say I have 1000 units, right? Each of these 1000 units are valued at 6 rupees by absorption costing, whereas they are valued at only 4 rupees by marginal costing. This closing stock is on the credit side, correct? So if there is a closing stock, what happens? Obviously, the credit side will be more under absorption costing, because of which the profit under absorption costing will be greater than the profit under marginal costing, correct? Suppose instead of this, I am having an opening stock of, let us say, 1000 units, right? Each of these 1000 units will be valued at 6 rupees under absorption costing and 4 rupees under marginal costing. Anyways, whether it's on the opening stock or on the closing stock, the stock valuation will be done higher by absorption costing system as compared to marginal costing system. It depends on which side it is. If you are having a net closing stock, right, then marginal costing will be reporting a higher amount on the credit side, and hence your absorption costing will be reporting a higher amount on the credit side, and hence absorption costing will be reporting a more profit. If there is a net opening stock, right, more the debit side, it means what? Obviously lesser will be your profit. Now absorption costing will be reporting a lesser profit. Or in other words, now in this scenario, if you see in our example, in the first case, what happened? How much was the opening stock? 0. How much was the closing stock? That was also 0. So the net stock was 0. Opening, closing, both adjusted together, it was 0. Since there was no stocks here, if you notice, the profit reported under the absorption costing and marginal costing was the same. Are you clear with this? Now, in the second situation, what has happened? Do I have an opening stock? No. Do I have a closing stock? Yes. I had 6000 units as a closing stock, correct? Now, closing stock is on the credit side, correct? And absorption costing values every unit at 2 rupees more. Correct, no? So 6000 into 2. So absorption costing has a higher amount of 12,000 rupees on the credit side, because of which, to the extent of 12,000 rupees, absorption costing's profit will be more. That's why marginal costing was 44, right? The absorption costing's profit was 56. Are you clear with this, guys? Are you able to understand this? Similarly, in the third quarter, what has happened? There was an opening stock, right? Opening stock of how much? 6,000. There was a closing stock of how much? 2,000. If you see net of the two, there was a net opening stock of 4,000 units. Correct, guys? Right? And each of these 4,000 units would have been valued more. Always absorption costing only values more by 2 rupees, right? 4,000 into 2, 8,000 rupees. The debit side was more in absorption costing by 8,000 rupees. So more the debit side, it means what? Lesser will be your profit. So now your absorption costing will be reporting a lesser profit to the extent of 8,000 rupees. So look at this. That is the reason why absorption costing was reporting only 52, while marginal costing was reporting 60,000 rupees. Are you clear with this, guys? Are you all able to understand this? And finally, if you see, I think that is also another scenario. Yes, you have what? An opening stock of 2,000, a closing stock of 0. Once again, this fourth quarter is also a scenario where you have a net opening stock. So 2,000 into 2. 4,000 rupees more on the debit side, which means a lesser profit as per absorption costing. So absorption costing would have reported a lesser profit to the extent of 4,000 rupees. Look at this. Absorption costing has 72,000 rupees of profit, whereas your marginal costing is reporting a 76,000 rupees of profit. This is what we have reconciled here. Are you clear with this? We have taken opening stock, we have taken closing stock, and we have taken the net stock. Are you clear with this? If I'm putting net credit, it means that it is lying on the credit side. That is, there is a net closing stock. This case, the third case, is going to be a net opening stock, right? And the fixed cost sitting inside the next net stock is going to be 2 into the net stock. Are you clear with this? So this is going to be the reason for the differences between your absorption costing and your marginal costing profit. Are you all able to understand, guys? Are you all able to understand? This has been explained here as a conceptual, as a concept point. Just a minute, let me just show this. Look at this. Have they given it anywhere here? Okay, I don't think it's been mentioned. Okay. Now let me just write a conclusion here. Please write it down if you want. Now, yes, when opening stock is equal to closing stock, right? So the marginal costing profit is equal to absorption costing profit. Correct, guys? Correct, guys? Or let me just put it, let me keep absorption costing as the base. Absorption costing profit is equal to marginal costing profit, right? Or when there is no opening stock and closing stock, even then my absorption costing profit is equal to marginal costing profit. That is, there is no net stock. No net stock can be can happen in a scenario when you don't have any stocks, or when your opening stock is exactly equal to your closing stock. Clear with this, guys? Suppose my opening stock is greater than my closing stock. That is, now my debit side is more in your absorption costing. When the debit side is more, the profit will be less. What happens? The absorption costing's profit will be lesser than the marginal costing profit. Why? Because absorption costing always has higher only, right? That higher you should see whether it's on the debit side or the credit side. If there is a net opening stock, absorption costing will be having a higher debit side, which will report a lesser profit. Suppose if the closing stock is greater than the opening stock, now absorption costing has a higher credit side, which will increase its profit. So absorption costing's profit will be greater than marginal costing profit. Are you clear with this, guys? This is the conceptual understanding of the differences between your absorption costing and marginal costing. Are you all able to understand this? Are you all able to understand this, guys? Yes? You guys have got this? You guys have got this? Right? And that is about this entire chapter. We have taken about 4 hours approximately, right? And we have covered almost the entire chapters. I mean, the revision, obviously it was revision, because in our regular lectures, as I told you, we'll be doing more than about 35 numerical problems will be done, along with detailed explanations for every single concept. But here we have touched upon all the major aspects. There are even some small aspects that we generally cover in the regular batch, but of course in a revision we can't cover everything, but the maximum extent possible that has been covered here. And I hope you guys are also clear with all the concepts that we just finished. Fine, guys, right? And with that, we are concluding with this particular chapter called as the mighty marginal costing, right? Have we left out anything? Can you guys just check and let me know? Have we left out anything? I hope I've covered everything. All the concepts mentioned. Let me just see. Yes, I think yes, I've just ticked up everything. Yes, guys, and that's about this chapter. Please don't fall into the trap of mugging it up. Marginal costing is an absolute beauty. It's an absolute beauty. So now, guys, have you all understood it? Are you all getting the confidence in this chapter? Are you all getting the confidence in this chapter? Please use the chat box. Right, please use the chat box. Tell me, let me know, are you all getting the confidence in this chapter? Is there even a single formula to be mugged up? Absolutely not. There is not even a single formula to be mugged up, right? Please tell me, guys, are you all clear with this, right? Even if you are later on watching it on a recorded mode, please use the comment box or on the comment section. Please tell me whether you have understood this or not, right? Fine, guys. Fine, guys. I hope you found this very useful. Fine. Done. Great, guys. Great. It's good to know. It's good to know that you guys are getting a lot of confidence in this. Superb. Great. Fine, guys. Done. Now let's move on to the revision of the next chapter, which is overheads. Now, to give a backdrop of this chapter is slightly big as compared to the other chapters, and this forms the core of the absorption costing, right? So now in this particular revision that we are going to do, I will be touching upon the major aspects of this overheads chapter. So definitely covering the entire overheads chapter is not possible. So the major aspects of overheads chapter will definitely be covered, right? And from an examination perspective, the never miss areas, I will just recapitulate it. Clear with this, guys? So this is going to be the agenda for the chapter overheads. Now, in this chapter, broadly, these are the 5 things that we're going to discuss. One is the concept of semi-variable overheads. Then we'll be doing the concept of primary and secondary distribution. Then about the absorption costing. Then 2 relative areas called as capacity determination and Machine-hour rate problems. These are 2 allied areas, right? And we will also be doing a few numerical questions in this particular segment. Fine, guys. Now first, let us start this chapter off with a standalone area called as semi-variable overheads. Now, this semi-variable overheads, what is it? Now, if you see, costs can either be a fixed cost or a variable costs, right? As you all know, what is a fixed cost? A cost that remains constant in total. For example, and a very good example regarding this could be your factory rent. Let's say I'm paying a monthly rent of 1 lakh rupees to my landlord. This rent is not going to change depending on how many units I produce, right? So whether I produce 10,000 units or I produce 1 lakh units, now the rent as such is going to remain the same. Yes, guys, right? So this is an example of fixed cost. Now, what is an example of a variable cost? Example for variable cost would be material cost, right? So in this case of variable cost, so what do you mean by a variable cost? This cost is incurred only if I produce the next additional unit. If I don't produce an additional unit, the cost with respect to that need not be incurred. For example, let us say for me to produce every unit of a pen, I need to use some plastics that is worth 5 rupees, right? Only if I produce that one pen, I need to incur 5 rupees, right? If I produce 10,000 pens, my material cost will be 10,000 into 5. If I produce only one pen, it will be 1 into 5. Or in other words, variable cost remains constant on a per unit level, right? And it moves proportionately with respect to the volume, whereas fixed cost, no, it remains constant in total. Are you clear with this? This is the basis of cost behavior pattern. Fixed cost remains constant in total and variable cost remains constant on a per unit level. Clear with this? Now, what do you mean by a semi-variable cost? Now, there could be certain costs which are neither constant on a total level nor they are constant on a per unit level, right? These types of costs are known as semi-variable cost. Now, for all the decision making purposes, definitely cost needs to be classified as your variable and fixed component. By the way, guys, the objective of this particular chapter overheads is actually stock valuation profit computation. This chapter is not a decision making area. That's why I said this is actually a separate segment of this chapter, a unique area alone, right? In this particular area alone, we will be seeing the concept of semi-variable overheads. So it's a separate segment in this particular chapter. Once this is done, then the remaining portion of the chapter is going to be interlinked. So this is a separate segment of this particular chapter. Now, for all decision purposes, I was telling you in the earlier session, that is in the cost sheet area, that for all decision making purposes, cost needs to be classified into variable and fixed. Now, there could be some costs which are neither constant on a total level nor they are constant on a per unit level. Now these costs are called as semi-variable costs. Now with the semi-variable cost, I cannot do any kind of decision making. So what I need to do is this semi-variable cost needs to be necessarily segregated into the variable component and the fixed component. Are you clear with this? How do we go about with that is what we are going to discuss here. Segregating the semi-variable costs, right? So in this segment, we are going to see what are the conditions to be met, right? There's something called as high-low point. There's something called as simultaneous equation. And what will you go about, what will you do in case the capacity is given in terms of percentages, right? These are some typical areas where institute is testing. If at all this particular concept comes in, these are the areas that they are testing. Now first, as I told you, fixed cost always remains constant on a total level. The variable cost always remains constant on a per unit level, and definitely two activity levels should be given to segregate your semi-variable cost into your variable component and fixed component. A typical example. Now, what they are saying is, when I'm producing 5,000 units, my repairs and maintenance cost is how much? 24,000 rupees. When I'm producing 8,000 units, my repairs and maintenance cost is going to be 36,000 rupees. Now, first, tell me whether this cost is a fixed cost. Tell me whether this cost is a fixed cost. This cost is clearly not, one second. So this cost is clearly not a fixed cost because it is not constant in total, right? Clear with this? Clear with this? Now, can I say this this cost is a variable cost? For that, I need to arrive at the per unit cost. So now look at this at 5,000 units level. What is the per unit repairs and maintenance? 24,000 divided by 5,000, that gives me 4.8 rupees. Whereas at 8,000 units level, it is 36,000 divided by 8,000. That is going to be 4.5 rupees. Now, if you observe here, this repairs and maintenance cost is neither constant in total nor is it constant on a per unit level. Now, this is a clear-cut case of a semi-variable cost. Now, what am I going to do in a semi-variable cost? I need to necessarily segregate it into variable component and fixed component. Sir, how will you do that, sir? See, clearly we can understand that in repairs and maintenance, some portion is fixed, some portion is variable. So, put together only this repairs and maintenance is there. Clear with this? Now, if I mix the two and all, I can't take a meaningful decision out of it. Hence, it necessarily needs to be segregated into variable and fixed component. How are we going to do that? Logically, you tell me, repairs and maintenance cost is 24,000 rupees if my production, my volume is going to be 5,000 units. If I increase the volume by 3,000 units, right? What happens? My repairs and maintenance cost increases by how much? It increases by 12,000 rupees. Correct? It increases by 12,000 rupees. From 24, it becomes 36, right? Now, can I say that this 12,000 rupees increase is nothing but the variable component pertaining to the 3,000 units? Correct or not? Yes, this 12,000 rupees. See, overall, this repairs and maintenance has both fixed as well as variable element in it. Now, if my repairs and maintenance cost is increasing, right? Because I'm increasing my output, it is purely because of the variable component sitting inside it. Or in other words, I can say that this 12,000 rupees is nothing but the variable costs pertaining to this incremental units of 3,000. So technically, what is my variable cost per unit? 12,000 divided by 3,000. I would say that the variable cost per unit is 4 rupees. Are you clear with this? Now you take any one output level. Now at 5,000 units output level, what is my repairs and maintenance? 24,000 rupees, correct? Right? And we know that this 24,000 rupees of repairs and maintenance has a variable component as well as a fixed component in it. So this 24,000 rupees is equal to, right? The variable component is how much? 5,000 into 4. That's going to be 20,000 plus the fixed component inside it. So now we can find out the fixed component. The fixed component is going to be 24 minus 20. 4,000 rupees. Are you clear with this? Or in other words, I can say repairs and maintenance, the variable component is 4 rupees per unit and the fixed component is 4,000 rupees in total. Are you clear with this? Now using this, I can take any kind of meaningful decisions. Are you clear with this? Now look at this. This is called as a high-low point. What is a high-low point? When they have given a semi-variable cost, necessarily they need to give two data, that is the semi-variable cost pertaining to two output level, needs to be definitely given. Only then you can do it. Now what do you do here? The variable component you will find out by using this formula, delta total cost divided by delta units, or in other words, there's nothing but the change in total cost divided by change in units. If you do that, you will get the variable cost per unit of 4 rupees. Now what will you do? You go to any one output level, right? So the total cost minus the variable component gives you the fixed component. If you see here from the lower point, so 24,000 was the total cost, minus of 4 into 5,000, the variable component gives you the balancing figure of fixed cost. Are you clear with this? So this is how you segregate your variable, you segregate your semi-variable cost into variable component and fixed component. And now with this, you can try to prepare the cost levels for any output. Are you clear with this, guys? Are you clear with this? So always remember, costs for all decision making purpose needs to be represented either as a fixed cost or as a variable cost. Clear with this? If there is a semi-variable cost, segregate it into fixed and variable component, and the variable cost always makes sense only if it is represented on a per unit level. Fixed cost makes sense only if it is represented in total. Are you clear with this, guys? This is called as your high-low point. Similarly, the very same sum can also be done using something called as simultaneous equation method. How will you do it? Very simple. Total cost is equal to variable cost plus fixed cost. Correct? No? Right? Because this semi-variable cost has a component of variable as well as a component of fixed in it. So you say that let the variable cost per unit be A and the fixed cost in total be B. Okay, so two variables we are taking. You frame an equation. This 24,000 rupees of the repairs and maintenance cost is nothing but 5,000 units into the variable cost A. So 5,000 A plus B. Correct. Similarly, this 36,000 rupees for the second output level is going to be 8,000 A plus B. Are you clear with this? So now you have framed two equations. Solve the equations for the A value and B value. A value is going to be your variable cost per unit and B value is going to be your fixed cost. Are you clear with this? These are different methods in which your overall semi-variable cost can be classified into variable and fixed. Sir, why are we seeing all these things in this particular chapter of overheads? Because generally the semi-variable cost and all actually fits into the category of overheads. Generally, your other items, other indirect expenses will only be semi-variable in nature. Technically speaking, these are a part of your flexible budget area. These are a part of your flexible budget area. That's why I said this particular segment of discussion alone is ideally not a part of the score of overheads chapter, because whatever we are going to see from now on in this chapter, like primary distribution, secondary distribution, absorption, it has a completely different objective to achieve. Are you clear with this, guys? Fine. And in case they have given it in terms of capacity, you know, the production, the output volume can be expressed either in units or in capacity. Suppose they have given this capacity. Let's say they have given for at a 30% capacity, my total cost is 23,000. At a 70% capacity, my total cost is 43,000. If they have given it like this, then using capacity levels also you can do it by taking an assumption and all. They have just said here, let 100% capacity be 100 units. In that case, a 30% capacity is going to be 30 units. A 70% capacity is going to be 70 units. Now with this, what will you do? You have two levels. You have two levels of cost. You have two output levels. So now the segregation will be the difference in my total cost divided by the difference in units. You'll get the variable cost per unit. That is what they have done here. Delta total cost divided by delta units. They have arrived at the variable cost per unit. Now you take any one output level. There you take the total cost. From that you subtract the variable component. So here they have taken, yes, the first part, 23,000, that is the total cost, minus the variable component is what? 30 units into 500, the variable component. The balancing figure is going to be your fixed cost. So now with this, they can find out that the variable cost per unit is 500 rupees and the fixed cost in total is going to be 8,000 units. Are you clear? 8,000 rupees. Now, if you have the data like this, now for any output level, you can arrive at the repairs and maintenance cost, because now you have the variable component and the fixed component readily with you. Are you clear with this, guys? This is the concept of segregating your semi-variable cost, and that is a separate matter of discussion in this chapter. It's ideally a separate area by itself. Clear with this, guys? Right? Now park this concept aside. Now is when we are going to enter into overheads. Clear with this? Shall we get started? Shall we get started here with this particular segment of overheads, the core of overheads? Now only we are going to get started. So now the first part is a standalone discussion. It's been done now. Now is when we are going to start off with this chapter of overheads. Clear with this, guys? Shall we get started? Shall we get started? Come on, guys. Come on, use the chat box. Yes, guys, participate. The Google Meet, guys. Now turn on your cameras. Do I need to tell you, guys? Come on, guys, turn on your cameras, please. I tried my level best to do this VC as well. So please, guys, it's only for you. It's only going to benefit you. And it also gives me a motivation that yes, people are actually interactive, right? So that's the reason, that's the whole purpose of it. Okay, and don't worry, the YouTube guys, I am constantly checking the comment box, the chat box, do not worry, right? So yes, okay, fine. Great, guys. Now let's get into this chapter. Now, guys, full attention. One of the core discussion is what we are going to do here. And trust me, it's not an easy thing for a faculty as well, because this is slightly a big chapter. I'm going to condense it and put it in such a way that whatever limited thing that we are learning here in this revision, that also gives you a value addition, because I don't want to just do something for the sake of it. And no, that's not the point here. You have assembled here, so you guys have given me the responsibility over your time. So please make sure that you are also making the best use of it. Now, this chapter, overheads, the second one. Right. What is this chapter all about? Now, this chapter helps you achieve the objective of stock valuation and profit computation. As I told you earlier, our subject has three objectives: stock valuation, profit computation, decision making, and control. And this chapter helps you achieve the objective of stock valuation and profit computation. Sir, how, sir? We saw in the cost sheet discussion that every unit of stock is valued at full manufacturing cost, or in other words, every unit of stock is valued at direct material plus direct labor plus direct expense and your production overheads. Correct, guys? Full manufacturing cost. Your AOHs and SOHs are period cost, P&L items, whereas these four are your trading account items used to value every unit of stock. Clear with this, guys? So now, whenever I am actually valuing my stock, I need to know what is the per unit cost of direct material, what is the per unit cost of direct labor, what is the per unit cost of direct expense, and what is the per unit cost of POH. Now, guys, direct material, direct labor, and direct expense, these are called as prime cost components. You guys know this, right? We just did it right now. Prime cost components. Now, I don't have a problem with prime cost components at all. Why? Let us say I am producing 1 unit, right? Whatever it is. For every unit of pen that I manufacture, right, I know exactly for 1 unit of pen how much amount of material is required, right? And what is the material cost per unit of that material also. Or in other words, my direct material, direct labor, direct expenses, my prime cost components are readily traceable and available on a per unit level. Agreeing with me on this or not? Yes. But the problem lies with my production overheads. Why? Production overheads by nature are indirect manufacturing costs. These are the indirect costs incurred inside the factory. I do not know on a per unit level, I do not know how much is the production overheads incurred. Correct, guys? Agreeing with me on this, right? These are items of costs that are incurred in bulk. These are items of costs that are incurred in bulk. Like, for example, an example of production overheads will be your factory rent, your repairs and maintenance, your supervisor salary, your depreciation, right, etc. There could be 20, 30 line items of expense. Now, Now, how can I trace them on a per unit level? I don't incur them on a per unit level. Are you agreeing with me on this or not? Now, in this chapter, now overall to achieve the objective of stock valuation and profit computation, I need to have the manufacturing cost per unit. Are you clear with this? Only if I have the manufacturing cost per unit, I know how to value every unit of my stock. So number of units lying in my stock into this manufacturing cost per unit, I can arrive at the stock valuation and achieve the objective. Now, for me to arrive at the manufacturing cost per unit, I don't have a problem with respect to the prime cost components because they are readily available on a per unit level. The problem lies only with respect to my production overheads. So the overall objective of this chapter is to calculate the overhead cost per unit. Are you clear with this? Only if I calculate the overhead cost per unit, I will be able to arrive at the manufacturing cost per unit. Only if I know the manufacturing cost per unit, I can achieve the overall objective of stock valuation profit computation. Are you getting the chain link here? Clear with this? So the immediate objective here is to calculate the overhead cost per unit. Agreeing with me on this or not, guys? Yes, you are all able to understand this. Now, sir, what is the big problem? What is the big problem, sir? You said you have line items, so many line items. These are all indirect costs, not readily traceable on a per unit level. We also understand that, but what is the problem? You collect all the costs, take the total overheads, right, divided by the number of units produced, you get the overhead cost per unit. No, matter solved, right? Why do you have to keep a separate chapter and make our life miserable? Guys, are you clear with this? This would be your next question. Take the total overheads, right, divided by the number of units produced, right, arrive at the overhead cost per unit. You said the objective of this chapter is to calculate the overhead cost per unit. Yes, we have found it like that. What is the big deal? Now, let me give you an example just to tell you why this could not work out like it. Let me give you an example to tell you why this could not work out like the way you just told me. Now, let us say I'm a company called Titan. Have you all heard Titan? Right? Tata's, it is in Tata Group. Right? By the way, Titan's stock has shot up like anything. That is FM topic. Coming back here. Now, Titan is in the business of manufacturing what they are in the business of manufacturing. The famous thing that they are known for is watches. Right? Not just watches. They also manufacture your eyewears, your eye gears. You know that, right? So Titan Eye Plus, they have a separate chain of stores there. So eye gears, right? And let us also say they also manufacture wallets. Example, clear with this, guys, right? Now, what has happened is, let us say in a same factory, using the common factory in a single factory, what they have done, they have manufactured 10,000 watches, right, 20,000 eye gears, right, and then they have manufactured 30,000 wallets. Are you clear with this, guys? Are you clear with this? Now, let us say overall in this entire year, they have incurred an overall total overheads of 6 lakh rupees. Overheads totally incurred was 6 lakh rupees. Now, you tell me this 6 lakh rupees, right? If I were to follow whatever you just said, so take the total overheads divided by the total number of units. So in that case, overheads divided by number of units, overheads figure, the numerator I have 6 lakh rupees. What will be the denominator? Can I say the denominator is 10,000 plus 20,000 plus 30,000, 60,000? Absolutely not. Now you tell me this is 10,000 watches. This is 20,000 different product altogether, eye gears, and 30,000 wallets, further another different product. Now these are dissimilar items. This is like asking 4 monkeys 5 plus 5 donkeys is equal to how much, right? You can't add dissimilar items. Are you clear with this? Are you clear with this? In this case, the denominator itself is indeterminate. Now don't tell me, sir, 6 lakh rupees are apportioned in the ratio of 1:2:3. What is the basis? What is the basis? Watch could be a high value product, right? A gear, eye gear could be a completely different product, and wallets, the cost consumption pattern itself could be different. You can't directly jump to the conclusion by saying add up everything and you just include it here. No, first of all, the denominator itself is indeterminate here. Are you clear with this? Are you clear with this? And hence this is one of the reasons, and hence it is not as simple as taking up your total overheads, dividing it by the total units, right? And then arriving at the overhead cost per unit. No, it doesn't work like that. Are you clear with this? This is the reason why we are having a separate chapter called as overheads. And in this chapter, whenever I use the word overheads, predominantly it refers to production overheads. Why? Because only the production overhead cost needs to be broken into a per unit level. This issue is not there for AOH and SOH. Why? They are anyways period cost. They are not considered for stock valuation. P&L items, it hits your cost sheet in bulk. It hits your P&L in bulk. Are you clear with this, guys? So clearly understand the word overheads generally means POH plus AOH plus SOH. But about 95 to 98% of this chapter revolves around production overheads only. Are you clear with this? First understand this, right? So whenever in the context of this chapter, I am using the word overheads, you understand that I am referring to production overheads. Clear with this, guys? Clear with this? Now, first you understood the objective of this chapter, number one. Number two, why we have the separate chapter, why are we studying it separately, and why is it not directly like, taking the total numerator divided by the denominator. Yes, you guys are able to follow this? Yes, guys? Now, coming to the core of discussion. Sir, now what is the solution, sir? On one side, I have some multiple line items of expenses, correct? These are some bulk expenses. And on the other side, I have multiple products, and each of these products I need to calculate the overhead cost per unit. So the ultimate objective of this chapter is what? To calculate the overhead cost per unit of watch, overhead cost per unit of eye gear, overhead cost per unit of wallet, correct? No, I am dealing in multiple products. Product wise overhead cost per unit I need to find out. Are you clear with this? Right? Sir, how are we going to bridge the gap? On one side, we have the bulk items of expenses, and on the other side, we need to arrive at the overhead cost per unit of each of the components. How are we going to do this? Using a three-step procedure. What are the three-step procedure? The first step is called as primary distribution. The second step is called as secondary distribution, and the third step is called as absorption. Are you clear with this? And these three steps put together is only called as absorption costing system. Are you clear with this, guys? Are you clear with this? Right? This is the basis. This is the basis and the reasoning why you are learning this particular chapter. Clear with this, guys? Right? So the three-step roundabout procedure called as absorption costing system. What are the three steps involved? First, you do something called as a primary distribution. Then you do something called as a secondary distribution, and then you do something called as absorption. At the end of this three-step process, what would have happened? Multiple line items of bulk expenditure would have got converted into overhead cost per unit of watch, overhead cost per unit of eye gear, overhead cost per unit of wallet. Are you clear with this? And the entire chapter revolves around how do you do it? And having done that, there are some further more complicated issues. What are they? These are the subject matter of discussion that we're going to see in this chapter. Clear with this, guys? This is a bird's eye view of this chapter. Shall we get started? Shall we get started? Guys, shall we get started? Yes, done. Now, let me give you an example. Right? Let us take an example of this Tirupur cotton belt, right? So, for those who do not know, there is a place in Tamil Nadu called Tirupur, which is known for its, textile industry, right? You take world-class top big companies like Arrow or Alan Solly or any big companies that claim themselves to have high-quality products. At the end of the day, predominantly, if they are doing business in India, they would have been manufactured in Tirupur. So technically, you are paying more for the brand and not for the product. Coming back here, so Tirupur belt, world class. You should see how they are doing it. You will even get a low quality product and you will even get a top quality product. They have multiple ranges. You will be mind blown, right? That is the level of this textile the depth of textile industry that we have here, something that we all need to be proud of in this, entire the country needs to be proud of. Anyways, coming back here, let us take an example of that. Now, what happens? Now, let us say first I have the line items of expenses. So, let us say I have your factory rent. Then I have supervisor salary, right? Then I have repairs and maintenance. Then I have depreciation of plant and machinery, right? All these things I am just having, let's say, power expense. So I have multiple line items of expenses. Now, first step of this absorption costing system is what? Primary distribution. What does primary distribution say? Now, let us say this particular company, what company? The textile manufacturing industry. Let us say they have the following departments in their organization. They have the following departments in their, in their factory. Let us say they have a spinning department. Then they have a weaving department. Then they have a printing department, right? And apart from that, they also have a canteen, right? And they have stores department. Clear with this? Now if you see the spinning department, I call it as P1 for our discussion. Weaving department, I call it as P2. Printing department, I call it as P3. Canteen department, I call it as S1. And stores department, I call it as S2. Sir, what is this P series and what is this S series? I will tell you. Now, if you see, typically in a textile business, first they will take the raw cotton, they will first spin and take the thread out of it. That is the spinning department. Having taken that thread, it needs to be woven, right? Based on whatever you want, maybe a sari or maybe a shirt or maybe a pant or whatever it is. That happens here in the weaving department. And once the weaving is also done, it needs to be printed. The color dyeing that you want, the pattern that you want, that needs to be done. And that's about it. Then the final product is over. Clear with this? So these three are the departments through which every product will get passed by. Clear with this? So the departments through which the products passes by are known as production departments. That's why I'm calling this as P1, P2, P3. Are you clear with this? Now in the factory, these three are not the only departments. They also have a canteen department to provide food to all the workers working in the factory. Similarly, they have a stores department to handle all the raw material and all. Now, my production does not get routed through these two departments, but these two are the departments which support the production departments. These are called as service departments. Are you clear with this? So clearly understand, in a factory, there will be production departments and service departments. Production departments are the departments through which the products will pass through, and the service departments are the departments which are meant for assisting the production departments. Are you clear with this, guys? Now, what the primary distribution says is, the primary distribution method says is, first, these line items of expenses are there, no? Right? Distributed between all the departments in the factory. Why? Why do you have to distribute it between all the departments in the factory? Because, so this chapter says that the reason for you to incur an expense is because you are having a department. If you don't have a department, you will not be incurring any cost. Are you clear with this, guys? Hence, so what you do is, these line items of expenses are basically incurred because of the presence of department. So you need to apportion all the line items of cost to all the 5 departments. Are you clear with this, guys? The 5 departments are, in this case, there could be 4 departments, there could be 20 departments also. In our example, I've taken 5 departments. Clear with this, guys? Sir, okay, sir, but on what basis will we do? On the basis of benefits derived ratio. Meaning what? For example, factory rent, right? Let us say it's a common cost, right? Of, let's say, 1 lakh rupees. This is incurred by all the departments put together only. No, it's a common cost. What will you do? It needs to be apportioned on the basis of the floor area taken by each of these departments. Clear with this? Similarly, your supervisor's salary, use a reasonable base. Your supervisor's salary should once again be apportioned between all these 5 departments, maybe on the basis of the number of employees working below them in each department, or maybe on the basis of direct wages. Your repairs and maintenance could be on the basis of the capital value of machines deployed in each of these machines, each of these departments. Your power cost may be based on the machine hours consumed by each of these departments. Are you clear with this, guys? Or in other words, first, the primary distribution states that whatever is the line item of expenses, there could be 20, 30 line item of expenses at the end of primary distribution. Each and every line item of expense should be apportioned between all the departments using a reasonable basis. Are you clear with this, guys? At the end of primary distribution, what would have happened? So 20 line items of expenses will now be reduced to just 5 line item of expenses. Are you clear with this? Right? Because now at the end of primary distribution, you will only be having P1 overheads, P2 overheads, P3 overheads, S1 overheads, and S2 overheads. And each of these overheads will be having a share of all the 20 line items based on the benefits that they have taken. Are you clear with this, guys? Now 20 line items got reduced to just 5. Are you clear with this, guys? Yes. Now at the end of primary distribution, right, now comes the second step called as secondary distribution. Now what happens in a secondary distribution is that, now what secondary distribution says, okay, now at the end of primary distribution, you have only 5 figures, no? P1 overheads, P2 overheads, P3 overheads, S1 overheads, and S2 overheads. Now what secondary distribution says is, look, why do I have the service departments? Why do I have the service department? To support my production departments only. So now, technically speaking, S1 and S2 departments, right, they are meant to serve only the other 3, P1, P2, P3 departments. So they are saying secondary distribution asks the service departments to redistribute their share of overheads back to the production departments, right? So S1 needs to give its share of overheads fully to P1, P2, P3, and stores departments. S2 should also do the same. So that is, the secondary distribution says the service department overheads should be redistributed back to the production department. Sir, on what basis, sir? On the basis of services rendered ratio. Services rendered ratio. I will tell you what it is. For example, canteen, the services rendered will be on the basis of the number of employees sitting there. Correct? No? Right? So canteen, what does a canteen do typically? They provide food to all the staff. Are you clear with this? Right? So the canteen's cost, S1 department overhead, should be redistributed back to P1, P2, P3 on the basis of number of employees. Are you clear with this? Whereas a stores department, so it's basically, this department handles all the materials and all that. So it needs to redistribute S2 department's overhead back to the production departments, maybe on the ratio of using the basis of the number of requisitions raised in a particular year, or maybe the material handled by each of the department. Some reasonable basis will be there. Are you clear with this, guys? Are you clear with this, guys? Are you clear with this? Yes. Now at the end of secondary distribution, what happens? The 5 figures will now get further reduced to just 3 figures. So now you will be having only P1 overheads, P2 overheads, P3 overheads. But guys, mind you, the total remains the same. The total remains the same. Obviously, the total will remain the same. The number of line items alone will reduce. If you add here the 20 line items, whatever is the total, that total will be equal to the total of P1 plus P2 plus P3 plus S1 plus S2. Further here also, after secondary distribution, the P1 plus P2 plus P3, it will give the same total only, because the total overheads will not change. Now the department-wise share alone keeps on changing. Are you clear with this, guys? Are you clear with this? So at the end of secondary distribution, now all department overheads now gets converted only into production department overheads. Clear with this, guys? Right? Now comes the third and the most important part called as absorption. So now what they need to do, so this is a textile industry, textile company, right? So now let's say they deal in 4 different products. They deal in menswear, right, ladies wear, kids wear, and let us say they also deal in footwear, right? Now what I need to do at the end of secondary distribution, now I have reduce down all the line items into just 3 line items. I have 3 bulk figures with me, correct? P1 overheads, P2 overheads, P3 overheads. Now this I need to convert it into overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear. Now once I do this, the objective of this chapter is done, and with this I will be able to achieve the overall objectives of stock valuation profit computation. How? Now I got my overhead cost per unit for each of the different types of products readily. My prime cost components are waiting for me on a per unit level, right? Just add the production overheads per unit, you will arrive at the total manufacturing cost per unit. With that you can do the stock valuation, and the entire subject is done with respect to this objective. Clear with this, guys? Now here if you see, I have 3 bulk figures. Now how am I going to convert this into the per unit level? That is the subject matter of discussion in the third phase called as absorption. Clear with this, guys? That is slightly an intricate technique. Clear with this, guys? So overall, this is the big picture of this particular chapter. This is the big picture of this particular chapter. Now if you just go through this particular material, now you will be able to understand this, right? So now yes, the primary and secondary distribution. Okay, so let me just walk you through this. The primary distribution, this is what I told you. See, what happens here is, now there are multiple line items of expenses. There are multiple line items of expenses here, correct? There are multiple line items of expenses here. So all the line items of expenses should be apportioned between what? Should be apportioned between all the departments, production and service, correct? This is called as primary distribution, correct? So at the end of primary distribution, so many line items of expenditure gets converted into all department overheads. Clear with this, guys? Then comes your secondary distribution. What will you do? The service department overheads are redistributed back to the production department. So at the end of secondary distribution, you have what? You have only your production department overheads. Are you clear with this, guys? Are you clear with this? Is everyone able to understand this? Right? Now let me take a small illustration. Let me take a small illustration here. Now you look at this, guys. We will be doing a comprehensive question with respect to this 3-step procedure. Do not worry about it. Now guys, now one more thing I want to tell you, right? This primary distribution is fairly simple. What is primary distribution? The primary distribution is line item of expenditure need to be apportioned between all the departments using some benefit derived ratio, logical basis. Clear with this, guys? This anyone and everyone can do. What does the secondary distribution say? The secondary distribution says that the service department overheads need to be redistributed back to the production department. Clear with this? Now there are different methods of secondary distribution. There are different methods of secondary distribution. This is very, very important understanding. There are multiple methods of secondary distribution. Now, many people know that there are different methods of secondary distribution, but the problem is they do not know that there is actually a rule as to when to use which method. So, if you see secondary distribution, broadly speaking, there are 3 methods. Broadly speaking, there are 3 methods. The first one is called as direct redistribution method. The second one is called as stepladder method. And the third one is called as, yes, reciprocal services method. And under the reciprocal services method, there are broadly 3 methods here. One is called as simultaneous equation method. Then you have something called as repeated distribution method. And finally, you have something called as a trial and error method. One not so good method, but anyways, it doesn't get tested much, but anyways, it's not a very good method as well, right? Clear with this, guys? Now, there are broadly 3 methods I told you: direct redistribution, stepladder, and reciprocal services. And the reciprocal services can be done either using simultaneous equation, your repeated distribution, or trial and error method. Okay. Now there is a rule, right? When to use which of these 3 methods. Basically, these 3 methods under the reciprocal services method will give you the same answer. That is simultaneous equation, your repeated distribution, and trial and error. these three methods will give the same answer, right, under the reciprocal services method. Clear with this, guys? Now, sir, what are we talking about here? The service department overheads need to be reapportioned back to the production departments, right? Now, when to use which method is what we are talking about right now. Are you clear with this, guys? Are you clear with this? Now, look at this. First, let me take an example. Direct redistribution method. That is the first method. Now, direct redistribution method, when will you use it? Direct redistribution method, when will you use it? Let us say I have three production departments, P1, P2, P3, right? Then I have two service departments, S1 and S2. Clear with this, guys, right? Now, in this situation, let us say S1 is a stores department. S1 is a stores department and S2 is a repairs and maintenance department. Clear with this? Now you tell me, a stores department will provide services to the production departments. Correct or not? Yes, guys. Will they provide any service to repairs and maintenance department? No, because stores generally, stores department provides services only where the material movement is there. The material movement will not be there here for S2 and all. Correct, guys? Are you clear with this? Guys? Yes. Similarly, here S2, the service department 2 is a repairs and maintenance department. S2 department also provides services to P1, P2, P3 only. S2 also will not provide any services to S1. Or in other words, wherever there is a situation where there is no give or take between the service departments, there is no give or take. In that case, I can use my direct redistribution method. Are you clear with this, guys? Are you clear with this? I'm repeating, when there is no give or take between the service departments, only then my direct redistribution method should be used. Are you clear with this, guys? Yes, you guys are able to understand this? Now, when do I use stepladder method? Let us say P1, P2, P3, I have three production departments, and S1 and S2, I have two service departments as well. Now, let us say S1 department is a stores department, S2 department is a canteen department. Now, what happens? Stores, anyways, these two departments will provide services to production department. That goes without saying, because they are service departments, they are meant to serve the production department. But what happens? Will stores department provide any service to the canteen department? No. What has the stores got to do in a canteen, right? Whereas the canteen department, will they provide service to stores department? Yes, they will provide food. They will not discriminate whether you are a production department guy or a service department guy. Whoever comes in, they will serve the food. Correct? No? Right? That's our Indian culture also, by the way. Yes. So basically here, this canteen department will definitely provide service to the stores department, but in turn, they will not take any service from the stores department. Or in other words, when there is either a give or a take, in other words, nothing but when there is a one-way traffic, only then you should be using stepladder method. Are you clear with this, guys? What are these methods, how to do it, that we will see. But first you should know when to approach which method. Are you clear with this, guys? Are you all able to understand, right? So only when there is a one-way traffic, right, you should be even using this method called as what? You should be using this method called as stepladder method. Clear with this, guys? Done? Now let me give you another scenario, and I want you guys to answer me properly. Now, let's say I have three production departments, P1, P2, P3, right? And then three service departments, S1, S2, S3, right? Now, forget the production departments. For you to choose the method, you should only know the relationship between the service departments. So, now let me tell you this. Let us say S1 provides services to S2, right? Let's say S2 provides services to S3, right? And let's say S3 provides services to S1. Clear with this? In this scenario, you tell me, can I use stepladder method or not? Or to put it simple, is there a one-way traffic in this question or no more than one-way traffic? So I just want an answer from you all. Come on, guys, participate on the comment section. By the way, someone is asking if this is live. Yes. So now tell me, guys, is this a one-way traffic question or not?
Yes, sir.
Is this a one-way traffic or not? Come on, guys, answer. Huh?
One-way traffic.
So now this is a one-way traffic question only. Why? Look, the relationship of the give or take should be looked at from the perspective of taking two departments at a time. Now, some students might think, sir, S1, what it is doing, it is also providing services, it is also receiving services. So now it is not a one-way traffic. No, you should not provide a service and receive a service from the same department. If you look at this, between S1 and S2, there is only a give or a take, correct? Between S2 and S3, there is only a give or a take. And between S1 and S3, once again, there is only a give or a take. Are you clear with this? That is, you take only two departments at a time and see whether there is a one-way relationship between them. If not, then you say, fine, okay, two-way traffic, the next method we will go. Are you clear with this? So the relationship should be seen between two departments at a time. Don't say as a whole, I'm giving as well as I'm taking. You can give to one department and you can take from another department. Still it is called as a one-way traffic only. Are you clear with this? In that case also, we will be using only the step ladder method. Clear with this, guys? This was a past exam question. I'll show you a question that was very, very nice, well coined. Right? Clear with this, guys? Done? And the third one, as you all know, is going to be a two-way traffic. Means what? P1, P2, P3. Let's say S1 and S2, right? And between the service departments, there is both give and a take. Let us say S1 is a housekeeping department, S2 is a canteen department. Housekeeping department means what? They will clean the place and all that. So they will also clean the canteen, correct? So housekeeping provides services to canteen. In turn, canteen also provides services to housekeeping department. So that is a two-way relationship, two-way traffic established here. In this case, you will be going for what? You will be going for the reciprocal services method. Clear with this, guys? And whenever you have a two-way traffic, those sums can be done either using either of the three methods, that is simultaneous equation, repeated distribution, or trial and error method. Clear with this, guys? We will be seeing what these methods are, but before that, first understand when to use these methods. Clear with this, guys? First of all, we are talking about secondary distribution. Primary distribution anyways is not a problem because that is done using some reasonable basis, and that's about it. Clear with this, guys? Clear with this? Now let's go to the question. Let's go to the illustration here. So the reapportionment method. Reapportionment stands for secondary distribution. The secondary distribution method 1, that is the direct redistribution method. What will you do? So they are saying this company has two production departments, two service departments, and they are saying department X, which is service department, provides the services to A and B in the ratio of 3:2. Similarly, department Y also provides services to A and B only in the ratio of 1:1. Means what? Between X and Y, there is no relationship, no traffic. Clear with this? Don't say one-way traffic. See, the first method is no traffic. The second method is one-way traffic. The third method is two-way traffic. Clear with this, guys? Clear with this? No traffic. Fairly simple. So what will you do? So this is the overhead as per the primary distribution. So anyways, the line items of expenses have been already converted into all department overhead. So now what is the objective here? Right now, secondary distribution. So the service department overheads need to be given back to the production department. Correct, guys? So it needs to be given back to the production department at the end of the primary distribution. The service department should not have any overheads with themselves. Everything needs to be given back to the production department. Are you clear with this? So now what will I do here? This 2000 rupees of department X, service department X, will be apportioned in the ratio of 3:2. Correct, guys? So I will reduce 2000 here and add up 1200 rupees share for department A and 800 for department B. Similarly, department Y share, entire amount of 1000, is being given back to A and B in the ratio of 1:1, 500, 500. Now at the end of the secondary distribution, what happens here? Department A gets a total value of 6700 rupees. Department B gets a total value of 4300. If you add the two, how much is it coming out to? 11,000 rupees. Correct, guys? Right? Now, overall, before we started, this total would have also been the same 11,000. 5,000, plus 3000, which is 8000, 8000 plus 2000, 10,000 plus 1. So this was also 11,000 rupees. So total value will not change, but only the internal composition will keep changing. Are you clear with this, guys? Are you clear with this? So now all department overheads has further reduced to only production department overheads. Are you clear with this? First we saw it under direct method, and in direct method, when will you use it? When there is no traffic. Are you clear with this, guys? In exam, please don't write no traffic and all. This is a word that I am telling you, right? It is not officially used for ease of understanding, right? That's why I'm saying it basically talks about the relationship between the service departments. Clear with this, guys? Next, step ladder method. We will be doing a sum. Do not worry about it, right? Then comes your repeated, your reapportionment method. That is your reciprocal services method. When will you use reciprocal services method? When there is a two-way traffic. Guys, I'm yet to do one-way traffic. Do not worry, I have a very good sum. We will be doing it. Fine. So now two-way traffic, under that the first repeated distribution method, we will be seeing how it works. Now basically guys, so when will you use your two-way traffic, your repeated distribution methods and all, your reciprocal services method? When there is both a give and a take between the service departments. In this case, if you see, Department X and Department Y are service departments, right? Department X provides services to A, B as well as to Y, correct? No, guys, yes. So Department X provides services to Y, yes. Now Department Y in turn, anyways, it provides services to A and B. They are production departments, right? But it also provides the services to Department X. Are you clear with this? Clearly there is a two-way traffic, and hence we are going and doing the sum under the reciprocal services method. And under the reciprocal services method, the first method is what? Okay, the simultaneous equation, we will do it. Now first we are doing it under the repeated distribution method. Are you clear with this, guys? Are you clear with this? What does this repeated distribution method says? First they are starting on with the primary distribution summary. So 5,000, 3,000, 2,000, 1,000. This is the primary distribution summary. So now what they are saying is, now simple, you keep on distributing it. So first Department X, right? It has a share of how much? 2,000 rupees. Reduce this 2,000 and give it to A, B as well as Y in the ratio of the services rendered. So 5:4:10. You just distribute it between all the other three departments. So now what happened? This 2,000 got distributed between A, B and Y. Are you clear with this, guys? Are you clear with this? Now what happens? As of now, Department X has a zero balance. Correct, guys? Yes. Department X has a zero balance. Now Department Y has how much? 1,000 originally, plus now it got 200 rupees share from Department X. Correct? No. Now I am in the secondary distribution. My objective is to make my service department cost zero and give it back to everyone. Now what I do is, this 1,200 rupees I need to redistribute it back to A, B and X also. So once I do that, I give it to A, B and X, the ratio of 4:4:2. Now what happens? Now Department X originally was 0. Now it has now got a share of how much? 240 rupees. Guys, clear with this? Clear with this? Now I was actually enjoying my position because I thought my job was over, right? 0. But now what has happened? Again, I'm getting a share from Department Y. Clear with this? Now what will you do? What will you do? Once again, you redistribute it. That's why it's called as repeated distribution method. Once again, this 240 share, you apportion it on the ratio of 5:4:1. Now what happens? Y was 0 till now, it got a share of 24 rupees. Now once again redistribute this 24 in the ratio of 4:4:2. Now you do it. Now what happens? Now X gets a share of 4 rupees. Now keep on distributing it till the time the value is very, very nominal. Now if you see this 4 rupees, if I distribute it, once again the ratio of 5:4:1. Now if I further do it, it will exactly be 40% of that. Yes, this is going to be 1.6 and this will be 0.4 technically. So now what they did, instead of saying 2, 1.6 and 0.4, they took this 0.4 and added it up with the B value and they made this as 0. Are you clear with this? Or in other words, the repeated distribution needs to be done till the time when the final value becomes very negligible and it can be rounded off and given back to the production departments. Now finally what has happened, X and Y became 0 and then I achieved the objective of converting the all department overheads to just the service, the production department overheads. Are you clear with this, guys? This method is called as repeated distribution method. Are you clear with this, guys? Are you clear with this? Any issues here, guys? Any issues here? Right? Now let's quickly move on to the next one. The very same sum can also be done under another good method. In my opinion, I would always suggest, if there is a two-way traffic, only follow simultaneous equation. Unless the question is specifically asking you to do it under repeated distribution, please do it only under simultaneous equation method. Now, what is this? What is this? So how do you do this? Now, first we will be calculating. In this, it's a three-step procedure. Step number 1, we will frame the equation. Step number 2, we will solve the equation. And step number 3, we will be calculating the apportionment. What is it? Now, since there is both a give and a take here, now if you see, now department X, what is the department X share of overheads? Can I say department X has its own share of 2000 rupees of overheads, right? Plus it will be getting 20% of the department Y share of overheads, correct? No, right? Or in other words, can I frame an equation and say X is equal to 2000 my own share plus 0.2 of Y, correct, guys? Clear with this, right? Now department Y on the other hand, can I say is nothing but 1000 plus it will be getting 0.1 of department X's share, correct? No, right? So here I will say X is equal to 2000 plus 0.2 Y. Then what is Y? Y is equal to 1000 plus 0.1 X. Are you clear with this? So now what we will be doing here is, so now you take any one of the equation. Let us take the equation number 2, right? What is equation number 2? Y is equal to 1000 plus 0.1 into X. Now instead of X, you substitute X with this value of 2000 plus 0.2 Y. So now if you do that, the entire equation will now be rewritten just in terms of Y, that is one variable. You solve for this equation, you will arrive at the Y value, and then substituted any one of the equation, you will get the X value as well. Are you clear with this? What is this X value and Y value? Wait, I will tell you now. Now what you need to do is, so the step 1 was framing the equation. The step 2 was solving the equation to arrive at the X value and Y value. The step 3 is your apportionment. Now in this apportionment, what are we going to do? This is how it started, right? 5,000, 30,000, 2,000 and 1,000. First, from X, you reduce how much? You apportion 2,245 rupees. Sir, why will I do that, sir? I have only 2000 rupees. That is the beauty of simultaneous equation method. It says, now currently you have only 2000. But later on you will once again get from Y, no? That I am anticipating it well in advance, and now itself I am asking you to apportion 2245, so that tomorrow when you get 245, that will also get knocked off here itself. You need not repeatedly do it. Just one time you apportion and leave it there. Are you clear with this, guys? So now itself you apportion 2245, the X value, in the ratio of 5:4:1. Correct, guys? Clear with this, right? Now what happens? Y gets a share of 1000 plus 224. This was already found out by our simultaneous equation method. Now it says happily distribute the 1224 in the ratio of 4:4:2. If you do that, now X will be getting a share of exactly 245. Now overall, if you see, this gets knocked off, and finally you have only the two departments overheads. Are you clear with this, guys? Or in other words, what we did here was, under the repeated distribution method, if you see, what was the total value of X amount distributed? Once we distributed 2000, then we distributed 240 rupees, then further we distributed 4 rupees. Totally we redistributed how much? 2244. Similarly, Y, how much we redistributed? 1200 plus 24. It's going to be 1224. Correct, no, guys? Right? So instead of calculating the figure by redistributing it, this directly here itself, I think this is 1000, no? Okay, yes. So here directly by framing the equation and solving, here we found it at the beginning itself. There is no point for us to repeatedly doing it. So now instead of 2244 there, because of that round off it's there, it is 2245 and 1244. This figure of how much you have to redistribute in total was found out at the beginning itself Based on that, now the redistribution was done. Are you clear with this, guys? Are you clear with this? In simultaneous equation method, we can check answers. Yes, you can check the answers accurately. Yes, guys, are you clear with this, guys? Yes, you guys are able to understand this, right? This is about your simultaneous equation method. Are you clear with this, guys? There is another method called trial and error method, not a great method, so that's why I'm not discussing it here right now, because it's not worth the time for discussion. Clear with this, guys? Maybe if you want, you can just go through it in your study material, but beyond that, it has never been tested and it's not a very great method as well, right, guys? Fine. That is about the discussion of primary distribution, and the secondary distribution under direct method and under the reciprocal services method. Now let us do one sum relating to the step ladder method. Shall we, guys? Yes. Now please take your question number, I think it's question number 1. Is it question number 1? Yes. No, question number 1. Just a minute. One second. Let me. Yes. Question number 1 only. Okay, guys, please don't look at the solution. Please do not look at the solution. Now, read this question. A manufacturing company has 2 production departments, P1 and P2, and 3 service departments, timekeeping, stores, and maintenance. The departmental distribution summary showed the following expenses of the month of December. So P1, P2, right? And then stores department overheads, timekeeping department overheads, and maintenance department overheads. Basically, what they have got us is they have the total primary distribution has been done, department wise overheads has been given here. Additional information they have given. Production department, okay, I think there's a mistake here. So production department is only P1, P2. Service department includes stores. Please make this correction. Only these 2 are production departments and these 3 are service departments. Okay. Now look at this. What have they given? The number of employees in each department is given. The number of requisitions made in each department is given. The machine hours in each and every department is given. Apportion the service department expense to the production cost centers P1 and P2. Basically, what have they asked for? Secondary distribution. Have they given you which method to follow? No, they have not asked you for the method. They want you to find out which method needs to be used. A brilliant sum, right, wherein they have not given the method directly, and also the services rendered ratio and all, that is the relationship between the 3 departments. They have given, cleverly they have given 3 service departments, right? I just asked you a question, no? S1 provides to S2, S2 provides to S3, S3 provides to S1, and I asked you guys whether it's going to be a single one-way traffic or two-way traffic and all, right? This sum is beautifully coined. It's a very small sum, but the issue here is to identify which method it comes out to. Right now basically, guys, a stores department, what does a stores department do? It will issue the raw materials. It does requisitions. Material requisitions will be honored by the stores department. Clear? So the services provided by the stores department should be evaluated on the basis of number of requisitions. Similarly, a timekeeping department. What do you mean by a timekeeping department? They actually keep a tab of how many hours were spent by employees in which department and all. They maintain the attendance and all. So the timekeeping department, actually, they provide services on the basis of the number of employees. Does it make sense? Right? And then you have a maintenance department. Maintenance department services are based on the number of machine hours. Correct, guys? Yes. So now, first, let us not even get into the sum. Let us not even get into the numerical problem. First, we need to find out which method of secondary distribution we need to follow. Agreeing or not? Guys, agreeing or not? Right? Now, which method we need to follow? Again, depends on the nature of traffic between the service departments. Right? I'm only bothered with the service departments. Correct? No? So, what I'm doing is, I'm taking the 3 departments and putting it as a matrix. Right? Timekeeping, stores, maintenance, right? Here I am keeping this as a service receiver, and timekeeping, stores, and maintenance. Here I am putting it as a service provider. Clear with this, guys? Now you tell me, timekeeping department. First, one more thing that you need to know, self-service should be ignored. What do you mean by self-service? Timekeeping department, what do? Wherever employees are there, the timekeeping department will be having a work there, correct? No, that is, they keep a tab of their attendance. In the timekeeping department also employees are there, no? So they provide service to themselves also, no? Ignore that. If you consider that, then it will always be a loop. I will be giving a share of my own cost to myself and it will be never ending. Clear with this? So always, because our objective is what? To give away all the service department costs to the production departments. So self-service should be ignored. So timekeeping to timekeeping, stores to stores, maintenance to maintenance. First put a dash here. Are you clear with this? Clear with this, guys? Now, tell me, timekeeping department, do they provide services to stores department? Simple. How do you know? If there is an employee in the stores department, it means they are providing service. In the stores department, are there employees? Yes. So I am putting a tick here and saying timekeeping provides services to stores. Now, timekeeping, do they provide services to maintenance department? Yes, there are some employees there also, no? Correct. So I am putting a tick here and I am saying yes, timekeeping provides services to maintenance also. Clear with this, guys? Next, stores department. Does the stores department provide services to timekeeping? So go to the number of requisitions. In timekeeping department, there is no requisition and all, which means if there is no requisition in a particular department, the stores will play no role there. So clearly, the stores department does not provide any services to timekeeping department. Clear with this, guys? Right? And does the stores department provide any services to maintenance department? Yes, there are some requisitions in the maintenance department, which means they are providing it. Are you clear with this, guys? Right? Now let's go to the maintenance department. Does the maintenance department provide, the maintenance department will be providing services only when there are machine hours. So if you see, there are no machine hours in any of the service departments. So clearly, the maintenance department is not providing services to timekeeping as well as to stores. Are you clear with this? Now, with this, what you can conclude? Look at this. You have three departments: timekeeping, stores, and maintenance. Correct? Now, timekeeping provides services to stores, correct? And timekeeping also provides services to maintenance, right? Stores, on the other hand, provides services only to maintenance, and maintenance, on the other hand, does not provide services to anyone. Now, anywhere can you see a relationship of a two-way traffic here? Anywhere is there a two-way traffic? You take any two departments, between timekeeping and stores, only a give is there, right? Between stores and maintenance, only a give is there. Between timekeeping and maintenance, once again, there's only a one-way traffic. Clear with this, guys? So between any two departments at a time, there is only a one-way traffic, and hence this is a very fit case for the step ladder method. Are you clear with this, guys? Yes. First, we are proving which method needs to be used, and only then we can even enter into the method. Clear with this, guys? Hello, guys. You guys are clear with this, right? You guys are clear with this? Fine. Yes, Ramya, you're understanding? Yes, Murli, everyone. Bharat, you guys are able to follow? Fine. Now comes the step ladder method. How do I do this? First, you list out all the primary distribution summary, whatever you've got, right? Now it's very simple. So timekeeping department, I need to apportion the costs on the basis of number of employees, correct? No? Right? So I will do it on the basis of number of employees, ignoring my own employee. So I need to ignore self-services. Correct, guys? Yes. So now I'll be doing it in the ratio of 20:15:5:10. Right? So 20:15:5:10. So we are doing it in the ratio. I've changed the sequence. That's why. So now what happens here? This 4,000 gets reduced from the timekeeping department and it gets evenly apportioned between all other departments. Are you clear with this, guys? Right? Next, what happens? The stores comes in. The stores departments, what they will do is, the stores department, I need to apportion on the basis of number of requisitions. So here, that is going to be 12:10:3. Clear? So this 5,800 rupees, that is 5,000 plus 800. The 5,800 component gets apportioned in the ratio of 12:10:3. right? Now stores department cost has also been fully apportioned. Now I have a balance only in the maintenance department of 3000 plus 400 plus 696. It's going to give me 4096. This amount needs to be apportioned between A and B alone, I mean P1 and P2 alone, in the ratio of 24:6. Yes, or 4:1, whatever it is. So once you do that, finally what happens, now you have only these two departments overheads, your production department overheads. Now this method is called as a step ladder method because after apportioning it, you can see the step like sequence. You can see this step like sequence. Are you clear with this? This is the reason why it is called as a step ladder method. Are you clear with this, guys? Are you clear with this, guys? Right? And that is about this particular concept of step ladder method. It can be observed that there are no reciprocal services among the service department, hence we can use step ladder method, right? While distributing overhead, distribute the overhead of that department which provides services to maximum number of other service departments and go in the descending order. If you look at this, the timekeeping department provides services to how many other departments? Two departments, stores and maintenance. The stores departments provide services to only maintenance, and the maintenance department does not provide service to any other service department, correct? So what I will do is I will apportion it in the same order. First I will apportion the timekeeping department's overheads, then I will apportion the stores department overheads, and then I will go and apportion the maintenance department overheads. Are you clear with this? That is the reason why timekeeping, stores and maintenance, this sequence we followed. Are you clear with this, guys? Are you able to understand, right? And that is about the entire concept of secondary distribution. Clear with this, guys? Clear with this, guys? Done. So this is one interesting sum. This is one interesting sum that was once tested. I think recently it got tested sometime back. So please be very clear with the concept. Don't think that you can use any formula, any method at any given point of time. It really doesn't work that way, right? So you need to know which method needs to be picked at which point in time. Clear with this, guys? Clear with this, guys? So that is about this particular question of step ladder method. Now with this we have finished the primary distribution, right? And we have also finished the secondary distribution. Clear with this, guys? Right? Now we need to move on to the third phase of this particular chapter, which is called as absorption. Now where does absorption fit into this category? Now I told you guys that let's say at the end of secondary distribution, I am left with P1 overhead, P2 overhead, P3 overhead on one side. What I need to do, I need to calculate the overhead cost per unit of menswear, kidswear, ladies wear and the footwear. Correct, the four different products that I deal in. This is what I need to do. So there is a gap that needs to be bridged, right, guys? There is a gap that needs to be bridged. Now how am I going to do that? Is what gets captured under this particular third phase of discussion called as absorption, right, guys? So now let us get started with this concept of absorption. How do we do it? Now let me give you a small example with respect to that, and once we do this example, we will be doing a comprehensive sum that covers primary distribution plus secondary distribution and absorption, all the three, right? Now let us say I have two production departments, P1, P2, right? Now the secondary distribution summary, I have done the secondary distribution. It says that P1 department's share is 20,000 rupees, P2 department's share is 15,000 rupees. Clear with this, guys? Done. Now what happens here? Let us say I have one more data with me. What is the data? The labor hours. The labor hours spent in department P1 is, let us say, 5,000 hours. Totally in P1 department, a total of 5,000 labor hours were clocked, right? And in P2 department, a total of 3,000 labor hours were clocked. Now I will say representatively, it cannot be exact, but representative, because these are all indirect expenses. But I need some reasonable base to actually come up with some kind of a relationship, correct? So now can I representatively say in department P1, right, for every hour spent, what is the overhead cost? To 20,000 rupees divided by 5,000 hours, can I say it is going to be rupees 4 per hour, correct? Similarly, in department P2, I will say 15,000 rupees divided by 3,000 hours, it is going to be rupees 5 per hour. Or in other words, okay, let us say the company deals in two products. The company deals in two products, A, right, and B. What happens? Product A, right, it passes through department P1 and P2. It takes 3 hours. It spends 3 hours in department P1 and it spends 2 hours in department P2. Similarly, I have another product B which spends, let us say, 2 hours in department P1 and 3 hours in department P2. Are you clear with this? Guys, clear with this? Now what I will be doing is, now I have some bulk amount of expenses. Now what I did, using some reasonable base, in this case I took labor hours. I tried to establish that overhead, right, using that base quantity, and I said, okay, generally I can say that in department P1, I generally incur 4 rupees for every hour spent. Clear? In department P2, I generally incur an overhead cost of 5 rupees for every hour spent. Correct? This relationship being established is called as absorption rate. Are you clear with this? This is called as absorption rate. So what is the meaning of this 4 rupees per hour? This is not product specific, product A or product B. If you spend 1 hour in my department, I will charge you with 4 rupees of overheads. This is the meaning. Clear with this, guys? Now, product A spends how many hours in department P1? 3 hours, right? Each hour I will give it a share of 4 rupees. Similarly, product B spends 2 hours in department P1. Each hour I will give it a share of same 4 rupees only. Are you clear with this? Similarly, product A spends how many hours in department P2? 2 hours. Each hour will be given a share of 5 rupees. Similarly, P2 spends 3 hours in your product B spends 3 hours in department P2, and each and every hour should be given a share of 5 rupees here. So now if I do this, finally what I arrive at here, so now this is going to be 3 into 4. So that's going to be 12 rupees. 2 into 5. This is going to be how much? 10 rupees. So overall, I would say the overhead cost per unit of A is going to be rupees 22. Are you clear with this, guys? Similarly, the overhead cost per unit of B, how much is it? 2 into 4, 8. 3 into 5 is going to be 15, right? Overall, it's going to be how much? Rupees 23. Are you clear with this? This way, finally, I achieved the objective of this particular chapter. So it started off with multiple line items of expenses like rents and rates, your factory rent, your supervisor's salary, your repairs and maintenance, depreciation, all these things. Primary distribution, I actually distributed all the line items of expenses to all the departments, right? And then secondary distribution, that is service department overheads got redistributed back to the production departments. And now absorption, I picked up a base quantity, tried to bridge the gap, and finally I converted the production department overheads bulk figures into overhead cost per unit of each of the product that the company deals in. It could be 5 products or 6 products. Let the company say it deals in A, B, C, D, E, 5 products. Each of the product, you just tell me how many hours it has spent in this department. Based on that, I can calculate the overhead cost per unit. Are you clear with this, guys? Are you clear with this, guys? This process is called as absorption, the third process. So absorption is a 2-step procedure. So what are the 2 steps involved? Step 1 is calculating the absorption rate, and step 2 is having calculated the absorption rate, I charged it on to my product. Correct? 3 into 4 I did, 2 into 5 I did. That is, that absorption rate, I multiplied it with the actual hours taken by each of the products. Correct or not? Right? This is the second particular step in this process, which is known as charging of overheads to the product. So now in your absorption, you have 2-step procedure. The third phase of this discussion, the absorption part, has 2 steps. Number 1 is calculation of absorption rate, and number 2 is charging of overheads to the products. Are you clear with this, guys? Are you clear with this? And with this, overall, this chapter's objective is getting achieved. Clear with this, guys? Yes, done. This is what they have explained here. Now 1 minute. In this case, what I did, I took labor hours. I took labor hours as the basis to calculate the absorption rate. Guys, yes. Sir, should I always use labor hours as the basis? No. There are six different base quantities. There are six different base quantities that you are allowed to take. In this case, we took labor hours. Labor hours was one such type of a base quantity. Clear with this, guys? There are six different types of base quantities that you can take. What are the six different types of base quantities that you can take? Labor hour, machine hour, then direct labor cost, direct material cost, direct labor cost, prime cost, and your production overheads. Or in other words, look, the first two are expressed in terms of hours. That is 4 rupee per hour, 5 rupee per hour. The next three are expressed as a percentage. That is what I will do is budgeted overheads, right? Let us say if it is material cost, I will say 20,000 rupees is the here. This is going to be my secondary distribution, right? And in department P1, let us say my material cost overall is 1 lakh rupees. So what I will do is, so the absorption rate will be 20,000 divided by 1 lakh. So I will say generally the department P1's overhead is going to be 20% of the material cost. Are you clear with this, right? Because if the numerator and denominator are both in rupees, it needs to be expressed as a percentage. And finally, the last method is your production units method. Production units method means what? Directly units. Right, directly the units. Suppose they have given 20,000 rupees is the department P1's overheads, and let us say overall some 5,000 units were manufactured in this department, right? That is A, B, everything put together. Let's say all are like similar items. So now what I will do, 20,000 divided by 5,000, I will say for every unit, whether it's A or B, I will charge it with an overhead of 4 rupees per unit. Are you clear with this, right? This way also it can be done, right? So this is the other, the last method, the last type of base quantity that can be used. Sir, why only 6 types of base quantity? If you notice carefully, all these 6 line items are some way or the other some direct items. When I say direct items, these 6 items are readily available in total as well as available on a per unit level. In this example, if you see, I knew how much was the total labor hours, and I also had the labor hour on a per unit level, right? Only because the fact that this given data was available on a total level as well as on a per unit level, I could bridge the gap of converting a total bulk indirect cost into a product level. Are you clear with this, guys? That is, all these 6 types of base quantities are generally available both in total as well as on a per unit level. This helps us to bridge the gap of converting that bulk line item of production overheads into overhead cost per unit of each of the products. Are you clear with this? That is the reason why we have only the 6 types of base quantities that are allowed. So what are the 6 types of base quantity? The first 2 are ours: labor hour rate, machine hour rate, right? Then you have 3 percentages: percentage of direct material, percentage of direct labor, and add the 2 percentage of prime cost. Are you clear with this? And finally, you have production units method. There are only 6 different types of base quantities that can be used. Are you clear with this, guys? Right? And the moment you calculate the absorption rate, that's why calculation of absorption rate is what? Budgeted overhead divided by budgeted base quantity. The base quantity could be any of these 6. Are you clear with this? And the moment you find that out, that is step number 1, calculation of absorption rate. Once you find out the absorption rate, that absorption rate should be multiplied with the actual base quantity consumed. In this case, what we did, we calculated that 4 rupees was absorption rate, multiply it with 3 hours, you will get the overhead cost of that particular department. Similarly, for department P2, it's going to be 10 rupees. Add up the 2, you get the overhead cost per unit. Are you clear with this? It's a 2-step procedure. Guys, are you all able to understand? Don't think that labor hours is the only basis for apportionment. Clear with this, guys? Clear with this, guys? Under or over absorption is an advanced level. I'll come to that, but before that, we will do a numerical problem. Guys, are you all understanding till now? Are you all understanding till now? Yes, this is actually, we are touching upon every single thing, almost every single thing in this chapter, right? So now let us get going with the next numerical problem, which is, I think, question number 2. Yes, question number 2. This was a past exam 10-mark question, a very good question. So a comprehensive problem. We'll be doing it now. Just give me a minute. Right, guys. Now, Superclass Company Limited has 3 production departments, X, Y, and Z, and 2 service departments, A and B. Now, they have given the line items of expenses, rents and rate. Guys, please don't look at the solution. I humble request you, if you want to get the best learning experience, don't look at the solution. The solution is meant only for ease of discussion. We don't have much time right now, right? Since it's a revision batch, in regular batch, every single sum, every single figure, I will be doing it on, I will actually be writing it along with you guys. That's how it is. In a revision batch, we need to pick up some speed because it's a revision actually. So here, if you want, I can do it, but I don't want to waste your time. That's the main reason, right? So please don't look at the solution. If you do look at the solution, it's actually, you know, the effect will not be there that much. Okay. So now, what are they given? Some different line items of expenses like rents and rates, lighting and electricity, indirect wages, power, depreciation, other sundry expenses and all. Line item of expenses have been given. Are you clear with this, right? What else have they given? The following are the further details. Floor space, right? Department wise, they have given X, Y, Z, A, B. What is the total floor space? 10,000 square meters, right? That 10,000 square meters, the breakup is given. Which department has taken how much area? This has been given. Why have they given this? This is the basis to apportion my rent and rate cost. Are you clear with this? Primary distribution. Guys, yes, clear with this. Next, lighting points are given. This is the basis for apportionment of lighting and electricity. Direct wages has been given, right? So now this is the basis for apportioning your indirect wages. Why indirect wages? Indirect wages is the supervisor's salary, correct? So who will be supervised? He will be supervising the direct workers only, right? If the number of employees headcount is given, you can take it. Here, the next reasonable basis, direct wages, you use that as a base. Clear with this, guys? Done, right? Then you have power costs. You can take horsepower of machinery. Then depreciation is given. So you can use the cost of the machinery as the reasonable base, right? Then they have given some working hours. We will see what it is and all, right? Then the expenses of the service departments A and B are to be allocated as follows. They have given this. Why have they given this? Why have they given this? Hello?
Secondary distribution.
Yes, this is a secondary distribution data. Now you tell me, guys, by looking at this dabba, you tell me whether this is going to be a no traffic, one-way traffic, two-way traffic. Which one needs to be followed? Come on. It's one-way traffic. No, Priya Sharavanan. It's not a one-way traffic. Look at this. Yes, it's a two-way traffic. It is reciprocal services method. Absolutely. Now how? Because department A provides services to department B. That's why you have a 10% here. Now, in turn, department B also provides services to A. Yes, there is actually another 10% coming up here. Yes, absolutely. Yes, it's going to be a reciprocal services method, two-way traffic. Which method to follow? Any of the three methods: repeated distribution, simultaneous equation, or what is the other one? Your trial and error method. But which one is suggestible? If you want to save your time in exam, that too with accuracy, better follow simultaneous equation method. Clear? Frame two equations. So three-step methodology. First, frame the equations. Number two, solve the equations. And number three, do the apportionment. And life is simple. Clear with this, guys? Fine. So first, primary distribution based on this data you need to do. Right? So the line items of expenses gets converted into what? All department overheads. Now that all department overheads further redistributed back, and now you will be getting your production department overheads. That's the end of secondary distribution, right? Now look at this. You are required to calculate the overhead absorption rate per hour in respect of the three production departments X, Y, and Z, because at the end of secondary distribution, you will just be left with X overheads, Y overheads, and Z overheads, correct? Now, what will be the total cost of an article, that is a product, with a material cost of 80, direct labor cost of 40, which passes through X, Y, and Z for 2 hours, 3 hours, and 4 hours respectively. Now, what they are saying, the company is in the business of manufacturing a particular product, right? For that product, they have given the direct material costs, they have given the direct labor cost. Sir, how did they find it? These are prime cost components readily available on a per unit level. This entire chapter of 3-step big procedure of absorption is applicable only with respect to indirect manufacturing cost of overheads. So prime cost components are always waiting for us. Are you clear with this, guys? Are you clear with this, guys? Guys are able to follow this, right? So now what happens here? Now they are saying overhead, they are asking us to charge it. So now what they have said is this particular product, it passes through departments X, Y, and Z, and the time spent in each of these departments are also given. So first, what we need to do, we need to calculate the absorption rate per hour for department X, department Y and department Z and multiply that with the respective hours, so that now we will arrive at the overhead cost per unit of this article. Now we can add the production overhead cost also per unit. You will arrive at the total manufacturing cost. Clear with this, guys? So all the three steps are involved in this particular numerical problem. Clear with this, guys? Clear with this? So now and they have clearly given in this question, it is going to be what? The base quantity is taken as labor hours. Sir, how do you know, sir? Because that is the only data which is given in total as well as on a per unit level. Are you clear with this? Are you clear with this? Right? So now if you look at it here, they have given the working hours, no? Guys, they have given the working hours here. Are you clear with this? They have given the working hours here. So now what we will do is at the end of secondary distribution, we have the department wise overheads divided by the respective hours. You will get the absorption rate, multiply it with 2, 3 and 4 respectively for each of the department. You will get the overhead cost per unit of the product. Are you clear with this, guys? Done. You guys are clear with this, right? But that is not all. This sum has another beautiful hidden treasure. Now, this is something that many of you guys will miss. Now, if you are especially, you can't afford to miss this in case you have attended the regular lectures. So all those red ink items and all should pop up right now the moment you read this question. Anyone from the regular batch, can anyone tell me what other beautiful adjustment is hidden in this question? Very good. Right. Now, guys, what students generally do, I will tell you. So now in this question, what you have is primary distribution. You would not have imagined at all that this treasure or this particular catch is being kept in the primary distribution area. We all think that how many line items of expenses are there in this question? 1, 2, 3, 4, 5, 6. So these 6 costs, what you will do, you will take a basis and you will apportion it, correct? But no, there is one 7th line item also in this particular question. Now, what is that 7th line item? If you look at this, so rents and rates, your lighting and electricity, indirect wages, power, depreciation, right? All these things are there, right? Other expenses. Now look at this, direct expenses of service department. Direct wages of service department. Now, what is this, sir? What is this? Now, before that, one more thing, I think one more doubt many of you might be having. Other expenses, why should I apportion it on the basis of direct wages? So, I will apportion it equally. Why should I apportion it on the basis of direct wages? Generally, this is based on the assumption that, globally accepted assumption, that human beings are the reason for incurring some additional cost. Hence, if nothing is mentioned about other expense, we don't know what is other expense, right? So many other miscellaneous expense put together, you apportion it on the basis of direct wages. That is the logic here. Now, sir, direct wages of service department, why am I considering here? First of all, we are in which chapter? We are in overheads chapter. Now, if at all something enters into my primary distribution, what can enter? Only my production overhead figures, production overhead expenses can only, indirect cost can only enter into my, indirect cost only can enter into my primary distribution, correct? Sir, wages and all is a prime cost component. Why are we seeing it here? This doubt is there or not? Guys, yes? Now, this is what I'm going to clarify here. Now, look at this. In this question, beautifully, they have hidden this line item. They have hidden this line item under this category. That is, you might think that they have given direct wages in this question for the purpose of taking it as a base to apportion a major line item. No. Now, they have given in the sum that X, Y, and Z are production departments, A and B are service departments. Clear with this, guys? Now, no doubt, direct wages forms part of your prime cost component, but not all direct wages. Let me give you an example. Let us say I am in the business of manufacturing pens. Okay, I am in the business of manufacturing pens. Right now, I have P1 department, P2 department, P3 department. Apart from that, I have one more department called as canteen. Right now, they have given direct wages direct wages of canteen department, some figure is given. Direct materials of canteen department, some figure is given. Clear? Now guys, you tell me in a canteen, that is from the perspective of a canteen, right? Direct material will be what? Tomatoes and potatoes only, right? Tomatoes and potatoes will only be direct material, guys, correct, right? From the perspective of a canteen, the cook's wages will be a direct wages, right? There will be 3 cooks and on top of them there will be 1 chef. The canteen will say the cook's salary is going to be direct wages, the chef's salary is going to be an indirect wages, correct? No, that is what they will say. But you logically think from the perspective of the company, whether you are paying for the cook or you are paying for the chef, everything is indirect from the perspective of the product. Will my product pass through the kitchen? Guys, will my product pass through the kitchen? No. So always remember the direct wages or indirect wages, whatever it is, the direct wages or direct materials or any direct cost of a service department is always indirect from the viewpoint of the company. Are you clear with this? So the direct is from the perspective of the respective department. Clear with this? But from the perspective of the entire company as a whole, that is still an indirect cost. Are you clear with this, guys? Hence, that is the reason why we have not taken the direct wages of X, Y, and Z production departments in this particular primary distribution table. You look at this here. We have not taken the direct wages of production department. Only the direct wages of the service department were considered, because though they might call it direct from the perspective of the service department, it continues to be indirect from the perspective of the company as a whole. Are you clear with this, guys? Many students have missed this. Many students have missed this across India. Sir, how do you know, sir, all India reach only for you? No, nothing of that sort. So after every attempt, there will be something called as examiner's comments. There, question wise, the examiners will give their expert commentary, as in they will say, for this question across the country, so much percentage of people got this answer right, or so much percentage of the people they got it wrong. To this extent, institute gives a lot of data. It comes once in 6 months in your students magazine, the month immediately following the result, whatever the magazine that comes in, or in the month of result, whatever it is. So they generally question wise, subject wise, question wise, they give you an expert opinion on that, so you can see where the students commit a mistake. Now when institute is actually coining all the questions and all, so what they do is this also they take into account, because they know generally where students commit a mistake, right? An attempt may be a first attempt for you, but institute has been taking it has been conducting exams for the last 50-60 years, so they know where exactly students stand. And of course, costing, FM and all the subjects, accounts, these subjects are right from the beginning. So obviously institute has a very good track record of where students commit a mistake and all. That's the reason why I'm saying these are very, very important things. I have handpicked questions based on the order of importance and where you guys generally make a mistake. Because if I am doing something that you guys already know, then there's no point or value addition here. Clear with this, guys? This is one very important thing. If this, if you miss to enter this into your primary distribution, then obviously this particular portion of your indirect costs will not enter into the products at all. Are you clear with this? So it will result in undercosting. So you would have incurred a cost, but you wouldn't have charged it to your customer. Look at the impact that it can have in a real life scenario. Are you clear with this, guys? This is the importance of it. Fine. So now once that is done, so what they did was they arrived at the primary distribution, right? And once primary distribution figures are there, now you need to do secondary distribution under what method? Under your reciprocal services method. We will be doing it under your simultaneous equation. So A is going to be how much? So A is going to be 9250 plus 0.1 of B. Correct, guys? Similarly, B is going to be 3150 plus 0.1 of A. Correct? So the first step was what? Under the secondary distribution, reciprocal services, the simultaneous equation method, 3-step approach. First, frame the equation. Having framed the equation, what will you now do? Solve the equations, substitute 2 in 1 or 1 in 2, you do anything. So convert the entire equation using one variable A or one variable B. If you do that, you will get the A value and you will get the B value. Clear with this, guys? Any problem here? This solving is not a major area, but you know, the major mistake can happen in these areas that I just told you. The first one is regarding missing out on this. The second one is regarding finding out which method you need to follow and all of that, right? Now, having done this, you need to do the apportionment. So now what you do, first you apportion A. So 9662, you fully apportion it on the ratio of 2:3:4:1. That is the services rendered ratio, right? And now you have what? Now you have here B, it gets apportioned 4116. Again, it needs to be apportioned in the ratio of 4:2:3:1. Guys, can anyone tell me how much is this? It's I think there's some typo error here. Can anyone tell me how much is this? I think it's 412. Okay, I myself found out 412. Okay, right. So once you do that, ultimately your service department costs will become nil, and then you will be ending up only with your production department overheads. So now your secondary distribution is done. Guys, clear with this? Clear with this? Now finally the third step, you need to do absorption. So what will you do? Department wise, you have the secondary distribution summary, right, divided by the respective base quantity. So what is the base quantity here? Labor hours. They had given in the question, the labor hours is 4670, 3020 and 3050, right? So now we just need to put it up here, right? So now you arrive at what? You arrive at the absorption rate by using your labor hours as the base quantity. Clear with this, guys? Guys, are you all able to understand this? Are you guys able to understand this? Right? You guys are able to understand, right? Now, once this is done, we need to charge the overheads to products. Once again, in this question, they have given that every unit of product X spends 2 hours in department X, 3 hours in department Y, 4 hours in department Z, right? Department wise, we know how much is the overhead rate to be charged. You have all of that. So now you multiply it, and finally you get the overhead cost per unit of this product, which is equal to 58 rupees, right? We are not done yet. Now for us, the prime cost components are waiting readily on a per unit level. 120 rupees is the prime cost per unit. To this, directly go and add this 58 rupees. Now you get the total manufacturing cost per unit, which is 178 rupees. Now with this, I can go on and achieve the objective of stock valuation and profit computation. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to follow?
Yes, sir.
Done, guys, right? Fine. This is the core and the most intricate discussion of this entire chapter, in fact of the entire subject itself, because overheads is a very heavy chapter. It's a big chapter as a whole, and many students fall into the trap of actually skipping this chapter. Guys, please don't do that. I don't believe, or I don't propagate skipping any chapters. But if at all you want to dilute something, maybe do it somewhere else, not in overheads, because overheads is the core chapter based on which the remaining chapters are all built on, right? Without overheads, it's not just overheads, it is called as absorption costing method. If you go to your study material, they would have written overheads hyphen absorption costing method. The entire it's actually a technique of costing. It runs parallel to marginal costing. That is the importance of this chapter, right? It is something else. This is the backbone based on which the other chapters revolve around. Your cost accounting systems, your cost sheet, in fact, all these chapters are based on this. So ideally, in my opinion, this chapter is always a must. So do not please do not skip this chapter or do something of that sort. Are you clear with this, guys? Done? You guys were able to follow? You guys were able to understand? You guys were able to understand this, right? So now let's move on to the next concept in this particular chapter. Very, very, very important concept, which is treatment of under or over absorption of overheads. Now, for you to enter into this concept, you need to know one concept called as predetermined rate versus actual rate. Predetermined rate versus actual rate. What do you mean by this, sir? Now, we saw that absorption rate, overhead absorption rate, is equal to overheads divided by some base quantity, and we saw that the base quantity could be any of the 6, correct? So your machine hours, labor hour machine hour, percentage of direct material direct labor cost, and your prime cost, And finally, you have your production units method. So all the 6 methods, any one you can pick, right? So of course, you can't use all the same, all the methods at a single time. Obviously, only one at a time you can then be used. Now, let me give you an example, guys. Very, very important understanding. This is a conceptual explanation, right? Without this, you can't even enter into the next area called as under or over absorption. You wouldn't believe. If you know, it's very, very simple. 10 marks, like you can take 10 marks in both your hands. That is the importance of the concept that we are going to see right now. Now, catch up running notes. Now, let me just give you an example. Let's say budgeted overheads, right, is equal to rupees 3 lakh. The budgeted hours, right, for the purpose of our discussion, I am taking the base quantity as hours. Okay, it could be any of the 6 base quantities. Please understand that is equal to 20,000 hours, right? Now, they have given you actual overheads is equal to rupees 30,000, rupees 3 lakh. And the actual hours is going to be the actual hours is going to be 15,000 hours. Now the question here is, if you calculate the absorption rate, that is, if you calculate the absorption rate using the budgeted data, that is, if you take the budgeted numerator divided by the budgeted denominator, that is the budgeted overheads divided by the budgeted hours. If you do this, then that absorption rate, since it is calculated using a budgeted data, it is called as a predetermined rate. Are you clear with this? Predetermined rate is also known as standard rate, is also known as budgeted rate, and all these are alternative terms for this. Predetermined rate, budgeted rate, standard rate, these are all some alternatively interchangeably usable words. What is that? Nothing but calculation of absorption rate using the budgeted data, right? So if I use the budget data for calculating my absorption rate, how much will be my absorption rate? 3 lakh rupees upon 20,000. That gives me how much? Rupees 15 per hour. Suppose I calculate the same absorption rate using the actuals, that is the actual numerator divided by actual denominator. So now that is called as an actual rate. Actual absorption rate is going to be 3 lakh divided by 15,000 hours. That's going to be how much? 20 per hour. Guys, correct? Now, just now we did questions regarding the 3-step absorption costing system, wherein the third step was what? Absorption. Correct? Absorption involves 2 steps inside it. Number 1, calculating the absorption rate. Number 2, charging of overheads to the products. My question to you is, the absorption rate that we calculate, should it be a predetermined rate or should it be an actual rate? Or in other words, for the purpose of charging overheads to the products, should I use the budgeted data or should I use the actual data? This is the question that I am asking you. Should I use the budgeted data or should I use the actual data? Right? Now, while many of you might think that, sir, what question is this, sir? 3 lakh rupees is the overheads I've actually incurred. 15,000 hours is the hours that I've actually spent. Where is the question? Obviously, I need to use 20 rupees per hour. The actual rate only needs to be used because that is the actual cost that have been incurred. No. You need to necessarily use only the predetermined rate for the purpose of overhead calculation. Or in other words, whenever I say absorption rate is always calculated on budgeted data only. Are you clear with this, guys? Are you clear with this? There are 3 reasons for this, out of which the main reason alone I will tell right now, right? Because let us not get too much into it. Generally, I make an elaborate discussion about this in my regular batch, along with numerical examples, some illustrations and all. Right now, you just understand why we use budgeted predetermined rate, that is the budgeted data. Now guys, what is the subject that we are learning? Cost and management accounting. To put it in short, costing. Now, we are not here to do a post-mortem work, right? Like accounts. Now, I'm not undermining your financial accounts. Financial accounts has its own objective. That's why These are all multiple branches of accounting only. Clear? It has its own objective. After a transaction takes place, you record it in your books and publish the results to the end user. That is the objective of your financial accounts. That is not what we do in cost accounts. In cost accounts, I need to concurrently value my stocks then and there. Whenever I say stock, please remember, stock is not closing stock. Stock is every unit produced is called as a stock. Clear with this? Or in other words, now just imagine, can anyone tell me what is the journal entry for closing stock in your financial accounts? Journal entry for closing stock in your financial accounts? No. In your financial accounts, there is no entry at all for closing stock because your stock is never valued in financial accounts. It gets valued only in cost accounts. That's why in all your numerical problems, in all your final account sum, closing stock value will be given as a separate adjustment. You plug it on the credit side of your trading account and plug it on the asset side of your balance sheet and it gets tallied. That's all. It's an adjustment item. There is no single journal entry or there is no valuation of stock under financial accounts. Stock valuation gets done only in cost accounts. Sir, how, sir? Why are we able to value your stock? Because in costing, the moment, right, a particular output FG comes out of my machine, I should immediately value it, right? I should immediately value it, or in other words, costing cannot wait till the end of the year. Are you clear with this? So the moment a particular product, this pen, I'm a pen manufacturing company. Now I have inputted material, labor, and I've incurred all the other expenses and all. The moment this pen comes out of the machine as a final product, now I know how much amount of material has gone into it. Actuals, do I know? Yes. I know every unit of pen consumes 5 grams of plastic. Every gram of plastic is so and so rate. I know. I know how much labor hour was required. Every hour of labor, how much am I paying? Actuals is no. Your direct expense, how much am I actually incurring? That also I know. The prime cost components are known in actuals. But you tell me, is the production overhead figure available on actual the moment the product comes out of the machine? No. For me, if I were to use the actual rate, then what I should do is, the moment the product comes out of the machine, I need to accumulate it, wait for the year end, finally arrive at my overall cost, add profit and fix my selling price. Can I say, if someone comes to your shop and asks you, sir, what is the cost of one pen? Wait, sir, the year is not yet over. Let the year get over. I will get my actual data. I will accumulate everything and I will fix my selling price. Absolutely, that is nonsense. It doesn't work that way. Or in other words, the moment a product comes out of the manufacturing unit, that is the machine, I need to readily value it, because in costing we pass entries for consumption of resources, not just for your revenue recognition and payment. No, we also pass entries for consumption of resources. We saw the flow of costs, from stores. If I'm moving the materials to my, if I'm moving the materials from stores to my factory shop, that also I pass an entry in cost accounts. This does not get captured in your financial accounts. From one hand, if you give money to the other hand, your financial account says that is an internal transaction. I will not record it, right? There has to be a concept of mutuality. Only when I deal with a third party, I will account, whereas that is not the case in costing. If you consume something, the consumption is also getting tracked here. Are you clear with this, guys? Or in other words, here, costing can't wait till the year end. Now, the moment a particular pen got manufactured, now I need to charge it with an overhead. Correct, guys? Now you tell me, will I be having the actual rate the moment it comes out of the production facility? No. So what is the rate that I will be having with me? Only the predetermined rate. Are you clear with this? Are you clear with this? Or in other words, always remember, whenever I say absorption rate means only budgeted rate or predetermined rate, because costing cannot wait till the year end. Are you clear with this, guys? Are you clear with this, guys? Yes. Now what happens here is, so finally if you see, now I can classify the overheads, as in the figures, in terms of figures, I can classify this into three. What I will say, budgeted overheads. What is my budgeted overheads? In this case, my budgeted overheads was how much? 3 lakh rupees. Correct, guys? I budgeted to incur how much? 3 lakh rupees. On the right extreme, I have my actual overheads. What was my actual overheads? Coincidentally, in this case, that is also 3 lakh rupees. Right, guys? Now, in between, I have one figure that is called as absorbed overheads. I have a figure called as absorbed overheads. Now, how do I charge my absorbed overheads? Very simple. So, now the moment a product comes out of my machine, a moment a product comes out of my machine, I will charge it with how much? 15 rupees for every hour actually spent in the product. I'm repeating, I will charge rupees 15 for every hour actually spent by the product. Are you clear with this? Or in other words, the total overheads charged will be my predetermined rate into actual hours, because the moment a product comes out of the machine, I know the actual time it took. That actual data is available with me, correct? It has already come out of the product, it has already come out of the machine now. I know it took 3 hours or it took 4 hours, as the case may be. So the hour data, the base quantity consumed, this is the reason why we use the base quantity consumed, plural tense we use, because that is readily available then and there. What is not available is only my absorption rate. So here, technically speaking, the absorbed overheads is a hybrid figure. It is predetermined rate. It's been applied on the actual base quantity consumed. In this case, the absorbed overheads will be 15 rupees I charge every time for every hour actually consumed. Totally, at the end of the year, how many hours were consumed? 15,000 hours. Correct? 15,000 hours were consumed. So overall, if you see, the absorbed overhead is going to be how much? Rupees 2,25,000. Are you clear with this, guys? Are you clear with this, guys? Are you clear with this? So here, the budgeted overheads is nothing but overheads planned. Overheads planned. Actual overheads is nothing but overheads incurred, right? And my absorbed overheads is nothing but overheads accounted. Are you clear with this? That is, this is the figure that will be appearing on my cost sheet. Are you clear with this? Because in my cost sheet, your prime cost components are actuals because they are known then and there, but your overheads figure alone is always absorbed. Don't think that it is actual. Till now, what have I done? I have not yet reached the end of the year. Till now, what have I done? Using the predetermined rate, I have applied it on every single hour that has been actually spent. That is what I keep doing. Guys, are you clear with this, guys? Are you clear with this? This is the core of absorption costing. This is the core of absorption costing. Now, what has happened? Finally, I reached the end of the year. Clear with this? Finally, I reached the end of the year. Now, what has happened? I noticed that till now, costing had accounted how much? It has accounted for an overheads figure of how much, guys? 2,25,000. But now I've reached the end of the year. Now I have the actual figures with me. Guys, yes. How much is the actual? 3 lakh rupees. So now what has happened? Now I find out that, look, I have accounted for only 2,25,000. But the actual figure is what? 3 lakh rupees. Now this needs to be, the difference between the two now needs to be rectified. No? See, no matter what, I should bring my actuals into the books. That is for there for sure. But why I was forced to use a predetermined rate because costing can't wait till the year end and the actual rate is not known then and there. Are you clear with this? That was the only reason I used my predetermined rate. Guys, clear with this, guys? Clear with this? So now what we do here is I take my predetermined rate, multiply it with the actual base quantity consumed. I keep on doing it. At the end of the year, I find out that, okay, absorbed overheads is 2,25,000. Means what? Costing has accounted only to the extent of 2,25,000. But at the end of the year, now I find out the actual to be how much? 3 lakh rupees. So now you tell me the difference between this 75,000 rupees is there, no? Guys, correct? This 75,000 rupees, I call it as under absorption. Are you clear with this? Are you clear with this? Means what? This is under accounted. I am yet to account for this 75,000 rupees of expense. So now guys, equally there is a chance for a situation of over absorption happening. Right? The absorbed overheads could have been 3,50,000. In that case, 3,50,000 minus 3 lakh, 50,000 rupees would have been my over absorption. Are you clear with this? I now need to go and bring down my cost. Are you clear with this, guys? In this case of under absorption, I need to introduce fresh cost because as of now, I've accounted only for 2,25,000 rupees. So now what has happened? I should have accounted for 3 lakh. So now at the end of the year, I am passing the rectification entry. So that rectification treatment is only called as concept of under or over absorption. Guys, are you clear with this? Now, all this concept of under or over absorption, why do we have? Because we are forced to use something called as a predetermined rate. Had I taken the actual rate, my absorbed and actual figures would have been the same, no? Correct, guys? This is happening purely because of the predetermined rate. Even the hours are actuals here. The rate alone is actually a budgeted rate. So purely because of the use of predetermined rate, which I'm forced to use. Because of this only, there happens to be a difference between the overhead accounted and the overhead incurred, which needs to now be bridged by using a concept called as under or over absorption. Are you clear with this, guys? Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this, right? This is the concept of under or over absorption. So for our explanation purpose, I will take under absorption and explain. Similarly, you understand that that is the case with over absorption. Now, what do we do with this? What do we do with this? This particular under or over absorption. How do we deal with this? 75,000 rupees is there, right? It now needs to be accounted, no? Guys, yes, clear with this? Now, if you see, what would have happened is, now, basically your production overheads, is it a trading account item or a P&L account item? It is a trading account item. That is, or in other words, it's a manufacturing cost, product cost, correct or not? Yes, guys. So technically what has happened till now, if you see in my trading account, there is nothing called as trading account in costing, but to make you understand, I'm saying till now, costing has recorded only for 2,25,000 rupees. Correct, guys? With respect to production overheads. Now you have a trading and P&L account. Now comes a question. Should this 75,000 rupees of under or over absorption, should it be treated as a product cost or should I treat it as a period cost? Now the next question is, should this be treated as a product cost or should it be treated as a period cost? Right? If you're saying you're treating it as a product cost, basically, or in other words, should it be taken to my trading account or should it be taken to my P&L account? This is the question, right? Now, globally, what they say is, take it as a period cost, meaning what? Hit the 75,000, take it to the P&L and close it off. Life is simple, right? Now, if I take it as a product cost, what will happen? There will be a huge impact. Now, guys, I would have already valued my stocks and all, right? By taking only 2,25,000 as my product cost. Now, once again, if I'm taking this 75,000 to my trading account, what happens? Now, the stock valuation will also change. Correct? Are you clear with this? If I take this as a period cost, that's very simple. Only my profit will reduce. But if I take it as my product cost, my stocks and all will change. Once again, I need to rework. Are you clear with this? Sir, what should we do, sir? Now, this is where in India, what we follow is wait. Don't jump to a conclusion. 75,000 rupees in this case is an under absorption, right? So what our Indian, the cost accounting standards and all say is, now, do not jump into a conclusion. First, this 75,000 rupees is there. This is an under absorption. See why this 75,000 rupees of under absorption is there. Classify it into two, right? So let us say out of this 75,000, right, 5,000 rupees difference was due to genuine price level changes, inflation, sir. Originally I prepared this predetermined rate. I arrived at 15 rupees per hour. By taking into account that overall, sir, my factory rent and all will be so much, right? Genuinely because of inflation, there to the extent of 5,000 rupees, there was a deviation. Balance 70,000 rupees, I'm just giving you an example, was due to inefficiencies of the company's side. Are you clear with this? So I'm repeating, there was a 75,000 rupees of difference, that is your under absorption. Now they have found out that out of this, 5,000 rupees is due to normal reasons, is due to normal price level changes, and 70,000 rupees is due to abnormal reasons. This abnormal reasons could be what? Your inefficiencies and so on. Are you clear with this? Maybe our staff took more time, or they were actually not that efficient, they took more leaves, or there were strikes, so many other things. Clear with this, guys? Now what they are saying, under or over absorption to the extent attributable to normal price level changes should be treated as a product cost, should be treated as a product cost. Are you clear with this? And the under or over absorption to the extent attributable to all other reasons, your abnormal reasons, inefficiencies, should be treated as a period cost. Are you clear with this? When I say period cost, directly take it to your costing P&L account and make it fully expire in the current year. Are you clear with this, guys? Are you clear with this? Are you all able to understand this? You guys are able to understand this? Now comes the major problem. Now comes the major problem regarding the product cost. Sir, now I am freshly introducing this 5,000 rupees as my product cost. Wouldn't there be a problem? Now my stock valuation, everything will change. Yes, it will change. Now, to put things in a much better manner, let us go back to that flow of cost which we saw in the cost sheet area, right? Where I told you all the costs are debited here. Now, as of now, the production overhead figure that I would have debited here was how much? 2,25,000 absorbed figure. Correct, guys? Guys, are you all able to follow this? Guys, are you all able to follow this? This is a very intricate discussion, right? Generally, this alone I take about 2-3 sessions in the regular lecture. So please be careful. Please be attentive here. I am condensing it because it's a revision batch, right? Now look at this. Look at this. So as of now, by the end of the year, I noticed that till now I have accounted for only 2,25,000 rupees here. Now they are asking me to further account for this 5,000, that is treat it as a product cost. This 70,000 anyways will go to my P&L account. That's not a problem. They are saying, sir, now you should also treat this 5,000 rupees as what? As your product cost only. Now, what is the issue here? What is the issue here? Now, already throughout this, during the course of the period, what I would have done, so all these things will be there, right? Your overall cost is there. So a portion of it is your cost of production, a portion of it is your closing WIP, right? And then in your FG ledger, what you have, this cost of production would have gone. There you have some opening FG also, right? Opening FG plus cost of production, that's your total goods available for sale. Out of this, partly some units would be sold, partly some units remains unsold. Clear with this? Or in other words, if you see, technically speaking, I would have valued my closing WIP, right? Then this cost of production represented by way of COGS and closing FG. Or in other words, these three figures would have been valued only by considering 2,25,000 as my production overheads. But at the end of the year, now they are saying, no, this 5,000 should also be treated as a product cost. Now what will happen? Now to the extent of this 5,000 rupees, I need to now once again redistribute it between these three parties. Because now if I add a cost here, ultimately these three are the ones who gets affected. Are you clear with this, guys? Are you clear with this? Guys, are you all able to understand this? Right? So what happens here is your under or over absorption to the extent attributable to price level changes, which is now treated as a product cost, will impact your three different accounts, or in other words, will impact three different people. Who are these three people? Your units sold represented in your cost of goods sold, your units unsold represented in your closing FG, and your incomplete units. Are you clear with this? Why this happens? Because till now I considered my POHs as only 2,25,000. Now suddenly they are asking me this to consider this 5,000 rupees also. When are they asking me to do this? At the end of the year. By then I would have already valued all my stocks and finished off, because costing can't wait till the year end. Now at the end of the year, they are saying this 5,000 rupees is genuinely because of the price level changes. Go and change it. Now I need to give its impact on these three ledgers. Are you clear with this, guys? Are you clear with this? And how will I do that? How will I do that? Very simple. So now here, if you see, this 5,000 rupees is the under absorption to be treated as a product cost. No, guys, correct? Right? Now I am just putting it up here, right? This product cost that we saw in our example was how much? 5,000 rupees, right? It needs to be distributed between how many people? 3 people. Who are they? Units sold, represented by way of COGS, right? Units unsold, represented by way of FG, and your closing WIP, that is incomplete units. Now let us say they have given 4,000 units of 4,000 units were sold, right? 750 units were unsold, and let us say 250 units were incomplete, equivalent units. This data is given. Now what you will do, you will apportion this 5,000 rupees, the extra amount of this under or over absorption attributable to your normal reasons, will now need to be given to these 3 people in the ratio of the units that are available. Are you clear with this, guys? Are you clear with this? How do I do that? Now you can directly do it now. That is 5,000 distributed in the ratio of 4,000 is to 750 is to 250. You can directly do it, guys. Correct, guys, correct. But wait, Institute has introduced one concept called as supplementary rate. Sir, difficult or nothing. What you need to do is add the 3. How much is it? 5,000 units. Correct? Hello, guys. Guys. Yes, Ramya, Priya, Murli. Yes, you guys are following. Yes. So now what they are saying is add the 3 total units. How many units are there? 5,000 units are there. They are saying first calculate something called as supplementary rate. Supplementary rate is how much? So your under absorption to be treated as a product cost, that is 5,000 rupees, divided by the total number of units, 5,000 units. So every unit should get a share of how much? 1 rupee. Are you clear with this? Now multiply this 1 rupee with each and every respective volume. So now you will get COGS should be increased by 4,000 rupees. Your closing FG should be increased by 750 rupees, and your WAP should be increased by 250 rupees. Now what has happened? The respective ledgers have also taken the impact, and now we can finally close our books. Are you clear with this, guys? Are you clear with this? Always remember, with respect to under or over absorption, first you compare what? How do you arrive at under or over absorption? Absorbed overheads gets compared with actual overheads. Correct? Now, the under or over absorption could be there. How do you treat? First, find out the reasons. Normal reasons, abnormal reasons. Abnormal reasons, directly take it to your P&L. Normal reasons, wait. What you need to do is, you need to distribute it between 3 parties. Units sold, units unsold, and your incomplete units. That is COGS, closing FG, and closing WIP. And how will you do it? Based on the units that are lying in the respective areas. That directly you can do, but Institute wants you to do it using something called a supplementary rate. Nothing great here. Instead of directly apportioning it, you in between call something as a rate and apportion it. Are you clear with this, guys? Are you clear with this, guys? Right? And once this is being done, finally this entire adjustment of under or over absorption will be over. Are you clear with this? Are you clear with this, guys? Yes. Now what we will do is, now we will take one numerical example in this regard. Now it was a past 10 mark past exam 10 mark question. I think in 2 consecutive attempts the same question, or I think a similar question, was tested back to back. That is the importance of this concept, because this is the heart piece or the core of absorption costing. So this is something that is a never miss, right? Fine, guys. So now let's go and do this. Let's go and do this here. Please take question number 3. Yeah, please take question number 3. Now, look at this. In a manufacturing unit, overhead was recovered at a predetermined rate of 20 rupees per labor hour. Right? So the predetermined rate means what? Budgeted overheads divided by budgeted base quantity. Now, the total factory overheads paid and the labor hours actually worked were 45 lakh rupees and 2 lakh labor hours respectively. During this period, 30,000 units were sold. At the end of the period, 500 units were held in stock while there was no opening stock of FG. Similarly, though there were no stock of uncompleted units at the beginning of the period, the end of the period there were 10,000 uncompleted units, which may be reckoned as 50% complete. Means what? 10,000 units 50% complete is equivalent to 5,000 units 100% complete. Are you clear with this? So clearly clearly you can say that units sold, how many units got sold, guys? 30,000 units. Units unsold, that is my FG stock, how much is it? It is going to be 5,000 units, right? And my closing WIP, how much is it? 10,000 into 50 percentage, another 5,000 units. Why do I need all these things? To the extent of normal price level changes, it needs to be apportioned between these three using supplementary rate. Clear with this, guys? Next, the accountant was able to obtain the following other information. The actual factory overhead included the following items. Now, what have they said? So 1,25,000 rupees paid to workers for a strike period under an award. 25,000 rupees was some penalty. 40,000 rupees obsolete stores now written off. 10,000 rupees paid towards consumables relating to prior periods now paid after a settlement of a dispute. 2 lakh rupees of factory overhead for the period was still payable and not yet accounted in the books. On analyzing the reasons, it was found that 60% of the unabsorbed overheads were due to defective planning and the rest was attributable to an increase in the overhead cost. How would unabsorbed overheads be treated in cost accounts? Past exam 2-3 times it has come as a 10-mark question. This is a core of absorption costing, because though it might look as if it's just an under or over absorption, for you to know this, you need to know the concept of your predetermined rate versus actual rate. Are you clear with this, guys? Now, first, can anyone tell me what is the total overheads actually incurred? Guys, come on, look at the question. Tell me, what is the overheads actually incurred? How much was the overheads actually incurred?
5 lakhs.
How much was it?
45.
45. Okay, I'm sorry. 1 second. Yeah. Even the Google, even the YouTube guys, come on, tell me, how much is the overheads actually incurred? Guys, YouTube folks as well. Come on. Yes, everyone. 45 lakhs, 45 lakhs, 45 lakhs, 45 lakhs, 45 lakhs. Okay. And now don't ever tell me that CA exams are difficult. It is just that you have ignored it. Read the question carefully, guys, and tell me where you've gone wrong. Read the question carefully and tell me where you've gone wrong. There is no point in saying that exams are difficult. See, most of the things we are not observing carefully. Read the question carefully. This is like a 11th standard error that you have made. 11th standard mistake that you have made. Yes, 2 lakh not yet accounted, now got accounted. Look at this, guys. Total factory overhead paid alone was 45 lakhs. And at the end, they have given 2 lakh overheads was still payable. We are not following cash system and all, right? Actual overheads incurred is how much? 45 plus 2, 47. Are you clear with this? It is 47 lakhs. The first step itself, if you make a mistake, it is like operation success, patient dead only. You would have done the correct answer for a wrong figure, no point. It's called as a chain error. They will not give you marks for this. They will not, for a 10-mark question, they will not give you beyond 1 mark. Most of the times, they will strike you and even reduce 2 marks from the previous question. Right, guys, come on, guys. This is not fair. This is not fair. Now, don't take me wrong. Don't take me wrong for saying this, but please be careful. It is okay to commit a mistake here. Doing it in the exam hall, 6 months is no joke, right? So please be extra careful. When you're reading the question, this means everything for you. This should be your world. Clear with this, guys? Fine. So first we started off with 45 plus 2. First of all, the overheads actually incurred is 47, right? Now from this, remove all these figures. Anyways, they are all some abnormal items. They are anyways going to be taken to your costing P&L only. They are ideally not a part of your routine overheads that you generally incur. Clear with this, guys? So remove it off. Remove it off. So minus 125, 25, 40, 10. Remove off all these things. So net production overheads actually incurred is only 45 lakhs. Clear with this? What am I going to do with these figures? These figures, they have by mistake included in production overheads. They are not production overheads basically. They are all some extraordinary items, like so abnormal items. So anyways, they should have been taken to your P&L account, but by mistake they have included in your production overheads. So now you subtract it. Technically speaking, 45 lakhs is going to be your net production overheads actually incurred. Clear with this? Oh, now some students will come and say, sir, this only we were saying and all. Right, I didn't ask for that. I just asked for the pro overheads actually incurred. Coincidentally here, this sum total and this sum total is matching. So this, you don't match along with that. Okay, so okay. That's why you were saying, Anil and all, now you're saying 45 lakhs still because of this only, Okay, and I should believe also. Okay, fine guys. Jokes apart, but yes, if you meant this honestly, then it's fine. But please be clear, don't make the silly mistakes and all. It is really it is going to cost you an attempt like 6 months is no joke. Anyways, guys, coming back here. So this is going to be my net production overheads actually incurred, correct? But what is the overheads absorbed? What is the overheads absorbed? So what is the overhead absorbed, guys? So the overhead absorbed is going to be, yes, they have given us a predetermined rate of 20 rupees, right? Multiply it with the labor hours actually spent. So 20 into 2 lakh, I'm going to get an absorbed overheads of how much? 40 lakh rupees. So overall, I know that 5 lakh rupees is an under absorbed overheads. I now need to come and account for it. Are you clear with this? Are you clear with this? Any problem here? Any problem here? No. Now, how am I going to deal with this 5 lakhs? Now, they have clearly said that 60% of that is going to be because of your, on analyzing the reasons, it was found that 60% was due to defective planning. You tell me, this was unavoidable. I mean, this was avoidable only. Due to your inefficiencies, you have incurred extra. So what they are saying is 60% of 5 lakhs is going to be 3 lakh. This is going to be due to inefficiency. And now the product cost, the balance 2 lakh rupees is due to genuine price level changes. So to the extent of 2 lakhs, I will treat it as a product cost. And to the extent of 3 lakhs, I'm going to treat it as a period cost. Are you clear with this, guys? Any problem here? Now, period cost, I don't have a problem. Take it to your costing P&L and knock it off. But this 2 lakh now needs to be introduced as a product cost. Now what happens? This 3 lakh needs to be shared upon those 3 people. Are you clear with this? Are you clear with this? This is the reason why I started off cost sheet itself with the flow of cost. Now you are able to understand. If I introduce it here, right, this guy takes an impact. So technically this guy enters here and he is represented by these 2 figures. So at the end, these 3 are the people who take the impact. So I now need to apportion between these 3 guys who were originally valued by considering a POH of only the absorbed figure. Now I need to introduce this figure extra also. That is my under absorption to the extent of normal reasons. Clear with this, guys? Are you all able to understand? Yes. Are you all able to understand? Right? You are looking at me as if you have muted, you have turned off the sound and as if you're looking at some gymnastics that I'm doing here right now. Guys, you're actually understanding, right? Yes. Okay, fine. Right. Okay, guys, fine. So now what you now need to do is, so now we've got units sold, units unsold, and our incomplete units 30,000, 5,000, and 5,000. So we can just add it up here. 35 and 5, you have a total of 40,000. So first we need to calculate what the supplementary rate. Remember, the supplementary rate calculation is there only for the under absorption attributable to the normal reasons. That is the one that is treated as a product cost. So take this 2 lakh that is under absorption treated as a product cost divided by the total units of 40,000. You get 5 rupees is the under absorption share that you need to give for every unit. So multiply it with the respective units. So now what happens? The value of FG, the value of COGS, and the value of closing WIP gets increased by 1,50,000 to 25,000 and 25,000 respectively. This way, the 2 lakh rupees that I now accounted for has been given to these 3 people properly. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to understand this? You guys are able to understand this? So technically speaking, now how do you account for this is that overall you have an under absorption of how much? 5 lakh rupees, right? So this under absorption of 5 lakh rupees, out of this what has happened? Now cost of goods sold, I have given it a share of how much? 1,50,000. FG, I have given it a share of how much? 25,000. WIP, I have given it a share of how much? 25,000. And the period cost component of 3 lakh, that anyways I take it to my costing P&L, 3 lakh rupees. Are you clear with this? So now I pass the rectification entry and finally I can close my books. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to understand. And because of this reason, basically, guys, you might, some of you might be wondering, sir, there should be cost of goods sold, no? Why is it cost of sales? Because ultimately your cost of goods sold, right, plus AOH plus SOH, anyways it needs to enter into your cost of sales only, right? So that's why if you see, we will be seeing it in cost accounting systems chapter. Now your cost of there is no ledger called as cost of goods sold. If you want, you can keep, but anyways you will receive it from the FG and give it to cost of sales. So it will be a via media ledger. So directly they take it to the cost of sales ledger only, because it becomes an expired cost. Clear with this, guys? So now what happens is, because of this adjustment, now what happens is my profit comes down to the extent of 3 lakhs and 1,50,000. See, this 1,50,000 is my manufacturing costs getting expired. My manufacturing cost expires to the extent of cost of goods sold, I told you, right? This cost of goods sold gets knocked off against my current year revenue, right? This 3 lakh anyways is a period cost that also gets knocked off against my current year revenue, guys, correct? So 1,50,000 plus 3 lakh, 4,50,000 rupees gets adjusted against my current year revenue, right? So my profit comes down further by 4,50,000, and to the extent of this 25,000, it remains unexpired. It escapes to the next year. Are you clear with this, guys? Are you clear with this? Because these are valued in the stocks. Clear with this, guys? Clear with this, guys? This is how you need to understand the concept of under or over absorption. Clear with this? Is everyone able to understand this, right? A very, very intricate discussion and a very technical discussion. Institute loves this area. Whether you love it or not, Institute loves this so much. So we are forced, you don't have any other option. So we should also love what the Institute loves only. Okay, clear with this? Yes, guys, done. You guys are able to follow this. Mark this as a very important question. Anyways, for that matter, whatever we do in the revision batch is all important, because I've taken only the most important areas here, but this is super important to, to make it more understandable for you. Clear, guys? Done. So that's about this particular segment as well. Now there are a few more allied concepts, small concepts. The major part of this particular chapter is over, right? So this is what it is. Maybe you can just go through it when you have free time, right? Because I've explained every single thing here. We have also done a numerical problem and we're done with this. Now there's something called as departmental overhead and blanket overhead rate. So now what is it? I will just tell you. Now guys, there is one more thing. Let us say a factory has two departments, P1, P2. Let us say the overheads is 20,000 rupees in department P1. Okay. And in department P2, the overheads is going to be 15,000 rupees. And let's say the labor hours in department P1 is 5,000 hours, and in department P2 it's 3,000 hours, right? Now there are two ways in which you can calculate the absorption rate. Now one I told you based on the data you use, budget actuals. Now forget that. That is one aspect. Another aspect is something called as blanket rate versus departmental rate. What is it? Now two options are there. Option one, I can calculate the absorption rate department wise. I can calculate the absorption rate department wise. Now let us say I am in the business of manufacturing two products, A and B. Product A takes 3 hours in department P1 and let's say 2 hours in department P2. Now product B takes 2 hours in department P1 and 3 hours in department P2. Okay. Now there are two ways in which I can apply the concepts of absorption costing here. One, what I can do is I can use something called as a blanket rate. Blanket rate means what? Now don't tell me how many departments are there and all in the company. First, what you do, total it up. That is, I will only calculate one absorption rate for the entire factory. Blanket, right? Add these two up. In the factory, what is the total overheads? 20 plus 15, 35,000 rupees is the overheads, right? And what is the total labor hours? 5,000 plus 3,000, it's going to be 8,000 labor hours. Correct, guys? Now, if you are using a blanket rate, now what I do is in a blanket rate system, I calculate a single absorption rate for the entire factory. So if I use this, the overhead rate will be 35,000 divided by 8,000. So I will say it is rupees 35,000 divided by 8,000 hours. So per hour, I will charge it with how much? 4.375 per hour. Yes, I will charge it with 4.375 per hour. Now, sir, how will I charge it to the products? Product A, product B. Sir, product A spends 3 hours in department P1, 2 hours in department P2. No, I am not bothered about all that. In the factory, totally it spends how many hours? 5 hours. That's all I'm bothered about. Give it a share of 5 hours. Each hour give it a share of 4.375. So it will come out to rupees 21.875. Well, thanks for the figure. Yes, 21.875. Now, how about B? B, sir, it spends 2 hours in P1, 3 hours in P2. Now again, I don't need the breakup. Tell me the factory as a whole, how many hours it spends? 5 hours. So here again, it's going to be 5 hours into 4.375. It also gets a share of 21.875 rupees. Are you clear with this? Now, if you calculate a single absorption rate for the entire factory as a whole, this is called as a blanket overhead rate system. Are you clear with this? Now, the other one is called as what? Departmental rate system. What is it? The one that we have been doing till now. The one that we have been doing till now. So we saw that P1, P2 is there. So department wise overhead, I have 20,000 rupees in P1, 15,000 rupees in P2, right? And then the labor hours are also given as 5,000 hours and 3,000 hours, right? So now what do? I calculate the absorption rate department wise, and I say for every hour spent in department P1, so the products should be given a share of how much? 4 rupees per hour. Whereas for department P2, it's going to be how much? It's going to be 5 rupees per hour. Clear with this? So now I calculate the absorption rate department wise, not on a total basis. Clear with this? Now what happens is product A, I know that it passes through both the departments P1, P2. In P1, it spends how many hours? 3 hours. In P2, it spends how many hours? 2 hours. So 3 hours in the rate of into 4, 2 hours into 5. So here I will be getting 12. Here I will be getting rupees 10. And if I add up the two, so every unit of A gets a share of rupees how much? 22 rupees. Right? Whereas for B, if you see, B also passes through P1 and P2. So it takes how many hours in P1? It takes 2 hours in P1 and it takes 3 hours in P2. Right? Every hour of P1 is charged with 4. Every hour of P2 is charged with 5. So here it's going to be rupees 8. Here is going to be rupees 15. If you add up the two, it gets a share of 23 rupees. Clear with this, guys? Now, which one of the two methods is better? Which one of the two methods is better? Obviously, hands down, departmental overhead rate system. Why? Why? Because one of the reasons is, look,
To know the cost of
technically speaking, department P2 is a costlier department. Department P1 is a cheaper department. Now, if you see, product B spends more time in a costlier department, lesser time in a cheap department. So it is fair that I should give it slightly more amount of overheads. Correct? No. Whereas overall, both the product spends 5 hours in a factory. No doubt. No doubt. But the breakup also is important. Guys, correct? The product B spends more time in a costlier department. Obviously, its share of overheads is fair only if I give more. Are you clear with this? Are you clear with this? So, the first reason why I'm saying a departmental rate is better is because a product might spend more time in a costlier department and lesser time in a cheap department. Now, all these things will be conveniently ignored if I follow a blanket rate. Are you clear with this, guys? Are you clear with this? That is number one. Number two, now look at this. If I use a blanket rate, what I will be doing? I will say total overheads divided by total base quantity. Correct? No? If I use a departmental rate, I have the flexibility to choose different base quantities for different departments. For example, department P1 is a machining department. I will use machine hours as the base. Department P2 is an assembly department. Here I will use labor hours as the base. So if I am following departmental rate, I have the flexibility to choose the base quantity department wise based on the factor that actually drives the cost in that department. Whereas if I use this particular blanket rate, I don't have such flexibility. For the entire factory, I have to necessarily use only one rate. Are you clear with this? So the second reason why departmental rate is better than my blanket rate is because of the flexibility to choose different base quantities in every single department. Are you clear with this, guys? Are you clear with this? Are you clear with this, guys? Yes. There is a third reason also. The third reason is, see, it is not necessary for a product to pass through all the departments. Agreeing with me or not? Agreeing with me or not? Let's say there are 3 departments, right? It is not necessary that all the products should pass through all the departments. Correct? If I follow a blanket rate system, I am forcefully giving all the departments' overhead costs to all the products, even though some products might not have passed through certain departments. Are you clear with this? So because of all these reasons, it is clearly evident that my departmental rate is better than my blanket overhead rate. Are you clear with this, guys? Are you all able to understand this? Are you all able to understand this? Yes. Now, the next chapter that we are going to see, ABC, yes, that will say that even departmental rate is bad, right? A better way of apportioning overheads to the product is an activity based costing system. Are you clear with this? So technically the next chapter we are going to see, ABC, is an extension of overheads only, but it is a modern way of apportioning overheads to the products. Are you clear with this? Are you clear with this? So I will be giving the same example. I will be giving the same example of departmental rate versus blanket rate. From there, so now we saw why departmental rate was better than the blanket rate. Now there we'll be seeing how activity based costing is better than the departmental rate also, because departmental rate also has some limitations. What that is what we'll be seeing. Are you clear with this, guys? So this is the next chapter is an extension of the present chapter. Are you clear with this, guys? Right? That is what they have mentioned here for departmental rate versus blanket rate. Clear with this, guys? Yes, fine. And that is about this area. Now this there is something called as capacity levels. That is your maximum capacity, practical capacity, normal capacity, actual capacity and all. You just quickly go through it once, not much of a value addition. There is one more important area that we are going to do right now, which is called as machine hour rate problems. Machine hour rate problem. Now, what is this particular concept of machine hour rate? So, yes, we are going to do this particular segment right now, and with this we will be finishing this chapter. Now, sir, what does this machine hour rate problems, why are you keeping it separately? Now guys, you all know that now we have 6 different base quantities for charging overheads, or in other words, for calculating the absorption rate. One of the base quantities is your machine hour, correct? No? Yes. So what do you mean by a machine hour rate? Simple, overheads divided by machine hours, correct? No, I will represent the overhead per machine hour. That is called, it is one of the 6 different types of base quantity. That's all. So why are we keeping it separately and studying it here, and why are you calling it as machine hour rate problems and all? I will tell you, this one small technical thing alone is there, but beyond that, not much of complexities. We are done with all the technique, very deep and very complicated areas are already done. This is just, a slight extension of what we have seen before. Now, what happens? Now, generally we know that your manufacturing costs are of 2 types. One is your prime cost components, the other one is your production overheads. Your prime cost components are readily available on a per unit level, whereas the production overheads is not available on a per unit level, but we convert it to a per unit level by using a 3-step procedure called as absorption costing system. That is what we have been seeing till now. Correct, guys? Yes. Basically, your prime cost components will have what? Direct material and direct labor and all. Guys, correct? Hello? Yes. Now, in some industries which are heavily tech-driven, technology-driven, highly mechanized industries, they will consider direct labor also as a part of production overheads. They will consider direct labor also as a part of production overheads. Sir, do not worry, it's a standalone area. It will be given in the question when they are considering it, right? Now, sir, what is it, sir? Can you give us an example? Yes. Now, let us say a company is in the business of manufacturing wooden doors. Right? Now, there are 2 ways of manufacturing wooden doors. One, you hire a carpenter. What he does, so he will bring a log of wood. In that, he will be doing all the workings and all. Right, you will ask for a design on the door, so all these things he will be actually spending his time, right, and he will be doing. Correct, guys? Another way of manufacturing the same wooden door is, you take the help of a machine. what you can do is, if you're not aware of this, what these guys generally do, some big manufacturer, dealers of all these wooden doors and all, they have a system in which they enter the design of the door. The door's design will be there, right? Like this, I want maybe some small hole here, maybe whatever it is, right? All these things they will mention. The design will be done. One click of a button, parallelly 100 doors will be, no, the machines will start working on 100 doors parallelly. Are you clear with this? Guys, are you clear with this? One click of a button, or it might take 2-3 hours, but parallelly 100 machines will be on and 100 doors will be manufactured of the same design. Are you clear with this, guys? Now, all these 100 machines are operated by a guy called machine operator. Machine operator. Who is a machine operator? The person, the staff who operates the machine. Now, you tell me, guys, if I am hiring a carpenter and manufacturing a machine, I'm manufacturing a door. In this case, it makes sense to consider the carpenter's wages as a prime cost and take it as direct labor. Now you tell me, this machine operator, though he puts his hands on the job and he works, but I can't establish a direct relationship between the time he takes and the number of units that gets produced. Now what this guy will do, he will turn on the machine, he will go for a walk around the factory, right? He will find one nice sweet spot, he will just sleep there. After half an hour, 1 hour, he will come back, turn off the machine. Correct? Now you tell me, is his time spent directly related? Does it directly relate to the production or the number of units of your doors manufactured? No. In this kind of setup, it makes sense to consider the machine operator's salary as a part of your production overheads. Are you clear with this? Though he's an assembly line worker, but his time spent and the number of units produced are not proportionate, because this is an industry which is heavily mechanized and tech driven. Are you clear with this? In this case, it makes sense to consider even the prime cost component, which we generally do, that is the labor, the machine operator's wages, should also be considered as a part of production overheads. Are you clear with this? So in this case, what we do is, so the production overheads will include what? It will include the machine operator's salary, right, divided by the machine hours. That's all. This one inclusion in the numerator, that is all is there. Beyond that, nothing great is here. For this only I gave this example. Clear with this, guys? Beyond that, nothing is there. Clear with this, guys? Yes. So now, shall we just go and do a numerical problem? Again, a repeated exam question, right? Let's do. And with that, we'll be signing off in this chapter. So the last one, question number 4. Yes. Now guys, read the question carefully. Read the question carefully. Again, a danger area. Okay, this is a danger area, so please be careful. Okay, a machine shop has 8 identical drilling machines manned by 6 operators. The machines cannot be worked without an operator wholly engaged on it. The original cost of all these 8 machines work out to 8 lakh rupees. These particulars are furnished for a period of 6 months. Normal available hours per month is 208. Absenteeism without pay is going to be 18 hours, right? Then the leave with pay is going to be 20 hours. The normal idle time, unavoidable hours, is going to be 10 hours. Then your average rate of wages per day of 8 hours is going to be 20 rupees. The production bonus estimated on wages 15%. Value of power consumed 8050 rupees. Supervision and indirect labor 3300. Lighting and electricity 1200 rupees. Repairs and maintenance including consumables 3% in the value of machines. Then your insurance is 40,000, depreciation 10%, sundry works expenses 12,000, general management expenses allocated 54,530. You are required to work out a comprehensive machine hour rate for the machine shop. Right? This is the question. This is the question. What do you mean by comprehensive machine hour rate? That is, take the total in the numerator. You should also consider the machine operator's salary. That should also be considered apart from your production overheads, divided by the total machine hours. Right? Now first. Now guys, in this question, first we need to calculate what? The total machine hours. What is the total machine hours? Have they given anything about the machine hours here? Can anyone answer? Can anyone answer? So what is the total machine hours given here? Have they given any data about the machine hours? Guys, please answer. What, you guys took a strategic time out? Huh? Please answer, no? Hello? Okay. Now, look at this. In this question, yeah, someone wants to answer. Yes, tell me, please. Yeah, go on. Okay. So now, look at this. In this question, what they've given is the machines cannot be worked without an operator wholly engaged on it, right? Which means what? The effective number of labor hours, the effective number of the machine operator's hours is going to be equal to what? It is going to be equal to the machine hours. Clear with this, right? Now what they are saying, there are 8 identical machines, right? They are manned by 6 operators, which means this figure of 8 is irrelevant. Why? Because only the time taken by the operator is going to be the total machine hours. Correct? There are only 6 operators here. So this amount, this figure of 8 is absolutely irrelevant for this particular question. Now what you do is, the normal time available per month is 208. From that, absenteeism without pay 18 hours. Then leave with the pay is going to be 20 hours. Normal idle time unavoidable is 10 hours. Now what we need to do here is, look at this here. First, normal available time. One more very important thing that many students miss out is, this is all for a period of 6 months, right? So for a period of 6 months fully. Now first, what is the normal time available? 208 hours is the time available per operator. Guys, clear with this? Hello, clear with this? So now basically what happens here is, I have 208 hours per month. Like that I have 6 months. Like that I have 6 operators. So the total time available for 6 operators for 6 months put together is going to be how much? 7,488. Are you clear with this? Next, what they are saying here, read this carefully. Absenteeism without pay hours is 18 hours. Be very clear. Here they are not saying this is 18 hours per month. Clear? The first data they have mentioned it as per month. Here they didn't mention it as per month. Means what? This is 18 hours for 6 months put together. Are you clear with this? So now what you need to do, 18 hours, right, for 6 months put together only, but that is for one operator. So multiply with 6 operators. Overall, the absenteeism hours is going to be how much? 108 hours. So I am going to pay them. I am going to pay the operators for how many hours? 7380 hours. Are you clear with this? This hours is required to calculate the overall machine operator salary. Are you clear with this, guys? Now further they are saying something. What are they saying? So there is a leave with the pay, 20 hours overall for a period of 6 months. Every staff takes a leave of 20 hours put together, and normal time unavoidable, normal idle time unavoidable is another 10 hours. So for these hours, the machines are not going to work. Correct? No? So what I will do, I will reduce that 20 into 6, 120, 10 into 6, 60. So the effective working hours is 7,200. Means what? The machines are running effectively for 7,200 hours. But however, I will pay the operators for how many hours? 7,380 hours. Why? Because this is a leave with the pay and a normal idle time. It is unavoidable. Means what? Your lunch break and all. I can't say I won't pay you for the lunch break and all that. Right? Because if they are coming to work, obviously some normal idle time needs to be given. Clear with this, guys? Then why are we reducing it? Because whether it's normal or abnormal, whatever it is, anyways, we are, if they are not available near the machine is not going to run. So effectively, the denominator, the total machine hours is going to be only for 7,200 hours. However, in the numerator, one of the components is my machine operator salary. For that, I need to consider 7380 hours. Are you clear with this, guys? Are you clear with this? Look at this. As the machines cannot be worked without an operator wholly engaged on them, therefore, the hours for which the 6 operators are available for 6 months are the hours for which the machines can be used. Hence, the 7,200 hours represent the effective working hours of machines. Are you clear with this, guys? You guys are able to follow this? Yes?
Yes, sir.
Right? Yes, Priyanka, that's right. And yes, Vaishnavi, yes, labor hour is equal to machine hour. Yes, you guys are right. Clear with this, guys. Done. Now, what have they given here? Now, with this, we calculated what? We calculated the denominator also, and we also calculated the overall hours for which I need to pay him. Then, one more thing they have given here. Uh, yes. Look at this. So now I need to calculate what is the total machine operator's salary. So now how do I do that? Now look at this. They have said the average rate of wages per day of 8 hours is going to be 20 rupees. That is 20 rupees is the wage that I pay for 8 hours put together. Apart from that, there is a production bonus and all. Okay, right? So now the machine operator's salary, how will we compute this? Okay, it's taken as 800 upon 8. Just a minute. I think there is some issue with the question here. 1 second. What has happened? I don't think it's 20 then. It has to be 800. Okay, please guys, just change this figure. It's not 20. It's 800. Please change this figure. It is 800. Per day of 8 hours, they are paid 800 rupees. There is one small issue in the question. Please correct it to 800 rupees. Okay. So the average rate of wages per day of 8 hours is going to be, yes, 800 rupees. So they are getting paid 800 rupees for working 8 hours. Effectively, the hourly rate that they get is how much? 100 rupees. So that is what they have found out here. Effectively, it's going to be 100 rupees. Clear with this? And for a period of 6 months, I'm going to pay them for a total of 7380 hours. 7380 hours into 100. Overall, my machine operator's wages is going to be how much? 7,38,000 rupees. Are you clear with this? This is for a period of 6 months. So now what we do here, we just go and plug this figure here. Operator's salary is going to be 7,38,000 plus a production bonus of 15% on the 7,38,000. That's going to give you 1,10,700. Right? Apart from that, the other costs that we have here, value of power consumed. Right? The figure is, I think guys, all these are multiplied by 10. I'm sorry, some typo error is here. So please add one zeros. It's 8,500, 33,000 and 12,000. Please add one zeros here, guys. There was some issue in the printing. So please, typing, please add one zeros here. So now it's going to be the power consumed is 8,500. Supervision and indirect labor 33,000. Lighting and electricity was how much? 12,000 rupees. Yes. Now, another common area where students commit a mistake. Now guys, look at this. Repairs and maintenance including consumables was 3% on the value of machines. What was the value of machines? Guys, what was the value of machines? 8 lakh rupees. Correct? Hello. Guys, answer please. It's 8 lakhs into 0.03. That's going to give you 24,000. Now you will think that 24,000 rupees should be the cost considered here. No. See what they have given. These are furnished for a period of 6 months. What is furnished for the period of 6 months? Only up to this dabba they have given it for a period of 6 months. So all these data are assumed to be given per annum, which means you need to now convert it into a 6-month figure. So basically what you need to do is here, if you see repairs and maintenance, 3% on 8 lakh into 1 by 2, that is 6 by 12. You get 12,000 rupees here. Similarly, insurance, this is 40,000 for 1 year. For 6 months, it's going to be 20,000. Depreciation, 10% on 8 lakh into 1 by 2, that's 40,000. Similarly, sundry works expenses, 12,000 into half, that's 6,000. And general management expenses apportioned here, 54,530 into half, 1 by 2, that's going to be 27,265. You add up everything, you get the denominator, you get the numerator, the total cost that needs to be apportioned, right? So the total cost divided by the machine hours. What is the machine hours? The machine hours, we got it as 7,200. You divide the two, now you get the comprehensive machine hour rate of 149.93, which means what? Every time a product passes through the machines, for every hour spent, I will be charging it with an overhead of 149.93. And what was special in this question? Here, we are also considering the machine operator's salary, which till now we were seeing it as a part of prime cost component. It has now been included as a part of your production overheads. Are you clear with this, guys? And that is about this particular chapter. Are you clear with this, guys? Are you clear with this? And overall, if you see right now, this is, it has taken us about 3 hours just to revise this chapter, right? But again, I'm telling you, there are certain other areas as well in this chapter. I'm not saying I'm covering everything, but in a revision batch, whatever is the best possible in the limited time, all the important areas we have definitely covered. So no doubt about that at all. Clear with this, guys? So with this entire chapter is over, and yes, that's about this. We have covered the semi-variable overheads, primary, secondary distribution, absorption, costing, the capacity determination, and yes, the machine hour rate problems. Clear with this, guys? And with this particular chapter of overheads is also over, right? Okay, right, guys? So let's get started. So this is chapter 12 for us, no? This is the 12th chapter. It's called as cost accounting systems. Cost accounting systems. What is this chapter? Actually, this chapter is also called as cost ledger accounting. Cost ledger accounting. This is also called as cost ledger accounting. So what is this chapter all about? And I told you, based on the past exam trends, this chapter is regularly being tested as a 5-mark area throughout the paper, somewhere or the other. Between this question 2 to question 5, generally they are inserting one 5-mark from the last 3 attempts. It has been regularly tested. So as per the trend, this chapter gets tested for 5 marks. At times it is also getting tested for 10 marks. That is unpredictable. But yes, generally for the last 3 attempts, it's been tested for 5 marks each. Now, what is this chapter all about? What is this chapter all about? Now, the first chapter that we saw was cost sheet, right? The same cost sheet chapter, cost sheet was in a statement format. The same cost sheet chapter, if you draw ledgers for each items of cost sheet, it is called as cost accounting system. So basically, only in this chapter we will get introduced to formal system of cost accounting. So we will draw up ledgers. You will draw up ledgers and draw the entire and each and every item of your cost sheet. You will place it in a ledger format, and finally you will prepare your costing P&L, that's for your financials. Are you clear with this? So this is the overall objective of this particular chapter. Okay, guys, are you all clear with this? Simple, same as cost sheet, but blend it with your accounting knowledge of debit and credit. So the prerequisite for this chapter is cost sheet and basic debit and credit of accounts. That's all you need to know. If you know this, automatically this chapter is sorted. Okay, clear? 5 marks, sure shot if it is coming. Let us finish it off in the classroom itself. That's about it. And of course, I'll give you a few sums. You just practice that and we are done with this chapter. Clear, guys? Clear? The best part of this chapter is that you already know it fully. You know it fully. Just that I will give you some rules and all. I'll tell you the rules of the game. You need to play along with the rules of the game. That's all. With the debit and credit cost sheet knowledge that you have. Prerequisite is only that. Debit, credit and cost sheet. If you blend the two, you get this chapter called as cost accounting systems. Are you clear with this? Now, I will give you an introduction. That's pretty much important. Now, let's assume that your dad is a salaried person. Okay? Your dad is a salaried person. Now, you tell me, does your dad maintain books of accounts, prepare P&L and balance sheet for his personal self? Does he do that every day? Or every year? No. Why does your dad not do it? Basically because he does not required under the law. Correct or not? Have you seen your parents prepare balance sheet, P&L, submitting it to some authority and all? Absolutely not. Why? Because it's not a legal requirement. Correct? Then why do companies and business entities alone do that? Because it's a legal requirement. So first of all, why are we maintaining books of accounts? Books of accounts maintenance has its own advantages, but above all that, it is a legal requirement. So only because it's a legal requirement, we all are maintaining books of accounts. Now, sir, legal requirement under what law? I'm just giving you a background. Fine. So now you have something called as Companies Act. Yes, you guys know, it's a part of your syllabus, right? Paper 2, law, right? So Companies Act is something called as Companies Act is there, that you know, no? Yeah, that is enough. Okay, now in that, if you see, I'm not getting too technical into it, I'm just giving you a bird's eye view. there is a section called as section 2 clause 13 that talks about maintenance of books of accounts. Maintenance of books of accounts. It says every company should maintain books of accounts with respect to its income and expenditure. This is basically your P&L. Then number 2, they should maintain records with respect to receipts and payments. This is nothing but your cash flow statement or your cash book. Then they say with respect to assets and liabilities, this is nothing but your balance sheet. And it doesn't stop there. It goes on to say that if a company is engaged in manufacturing or mining or production related sector, if a company is operating in manufacturing or mining or production sector, they need to maintain detailed records with respect to utilization of material, labor, overheads, etc. These are the wordings given in the act. They are saying if a company is into manufacturing, mining or production sector, they need to maintain detailed sets of record with respect to utilization of material, labor, overheads. That is utilization of cost components. Now I've already told you, in your financial accounts, from your raw material moves from stores area to factory shop, do you pass an entry? No, it happens within a factory. Concept of mutuality is not there. Your financial accounts, you will record a transaction only if a company deals with an outsider or a third party. Whereas inside utilization entry is never getting passed in your financial accounts. That is an exclusive scope of cost accounts. Are you clear? Basically, your company law is asking you to prepare. Cost records with respect to manufacturing sector. Are you clear with this? So basically, your cost accounting, reason why you have something called as cost accounting stems from this particular section of the company law. It says pass entries or maintain records with respect to utilization of expenses. Are you clear? Utilization of expenses is taken care of only under cost accounting. Guys, are you all clear with this? So basically, this is the reason why we have something called as cost accounting. Are you clear with this? Yes? Are you all clear with this? Now, should all companies maintain cost records? No. In your Companies Act, it clearly mentions only certain classes of companies that are notified by the central government. If it exceeds a certain threshold limit, let's say 500 crores of turnover, something like that. So turnover threshold, capital threshold and all, you might have seen some threshold limits are given. If it is a big manufacturing company that satisfies the requirement as mentioned by the central government, these companies need to separately maintain one complete cost records. They need to have one complete cost records in place. Are you clear with this? And you all know that financial accounts gets audited by whom? By auditor. What auditor? What is the qualification? Chartered accountant. Similarly, this is covered under section 139, just by the way. Now similarly, your cost accounts gets audited by a cost and management accountant. This is covered under section 148 of the Companies Act. Fine, the section and all is not relevant, but I am just giving you a proper backdrop. That's all. Are you clear with this? For our subject, it's not requirement, but you should know when someone is asking you, why are you learning this subject? Apart from the advantages that this subject has, first thing, is it a legal requirement? Yes, it is a legal requirement. So basically, your financial accounts are maintained as per accounting standards. Correct or not? Who prescribes accounting standards? There is a body called as NFRA. In consultation with your Institute of Chartered Accountants of India, they have some accounting standards that needs to be followed. Correct or not? Similarly, if you see that there is something called as cost accounting standards that need to be maintained, that need to be followed when you are preparing your cost accounts. Now, this cost accounting standards are prescribed by the Institute of Cost and Management Accountants of India, or Cost and Works Accountants of India. They've recently changed the name to Institute of Cost and Management Accountants of India. Clear with this? Now they have prescribed from some 24 standards. These standard numbers and all are not there for your syllabus. But is the content of the standard there for your syllabus? Yes. Yes. Nothing. We've already seen everything. Now we saw the treatment of in your overheads. Now you should always use a predetermined rate, correct? And under or over absorption, use of supplementary rate, all these are given only in your cost accounting standards. We didn't learn it by number, that's all, because it's not there for your syllabus. Whatever we have seen till now, every single thing is there only in your cost accounting standard. Else, if something like a cost accounting standard is not there, you will follow your own base, I will follow my own base. So there will not be any uniformity. The purpose of accounting itself gets defeated. Are you clear with this? So whatever we have covered till now, we have picked it all from our cost accounting standards without knowing the numbers of that, because it's not there for your syllabus. Are you clear with this? Are you clear with this? Now, why are companies required to maintain cost records? Because it's a part of your, not a part of your syllabus, it's a part of the law. It's a part of the law, and law says that you need to maintain. Now, the law says that you need to maintain cost records, correct or not? The law gives you two options. The law gives you two options. Now, you can maintain your costing records in two manners, in two systems. One is called as a non-integrated system. Non-integrated system. The other one is obviously called as integrated system. Integrated system. So one is called as a non-integrated system. The other one is called as an integrated system. The law gives you a choice to follow either of the two systems of cost accounting. What are these two systems, sir? Why do I have these two systems? Very simple. Now, anyways, a company needs to maintain financial records, correct? Now, over and above that, if you are satisfying the conditions, you should also maintain something called as cost records, correct or not? Now, if you are following a non-integrated system, what you will do is, in your company, you should have two separate departments. One is a finance department, the other one is a costing department. Now, the finance department will maintain only finance related books. The costing department will maintain only the cost related books. Meaning what? Your financial accounting and cost accounting are maintained by two different set of teams. They are not merged together. They are maintained by two different set of teams who concentrate only on their system of accounting. One guy follows only the financial accounting. He does paper number 1, correct? The other guy does only paper number 3. That's all. Clear with this? At the end of the period, these guys report a profit called as a financial profit. These guys report a profit called as a costing profit. Now, you have two profits, yes or no? Will these two profits match with each other? No. Because we saw in our subject, the profit we report is only operating profit. In your financial accounting, the profit you report is a net profit. And not just that, there are certain other things that could be a reason for a reconciliation. So what you need to do is, at the end of the period, you need to reconcile the difference between your financial profit and cost profit. Are you clear with this? This is about non-integrated system. Integrated means what? Together. Non-integrated means what? Not together. That's all. So I maintain my financial records and cost records independently, and I report a financial profit and a costing profit, and at the end of the year, I will look at the differences and I will reconcile them. Are you clear with this? Now, what do you mean by an integrated system? I will have only one team. Now, for costing and for financial records and all, I don't have two different teams. I don't have two different set of books. I will merge everything into a single set of books. So, parallelly, inside a single set of books, I will also pass entries for purchase and payment, plus I will also pass entries for utilization. So, what I will do, in my financial account, I will add on my cost account, and I will merge everything put together, and I will maintain everything in an interlocked fashion. Now you tell me, here how many profits I report? Only one profit. I don't have two set of profit. Now if I report only one profit, is there a question of reconciliation? What I will reconcile with what? No. So first understand, the concept of reconciliation arises only if you are following a non-integrated system of accounting. Are you clear with this? And these are the three objectives of our subject. Maintenance of books of accounts as per non-integrated, maintenance of books of accounts as per integrated, and reconciliation statement in case of non-integrated. These are the three things that we are going to learn in this particular chapter. Are you clear with this? Are you clear with this? Many students, they don't know that reconciliation is applicable only for non-integrated. They say reconciliation statement is applicable throughout everywhere. First, to know why we have a reconciliation. Only when there are two sets of profit, only that can be reconciled. You report only one profit, you will reconcile that with what? No, there is nothing to be reconciled. Correct or not? Are you all understanding this, guys? Are you all understanding? So that's about the overview of this particular chapter, what we are going to see. Are you clear with this? And as I told you, the best part about this chapter is you already know it. You already know it. It's nothing but your cost sheet giving some accounting element of debit and credit to the items of cost sheet. So, sir, under integrated system, when they find operating profit separately, we will see it, no? We will see it. So, under integrated system, what they will do is, they will maintain the costing profit. So, till the level of operations, what they will do, they will maintain, they will have this costing P&L. They will have this costing P&L, operating profit. That operating profit will be transferred to your main P&L account, financial P&L. From there, they will also debit and credit non-operating items. They arrive at the net profit. We will see it later. Don't worry about it. Fine. So, basically, as I told you, you have two manners of maintaining your cost accounting records. One is non-integrated, that is separate sets, and the other one is integrated. And the concept of reconciliation arises only in case you're following a non-integrated system of cost accounting. Are you all clear with this? First thing, are you all clear with what we are going to study in this particular chapter? Clear, guys? And as I told you, it's repeatedly tested for 5 marks and all. Don't miss out on that. And at times it has also come for 10 marks. So let's not take any chances. Let's do it here. Are you all clear with this, guys? Are you all clear with this? Now, so first let's go to the non-integrated system of accounting. Now, if we take time in understanding how to do this non-integrated system, simultaneously integrated system is also covered. Done, over, that's all. I will tell you how. When we are doing it, I will tell you how. That's all. It's very, very simple. If you know non-integrated, automatically you will know integrated. That's all. You need not separately do that. You need not separately, learn that. It is already covered under non-integrated. I will tell you how and all. Now, so take the heading. So the part 1 of this particular chapter is non-integrated system. Non-integrated system. Non-integrated system. What do you mean by non-integrated system? Costing records are maintained separately, financial records are maintained separately, and we are going to prepare costing records alone, separately. Are you clear with this? Are you clear with this? Are you clear with this? Fine. Now, you guys know what to debit, what to credit, no? Asset and expenses, increase will get debited, decrease will get credited. Then liabilities and income, increase will get credited, decrease will get debited. Correct or not? These are the basics. These are the basics of accounting. Correct? And of course, if there is a capital account, increase credit, decrease debit. Of course, we will not be seeing any kind of capital account. Basically, there can only be 5 types of accounts. No. Now, I'm telling you honestly, when I was in my 11th, they were teaching me debit the receiver, credit the giver, real account, nominal account. Trust me, I didn't want all that. Whatever it is, max, there can only be 5 types of accounts. Correct? So, expense and asset, increase debit. Then liability and income, increase credit. Capital, increase credit. That's all. And if it is the other way around, you should credit or debit the otherwise. That's about it. This is all accounting is. Correct or not? Fine. Nothing great here. We all know the basics of accounting. Fine. So, I generally don't use this real account, nominal account, personal account and all. I only use this way. These 5 ledgers, 5 different types of ledgers, increase, decrease, what you should do. If you know this, entire accounts is over. That's all. Correct? Clear with this? Fine. Now, this knowledge you guys have. Now, what I will tell you is, now, we will be seeing in a time from now, in a few seconds from now, I will tell you one particular transaction. You should tell me the journal entry for that. Can you tell me? Yes, based on whatever we have just seen, increase, decrease, debit or credit, correct? But there is only one rule for this game. There is only one rule for this game. There is only one rule for this game. Yes, the rule is, I will tell you a set of 11 ledger accounts. Okay, a set of 11 ledger accounts, I will tell you. You can use only those 11 ledgers account for a debit or credit. Basically, whatever entry you want, you pass. But you should pass only using these 11 ledgers. That is, the debit or the credit should go to either of these 11 ledgers. Deal? Yes, that's all you need to do. And I will tell you the transactions then and there. As I keep telling you the transactions, you tell the entry and parallelly write it. All these in detail is not given in the material that I've given you. Clear? Then and there you do it, and we are done with this area. That's about it. And of course, in between, I will tell you where all there are separate treatment that needs to be done. In fact, whatever chapters that we have studied till now, material, labor, overheads, every chapter gets converged here, and I will tell you how to give the accounting treatment for all that. That's the beauty of this chapter. So basically, we will converge whatever we have learned till now, and this chapter's objective is objective A. That is stock valuation and profit computation. We are trying to report the profit. Correct? Are you clear? This chapter's objective is not at all B or C. Are you clear with this? Fine. Decision making control is not at all there in this chapter. This chapter is wholly and solely about your objective A, your stock valuation and profit computation. Are you clear with this? So we are only talking about how to report your costing profits. Are you clear? Now, please note this down. Please note this down. List of ledger accounts. List of ledger accounts. Please note this down. It might be there in your material that I've given you, but please note it down. Please note it down. I'm telling it to you for a reason. Now, what are the ledger accounts that you have? Number one, stores ledger control account. I will call this as SLC. SLC. This is basically your raw material account. Your raw material account. So raw material, increase debit, decrease credit and all you will know. Correct? So raw material, tracking your raw material gets tracked under stores ledger control. Next, WIP control account. WIP control account. This is for your WIP. That is nothing but your factory shop. I told you. Correct? Third, write down FG control account. FG control account. This FG control is nothing but your FG stock, your warehouse area. Clear? Leave a line gap and write 4. Please leave a line gap and write 4. Wages control account. Then number 5, production overheads account, POH. Number 6, admin overheads account. Number 7, SOH, selling overheads account. Then leave a line gap. Number 8, abnormal loss account. Abnormal loss account. Then leave a line gap. 9, cost of sales account. 10, costing P&L account. Leave a line gap and write number 11, general ledger adjustment account. It's also known as cost ledger control account. So GLA, also known as CLC. These are the 11 ledgers. Quickly note it down. Quickly note it down. Done? Done? So what are the 11 ledgers account I told you? Your stores ledger control, WIP, FG. Then I've asked you to do wages, POH, AOH, SOH. Then one abnormal loss account. Then you have cost of sales, costing P&L, and finally you have your general ledger adjustment. Clear? Yes. Now what you do is maybe take another ink, maybe take a green ink, put a bracket within the first 3. Put a bracket within the first 3, across first 3, and write it down, stock accounts. These are stock accounts. Stock accounts. Stock is what? An asset. Correct or not? These are stock accounts. Then put a bracket across 4 to 7. Items number 4 to 7 and write down expense accounts. Expense accounts. Expense account. Then abnormal loss is a loss account. Is a loss account. Then this cost of sale and costing P&L. Cost of sale and costing P&L. It is nothing but some consolidated accounts. Consolidated accounts. And finally, you have something called as a general ledger adjustment. General ledger adjustment. That is nothing but write down self self-balancing ledger. Self-balancing ledger. Self-balancing ledger. I will tell you what each and everything is. Don't worry. Write down self-balancing ledger. Now, whatever is your costing related entry, I told you, you can only make use of these 11 ledgers. 11 ledgers. Now, raw material related stores control account. Your WAP related WAP ledger. FG related FG control account. Clear? These three are stocks. Then you have 4 items of expenses. Wages, POH, AOH and SOH. Are you clear with this? So then material cost, it gets tracked under stores ledger control. Are you clear? Are you clear? Yes, are you clear with this? Then you have one abnormal loss account. Remember, we opened abnormal loss, which chapter? Process costing, abnormal loss account, or you can also have an abnormal gain account. Clear? Yes. Normal loss, do you have an account? No. Why you don't have an account? Normal loss is not valued separately. Its presence is only felt by way of inflating the per unit cost of expected good units. That's why you don't have a ledger called as normal loss account. Are you clear? Are you clear with this? Then you have cost of sales. This is nothing but expired cost. Now I will collect all my expired costs together and then I will take it to my costing P&L. Correct or not? You tell me, when you are actually, let's say you are shifting your house from one place to another, what will you do? Option 1, you will put all your belongings in one truck and you will send the truck to the new house. Or option number 2, each and every item you will take it on your head and go, put it there, come again and again do it. Which option will you do? Option 1 or option 2? Option 1. Basically, you will use a truck to transport everything put together, and once the truck is full, you will send the truck. Maybe then you will send the truck back again for a second load. Correct? That is different. But what you will do is you will collect everything together and send it in a single shot. That's why we have a cost of sales account. What you will have is each of the components of cost individually, you will not take it as expired. Everything is an expired cost. Cost of goods sold is an expired cost. Selling overhead is an expired cost. Admin overhead is an expired cost. These 3 things, don't take it separately to the costing P&L. Ultimately, it goes there. Even I know that. What you should do is have a truck. That truck is called as cost of sales account. You park it in this truck and in a single shot, you transfer it to the costing P&L. Are you clear with this? This is nothing but a truck account. Always it closes. Are you clear? And costing P&L, you know, debit side, credit side will have the sales. Debit side, you will have all the expenses that is transported by way of this truck. Cost of sales. Correct or not? And you guys know, sales minus cost of sales is only a profit. Correct or not? Yes. So that's how the entire format of cost sheet is only getting placed here. Are you all getting a bird's eye view of this? Now, why do we have this ledger account called as general ledger adjustment? Now, for example, now guys, you tell me, purchase of raw material. What will be the entry in your financial accounts, Purchases account debit to cash or bank or maybe the supplier account, creditor account, correct? Now, what will be the entry in our subject? Now, when I purchase something, my raw material stock increases, asset increase gets debited, stores ledger control account debit to bank account. Let's say I'm paying by cash. Now, do we have bank account in any of the 10 ledgers till whatever we've seen till now? No. Now, this bank account is actually a financial, purely a financial particular financial ledger, correct? It's nowhere relating to costing, but we can't omit it. If you omit it, then you can't maintain double entry, correct or not? So, whatever ledger is not lying within the 10 ledgers that we have seen above, park it in a ledger called as general ledger adjustment, or it's also called as cost ledger control account. Are you clear? So, whatever ledger is not covered in the above 10, park that debit or credit in the GLA account. Are you clear? For our classroom discussion, we will call it as GLA, General Ledger Adjustment. In exam, they can also give it as a cost ledger control. Watch out for that. Are you clear with this? Guys, are you clear with this? Yes. So now this is the rule that I am telling you. Whenever you want to pass a journal entry, use any of the 10 ledgers, park it there. If those 10 ledgers are not there, then you can park it in a general ledger adjustment account. Clear? Clear? As simple as that. That's about it. Are you clear with this? Now what I will do is, let's get into the transactions. I will tell you the transaction. I want you to tell me the journal entry and I will note it here. Parallelly, you should also note it along with me. I will not give you time to note down and all. It's something elementary thing. For us, it's an elementary thing that we already know. Just that using this rule, you need to do it. That's all. Are you clear with this? And then we will do one full comprehensive sum. Don't worry about that. Shall we, guys? Shall we get started? Shall we get started? Right. Now, when you are doing this, visualize that factory. Visualize a factory in your mind. In a factory, you have how many locations? 3 locations. What are they? Stores, factory shop, and your warehouse. Correct? So this is a place where your raw material gets stored. This is a place where your WAP gets stored. This is a place where your FG gets stored. Visualize this. Whenever I tell you, ask you for an entry, visualize this place and answer, because we have these 3 stock accounts. Correct or not? Visualize this in your mind and answer. You will definitely get it. You will definitely get it. Are you clear with this? And remember, these 3 are assets. These are not expenses. These 3 are assets. Stock, no? Stock. These 3 are assets. Are you clear? And these 3 ledgers you can't find anywhere in your financial accounts. That's why financial account, when you are purchasing, the entry will be purchases account debit to party account. When you are selling, it will be party account debit to sales. So you are debiting one item, one purchase account at the time of purchase, and you are crediting sales account at the time of sale. It is nowhere linked. Correct or not? That's why stock can never get valued in your financial accounts. Whereas we are maintaining stocks. We are maintaining stocks separately. These ledgers you will find nowhere in your financial accounts. Are you clear with this? Are you clear with this? Guys, are you all clear with this? Yes? Fine. That's why you can't track the movement in your financial accounts. And that's why they are saying utilization entry can be passed only in our subject, cost accounts. Are you clear with this? Guys, are you clear with this? Simple reason, the objective of accounts is different. The objective of our subject, costing, is different. Are you clear? That's why. Are you all clear with this? Fine. So now, first, let me just tell you, write on number one, raw material related entries. Raw material related entries. Under that, first, purchase of raw material. Tell me, what will be the entry, guys? What will be the entry? Come on. Source ledger control account debit to GLA, cash or bank or creditor. Since I don't have that, park it in the 12th man, 11th man we have, no? Yes, is nothing but your GLA account. Are you clear with this? Yes, write down the entry. SLC account debit to GLA. Are you clear? This GLA can either be a cash or bank or your creditor, whatever it is. We don't maintain all those ledgers. Are you clear with this? Guys, is it understandable? Yes. Shall we move to the next one? Write down. Number two, raw material issued to the factory for production. Now tell me, in financial accounts, what is the entry? In financial accounts, what is the entry? No entry at all, no? See, from my stores, I am issuing it to my factory shop. What will be the entry? Financial accounts will not track this. This is the consumption entry, utilization entry. But here, what will happen if I do that? What will be the entry? Your WAP stock will now increase, but your SLC stock will decrease. So you know, WAP increase, asset increase gets debited, and SLC decrease, asset decrease gets credited. So entry will be what? WIP account debit to SLC account. Are you clear with this, guys? As simple as that. Nothing great. You already know. Now we are blending cost sheet along with the knowledge of debit and credit that we have got. As simple as that. If you mug this up, please never ever do that. If someone mugs this, then the course name is Started Accountancy. Accounts, never. Mugging up is a sin. It's a crime. We guys can't mug up accounts. In your 11th and 12th, maybe if you have done fine, it's okay. It's forgivable. CLA, you can't mug up accounts. Accounts is in our bloodstream. It's in our bloodline. You can't mug up accounts. Why I'm saying this is, I have conducted many interviews. First question I asked them, tell me sales entry, credit sale entry. That itself they are not able to say. You will not believe. You will not able to believe. CA Inter first group cleared students. They are not able to say sales, credit sale entry. They are saying creditors account debit to something. What? Seriously, GST order, if I am asking them, I'm only asking them for a normal entry so that I can at least know what is the level of knowledge. Yepra exam pass panna keta, sir, that somehow we mugged up something. Definitely not. Then why are you sitting here? The very fact that we are sitting here, if you don't know something, you learn it. Please don't mug up. If you don't know something, don't feel bad about it. You learn it. Never mug up. Accounts are magadikiranga. I'm telling you, I'm not telling this because someone told me and all. First hand experience. I have conducted many interviews for our own firm, and I saw this basic accounts entry they are not able to say. Your BCom graduates also, some CA inter first group cleared students also. I was surprised. Paper 1 has accounts. The level of group 1 accounts is more than the 3 years of your BCom. How can you do that? I'm still not able to digest that fact. Simple entries keta kuda solla maatiraanga. So please, if you I am not pointing out anyone, but what I'm trying to say is, in case you are not strong in accounts, ensure that you learn it conceptually. You can easily learn. Now there are a lot of free courses on YouTube also for basic accounts and all. It's okay. If you are weak somewhere, it's okay. Take the extra efforts and do it. That's all. Clear? Please don't mug this up. Okay, fine. Because I've seen this, I couldn't tolerate. Really, I couldn't tolerate. How can someone mug up accounts? Where they are so na kuda parvala. Accounts, how can someone mug up sitting in this course? So I have seen it. That's why I'm telling you so much. Fine. Yes. Next one. Right. Third. Now, let's say you have issued more raw materials and that factory shop is returning the excess raw material. Let's say raw material returned to stores from factory. What will be the entry? Now, your SLC balance will increase. Guys, I want everyone to answer. Please keep your videos turned on also, I told you. Fine, please guys, please do that. Yes, good. Nikita and Yashwant, these two guys have kept their videos turned on. Others, please turn on your videos. Fine, look at this. So when it gets returned, so what will be the entry? SLC account debit to, that's all. SLC account debit to WAP account. Are you clear with this? That's about it. Next. Fourth point. Raw material returned to supplier. Purchase return. Logically think and tell me what will happen. Now, creditor account debit to your SLC. Since we don't have a creditor account, that will be your what? GLA account. So GLA account debit to SLC. What, Vishal? Yes, you're understanding? Yes, okay, fine. So write down. GLA account debit to SLC account. Are you clear with this? Guys, are you all clear with this? Yes, are you all clear with this? Next. Point number 5. Purchase of raw material for special orders. Now, this is how they will give in the exam. Purchase of raw material for special order. What is the entry? SLC to GLA. No. SLC account will not at all get impacted. I'll tell you. Correct. You're right. Krishna Priya. Yes, that is the right thing. Now, wait. I know this might sound very, the wordings are very misleading. Special order. Guys. I'll tell you one example. Maybe then this will help you remember. Now, what happens generally in your house? Your mom is asking you to buy some groceries. What will you do? You will buy the groceries and keep it in a storeroom. If you don't say, sir, I don't have a storeroom in my house. You store it somewhere, no? You will just pour it directly, You will store it somewhere, no? That is called a storeroom, okay? I told you, a bin can be a small dabba or it can also be a room, fine? So you pour it and keep it somewhere, correct? You store it in a place and then you will use it. Your mom will use it whenever she wants, correct or not? So that's how generally in factories also it happens. Whenever you buy something, you store it in a stores area. Whenever the factory manager is asking, I will issue from the stores. Correct or not? Yes. Now, what happened? One day, a few guests came to your house. And these guests, you know what they are known for? Coming just before the day of exam. That's when they will come. So they will not say, can I come? They will say, I am going to come. So it's an information to us. So what you should do, you should go to library, correct? Okay, so basically for that, they are giving you a heads up. You should also be very careful. Okay, anyways, so now what they will do, now let's assume your guests have come home, okay? Some 4 or 5 people have come home. Now these guests what they are saying, let's say an example, they are saying, if you don't serve biryani, then we will be mood out. So biryani kudukalena mood out aidum, correct? Okay, let's assume, fine, I'm a vegetarian, so let's assume it's a veg biryani, okay? Fine, right, okay, fine, veg biryani. Guys, example, please. Example kuda vada matanga. Right, okay, biryani is a very overrated food. I don't think it's like that much worth the hype and all, but anyways. Okay, so let's say they are saying only if you give me biryani, then I will be satisfied, else I will go around and do my gossips as if they don't do it otherwise. Okay, so they will do all that. Okay, relatives, okay, right, okay, fine. So basically they came home, they said only if you want biryani, then only if you serve us biryani, we will be like, we'll be in good terms and all. Okay, so what your mom is asking? Your mom has said she's running out of stock. See, generally every day you will cook your normal rice with that basmati rice. No, that biryani has a separate rice, no, that basmati rice and all, that costs more than 100 rupees per kg, no. So what she is asking you to go and buy it from a nearby shop. Just go and buy this basmati rice I want to cook. You go, you bought it. What? Your mom is asking you, so give that basmati rice to me. You said, no. What is the policy? I will go keep it in the store place. From there you go and collect it. Will you do that? Or directly now you will come. Today it's an urgency, no? Special order has come, no? Directly you will consume it. What will you do? Directly consume or go to the stores and then come back? Directly consume. This is called as a special order. In case there is some urgent order, now what you will tell is, you will tell the supplier to directly deliver it in the factory shop. You will not ask him to put it inside the stores and from the stores you will take it there. No, directly issue to the factory shop. Now tell me the entry. WAP account debit to GLA. Are you clear? Enna madam, GLA to WAP. Guru, how is GLA to WAP? Tappa type padichiya. Okay, Tirumala type padikana. Fine. So it is WAP account debit to GLA. WAP balance is increasing and your creditor balance is increasing. Creditor balance is not there, so you will credit your GLA. Clear with this, guys? Exam, they will give the word special orders. You should know that it means directly issued to factory, directly to factory shop. Directly to factory shop. This is what it stands for. Are you clear? In exam, remember biryani. Okay, right? This guest biryani, you just remember. Are you clear with this? Are you clear with this? That's why I'm giving all these kind of nonsense examples. Okay, please guys, understand. Right, now. So the entry will be what? WAP account debit to GLA. To GLA. Okay, clear? Next. Number 6. Now, in your store's ledger, you will only store, in your stores area, you will only store direct material, or you can also store indirect material. You will store all types of material, correct? If it is consumed directly, let's say I'm in a textile manufacturing company, I have cotton, correct? If I use this cotton for producing cloth, I will say that is a direct material, correct? Now, this cotton I can also use to wipe this particular machines and all, no? If I use it for that, it's going to be an indirect material, correct or not? Correct or not? So write down the next one. Indirect material issued to production. Now what will be the entry? Now what was an asset now turns into an indirect expense. So POH account debit to SLC account. Are you clear? Increase in expense, POH debit, decrease in asset, SLC credit. Clear with this, guys? Clear with this? Are you clear with this? So write down POH account debit to SLC. Are you clear with this? Don't mug up anything. Everything is logical here. Are you all clear with this? Next. Number 7. Write down raw material lost within bracket abnormal. Why normal? Already you know how to account for it. It gets accounted. It gets distributed between expected good units. Fine. There is no entry for that, but it inflates the per unit cost of expected good units. Abnormal loss. Some thief came, or because of some fire, it just got destroyed. Fine. What will be the entry? Now, abnormal loss account debit, loss debited to SLC account. Why? Reduction of asset gets credited. Are you clear? As simple as that. Just write down abnormal loss account debit to SLC. Are you clear with this, guys? Are you clear with this? Isn't it easy? Damn easy. That's all. Yes. 8th, the final thing. Now write down transfer of raw material from one job to another. Now guys, let's say I am in a job costing setup, meaning what? I manufacture customized products. Okay. Now let's say I am a company like BHEL. I am a company like BHEL. Now what business am I into? I am into the business of manufacturing machineries for my client. I manufacture machinery. Now let's say customer A is a textile manufacturer. So he is asking me to build one machinery for his business. Customer B is a stationery manufacturer, pen manufacturer. He is asking me to manufacture a machine for him to manufacture a pen. Are you clear? So for him, whatever is required, I will manufacture some specialized machine. You tell me, can I say I will incur the same amount of cost for both? No. No. So what I will do, his machine I will construct in a factory shop. Parallelly, simultaneously, I will be having another team to construct. So the other guy, this stationary guy's machinery, that also parallelly I will be manufacturing in the same factory. Correct or not? Now what happens? The type of raw materials needed and all will be different for both the products. Correct? Correct. Now there can be certain common items that we'll be using. Correct? Let's say nuts and bolts. Nuts and bolts. Now let's say this is your factory shop. This is your factory shop. Now you have machinery 1 manufacturing here, machinery, or say product 1 is getting manufactured here, product 2 is getting manufactured here. Your store place was there. Okay. Now what you did was, from the stores you issued some nuts and bolts to product number 1 and it was manufacturing. Now let's say product number 1 has some excess nuts and bolts. Okay. Now product number 2 requires some nuts and bolts. Now you tell me, what will you do? These two are brothers standing nearby. Will I immediately transfer this? Logically, will I transfer this? Okay, I have some excess, you take it up. Or will I say, no, I will return it back to the stores. You go to the stores and take it back. What will I do? There itself, on the factory shop itself, from one job, I can transfer the materials to another. Correct or not? Now, in this case, basically, this is all a WAP ledger. It's all a WAP ledger, but job 1 account is a subledger, job 2 account is another subledger. For example, if I say debtors account, now you tell me guys, entry when your credit sales entry is what? Debtors account debit to sales, correct or not in your accounts? Now debtors account, will there be one account? No. When you are passing an entry, you will not say debtor account. You will say Mr. A account, Mr. B account, Mr. C account and so on, correct? If you merge everything for grouping purpose, you call it as sundry debtors. Similarly, in a job costing setup, WAP ledger is called as a main ledger. But if you see it, actually, there will be many sub-ledgers inside that. Job 1 account, job 2 account, job 3 account separately. Clear? So, in this case, if I am transferring some raw material from job 1 to job 2, what will be the entry? Job 2 account debit to job 1 account, that is the receiving job account debit to the giving job. On a broader level, the entry actually is WAP account debit to WAP only. But inside, if you see, within the two parties, there is a change. Are you clear with this? So don't tell me that, sir, job 1, job 2 is not within the 10 subledgers, 10 ledgers that you gave me. It is nothing but a WAP subledgers. Are you clear with this? Are you clear with this? So the entry will be what? Receiving job account debit to giving job, or in other words, transferee job account debit to transferor job. Transferee job debit to transferor job. Transferee job account debit to transferor job. That is, the receiving job will now have a more balance, so debit it. The giving job will now have a lesser balance, so credit it. Are you clear with this? Guys, are you all clear with this? Are you all clear with this? Is everyone clear with this, guys? Hello? Yes? You guys are clear with this? Now, let's move to the next one. Let's move to the next type of entries. Wages related entries. There are only two entries here. Wages related entries. There are only two entries in this area. Number one, incurrence of wages within bracket paid / outstanding. Paid / outstanding. Incurrence of wages. When I incur wages, what will be the entry in your financial accounts? Wages account debit to cash or bank, or wages account debit to outstanding wages. Correct? If you haven't paid, correct? So here what will be the entry? Wages control account debit to GLA. Are you clear with this? That's about it. So write down wages control account debit to GLA. That GLA can be cash or bank or vendor, or it can be an outstanding wages, whatever it is. Are you clear with this? Are you clear with this, guys? Is everyone understanding this? Is everyone understanding this? Yes. Now, number two, utilization of wages. Utilization of wages. Now what happens, guys? Now what happens if you see, let's say I am maintaining a wages account. Okay, so to GLA, I would have given some figure on the debit side. Correct, guys? Correct or not? Now what happens? This wages need not necessarily be direct wages. All wages put together, I have put it in a single figure. Now, to the extent it is attributable to direct wages, I will transfer it to which account? WAP account. Correct or not? So I will transfer the direct wages component to WAP account. Then indirect manufacturing wages, I will transfer it to POH account. Correct or not? Then let us say I have indirect admin related overheads. I will transfer it to AOH. Indirect sell-in related overheads, I will transfer to SOH. Now, if there is any abnormal idle time, what will I do? Transfer it to abnormal loss account. Are you clear with this? I will transfer it to abnormal loss. So basically, if you see, whatever you have incurred, it will be a sum total of all these things. Are you clear with this? Always remember, wages account will tally and should tally. Why? Because you can't stock wages, no? It's not like raw material. You can't stock wages, correct or not? So any abnormal idle time, treatment of abnormal idle time, that's what I'm talking about here. Abnormal idle time, what will I do? I will transfer it to abnormal loss account. Are you clear? So abnormal loss account is a common account for tracking your abnormal material loss and abnormal idle time. Are you clear with this? Are you clear with this? So utilization of wages, what will be the entry? Write down WAP account debit. So this is with respect to direct wages. POH account debit. This is with respect to in factory supervisor. Example, factory supervisor. Then AOH account debit. Let's say this is office workers. SOH account debit. Let's say this is sales depot workers. Then abnormal loss account debit. This is abnormal idle time to wages control account. Are you clear? So to the extent attributable to the respective components, you will transfer it to the respective items. Guys, are you all clear with this? Are you all understanding this? Are you all understanding? Guys, please answer no something. Please, are you all understanding this? Yes? You guys are understanding this? Perfect. Right, guys? Very good. Are you all clear? Yes. Okay, fine. Madhubita. Yes. Others? Yes, you guys are clear with this? Yes. Okay, done. Are you all clear with this? So that's about your wages related entries. Now, one more component of prime cost is there. What is that? Direct expenses. Now, in the 10 ledgers, do we have a direct ledger expense account? Do we have a direct expense account? No. Correct? We don't have. Now, assume direct expense ledger was also there. Example solra. Just assume direct expense ledger was there. What would have been the entry? First, incurring direct expenses. Direct expense account debit to GLA. Assume it was there. This is not an entry. Okay. Now, why do you incur direct expenses? In your factory shop, correct? This will be transferred to where? WAP, correct or not? So the entry will be WAP account debit to direct expense, correct or not? Basically, this direct expense gets cancelled. Or directly can I pass the entry WAP account debit to GLA? Are you clear? So for direct expense, the entry is going to be WAP account debit to GLA. This is a pass-through ledger. What is the point in having it? So they have decided not to have that ledger only. I have not decided like that. They have decided in cost accounting standards. Are you clear? So you don't have a direct expenses ledger. Direct expenses are directly debited to your WAP account. The entry is going to be WAP account debit to GLA. Are you clear with this? Yes, guys. Are you all understanding this? Fairly simple. Yes. So the components of prime cost are over. So you know how to pass entries for that. Are you clear? Now comes the main part of the discussion. Your overheads, mainly your overheads. How do I account for overheads? That is the subject matter of discussion here. That's the, relatively complicated part. I wouldn't say complicated. You guys know how overheads operate, but whatever we saw in overheads chapter, now we are just going to put it in a ledger format. Are you clear with this? Let's get started. Let's get started. So the next one is going to be your overheads related entries. Overheads related entries. First, you tell me guys, how many types of overheads do we have? How many types of overheads? 3 types. What are they? POH, AOH and SOH. Correct. Fine. Now, we saw that these two are. No. For the time being, please don't go back to this format of cost sheet and say, sir, what happened to those 4 specific items and all? No. I told you, ideally, those 4 items of additions and all, they are actually a part of POH only. Now, that exclusive separate identity and all is there only for cost sheet chapter. When you are doing all this cost ledger accounting, everything gets merged into POH. That's why I told you, our institute wants to test it in that way. That's all. Even CMA institute doesn't have those 4 separate items and all. CMA exam, if you are sitting, this format of cost sheet itself is not there for you. Okay, it's separate. It's like you don't have that. Everything is merged into only one, your POH. So have this general thing that the knowledge that I gave you, the general logic behind it. So all these things, whatever cost incurred, indirect cost incurred inside the factory is POH. Indirect cost incurred inside your corporate office is your AOH, and sales area is your SOH. Are you clear? And you guys know that this is a period cost. Correct guys? Correct guys? And this is a product cost, and this needs to enter into your product through the absorption route. Are you clear with this? And this is what we saw, absorption. These two are period costs, means they also get absorbed, but directly they just hit your costing P&L. Are you clear with this? Are you clear with this? Are you clear with this? Fine. Now what we will do is now in each of these 3 overheads, whenever I say overheads, now I'm saying all the 3 overheads, generally you have 3 phases of accounting in each of the category, be it production overheads or admin or selling overheads. You have 3 phases of accounting. Number 1, actual overheads, accounting for actual overheads. Number 2, accounting for absorbed overheads. And number 3, at the end of the year, you do what? Under absorption or over absorption. Correct? So for all the 3 types of overheads, you have this common thing. Account for actual overheads, account for absorbed overheads, account for under or over absorption. Yes? Are you clear with this? Now you might have a doubt, sir, you only told me overhead absorbed is only accounted. Overhead accounted. I told you, no, overhead absorbed is only overhead accounted, no? Yes, that is only accounted. How to do all these things, I will tell you right now. So just wait. Once we finish this, if you still have doubts, you can ask me. Clear with this? Clear with this? Now, let me just go take a POH account. Fine. Let me take a production overhead account. Now, guys, you tell me guys. Now, actual incurrence of production overheads will increase the production overheads expense. Are you clear? It will get debited or credited? Debited. Correct or not? Now you tell me, production overheads, indirect materials, I will get it from SLC. Correct or not? Issue of indirect materials. We saw what was the entry? POH account debit to SLC. So can I say to SLC? This is my indirect material, some figure. Correct? Then indirect wages, it would have been transferred from your wages control account. Correct? POH account debit to wages control. Yes, Vishnu. Yes, correct. We saw the entry, no? Indirect wages. Correct? So to what? Wages control account. Let's say some figure. Apart from that, any indirect expenses now you are incurring, what will be the entry? You are incurring an indirect expense right now. So production overheads account debit to GLA. Correct or not? WAP varudhu. Actuals will go into your WAP directly. It can't get into your WAP directly. Correct or not? Fine. So to GLA, correct or not? To GLA, I have some expense. Are you clear with this? Are you clear with this? So these are all actuals. This is indirect material. This is indirect labor. This is indirect expense. I told you all these three put together is called as production overhead. Are you clear with this? We drew all the line and all. I told you green ink item put together, bucketed together, prime cost. Red ink item put together, it's called as POH and all. I told you that how it is coming. Are you clear with this? Guys, please respond. Please respond. Yes. Now you tell me. Now you tell me. Now you tell me. Guys, now you tell me. Now, throughout this year, I keep incurring these expenses. Correct or not? Correct or not? Now, I need to value my every unit of product the moment it comes out of my machine. Correct? Now, can I wait for the year end and do that? No. Costing can't wait till year end. So what do? You arrive at something called as absorption rate, multiply with the actual base quantity consumed, and parallelly you absorb. That is, parallelly you charge. You remove it from your POH and take it into your WIP account. Correct or not? Correct or not? Guys, correct or not? Absorbed overheads. So what I will do, absorbed overheads will be by WIP some figure. The entry will be WIP account debit to production overheads account. Are you clear with this? Why? Because now I am taking it. Expense get reduced and it gets converted into an asset. It gets converted into an asset. I am charging the overheads into the product. Product means what? An asset. Are you clear with this? Are you clear with this? Now, let us assume. Now, you guys know that these three figures put together are actuals. Correct? Correct? This figure is what? Absorbed. Correct? Now, always remember, these three figures are actuals. This figure is absorbed. Correct? Let us say these three figures put together. Is, let us assume, this is going to be 60,000 in our example. Okay? Now, what I will be doing, now guys, look at this. The beauty of this production overhead ledger is that both the debit side and credit side will be parallelly ticking. That is, as and when I incur an expense, I will keep on debiting the ledger. And as and when I keep producing the unit, I will keep on be absorbing using my budgeted rate. So both the sides will be parallelly functioning. Are you clear with this? I will not wait for the actuals. I will do it based on absorbed. That's why I said overheads accounted into the product is only going to be absorbed. Actuals will get debited here. Actual will get debited here in your POH account. Clear? Now let's say I have absorbed a total of 50,000. Yes, we have used some budgeted rate and all, predetermined rate into actual base quantity. Correct? At the end of the year, will your actuals and absorbed be equal? Mostly not. Now in this case, if you see, I have debited 60, but only 50 went into the product. Correct or not? So it is a case of what? It is a case of what? Under absorption. I have absorbed only 50, but actually I have incurred 60. Are you clear with this? So what I will do with respect to this 10,000? I have two methods. You remember? If it is normal, if it is because of normal price level changes, I will use something called as a supplementary rate and apportion between three people. Who are they? Your cost of sales, that is units sold, FG account, WAP account. Are you clear? I wanted to tell you this. You are saying Pata Madri irukku. What is this? Come on, we've spent a lot of time on overheads. No, day 1 and day 2. We put together, we did overheads. Guys, day 2 we did it. Yes, day 2 we did it. Guys, yes, clear with this. Correct? Fine. So basically, if it is attributable to normal reasons, price level changes, these three people will get a share. Or if it is because of abnormal or inefficient reasons, directly take it to your costing P&L. You guys remember that? Yes, you guys remember that? Yes or no? Yes or no? I showed that and all. Yes, and one 10-mark question also, I told you how to do that. Yes, guys, you remember this? Inefficiency in planning. Strike, I told you. That example, I also told you one more thing. In that, paid was there on top, outstanding was there in the bottom, 45 lakhs plus 2 lakhs, 47 lakhs. Now you remember, Yes, yes. Are you clear? Are you clear with this? This you should tell me. I am telling you. Who is going to write the exam? You guys are only going to write the exam. எங்கேயோ பார்த்தா வந்து இருக்குன்னு சொன்னா மத்தியா அப்போவே தெரிஞ்சிருக்கு எனக்கு. Okay, right. Okay, fine. So this could generally what happens, this will be treated as, in the absence of any information, you will treat this as a period cost. If nothing is mentioned, guys, if nothing is mentioned, you treat the under or over absorption as a period cost. Are you clear with this? So I will say by costing P&L. But actually it need not be costing P&L alone. It can also be those three guys. That is your cost of sales, your closing, your FG account and WAP account. They can also get a share. In this case, we are assuming that it's only a period cost. So this part is a pencil circle balance figure. Are you clear with this? Are you clear with this? Guys, are you clear with this? Are you clear with this? Sold and out. Yes, is the period cost that I'm assuming, so I'm taking it as 10,000. Else what you will do, you will say it is by cost of sales, by FG, by WIP. Put together it will be 10,000. But how I split this 10,000 between these three parties will be using the supplementary rate. Are you clear with this? I'm just giving you here. That's all. Are you clear with this? Enna puriyala okay. Solunga. Okay, are you all clear with this, guys? Are you all clear? We have done all the three phases with respect to production overheads. Actual, absorbed and treatment of under or over absorption. Remember, this 10,000 is an under absorption, hence it is here. If it is an over absorption, it will be on this side. Are you clear? It's only a balancing figure. Are you clear? And it need not be necessarily be transferred to costing P&L. If it is a product cost, if it is on account of normal reasons, share it between these three guys. I told you before, yes? Are you all clear? What is the entry we saw? Cost of sales account debit, your FG account debit, WAP account debit, to POH. I told you the logic for crediting the POH account. I will tell you later. This is the reason why we are crediting it. Are you clear? Because at the end of the day, we are consuming more. Are you clear with this? Guys, are you all clear with this? Are you all able to link? Are you all able to link? Now this Vikram Padatla, if you get this Kaidi, you are appreciating. Hey, are you understanding this? There we saw, now there we left out. Now we are linking it here. Okay, are you? You need not appreciate me. First you understand. That is enough. Are you all understanding, guys? Yes. Are you all understanding this? Yes. Fine. Are you all clear with this? Now let's assume. Now let's say this is with respect to what? Production overheads. Now with respect to AOH and SOH, things are fairly simple. Let's say AOH account, SOH account. Things are fairly simple here. Now here also what I have, indirect materials I will get from SLC ledger, indirect labor I will get from wages control account, and any indirect admin overheads I am incurring now only, I will park it to GLA, correct or not? So these are all actuals. Then what I do, I will also absorb. Generally the absorption rate for AOH and all will be a percentage of cost of sales or something like that, cost of production generally they will do. So now you tell me this AOH, SOH and all, is it a product cost or period cost? Period cost. So where will I take it to? I will FG, wait. I will take it to costing P&L. But I told you we have one truck, no. Directly don't take. Everything you will put on your head and take, or you will park it in a truck and you will drive the truck comfortably. Yes, you will take the truck only. So take it to your by cost of sales account, and if there is any difference, this is based on absorption, and if there is any difference, that is always going to be by or to, will always go to your costing P&L account. Are you clear with this? Are you clear? Because it's a period cost. Similarly for SOH also the same thing. To SLC, to wages control account, to GLA, you have all the actuals. Then the absorbed will go to by cost of sales, and if there is any under or over absorption, you will take it to your costing P&L. Guys, are you all clear with this? Is everyone understanding this? Is everyone understanding this? Guys, is everyone understanding this? Yes? Is everyone understanding this, guys? Are you all understanding this? Yes? Right? Perfect. Now, yes, okay. Right? Are you all understanding this? So basically, you have three phases of accounting with respect to overheads, all types of overheads. What are the three phases of accounting? First, the actuals will be debited, absorbed will be credited. If it is a POH account, take that absorbed to your WAP ledger because it's the product cost. If it is a AOH or an SOH, take it to your cost of sales account. It is an expired cost. And under or over absorption, what you should do in case of a POH, if it is a product cost distributed between the three parties using a supplementary rate, or if it is a period cost, you take it to costing P&L. In case of AOH and SOH, under or over absorption is always a period cost. It should always be taken to your costing P&L account. Guys, are you all clear with this? Are you all understanding? Guys, we are taking such a long time so that we are spending more time on the concepts, because that's when you will understand. Are you all clear with this, guys? Are you all understanding this? Is everyone able to follow this? Is everyone able to follow this? Yes, fine, right. Now, you should know one thing. You should know one thing. There is one problem with respect to, but apart from that, yes, there is one problem with respect to AOH also. There is one problem with respect to AOH. What is that problem? What is that problem? I'll tell you. Now, this is the general rule, guys. This is how we do it. You guys are understanding it. POH, AOH, SOH. AOH and SOH, the treatment is same. Correct? Debit your actuals, take your absorb to your cost of sales ledger, balance your under or over absorption, take it to your costing P&L. Clear with this? Clear with this? Now, there is one problem with respect to AOH treatment. What is the problem? What is the problem? Now, can anyone tell me the format of cost sheet? Can anyone tell me the format of cost sheet? Guys, come on, make it fast. Direct material plus direct labor plus direct expense gives you prime cost, plus POH gives you your gross works cost, plus opening WAP minus closing WAP gives you net works cost or simply works cost or factory cost, whatever it is. From that 4 items of plus or minus and all, forget that. Yes, that is there. Forget here. Okay, you just merge it. Okay. Now, what they are saying is, after that, what you do, you adjust for your opening FG, closing FG, you get your cost of goods sold, correct? Cost of goods sold. And after this only, you add your AOH and SOH. You are saying, will AOH and SOH be considered for the part of your stock valuation? No. That's why what we do, POH is considered here for the purpose of valuing my stock. What stock? All my stocks. WAP, FG, everything. Correct or not? Now, don't ask me the reason. Don't ask me the reason. It is not something that, that is very logical also. What they are saying is, please take this with a grain of salt. What we have studied till now is absolutely correct. Absolutely correct. That is only the right treatment. What some people do is, they treat AOH as a product cost. They treat AOH as a product cost. But wait. They treat AOH as a product cost, but they treat AOH as a product cost only to value your FG. So they don't add AOH here. If you add AOH here, it will also be used for valuing your closing WAP, correct? So what they do, they don't want to use AOH to be valued, they don't want to use AOH to value the WAP. They only want to use the AOH to value their FG stock. So what they do here is, so they add a POH, they arrive at gross works cost, add opening WAP, closing WAP and all. Yes, these things are done. Then what they do here is, after they arrive at the net works cost or factory cost, they add AOH. They treat, what is this AOH? I am not talking about AOH related to production. No, I am talking about corporate office expense. That itself they are treating as a product cost. But wait, they are saying this will be used exclusively to value your FG. It should not be treated at par with POH. Are you clear with this? Why are they doing this, sir? GOK only. God only knows. We don't know the reason why they are doing it. Some globally, it's a practice. Some people do it. No logic at all behind that. They feel that admin overhead should also be treated as a product cost, but use it only for valuing your FG. Don't use it to value your WAP. I'm telling you, there is no logic behind this. If there is no logic behind this, then why are you teaching us this? Because in your cost sheet chapter, they are very clear. I'm talking from an exam perspective now. In your exam, what you should do? Cost sheet chapter, they are very clear. Very, very clear. AOH is always a period cost. But the same cost sheet chapter, when they are putting it in a ledger format, at times they are asking you to treat AOH as a product cost only to value your FG. How will we know that, sir? The question will give you. The question will drop you some hint with that you need to find out. It is still there in your exam. That's why I am telling you. Always this is very difficult for me to convince students. One batch, one student came and he started fighting with me. Sir, how is it possible, sir? You only taught like that. Hey, actually, in the Sunday போடணும். I should only ask the institute why they are doing, as if I only created all this. I am just telling you, mark வேணுமா வேணாமா, that's all. It's my duty to tell you what is actually correct, what is required for your exam. So I am telling you both. If you want, you do it, and I told him and I left it there. But honestly, yes, it is hard for me to digest also. But in one chapter, see, if you are following something, you should follow uniformly. In one chapter, they are saying this. In another chapter, they are saying like this. That's what I'm telling you. For your exam, do this. That's all. If they are asking you to treat AOH as your product costs, you should treat it as a product cost exclusively to value your FG. Are you clear with this? Guys, are you all clear with this? Yes, are you all clear with this? So if you add AOH to this, now you will get the cost of production. From that, you will add your opening FG minus your closing FG. You get your cost of goods sold. Now from this, what will you do? You will add only your SOH. AOH is already added above. You will get your cost of sales. Are you clear with this, guys? Are you clear with this? This is one unique way of dealing with AOH. Why? I don't know. I don't know. No one knows. I tried to refer many books and see. No reason is very logical. They have given their own reasons. I am not satisfied with the reasons, and I don't want to tell you that this is why it is like this. Because if I tell you, then you will also start believing it. So I don't want to do that. I am not convinced with any of the reasons that they have given. Some authors I saw, globally they don't follow this, but at times they do it. At times they do it. And in our institute study material, they have done most of the sums using this way only. Most of the sums for this chapter alone, treat it as a separate chapter and deal with it. That's all. Are you clear with this? So an alternative way of treating AOH is what? Not treating it as a period cost, but treating it as a product cost exclusively to value your FG. Are you clear? Now you tell me your AOH account, how it will look like. Now, debit side, if you see, the actual expenses will be there. Actuals, that is to SLC, to wages control account, to GLA, that is indirect material, indirect labor, indirect expenses. I am just having it, or admin related, correct? When I am absorbing, what will I do? I will take it to what account? I will take it to what account? I will not take it to cost of sales. I am telling you now, I am treating it as a product cost. Cost of production. Do you have a ledger called cost of production? Who said cost of production? Silently you are sitting on the corner. I will take it to FG account. I will take it to FG account. Look. Here, look at it. POH was taken to WAP account because it was used for valuing WAP, correct? And if it is included in valuing WAP, it will also be taken for valuing FG, correct or not? Correct or completed goods and incomplete. If you take it into account for valuing completed goods, automatically that will be included in your FG value. Here what they are saying, bypass WAP and directly use it to value your FG. So we will take this to your FG account, and the balance, whatever is under or over absorption, that will always be a costing P&L, that will always be a period cost. Are you clear with this? This one small addition, can you remember, guys? Can you remember? Yes, what happened? Okay, I will summarize. If AOH is a period cost, debit side anyways actuals, credit side absorbed, you will take it to cost of sales. Why? It is a period cost. If they are asking you to treat AOH as a product cost, in that case, you will absorb it to directly FG. You will not absorb it to your WAP. Are you clear? So in this case, what happened? In this case, what happens? Now, in this case, what happens? Absorbed POH will be taken to WAP account. Absorbed AOH will be taken to FG account. And absorbed SOH will be taken to your cost of sales account. Are you clear with this? Guys, are you clear with this? Please reciprocate online, guys. Is there anything that you want me to repeat? Guys, please tell me, are you all understanding? Are you all understanding? Yes, are you all understanding? Yes, guys, are you all understanding this? Folks, yes, are you all understanding? Please, guys, Yes. I don't like calling people by doing this and all, but you are not turning back. What should I do? Yes, okay, you guys are understanding. Yes, perfect. Are you clear with this? Are you clear with this, guys? Yes. So basically, you have two ways of treating your AOH. If it is a period cost, you will take the absorbed AOH to your cost of sales ledger. If it is a product cost, you will take it to your FG ledger. Are you clear? How will I know how will I know how to treat it? Whether as a product cost, period cost, the question will give you a hint. We will see it. We will see it later when we are doing the question. Are you clear? So we have seen what the actual absorbed and treatment of under or over absorption. Are you clear with this, guys? Are you clear with this, guys? Are you all clear with this? Are you all clear with this? Now what happens? Let me just show you how your ledger accounts will look like after we pass all the entries. How your ledger accounts will look like. So first tell me how many ledger accounts we have. SLC, WIP, then FG, correct? Then these three stocks we have. Then we have 4 expenses. What are the 4 expenses? Wages control, POH, AOH, and SOH. Perfect. Then what do we have? One abnormal loss account. And then what do we have? We have cost of sales account. And then we have one costing P&L account. Apart from that, we also have a general ledger adjustment account. Fine. Now, how your accounts will look like? These 3 are stock accounts, correct? So any purchase will get captured here. Any issues will get captured here, correct? So in case of SLC, correct? So which means you will have a balancing figure. By balance carried down, you will have a figure, correct or not? You will also have a by balance carried down here. You will also have a by balance carried down here. Why? These 3 are asset ledgers. They will not get closed. Balance, opening stock, closing stock. This is the reason why you have your raw material, WIP and FG. 3 stocks has opening and closing balance, correct or not? Wages account, I told you, incurrence entry, utilization entry, always tallied, correct? POH account, actuals, absorbed, and balance is going to be your costing P&L, correct? Actual, absorbed, balance is going to be your costing P&L. Again, here balance need not necessarily be costing P&L, it can also be distributed to the 3 fellows. You know that, fine? Here, in our example, I'm telling you. Now, selling over is also actual, absorbed, costing P&L. Now, have this in mind. AOH, I have two treatments of absorption. If it is going to be a period cost, take it to your cost of sales. If it is going to be a product cost, take it to your FG ledger. Are you clear? Next, abnormal loss. I will have here 2 SLC, 2 wages control account, correct? This is nothing but abnormal material loss. This is nothing but abnormal idle time. I will give this and I will take the entire thing to my costing P&L, correct or not? This ledger also gets closed. Now, in my cost of sales ledger, what will I have? I will receive from FG, cost of goods sold I will get from FG, correct? So I will have 2 FG, then I will have, if AOH is also a period cost, 2 AOH, 2 SOH, I will have all these things in a truck, single shot I will transfer it to my costing P&L, correct? In my costing P&L, if you see, I will have by sales in the sense GLA, sale entry will be there, then the cost of sales will come from here, 2 cost of sales. Apart from that, if there is any under absorption and all, it gets captured here. 2 POH, AOH, SOH, some under absorption comes here, over absorption comes here. Are you clear with this? Then I will also have abnormal loss, which always will be on the debit side. And if I net all these things off, I get my operating profit. This operating profit, what will I do? What will I do? You tell me in company accounts what you do. If you have a profit, you transfer it to your reserves, correct or not? So whatever is that reserve, you transfer it. So basically, it's going to be a P&L account, debit to reserves. Now, do you have a reserve account here? No. So what do you transfer it to? GLA. So whatever is the net profit, you will transfer it to GLA. And GLA, what happens? It is a sum total of all the accounts that we have generally passed. And that's about the entire set of 11 ledgers you will be having. If you were to prepare a trial balance, you will have only 3 debit items and corresponding total will be your credit side total in your GLA ledger. Your trial balance will tally. Are you clear with this? So GLA generally has a credit balance. Guys, are you all understanding this? Are you all understanding this? Are you all understanding this? Is everyone understanding this? Guys, are you all understanding? Yes, sure. You guys are understanding it? Yep, fine. Is this understandable? No? Okay, fine. Right. So now what happened was we closed all the expense and loss accounts and we had balance only in asset accounts, that is stock ledgers. Correct or not? correct or not? This is what we have done, and that's about the entire discussion here. But a few more things that you need to know. Now if you see in your FG account, now if you see in your WAP account, now whatever is the total cost get apportioned between two, no? What and what? Completed units and incomplete units, correct? This completed units means what? It should get transferred to the FG account, correct? So when the units are completed, they will not give this as a separate transaction. If at all they give, it's okay. If not, you should know that necessarily units completed should be transferred to FG. What will be the entry? FG account debit to WAP, correct? Now in your FG account, whatever units is sold, the cost side you will transfer it to your cost of sales account, correct? Entry will be cost of sales account debit to FG, correct? Now for sale you will have two entry, one for movement of cost, the other one for recognition of revenue. Are you clear? For movement of cost, what happens? From my FG, now I am giving it away. Entry will be cost of sales account debit to FG. Similarly, I make a sale, no? What will be the sale entry? It will be debtors to sales. Then what will happen? P&L debtors account debit to sales. So you have two entries. So generally I am telling you, sale entries, debtors to sales and sales to P&L, correct? So basically, can I say these two gets cancelled, correct? Or can I say the net entry is only debtor account debit to P&L, or in other words, can I say GLA account debit to P&L? So what you do here is, that's why in costing P&L, sales is credited as by GLA. Are you clear with this? Okay, boss. You tell me what is the sale entry? Debtor account debit to sale. Why are you crediting sales ledger? Income account gets credited, correct? Now you will keep it only in the sales ledger. Your sales ledger, what happens? It gets credited. It has a credit balance. What will you do it? At the year end, you will keep it there. You will transfer it to P&L, no? And close off this ledger. It's a nominal account. It can't be carried forward to the next year. The entry is what? P&L account debit to sales. That's why it gets credited to your P&L account. Correct or not? Directly, I am just merging the two entries and passing it as your GLA account debit to costing P&L. Are you clear with this? So for sales, you have two entries, cost side entry and revenue side entry. Now this cost side entry is not there in your financial accounts, correct? Cost side, will you say cost of sales account debit to FG and all, you don't have this ledgers only, correct? That's why everywhere we use the word control. WAP, control account, FG, control account. Control means what? An internal ledger. It's an internal ledger. It's only for your internal purpose. That way you can differentiate what's an internal account and an account that you deal with an outsider. Are you clear with this, guys? So that's about the overview of this entire particular area. So what we saw was right from how you issue, how you purchase the stock, how it gets consumed and sold, all the set of transactions we have seen. Guys, are you all clear with this? With a specific focus on what? With a specific focus on absorption. Your overheads, actual, absorbed, and the balance figure should be taken to your costing P&L. That under or over absorption, you remember, it need not be on the credit side. It can also be on the debit side. Under means here, over means here. So it can be on either of the sides. So if I say under, automatically, the ulta entry is going to be for over absorption. Are you clear with this? Now, one final thing I will just tell you. We will take a break after that. And then we will come back and do one comprehensive sum and finish it off. Clear? One final thing I want to tell you before we take a break. One final thing. Please hear me out. This is something that I'm going to tell you for the first time. So please scribble running notes for this. It's quite important. Okay. Guys, come on. Now, let me just take an example. Let's say we are having a POH account. Let's say on the debit side, we have 20K. What is this 20K? Actuals are absorbed. Actuals, yes. Now, what will be on the credit side? Absorbed. Let's assume it's this 15K. I have absorbed 15K. Actually, I have incurred 20K. What is my under or over? Under absorption. How much is that? 5,000. Perfect. Now, how will I treat this 5,000? Number one, if it is a product cost, apportion it between those three guys. Cost of sales account, FG account, WAP account, using something called as supplementary rate. Perfect. Done. Second, if it is because of abnormal reasons, what will I do? I will take it to my Costing P&L, correct? Perfect. So globally they said it's always a period cost, but our people said deep dive into it, segregate it to the extent attributable to normal reasons, take it to your those three items, abnormal reason, then you take it to your costing P&L, correct? So two methods we saw. So method one was what? Your normal reason. Method two was what? Abnormal reason, that is period cost. So this is product cost. Here you treat it as a period cost. Now there is a third method. Now, sir, why didn't you teach this before when we did overheads chapter? Because again, this particular area was not there in overheads chapter. This particular area is there only in this chapter they have given. And suddenly if you see your study material, in this chapter alone they would have given something you will not even understand what it is, because it is not explained anywhere. So I want to give you this background. So there is a third method. What does this method say? Don't do anything. The method says don't do anything. It says you need not do any accounting. Okay, you need not do any kind of accounting. Guys, not in the class. This is not fair. Please don't do all this in the class. Okay. So the third method says, fine, just leave it just like that. Now, for example, this is your actuals. This is your absorbed. 5,000 what they are saying, generally we take it to costing P&L. This method says, you just leave it there as by balance carried down. What? By balance carried down. How can you take this? It's an expense ledger and you want to carry it forward the next year. Isn't it illogical? No, there is some good logic here. So guys, tell me, what does the third method says? Don't do any kind of accounting here. Leave it there. It will be taken care of automatically. How can it automatically taken care of? I will give you the logic. Are you clear with this? The third method says what? Leave it just like that, which means in the next year, POH account will have an opening balance, correct or not? It will be a running ledger. So all your overheads will be running ledgers. This is another method that is also followed in India. This is another method that is also accepted in India. Now, sir, this is an illogical method and you are also trying to support this method. Why is it like this? Why do you say it's a logical method? Now, if you look at this, let's assume the budgeted overhead was rupees 20,000. Let's say the budgeted hours is going to be 20,000 hours. So what's the absorption rate? 1 rupee per hour, correct? Now let's assume that the actual hours is going to be 15,000 hours. Meaning, what's my absorbed overheads? 15,000 into 1, correct or not? Which is going to be 15,000 rupees, correct? Correct guys. Now what this method says is, you had originally planned to incur 1 rupee per hour, correct or not? So let us prepare our costing records only at normal costs. Let us not prepare it at actual cost. Now if I don't record for this difference, if you see 5,000 rupees difference, if I don't record it, bring it to my P&L, it's as good as I'm ignoring it, no? Correct? If I ignore it, which means I'm overstating my profit, correct or not? It says it's okay. The method says it's okay. Why? Because I don't want you to report actual profit. I want you to report normal profit. You normally budget 1 rupees per hour only, no? Yes. Now 20,000 was planned. You have absorbed only 15,000. Why? Because there is a problem with your budget. Who asked you to plan for 20,000 hours and consume only 15,000 hours? You should have originally planned for 15,000 hours. Had you planned for 15,000 hours and consumed actually only 15,000 hours, this problem wouldn't have arisen, no? Correct? So, account only at normal cost. Don't say I'm not, I want to account at actual cost and all. Actualities will have some abnormalities. Please don't have any of this. So, I will always account only at normal cost. Now, you can have a doubt. This method goes on to say, wait, you need not have to worry. This year there is an under absorption. Hello? This year there is an under absorption of 5,000 rupees. It will be carried forward the next year, correct? What this method says is, next year if there is an over absorption, it gets knocked off. Correct? Over a period of time, this should get knocked off. Yes, if there is an over absorption, it gets knocked off. So this method is good only. Now you will have another doubt. What if in the next year also I have an under absorption? Correct? Yes, number pulling alam bayangaram la. Yes. So yes, next year also has an under absorption. What will you do? Then this method says there is something seriously wrong with your budget. There is nothing wrong in my system. Correct only, no? Only if your budget is almost same as your actuals, this problem itself will not be there. The problem arises only if you are not budgeting properly. So if you keep on accumulating, your under or over absorption, suddenly in 1 year, if you notice and hit your P&L, that single year can't take this entire cost, and there will be an abnormal loss in that particular year. Correct or not? That can't be done. Yes, this method also agrees. What this method says is, it will show you a trigger. If 2-3 years you start accumulating it, it means that you're going wrong in your budget. Go rectify it. Clear? So it's not, the objective here is not to keep on accumulating it. It should not be accumulated. It should get offset within the next year or two. If it is still accumulating, go revise your budget at least from the forthcoming years onwards, so that over a next period of time it gets knocked off. Are you clear with this? So this method is also accepted. Are you clear with this? So what you should do in this method, you just have to carry it forward as a balance, and your overheads account will also keep running as a ledger. How will I know, sir? How will I know which method to follow? In your question, they will give you an opening trial balance. In that opening trial balance, if you see production overheads account, it means that they are following this method. Are you clear with this? If your overheads account, generally will it have an opening balance? Absolutely not. It's a nominal account, expense. But if it still has an opening account, it means they are having this habit of you're carrying it forward. Are you clear with this? Are you clear with this? So if you do this, definitely what happens? Your profit will change. If you are not considering under absorption, current year profit will change and all. No, it will be more overstated. They are saying we are reporting normal profit. We are not reporting actual profit. So it's okay you follow this method, but ensure that in your cost accounting policy, you mention the method in which you are absorbing your overheads. Are you clear with this? This is a cost accounting policy similar to depreciation. I told you have methods of depreciation, methods of stock valuation in your accounts. It's a cost accounting policy. What is cost accounting policy? Your treatment of under or over absorption. That is your cost accounting policy. Are you clear with this? So broadly, three ways are there. One is distributing, or okay, you can actually say two ways. One is segregate it into product period and do it accordingly. The other one is just carry it forward to the next year and close it off. Are you clear with this, guys? Are you clear with this? With this, we have completed the entire accounting treatment with respect to non-integrated accounts. So let's take a break now. Yes, let's get started. Now, it's on page number 88. Yes, 88. Okay, so let's do this. Okay, right. Now, the following balances are obtained from the books of XYZ Company Limited on 1/1/20X1. Stores Ledger Control Account, WAP Control Account, FG Control Account, General Ledger Adjustment Account. Clear? They have given some balance. Okay. The following information is received at the end of the year. So they have given some transactions and all. So they have given a list of transactions here. Okay. So we will read it. We will read it whenever we are doing the sum. You are required to record the entries in cost ledger for the year and prepare the trial balance. That's all. They are saying you are required to record the journal entries in cost ledgers. Now guys, you tell me, now costing books can be maintained in two systems. What are the two systems? Integrated, non-integrated. In this question, which method should you follow? Non-integrated. Why? Huh? Why? Trial balance la? Trial balance la? They have given, correct only, no, you were correct. Yes, in the trial balance, they have given a GLA account, which means that GLA account is there only if you are following a non-integrated system. Correct? Yes, guys, are you all clear with this? So, yes, this sum has to be done by way of your particular, what do you call? Non-integrated system. And one more thing. Look at this. Read the wordings. Admin overheads applied to finished goods. Yes, which means it's a product cost that needs to be charged to your FG. Are you clear? So this is where I said the question will give you the hint. Are you clear with this? Fine. I think the others or the other areas are all something that we can directly do. So now I'll tell you how to do this sum. What you need to do is open 11 ledgers. First open 11 ledgers. Empty ledgers you open and keep. Whenever you read, go in a sequential order, starting from the opening balances. Transaction wise, you do the dual posting, debit in one ledger, credit in another ledger. Transaction wise, you do it. By the time you reach the last transaction, you will complete the entire sum. Are you clear with this? Always follow this. Whenever they are testing you on these kind of sums, go chronologically in the same order and finish it off. Yes, guys, shall we get started? Shall we get started? So please go and open your, so go to your book. It's on page number, so question number 1 on page. Okay, okay, right, fine. So let's get started. Now, what is the first ledger? Hello, guys. Yes, stores ledger control account. Fine. Just open it. Open it. 4, 5, 6. Leave some 6, 7 lines gap. Leave some 6, 7 lines gap for this. Gap as in the ledger should be 6, 7 lines worth. Next, go to your WIP control account. WIP control account. Another 6, 7 lines gap. Another 6, 7 lines gap. Then go to your FG control account. Go to your FG control account. Relatively smaller, some 4 lines gap is enough. Then go to your wages control account. Wages control account. Please write it fully. Wages control account. So leave some 6, 7 lines gap. Then go to your POH account. Open a POH account. Production overheads account. Production overheads account. So leave some 5 lines for this. Debit, credit. And guys, under this POH account, leave some 1, 2, 3, 4, 5, 6 to 7 lines gap. Plain gap, no ledger, plain gap. I will tell you the reason and all. You just leave some 6 lines gap below this POH. Below this POH, I will tell you. Trust me, I will not waste your space. I will not waste the space, don't worry. I will do it. I will do it. Okay. So some 4, 5 lines gap you leave. Then open AOH account. Open AOH account. Some 4 lines gap. 4 lines gap. How will I know how many lines to leave? Automatically, when you start practicing, you will get it. So don't worry about that. Next, SOH account. Another 3, 4 lines gap. Safety purpose, 4 lines you leave. Then you have what? What is the next ledger? Abnormal loss account. Yes, abnormal loss account. Abnormal loss account. Leave some 4, 5 lines. 4 lines will do. 4, 5 lines gap. Guys, I hope you guys are opening the ledger. Okay, yes. Then open cost of sales ledger. Yes, cost of sales account. Cost of sales account. Cost of sales account, small ledger, 4 lines gap will do. Then costing P&L account. Costing P&L account. Leave some 8 lines gap for this. Leave some 8 lines gap for this. Then general ledger adjustment. You need not plan your space because this is the last ledger. So maybe you can just open and keep it. Maybe you can just open and keep it. Whenever you want to extend, you can extend it because it is not going to be, it's a last ledger, so you can plan. You need not plan your space for this. So all 11 ledgers open, guys. Guys, opened all the 11 ledgers. Yes. Shall we get started? Shall we get started? Shall we get started? Yes. Yes. Okay. Let's do this. Let's do this quickly. Now, first go read the question. Read the question. So what do you have first? You have some opening balances. So shall we just go and fill it up? Guys, I'm going to pick the figures only from you. I'm going to pick the figures from you. So please be alert. Please be alert. So first tell me, what is the first ledger? SLC. So write down. To balance. Carried down. How much? 5,000. Then sorry, yeah, brought down, yes. To balance brought down, 5,000. Then WAP ledger, to balance brought down. How much is that? 2,000. Then FG account, write down. To balance brought down. How much? 1,000. Correct? Then GLA ledger. Correct? So just go down and write down GLA by balance brought down. How much is that? 8,000. Correct? So the opening trial balance entries have already been populated here. Guys, clear? Clear? Trial balance is done. Now what you need to do, current period transaction, read the transaction, do the dual posting then and there. Simple guys, 10 marks, take it in both your hands. Shouldn't make any mistake here. Now, what is the next one? Purchase for stores. Entry will be what? SLC you will debit and you will credit what? Guys, GLA. Yes, GLA gets credited, SLC gets debited, correct? So write down, to GLA, how much? 29,500. So immediately what will you do? Go to GLA and buy SLC. How much? 29,500. 29,500. Next. Purchase for special jobs. Entry. WIP account debit to GLA. Direct purchase. Biryani. Yes, direct purchase. So yes, since we are in GLA, we'll do it. Buy WIP. How much? 1,800. So go up and go to your WIP ledger. Done? Yes. Write down to GLA. Va? Write down special job. How much is that? 1,800. Next entry. Returned from suppliers to returned to suppliers from stores. Entry. SLC reduces credit, so GLA debit. So go to your GLA account, go to your SLC ledger. First, write down buy what? Yes, write down buy GLA. How much? 200. Then go to your SLC, go to your GLA and write down to what? To SLC. How much? 200. Correct? Next. What is the next one? Now, they have given a few items here. Now, direct wages, indirect factory wages, salaries of admin staff, salaries to selling and distribution staff, abnormal idle time. Total is 31,300. What will be the entry that you will pass? Now, tell me, when you have wages, two entries are required to be passed. One is incurrence. The other one is utilization. First entry will be wages control account debit to what? GLA. How much? Single shot 31,100. Then from my wages I will distribute this to WAP. I will give this to what? POH, this to AOH, this to SOH, and this one to abnormal loss account. Correct or not? Guys, we saw that entry now before. Yes. So let's do this. So first go to your wages control account. So write down what's the entry. First, to GLA, how much? 31,100. Immediately go to your GLA ledger, do the dual posting. Buy wages control account. WCA means wages control account. 31,100. Correct? Yes, guys. Then what will you do? Utilization entry. In your wages control account, go to your wages control account and write down buy WIP, that is for direct wages, 20,500. Then buy POH, how much is it? 4,500. Then buy AOH, how much is it? 3,400. Then buy SOH, how much is it? 2,400. And buy abnormal loss, how much is it? 300. Clear? Now go to the respective ledgers and debit these items. Can you tell me one by one? First WAP, how much? So write down to what? To wages. Within bracket, please write down direct wages. WAP account alone we will track this. So tell me how much is it? 20,500. Then POH account. So go to your POH account and write down to what? Wages control account. How much is that? 4,500. Then admin overheads. Two wages control account in your admin overheads. Two wages control account. How much? 3,400. Then go to your selling overheads. Write down two wages control account. How much? 2,400. Yes. Then go to your abnormal loss account. Write down two wages control account. How much? 300. Correct? Direct expenses entry. WAP account debit to GLA. So go to your WAP account. Go to your WAP account and write down to GLA within bracket. Write down direct expenses. How much is that? Evlo 2,200. So immediately go to your GLA. Immediately go to your GLA ledger and write down by what? By WIP. How much? 2,200. Please guys, always do dual posting immediately. If you do only one posting, then again you need to read the sum and do the second posting. It's a waste of time. When you're reading a transaction, do the dual posting, dual entry. Next up, okay, production expenses. So guys, tell me, production expenses incurred only, no? Correct, this is incurred, right? Fine, so production expenses, how much? Entry to POH account, like you need to go and debit your GLA. How much? 5,100. Immediately go to your GLA ledger and credit POH account. Write down by POH. How much? 5,100. Next transaction. Admin expenses entry. AOH to GLA. So write down in your AOH ledger to GLA. Figure 4,100. So go to your GLA ledger. Write down by AOH. How much? 4,100. Yes. Next. Selling and distribution expenses. So selling and distribution expenses. So go to your SOH. Write down to GLA. Figure 2,600. So immediately go to your GLA ledger. By SOH. How much? 2,600. Then what have they given? Stores issued to production entry. WAP account debit to SLC. So in your WAP account write down to SLC within bracket direct materials. Within bracket direct materials. How much is that? 30,500, and immediately post it here on your SLC ledger. Write down by WIP 30,500. Correct guys? Done? Guys, are you all doing it along with me? Yes, you guys are doing it, no? Then what is the next transaction? Materials lost from the stores by theft. Yes, 400 rupees entry. SLC reduces and there is a loss entry. So abnormal loss account debit to SLC. In your SLC write down by abnormal loss. AL stands for abnormal loss. Figure is 400. So go to your abnormal loss ledger. Go to your abnormal loss ledger and write down what? To SLC. How much? 400. So basically your abnormal loss has your abnormal material loss and your abnormal idle time. Correct? Fine. Then what else? Stores issued to maintenance account entry. POH account debit to SLC. Correct. Maintenance, obviously stores will be located in the factory. In the absence of information, it is for factory maintenance. Okay, clear? So from my stores it gets reduced and it turns into an indirect manufacturing cost. So entry will be POH account debit to SLC. So write down POH account, go to POH account and write down to SLC, figure 1,300, and then what should you do? Go to your SLC ledger and write down by POH. How much? 1,300. Are you clear with this? Dual posting done? Done guys. Next, production overheads. Production overheads applied to production. How much? 20% on prime cost. What is this? 20% of prime cost is called as what? Absorption rate. I told you 6 base quantities can be there. What are the 6 base quantities? Machine hours, labor hours, percentage of direct material, percentage of direct labor, percentage of prime cost, and finally your production units method. Are you clear? Here they have used percentage of prime cost. Now prime cost, do you know? Prime cost, do you know? Yes or no? You can add it up. That's why this POH account, under that I have given you some gap. That gap is what? Calculation of prime cost, and that prime cost apply 20% and do it. So tell me guys, what is the absorbed overheads? Applied, absorbed, all one and the same. What's your prime cost? You can just look at your WAP account. Guys, look at your WAP account and see this. That's why I have given all these names and all. You can easily get it. So tell me, how much is it? Material, labor, overhead, sorry, material plus labor plus direct expenses, correct or not? So tell me, how much is your prime cost? 53,200. Any other answer? Any other answer? 53,200. Any other answer? I know what you guys would have done. I know what you guys would have done. You guys would have added only these three, correct? This 1,800 special job means what? That is also material consumed, but it directly came from the supplier's location to my factory. That is also a part of your, prime cost. Guys, clear with this? How many of you missed that out? How many of you missed that out? Online folks, how many of you missed it out? Yes, please mark it in a red ink. Please mark it in a red ink. That's the reason why I'm giving this alone within brackets and all. Please put it in a red ink. So write down under POH account, write down working note, POH absorbed. POH absorbed. Under that, write down direct material consumed is equal to, so here on the extreme right, just go to the bracket and write 30,500 plus 1,800. This 1,800, put it in a red ink. 1,800, put it in a red ink. This special job is also direct material consumed only. It's going to be 32,300. Next, direct labor, how much is that? 20,500. Then what's your direct expenses? 2,200. Clear? Fine. So what's going to be your prime cost? Prime cost is going to be 55,000. 55,000. Now tell me, POH absorbed is going to be 20% on 55,000. How much is that? Which is going to be 11,000. Are you clear with this? Are you clear with this? How we arrived at absorbed production overheads, guys? Are you all understanding this? What will be the entry? WIP account debit to POH, guys. Answer no. Only a few students are answering. Napa? What is the entry? Okay, WIP account debit to POH. Appdi sonna ipdi solreenga. Idu sir solradhu. Okay, right. Okay, so write down by WIP. How much is it? 11,000. Go to your WIP ledger. Go to your WIP ledger and write down to what? To POH. POH within bracket working note. 11,000. Are you all clear with this? Guys, are you all clear with this? Guys, are you all clear with this? Yes. Next. What is the next item? Admin overheads. Apply to what? Apply to finished goods. Entry will be what? So you will remove it from your admin overheads and park it in your FG. So take a red ink. This is a unique item, I told you. So take a red ink, unique item. So go to your FG ledger. Go to your AOH ledger. Go to your AOH ledger and write down by FG. How much? How much, guys? 7,200. And go to your FG and write to what? To AOH. How much? 7,500. Are you clear with this? 200 are there? Okay, 7,200. 7,200. 7,200. Okay, right, 7,200. Then selling and admin expenses applied to cost of sales. How much is it? 6% on sales value. So how much is your sales value? 80,000 into 6%. How much is that? So 4,800. Take a normal ink. Take a normal ink and write down. So go to your what? Say SOH account, what will you write? By cost of sales. Correct? It's a period cost. How much into how much? 80,000 into 6%. How much is that? 4,800. So go to your cost of sales. Truck account, cost of sales. To what? To SOH. Figure 4,800. Clear, guys? Clear? Are you all clear with this? Are you all clear with this? Next step. What is the next thing? Finished goods produced during the year 66,000. Entry will be what? Okay. FG account debit to WAP. So your WAP now turns into FG. Correct. So write down. Go to your FG account. And write what? To WAP. Figure how much is it? 80. Yeah. The next figure. 66,000. 80,000 is sales. 66,000. Correct. Then go to your WAP account and write down what? By FG. How much? 66,000. This is nothing but cost of goods produced. You remember? FG done your transfer. Completed units. They have given the value. You need not value it. Fine. Next, what is the thing? Goods sold during the period at sales value. Entry will be what? I told you. Net entry. At sales value. GLA account debit to costing P&L. Correct or not? Costing P&L, you will credit sales, no? Correct or not? Sale value, boss. Sales value, yes. So go and write down. What is this? Costing P&L. Write down. By what? By GLA. Figure 80,000. GLA account. Write down. To costing P&L 80,000. To costing P&L 80,000. Next. Goods sold during the period at cost. Entry. I told you, sale you have two entry. Revenue side entry and cost side entry. What is the cost side entry? Now what was there in your FG stock goes into your cost of sales. Correct or not? Guys, what happened? Only few students are answering. Others, yes, are you all understanding? What was an asset now becomes an expired cost. Cost of sales account debit to FG. So go to your cost of sales account. Write down to FG. Figure how much? 69,500. And go to your FG account and write what? By COS, cost of sales. How much is it? 69,500. Done now. Everything is done. Yes. So now let's start closing the ledgers. Transaction wise we have done. Let's start closing the ledgers. Now first the SLC ledger. Debit side total or credit side total? Which side there is? The total is more. Debit asset has more debit side. No. Debit side will be total. How much is it? 34,500. What is the balance figure? By balance carried down. Evlo? 2,100. Correct? Pencil circle balancing figure. Correct? Asset account shares a balance. Next, WAP account, total it. Debit side total, how much? 68,000, which means by balance carried down, how much? 2,000. Total is 68,000. Correct, guys? Yes, done. Next, FG, total it up. How much is it? 74,200. Out of which you have sold 69,500. What is the balance FG? By balance carried down. Figure 4,700. Are you all clear with this? Wages account. What is the balance? No balance. And this account should necessarily tally 31,100. Whatever is your incurrence should be utilized. Correct? Yes. Next, POH account. Debit side total or credit side total? It can be any side, no? Correct. Ideally, it can be under or over absorption, can be in any side. Correct. So tell me, FG account, your POH account, which side it's more? Credit side, meaning what? Under, over absorbed. You have absorbed more than what you have actually incurred. So how much is your under or over absorption? How much is that? So write down to costing P&L. How much is that? 100, pencil circle, and then pull an arrow and write down over absorption. Over absorption. Immediately what should you do? What should you do? Immediately go to your costing P&L and put it on the credit side. By POH account. Costing P&L by POH account within bracket over absorption. What is the figure? The figure is 100 rupees. Guys, are you all clear with what we are doing? Look how we are sequentially closing the ledgers. This is something that you should do in the exam also, guys. Okay, clear with this? Clear with this? Now, go to your AOH account. Go to your AOH account. Which side has a more balance? Debit side or credit side? Debit side. So, which means you have incurred more. So, 7,500, 7,500. So, by what? Costing P&L. Under or over? It is an under absorption. Figure 300 rupees. Are you clear with this? In the absence of information, you treat it fully as a period cost. I mean, anyways, this is a period cost. I'm talking about POH, treat it as a period cost. So, in the question, if they have not given any opening balances, which means they are not following that carrying forward method, immediately what should you do? Come down and fill your costing P&L, write down to what? To AOH. How much is it? So, it's under absorbed to the extent of 300. Next, guys, next is what? SOH, debit side total, credit side total. Debit side, how much is it? 5,000. 5,000. So 5,000, huh? Okay, so it's going to be by costing P&L 200 rupees under absorbed. 200 rupees under absorbed. So go to your costing P&L and write down 2 SOH within bracket under absorbed. Figure is how much? 200. Next, what is next? Abnormal loss. Abnormal loss. So tell me, what is the abnormal loss thing? What is the abnormal loss? Total is how much? 700. What will you do with this total? Take it your costing P&L. Write down by costing P&L 700, pencil circle, balance figure 700. Immediately go to your costing P&L and write down 2 abnormal loss. Figure is how much? 700 rupees. Are you clear with this? Are you clear with this? So with this, even your abnormal loss account is closed. Then what happens to your cost of sales ledger? Okay, right. So cost of sales, how much is the total? 74,300. So by costing P&L 74,300. So in the truck, I have already loaded these two components. In a single shot, I will transfer it. Correct. 74,300. So here, go to your costing P&L, write down to cost of sales. How much is it? 74,300. Now, can we just close this costing P&L ledger? Debit side total, credit side total. Which side is more? Debit. Credit 80,100. 80,100. What is the profit? What is the profit? 4,600. 4,600. You will transfer it to what ledger? GLA. Transfer to reserves. No reserve account here. So transfer to GLA. Within bracket, write down profit. Within bracket, write down profit. Immediately go to your GLA ledger and do what? By costing P&L. The figure is going to be 4,600. Now total it up. Total it up. GLA will always have a credit total. So tell me, how much is the total credit? 89,000. 89,000. So basically, what is the balance? 2 balance carried down. How much is that? 89,000 minus 80,200 is going to give you 8,800, right? 8,800. Guys, are you all clear with this? Are you all clear with this? So look how beautifully we have just done it. If you go by sequence, it will automatically be clear. Just go by the sequence. Are you all clear with this? Wait, we are not done yet. We are not done yet. We just need to prepare a trial balance. We just need to prepare a trial balance. How many items will be there in trial balance? How many items? 4 items. Not 11 items. All the expense and loss accounts will be closed, you know. You have 3 stocks, debit and 1 credit, that is GLA. That's all. That's all. Clear? No 11 items and all. Okay, just write down trial balance. Trial balance. So debit and credit, particulars, debit and credit. Particulars, debit and credit. First, SLC account, how much is the balance? 2,100. Next, WAP account, how much is the balance? 2,000. Next, FG account, how much is the balance? 4,700. Clear? Then fourth, GLA account, how much is the balance? Hyphen and 8,800. It's on the credit side. It's on the credit side. Clear? So total it up, successfully tallying or not? Even if it is not tallying, we are known for making it tally. Yes? Yes? Right. Done. Completed, guys. Completed this. Are you clear with how the flow of this particular chapter is? Transaction wise, you just do the entries. Park all the ledgers. First open all the ledgers. Fill that opening trial balance figures. And whatever is the transaction wise, I want you to pass the entries. Are you all clear with this? Are you all clear with this, guys? Are you all clear with how to proceed about with these kind of sums? Yes. Are you all clear with this? So what are the 11 ledgers that we've got here? Guys, what are the 11 ledgers that we've got here? 3 stocks, SLC, WAP and FG. 4 expenses, wages, POH, AOH, SOH. 1 loss, abnormal loss. Then 2 collection account, that is cost of sales and costing P&L. Then finally you have what? You have what? GLA ledger. Now when you are purchasing one raw material, what is the entry? SLC account debit to GLA, correct? Now this is under non-integrated method. Under integrated method, what you do, you are going to maintain all the financial ledgers and costing ledgers together, no? So what you are doing, instead of GLA, so first you use the 10 ledgers, instead of GLA, go park in the respective financial ledger itself. So when you are purchasing raw material on credit, what will be the entry? SLC account debit to the creditor account, correct? When you are purchasing it by paying your cash or bank, the entry will be, it's going to be SLC account debit to cash or bank. Are you clear with this? Simple integrated system means first 10 ledgers of your non-integrated system, and instead of GLA, zoom it out and actually do the entire, provide the entire financial records itself. This GLA ledger is nothing but a summary of all your financial ledgers, correct? Instead of providing a summary, go park it in the respective financial ledger itself, and that is called as integrated system. That's all done. Are you clear with this? There is no new value addition there. Ditto same. Costing ledgers, the 10 ledgers should be there. Correspondingly, till now, what we were parking in GLA should go to the respective financial ledger, and we are done with both the systems. That's all. That's all. Similarly, these kind of sums will be there for integrated system also. You just need to go and park it. Now, integrated system, what they will have? Opening trial balance. They will not have GLA account. Instead, they will have bank account, cash account, debtor account, creditor account. They will give everything. So, respective accounts you need to open and park it then and there. Are you clear with this, guys? Are you clear with this? So, basically, if you know how to operate non-ledger, non-integrated accounts, you will automatically know how to operate integrated accounts. Integrated account is nothing but instead of GLA, go park the ledger, go park the figure to the respective ledgers. Are you clear with this? Are you clear with this? That's about it. That's about the two systems of your cost accounting system. Two cost accounting systems. Guys, are you all clear with this? Are you all clear with this? Fine. Now, one more thing I've told you. AOH has 2 treatments. I can either treat it as a period cost, which generally you should take. Now, if the question gives you some hint and all, charge to FG and all, what you will do, you treat it as a product cost, but charge it to your FG directly. Very good. Now, second one, there are different treatments of under or over absorption. I told you under or over absorption, generally what we do, segregate it into product period cost and accordingly account for it. Else, the other way of doing it is just completely carry it forward. Carry it forward to the next year. Current year, you don't pass any entry at all. Carry it forward to the next year. I told you that is also followed in India. Our cost accounting standards also says that it's a logical method. Clear with this? Clear with this? Fine. Are you all understanding the first 2 segments of this particular chapter? Integrated, non-integrated. Fine. Let's move to the third segment of this chapter, which is called as reconciliation. Now you tell me, reconciliation statement arises when I am following non-integrated, because non-integrated only reports 2 sets of profits, correct or not? Financial profits and costing profits. So let's get started with this particular area. It's fairly a simple area, something that you guys would have already done in your 11th standard, right from 11th standard. Have you guys seen this BRS? BRS, bank reconciliation statement. Yes, when that BRS comes alone, I don't know why there are many students, what they do is, the tea கடையில் வர மாதிரி ஆத்திட்டே இருப்பாங்க. Like this, they will keep on doing it. It's okay, man. Oh, அதுக்கு பேர் hand method, ah? Okay, right. Whatever that is, they will keep on doing like this. They will visualize bank statement, cash statement and all. Fine. Okay, right. Okay. Basically, guys, let's quickly finish this off. No, let's quickly finish this off. Okay. So now, basically, what happens in this area? What happens in this area? Now, first of all, reconciliation. The concept of reconciliation. You will reconcile what with what? One profit with another profit, that is financial profit with your costing profit. So this concept of apportioning the two or reconciling the two profit arises only when you are following a non-integrated system. Okay, fine. So we are going to talk about RECO, that is reconciliation of what? Of costing profit and financial profit. Are you clear with this? Now, some people mug up the format and all. They'll say start from this, add a less and all. Now, broadly, you tell me conceptually, broadly, what could be the reasons why my financial profit shows a different profit and my cost account shows a different profit? What could be the reasons? Can anyone tell me? First, non-operating expenses and income, correct or not? Guys, correct or not? Yes, the first reason for the difference, can I say, is because of non-operating items. Non-operating items. Example, dividend, interest and all. You tell me, dividend received, will it be considered as an income under costing? No, but it will be considered as an income in your financial books, correct or not? Interest paid, it will be considered as a cost only in financial accounts, not under costing, and so on. Are you clear with this? So because of this, that's why I'm saying our subject reports what? Our reports operating profit, whereas in financial accounts you prepare what? You report your net profit. Are you clear with this? Now this is one reason. What is the second reason? Absorption. Under or over absorption. Under or over absorption, is that the reason? At the end of the year, what you do? See, now in your financial records, you debit the actuals. In your cost records, you debit the absorbed. At the end of the year, you compare that with actuals and give it an accounting treatment, no? Correct or not? So even in costing, you match it with your actuals. Then tell me, how can that be a reconciling item? Are you clear with this? Yes, but you are right if the company has a policy of carrying it forward. Are you clear with this? If the company has a policy of carrying it forward, then only, yes, it's a reconciling item. Else, I am accounting for that at the year end. Correct or not? Yes, guys, are you all understanding it? So, under or over absorption, which is carry forward, this could be a reconciling item. Are you clear with this? And in this segment of our chapter, throughout this segment, they will always assume that the company is carrying it forward. Why? Only then you will get one more reconciling item, no? For that only, nothing great and all. Clear? So whenever you are in a reconciling reconciliation area, always it goes without saying, don't assume otherwise. It is always unwritten rule that the company is only carrying it forward. Are you clear? Because it will give you one more reconciling item. For that, they would have kept some marks and all. Clear with this? Fine. Now, this is at least some logical thing. The third reason is the most illogical reason of all. Please, it's actually not a reason in real life, but for our exams, they are considering it. They are saying difference in stock valuation. Now, I told you, they are saying the stock valued under financial accounts is different from stock valued under cost accounts. First of all, I told you, financial account itself, it borrows stock figure only from us. How can it be different? Fine, they want one more reconciling item, so they have kept it. Are you clear with this? Broadly, only these three can be reconciling items. Are you all clear with this? What are the three reconciling items that we've got? Non-operating items, then your under or over absorption. In this leg of discussion, always assume they are carrying it forward. Okay, if they are not carrying it forward, accounting for it, then it can never be a difference, reconciling item. And the third one is stock valuation. Fine, stock valuation now ideally it should not be a difference. Clear with this? And one more thing, prime cost components. Prime cost components, can that be a reconciling item? No, no, why not? Prime cost components, can it be a reconciling item? I'm asking you. No, why not? Prime cost, what are the prime cost components? Direct material, direct labor, direct expense. In your financial account, you always debit the actuals. In your cost accounts, what do? Cost accounts also, prime cost components hits your cost sheet in actuals. That is the reason it can never be a reconciling item. Are you clear with this? Are you all clear with this? And under or over absorption, also remember, it will be a reconciling item only if the company is carrying it forward, and generally we assume that the company is carrying it forward. Are you all clear with this? These are broadly the three reasons why at all a company can have some reconciliation. Are you clear with this? Now with this backdrop, we will go to the sum. Cash discount, yes, cash discount is a non-operating item. Yes, Muralidhar, cash discount, I told you it's a non-operating item. So it will be considered only in your financial profit. It will not be considered in your costing profit. So accordingly, add or subtract. Whether to add or subtract, that we will see right now. But that is a reconciling item. Are you clear with this? Yes, guys, are you all clear with this? Fine. Now, have this alone in your mind. There is no specific format at all. There is no specific format. Add these items, reduce these few items, and you are good to go. Are you clear with this? Are you clear with this? What to add, what to minus, you have it in your mind, logically think. It depends on which profit you start with. Generally, what I would suggest is, now, what is our subject? Costing, correct? Now, from financial accounts, you try to do some reconciliation and arrive at cost accounts. Are you clear? Or in other words, it's not correct, but in other words, I'm saying, from wrong, you go to right figure. It doesn't mean that financial accounts is wrong, but I'm telling you, for the purpose of our subject, the right figure is only our costing profit. So start from financial profit, keep that as the base, to which add or subtract accordingly, arrive at the costing profit, if nothing is given in the question. Suppose in the question they are necessarily asking you to start with the costing profit, then do it as given. Start with costing and add or minus and arrive at your financial profit. Are you clear with? But generally, I would say, if nothing is given in the question, start with financial profits, add or subtract, and arrive at your costing profits. Are you clear with this? Are you all clear with this? Fine. Now, let's go to this question. Let's go to this question. Yep. So, go to page number 94. Now, read the question. What have they given? A company's profit as per costing system is how much? 46,126, whereas the audited final accounts showed a profit of 33,248. So they have given you the costing profit, they have given you the financial profit. You need to reconcile. From the following additional information, you are required to prepare a reconciliation statement showing clearly the reasons for the difference between the two profit figures. Clear? What do you need to do? Prepare a reconciliation statement. So they have given the financial P&L. Sales is given, opening stock purchase, subtotal is given here, this is subtotal, minus closing stock they have done here. So instead of increasing on the credit side, they have reduced it on the debit side, that's all, but it's actually one and the same. Direct wages, factory overheads and all is given, so gross profit, they have transferred it here. From that, admin selling is all removed. One sundry income is also added, they have arrived at the net profit. Are you clear? They have given you the financial P&L. Financial P&L, how do you know it's financial P&L? The sundry income and all is there, no? Correct or not? Yes, yes, fine. And that is the reason why you know that it's a financial P&L. Fine. And of course, one other way of knowing is the figure 33,248, they have given 33,248, it's a financial P&L. Are you clear? Now, the costing record showed the following. The closing stock was different. I told you, ideally, this should never be the case. Anyways, take it with a grain of salt. Direct wages start to production was also different. This is pathetic. You tell me a prime cost component, can that be different under costing and financial accounts? Absolutely not. Absolutely absurd. But anyways, take it with a grain of salt. Again, this is also given, do it. That's all. Don't ask me, it is illogical. It is actually illogical. Fine. Next, factory overheads absorbed. Actual is given here. Absorbed is given here. The difference between that under or over absorption, you should always assume that the company is carrying it forward. Hence, it is a reconciling item. Are you clear with this? Are you clear with this? Similarly, for admin overheads also, you find the absorbed figure, actual figure is given. Difference between the two, carry forward, no accounting treatment is done. then so it's going to be a reconciling item. And you have some selling expenses charged, that is also absorption is given. So basically all the three overheads, absorbed figure compared with actuals, under or over absorption, assume that they have actually done what? They have done what? They have actually ignored it, that is they have just carried it forward. Are you clear with this? Easy sum, guys. Shall we just do it? And I told you, you start with what? You start with financial profit and arrive at what? Costing profit. Shall we get started? And I'll tell you what to add, what to subtract, how that logic has to be done, I'll tell you. So instead of doing all these things, maybe it's a better way of doing it. So let me just do it this way. Fine, let's get started. So this is question number 2, right? On page number 94. So write down question number 2. Now, guys, write down reconciliation statement. Please write down reconciliation statement. Now, I'll give you the template. Please follow this. It's a good template. Write down particulars and two amount columns, rupees and rupees. One is inner column, one is outer column. That's all. Clear? Now, what you do is, you start with what? Start with the wrong figure, arrive at the right figure. Okay, right, wrong, right, but I'm just telling for so that you can remember. Start with financial account. First, write down profit as per financial accounts. Outermost column, right? How much? 33,248. Fine. Then what you do? Write down add, and leave some 4 lines gap. 1, 2, 3, 4. Then write down less and leave again 4 lines gap. 1, 2, 3, 4. And finally, if you add and less all these things from your financial profit, you get what? Yes, write down profit as per cost accounts. Profit as per cost accounts. Don't write the figure. This should be an arrived figure. You should get 46,126. Clear? Now I'll tell you what you need to do. Take a blue ink and write working note. Why blue ink? Because this need not be done in the exam. I'm just explaining the thinking process so that from next sum onwards in your mind you can do it. This sum alone, this needs not be done. No, the sum has to be done in the exam. Working note alone. Okay, that's why working note alone I'm saying. Working note alone you should not do. So, okay. This working note need not be done. Okay, directly you can do it. Now, the working note, I will give you one template. Write down transaction, and 3 columns, small columns. Write down FP, that is financial profit, CP, costing profit, and TBD. What is TBD? Oh yeah, correct. And if you see your IPL fixtures and all, in the playoffs alone they will write TBD, to be decided. Correct? To be decided, because actually in the back end everything will be decided. Cup also name they will write, but that they will not tell us, and like fools we will also keep watching. Still that craze will not go, no? Yes, even I watch. I'm also a fool. I'm accepting only. So yes, that is like sports is something else. Okay, right. Anyways, coming back here. Now, okay, guys. So now first tell me. Now look at that. Now you go to the question. Now tell me what is the first item that is a problem, that has a problem. They have given some items and all. Closing stock. So first closing stock. So point number 1, closing stock. Now you tell me closing stock is valued more under financial accounts or under costing accounts. So cost accounts, yes, sorry. So in your financial accounts it's 150 something. In your cost accounts it is 160 something. Now you tell me your closing stock is a credit item, correct? The credit item is more under where? Costing, meaning what? The profit under costing is more, the profit under financial is less, correct? The costing under financial profit is less, the profit under costing is more, correct? So now you tell me you are standing here. You have started from financial profits, you need to arrive at costing profit. From here, if you want to go here, what will you do? Add. Are you clear with this? Are you clear with this? Simple, no? That's why I said this need not be done in the exam. But one sum, I'm just doing it and showing it to you so that from the next sum onwards, when you're doing it in your house, you can just have this in your mind and do it. That's why I said, suppose you're starting from costing profit and doing financial profit, just reverse this. Okay, so that it will always be there in your, because this is an easy thing, but it's also a confusing thing. That's why I'm telling you, please have this in your mind. So tell me, what is the figure? 6152. So write down, under add, write down, overvaluation, these things should be in black, overvaluation of closing stock in cost accounts. CA means cost accounts. 6152. Next, what is the next item? Direct wages. So write down point number 2, direct wages. You tell me, direct wages is more under cost accounts or financial accounts? Under cost accounts or financial accounts? Under cost accounts or financial accounts? Direct wages is more under cost accounts. It is less under financial accounts. Expense is less under financial accounts. Your financial accounts will report more profit, correct? But your costing will report less profit. So from a higher state, you need to reach a lower state. So subtract. Are you clear with this? So go to your less items and write down difference in wages. Ideally, this should not even be a reconciling item. But anyways, difference in wages 3, 4, 6, 8, correct? How did you get 3, 4, 6, 8? 49,734 minus 46,266, correct or not? Guys, are you all getting it? What is the next line item? Factory overhead absorbed. You tell me what happened here. Actual factory overhead is 41,000 and odd. Now my absorbed overhead is only 39,000 and odd, which means what? You have under absorbed or over absorbed? Under absorbed, meaning what? The amount debited to your costing is less, correct or not? Which means the amount debited to your financial is more. So if your debit item is more under financial, the profit under financial is less, correct or not? So your profit under financial is less, your profit under costing is more. From less you need to reach more, so add it. And what is this item called as? What is this item called as? Under absorption. UA of POH, correct? Under absorption of POH. Guys, are you all clear with this? Are you all clear with this? So just go and update here. Under absorption of POH. So just go and add it. Add the name. Yes, just go and add it. It's very inconvenient. Just go and add it. So write down under absorption. Just go and add it. Under absorption of POH. How much is the figure? 2224. Next, what is the thing? Next, what is the thing? AOH. Actuals is how much? 19,690. Correct. Absorbed is how much? 20,790. Yeah. 20,790 is it? Yes. Okay. So tell me, what is the difference? Under or over? Under or over? Now, what is the amount? The amount debited in costing is more, which means the amount debited in financial is less, which means your financial profit reports a more profit, correct or not? Financial profit reports a more profit, costing reports less, so you need to subtract. From here you need to arrive here. This is what? Over absorption, correct? Over absorption of AOH, you need to subtract. How much figure? So write down over absorption of AOH. Figure is how much? 1100. Clear? What is the next item? Selling overheads. So tell me, under or over absorption? I think there is an under absorption of SOH. Meaning what? Your SOH actual is more, which means in your financial, your profit will be less, costing it will be more. Add it up. How much is it? 9,700. So write down under absorption of SOH 9,702. Correct? Then finally, is there anything else? Sundry income is there, no? That sundry income, if you see, sundry income, it is created only in your financial profits, which means your financial profits reports more. It should not be included while computing your costing profits. So you need less that. So write down sundry income. Sundry income, how much is that? Hello? 632. 632. So add all the add items. It's going to be 18,078. Correct? Just add these three items. Subtract items total is going to be 5200. So if you net it off, 33,248 plus 18,078 minus 5,200, how much is it? 46, 126. Are you clear with this? Is this tallying with what is given in the question? Yes, it is tallying. So this is how you will do your reconciliation item. Are you clear with this statement of reconciliation? This is how it has to be done. Let me just give this a proper finish. So now what we will be doing is, now we just saw the reconciliation, right? So how to prepare this reconciliation statement or not. Now this reconciliation thing can be done either in a statement format or it can also be done on an account format. So it's called as a memorandum reconciliation account. We will see how that is. Now guys, what we'll be doing right now is, solved illustrations are there, so you need not solve fully, so can be happy about that. But just that I'm going to do 3 illustrations. These are all past exam questions. Especially the first illustration that I'm going to do is very important. I think it was tested in July 21 attempt, if I'm not wrong, for 10 marks. Okay, so 10 of 5, I'm not sure, but yes, it was tested in July 21 attempt. So let's do that question right now. So these 3 illustrations, I just want to do it so that once we do it, you will get a complete control over this chapter. Are you clear? So till now what we have done, we have actually covered the entire chapter in terms of all the concepts. We are going to do a few more illustrations just so that you get it right. Just so that you get the entire holistic view of the chapter. Clear with this? Fine. So let's get started. So take page number 90. Right guys, come on, let's get started. Now in this illustration, look what have they given. Look what have they given. They have given you the financial P&L. Direct material, direct wages, POH, AOH, sales are given, and the net profit is also given. Clear? Budgeted output 10,000 units, actual output 8,000 units, production overheads out of this 60% is fixed. Okay, right? Now they are telling you that AOH is 100% fixed. Calculate the profit as per cost records. This is what they have asked you. This is what they have asked you. Yes, clear? Clear? Now don't look at the solution. Please don't look at the solution. If you look at it, nothing is there. Nothing, no creativity is there. Now please do it on your own. Try getting it by yourself. Try getting it by yourself. Now what they have done is, in this sum, they have taken your admin overheads as charged to production. Okay, so admin overheads, they have treated it as a product cost. They have treated it as a product cost. But why? They are asking you to prepare a cost sheet. That's all. They are just asking you to prepare a cost sheet. Reconciliation, they are not asking you. They are just asking you to prepare a cost sheet. Now, fine. Okay. Now you tell me, guys. In your financial accounts and in your cost accounts, correct? Now your prime cost items will appear as such, that is in actuals, correct or not? So if you see direct material, direct wages, these 2 figures are actuals, correct? Now you subtotal, you get your prime cost, correct? Now what is the overheads figure that comes in here? Overhead is absorbed overheads, correct or not? Guys, please, yes, tell me yes or no. Now you tell me, what is the total overheads that they have given? Production overheads, 8 into how many units? 10,000 units. Guys, correct or not? 8 into 10,000 units. The total overheads is how much? 80,000. Huh? This is 20. Yes, on the top they have given rupees in lakhs. No. So my total production overheads is 20 lakhs. Correct? Correct, guys? Hello? Correct or not? Out of which, how much is my variable? How much is my fixed? Variable is how much? So variable is 40%. 40% is how much? 8 lakhs. Nane. It is not 80,000. It is 8 lakhs. Your fixed component is 12 lakhs. Guys, correct or not? Correct or not? Correct or not? Fine. This is what? Actuals. This is what? Actuals. Correct? Correct? Right? This is your actuals. Now you guys tell me. Now, this, in the absence of information, can I say that my actual fixed overheads is equal to budgeted fixed overheads? Correct or not? So can I calculate my budgeted rate, absorption rate, budgeted fixed overheads divided by budgeted units? How much by how much? 12 lakhs divided by 10,000 units. Per unit, how much is it? Per unit, how much is it? 120, 120 rupees. Correct or not? 12 lakhs by 10,000 is 120. Correct? Fine. Now this is my per unit absorption rate. 120 rupees into actual units of 8,000. How much is it? 9,60,000. Guys, correct? 9,60,000. Correct or not? This is the absorbed fixed overheads. Correct, guys? Correct, guys? Your variable overheads is actually your direct expenses, similar to your direct expenses. Correct or not? Variable overheads, I told you, it's nothing but it's actually similar to your direct expenses. Some people call it as variable overheads. Correct? It will also hit your cost sheet in actuals only. Only the fixed component needs to get absorbed. Correct? Yes. So tell me, what is the total overheads absorbed? 8 lakhs plus 9.6 lakhs. Correct? What I am telling you is, this 20 lakhs is actuals. Adu puriyada? Yes, this 20 lakhs is actuals. That you are understanding. This can be segregated into variable and fixed. Variable 8 lakh, fixed is 12 lakh. What is 12 lakhs? Actual fixed costs. Now, in the absence of information, I am assuming that the actual fixed cost is equal to my budgeted fixed cost. Correct? Now, what they are asking you to do, prepare a cost sheet. In your cost sheet, what will appear? Absorbed fixed overheads. How will you calculate the absorbed fixed overheads? Budgeted rate into actual units. Budgeted rate, how will you calculate? Budgeted fixed overheads of 12 lakhs divided by budgeted quantity of 10,000. So, the budgeted predetermined rate is going to be 120. 120 into actual units of 8,000 gives me my absorbed overheads of 9.6 lakhs. Yes? Yes? Now, on this 9.6 lakhs, I can add this variable overheads as such, 8 lakhs. So, what is the total amount of POH that is being charged to your cost sheet? 17.6 lakhs. This is what they have given here. This is what they have given here. Look at this, budgeted overheads divided by budgeted output into actual output. How they have given 60% of 20 is going to be 12 lakhs. Divided by 10,000 into 8,000, they have arrived at this 9,60,000 plus 8 lakhs they have added. So, it's going to be 17,60,000. Are you clear with this? Are you clear with this? Yes. Now, they have done it here. So, if you subtotal this, you get your factory cost. Then they have given you something. What is that? AOH also they have given. So, what is your AOH figure? What's your AOH figure? 8 lakhs. The same thing that I will do. In the absence of information, I will assume that the actual AOH was equal to my budgeted AOH, correct or not? So what you will do, it's nothing but 8 lakhs divided by 10,000 into how many units? 8,000. So how much is that? 6,40,000, correct? Absorbed admin overheads. So 6,40,000. If you add this up, you get your cost of production 74. Sales has been given. You arrive at the profit. Are you clear? In this sum, they have not adjusted for under or over absorption. Why? They are assuming that it is a carried forward figure. Are you all clear with this? This was tested, guys. July 21 exam. July 21 exam question. July 21 exam question. Are you all clear with this? How to tackle these kind of sums? Are you all clear with this? Guys, are you all understanding? Really, you guys are understanding? Yes? Yes, are you all understanding? Able to follow this? Clear with this, guys? Clear with this? Fine. So, that's about this particular question. And look at this. FG valuation is always different. Okay, this is actually not the case. This is actually not the case. You need not actually read this. Maybe you can just put a cross mark here. Fine. When nothing is mentioned, raw material, WIP inventory are same in cost accounts and financial accounts. That is fine. But FG value is always different. It is not always different unless and until it's expressly given in the question. Are you clear with this? So from your financial data and additional data, you know how to prepare the costing data. Are you clear with this? You guys are understanding this? Yes. So let's go to the next one. Let's go to the next one. Now look at this. Look at this particular question. Look at this particular question. What have they given? They have asked you to prepare a memorandum reconciliation account. In that, they have given you certain figures. Loss as per cost accounts, which means they are starting with cost accounts. Okay. Then under absorption, over absorption, bad debts, legal expenses, interest on investment. They have these figures. Now you tell me, you are starting from where? Cost accounts. You want to reach where? Financial accounts. Now, loss as per cost accounts. Since it is a loss, it is parked on the debit side. If you are putting a statement format, you will put it within brackets. If you are putting it on a ledger format, put it on the debit side. Are you clear with this? Next, under absorption of AOH. You tell me under absorption of AOH. How much is it? 6 lakhs. Now you tell me under absorption means what? The AOH as per costing books is lesser, correct? When you are debiting a lesser expense, your cost accounts will report more profit, your financial accounts will report lesser profit. So you will do what? You will subtract. From here you need to come here, or instead of subtracting, I will say park it on the debit side. Are you clear? Over absorption is the other way around, So you will add, that is nothing but credit side. Are you clear with this? Bad debts, in our subject, was it there? No. But in your financial accounts, it needs to be debited. It is not debited in my book, so it is more under costing, less under financial accounts. I need to subtract. Are you clear with this? Similarly, legal expenses, it is not considered in our subject. Correct? Correct? So it was not there in our subject. So our profit is more, financial profit is less. So what you need to do? Less it. That is debit. Then interest on investment, it was not there in our subject. It's there in financial profit. So costing profit is less, financial profit is more. Add or put it on the credit side. So if you balance this, you will get here something like 50 rupees the figure. That's a loss as per your financial accounts. Are you clear? If you get it on this side, it's a profit. If you get it on this side, it's a loss, similar to your P&L account. Are you clear with this? So the same statement can also be prepared in a ledger format. Are you all clear with this, guys? Are you all clear with this? Yes, isn't this easy? Fair enough? Fair enough? Yes? Yes? Fine. So let's move to the last one. Let's move to the last one. So what have they asked here in this particular question? Okay. Fine. So in this question, what they have done, they have given you a cost sheet. Guys, this is typically how the sums will look like. They have given you a cost sheet, okay, and they have given you the financial P&L. They are asking you to prepare a reconciliation statement. Are you clear with this? So they have prepared the cost sheet. So costing profit is there. They have prepared the financials, your financial P&L. So your actual, your financial profit is also there. You need to reconcile between the two. It's the solid same sum that we've been doing. So now in this question, they have started with what? Costing profit. Fine. So costing profit is a starting point. Your financial profit is your ending point. Now you tell me what happened. Every component you compare. Now opening WAP in costing is how much? 20. Whereas opening WAP in finance is how much? 15. Which means opening WAP is valued more under which subject? Costing. Which means costing reports a lesser profit. Financial reports a more profit. Add it. Are you clear with this? Similarly, closing WAP figure as per our subject cost sheet, how much? It's 15, huh? Okay, 15. As per your financial profit, it's going to be how much? 22. 22, which means what? Your financial profit, what happens there? It reports more profit. Financial profit has a more credit side. It reports more profit as compared to costing. It needs to be added. Are you clear with this? Similarly, all other items we have already done. This overheads, closing FG, dividend and all these things, we have already done it. So this is given just so that you can revise it once. Are you clear with this? So basically, your reconciliation statement, it can either be in a statement format or it can be in a ledger format. Are you clear? The main question that I wanted to discuss was the first sum that we discussed, this sum, how to drop, when they have given a financial data, how to drop a cost sheet using that is what is required. Are you clear with this? And AOH, nothing is mentioned in the question. Ideally, you can also put AOH here, that is after your particular cost of production. But in this sum, it will not change the answer because you don't have any stocks, no? So you don't have any stock. WAP is also not there, FG is also not there, so the answer will not change. But anyways, you can ideally, it should be only a period cost. Are you all clear with this? The main problem was with respect to POH, apportioning it between variable fixed. The variable should be absorbed, the fixed should be absorbed, the variable can be taken as such. That concept alone you should know. Are you clear with this? Are you all clear with this, guys? So with this, we have actually completed this particular chapter called as cost accounting systems. So we started off with non-integrated, then I told you integrated and non-integrated is one and the same. Instead of GLA, park it in the respective ledgers, and finally we did what? We did your reconciliation statement. Are you clear with this? Are you all clear with this, guys? Yes, you guys are clear with this? Yes, fine, clear? Done, perfect. Right, so now let's move to the next chapter called as, okay guys, so let's get started. With chapter number 11, budgetary control. Chapter number 11, budgetary control. Now, the past trend indicates that this chapter, which earlier was tested more for theory, is now getting tested also in the practical segment of it. Earlier, if you see, in the initial till now 9 attempts have been completed till ever since the new syllabus got introduced. Out of that, in the first 6 attempts, definitely you can find one theory question from this chapter in question number 6. Always, be it zero-based budgeting, whatever it is, always there will be one theory question from this chapter. Then slightly after that, in the last 3 attempts, they have been testing this in the practical side also. Then and there it comes and goes. So this 10 mark or 5 mark or whatever it is, generally 10 mark comes in. So this chapter can actually be tested either in this practical area for 10 marks or maybe 5 marks, or definitely in the under theory area. But definitely this chapter is being tested whatsoever. Since we have only just about 15 chapters and they have 100 marks, 100 marks means they have so many questions that can be asked. So institute is happily making use of all this. So certain chapters indicate a trend. Certain chapters you need to definitely, you need to make out that, fine, looking at the past few attempts trend itself, it clearly indicates that from the institute's viewpoint, this chapter is kind of, they are slowly drifting from theory portion to this chapter, which was earlier tested in theory portion, is now slowly being tested under the practical area. So again, the surprise element could be there. It's not regularly coming, but doesn't mean that you can skip it. Fine. Just today, 2 hour session. Let us just try to finish this chapter. Nothing big is there. Nothing big is there. Just whatever I'm telling you right now, you just make use of that, whatever knowledge that I'm giving you right now. Go home, practice sums just like usual, and you're done with this chapter. Okay? It's all conceptual. The best part of this chapter is, in some way or the other, we have already finished this chapter. Broadly, this chapter has 2 segments. I'll tell you. One is called as functional budget, flexible budget. The other one, functional budget, is similar to cost sheet chapter. Flexible budget is similar to your marginal costing chapter. Basically, we've already done it. Then why are we seeing it here? I will give you a direction and we'll see it in a structured format, and there are certain sums that we'll be doing only here. Are you clear with this? So basically, this is something that we've already covered. So it's going to be a light session. It's not going to be very, very serious concepts and all. Something that we've already done. We're just going to brush it up and give some direction to it. So let's try to finish it up today. So that's the agenda for today's session. Now, in this chapter, I told you, broadly, this chapter can be classified into 2 areas. One is called as functional budget. The other area is called as flexible budget. Apart from that, you also have one more independent concept called as budget ratios. We'll first see that budget ratios and close off. That budget ratios, some 6 ratios they would have given. You just need to know what these ratios are, and there is only one sum in the study material that I've given you here. We will see the logic for that and we will just get going. Are you clear with this? So this is going to be the agenda. So functional budget, flexible budget, and one independent concept called as budget ratios. Some people, I think budget ratios, what they do is they treat it as a part of standard costing chapter. But ideally in your study material, it is given only under budgeting chapter. So we will also do it only here. That's why I didn't do it under standard costing. Clear? Yes, guys, clear with this? If at all this budget ratio comes, that is only one sum in the study material. That sum we will do it in the classroom. 6 formulas you just need to remember. I will give you the logic as usual. You just remember those 6 formulas. We will do an illustration and close it off. That's all. The budget ratio part will be done. After that, I will just get into the actual part of the particular chapter called as functional budget and flexible budget. That's where we actually get started with it. Okay? Clear with this, guys? Clear with this. Now, what do you mean by a budget? In layman words, what do you mean by a budget? A budget is nothing but, you can say, a target. You can call it a plan of action. You guys generally budget, no? You have your budget, correct? Every day you have your budget, like for the amount that you spend, you have your budget. For the time that you spend, you have your budget. Beyond this, I don't have time to spend. Yes. So budget in normal parlance, it only means that it's a plan of action or it's some target that you're having. As simple as that. Now, I told you there are 3 objectives of this particular subject. What are the 3 objectives? Stock valuation, profit computation, decision making, and control. Now, this chapter helps you achieve 2 objectives: decision making and control. Decision making and control. I will tell you how. Now, you know that in any organization, what they do is first they set some targets. And based on this target, only the actual performance get compared. Correct or not? We saw it in standard costing, no? Now, standard costing, you guys computed standard hours, standard rate. Where did you get that from? From the budgeted data, no? Correct or not? So unless and until you prepare a budget, you can't set your targets and compare it with your actual performance. This way, you are achieving the objective of control. Are you clear with this? Are you clear with this? But then, how will you arrive at the standards? Or how will you arrive at the budget? Let's say, for example, the company says in the current period, they are telling the sales department, you should sell 50,000 units. You should sell 50,000 units. Let's say at the rate of 50,000 units should be sold at the rate of 100. Okay. Now, what happens if you see, even in our budget, no, in our country's budget, your budget of finance act and all comes, there people sit in the Lok Sabha and they discuss, no? Yes, that's how even it happens in top level companies and all. There will be multiple set of people who will propose their own budget. Ultimately, they will decide and they will go for the one that is best. Now, what happens? I am sitting in a board meeting. One set of people say, sir, in the next year, what we should do is, we should sell 50,000 units by fixing the selling price at 100 rupees. Correct? Now, what happens? Another set of people come and say, no, sir, let's not do this. What we will do is, let's make use of the law of demand and supply in economics. Let us slightly reduce the price to 95 rupees so that we will achieve more volume. Let's say 55,000 units. Correct? So, one set of people say, sir, fix 50,000 units at the rate of 100. Another set of people say, fix 55,000 units at the rate of 95. Now, when I am fixing my budget, I will have multiple alternatives. Between those alternatives, I need to choose the best alternative. No, out of these two, which one will I choose? It depends. Whichever alternative gives me the maximum profit, I will go for that. Correct? So this way, but for fixing a budget, I need to choose between multiple alternatives. This way, it helps me achieve the objective of decision making. Are you clear with this? So choosing between multiple alternatives is how I help achieve the objective of decision making. Having said that as my target, when I'm comparing it with my actual, it helps in my control. So broadly, this chapter has two objectives. Are you all clear with this? Are you all clear with this? So this is what, that's why I told you, every chapter when you learn the objective why we are studying it, so that you will have a crystal clear clarity on that. Clear with this, guys? Are you all clear with this? Perfect. Done. So this is about the introduction of this particular chapter. Now, what I will do is, first we will go to budget ratios. It's an independent topic. It need not be attached to any particular chapter. But anyway, since in the study material they have given it under this chapter, what we will do is, we will study it first, and then I will tell you, I will go to the next two segments. That is your flexible functional budget and all. I will tell you what it is. I will give you a background. We will do some and close it there. That's all. Clear with this? So let's go to the next part of this particular, the first part of this particular chapter called as your ratios, budget ratios, also called as your performance ratios. Now, guys, I want you to remember these 6 formulas. These 6 formulas, please don't think that it's not important. I myself have seen in one attempt they tested this. They tested in question number 1, mandatory question, they tested this. You can't, that's why I'm telling you, question number 1 is always unpredictable. To reasonable extent, you can predict that material and your marginal costing and process and joint and buy. These chapters generally come, still you are left with 1 or 2 more questions in the question number 1 area. So there you can have subdivision. Any 1 or 2 questions can come from any area, any concept from the entire syllabus. So basically, once I saw this question was asked. This question means this question that we are going to see right now. It was asked for 5 marks in question number 1. What will you do? If you omit? So classroom itself will finish this area. It doesn't even require a practice. This is that kind of a particular area. Classroom itself will finish it, so that at least you are equipped with this. Okay, clear? Now, first formula you guys already know. First formula you guys already know. Efficiency ratio. What is the formula? Standard by actuals. I told you, I am allowing him 100 hours, but actually he has taken only 80 hours, which means his efficiency is 125. That is, he is over efficient. Should be beyond 100% or beyond 1 if you want to put it in decimal. Correct? This formula you guys know, standard by actuals. Yes. Activity ratio, also called as volume ratio. What is this? Now, simple. Let's say I budgeted so many hours. Okay, first of all, what do you mean by standard hours? The time allowed for the actual production. Correct? Correct? What do you mean by budget hours? The time allowed for the budgeted production. Correct or not? Correct or not? Correct or not? Basically, what they are trying to find out is the time allowed for actual production divided by the time allowed for budgeted production. Basically, what they are trying to find out of total what you have budgeted, what is the actual, that is, what is the standard for actual that you are actually, the activity at which you are actually operating. What they are trying to find out is, let's say I budgeted for 1000 hours, and let us say that the standard hours is only 800, which means what? The activity that I'm planning itself is only 80% of the capacity. I am planning to operate only at 80% capacity. Are you clear with this? This is called as activity ratio. Standard hours by budgeted hours. Clear? Logical? Logical. I'm trying to find out what is the activity at which I'm trying to actually work. Are you clear? Yes. Next, calendar ratio. Does it ring any bell? Yes. Where did we see this? Calendar variance, fixed overhead cost variance. Under that, volume variance, you had three subdivisions: capacity, calendar, and efficiency. Under that, I told you possible budget fixed overheads minus budget, wherein we saw 21 days, 20 days, and all. You remember? Basically, but this is nothing but available working days divided by budgeted working days. In that example, if I'm not wrong, there we budgeted how much? We budgeted 20 days, but only 19 days for us, something like that. Something 21 and 20, 20 to 20. So whatever it is. So available working days divided by budgeted working days. Are you clear with this? Days in the sense hours. Every day has same number of hours. So yes, you can do it in terms of number of hours. Available working hours divided by your budgeted working hours. This is similar to your calendar variance that we have seen before. Guys, are you clear with this? Yes. Next, standard capacity usage ratio. Now, what is this they are saying? Let's say I have a factory and I can utilize a total of 1000 hours. I can utilize a total of 1000 hours, but practically I know I can't utilize the entire 1000 hours. Correct? So based on this, I budget only to use 900 hours. 900 hours. This is what they mean. Budgeted hours divided by maximum possible budgeted hours. Out of your maximum capacity, how much is you are budgeting? How much is it that you are budgeting? That is only called as standard capacity usage ratio. Out of the maximum possible, how much is it that you are budgeting? Then what do you mean by actual capacity usage ratio? Out of the maximum budgeted hours, how much is it that you are actually using? So actual hours divided by maximum budgeted hours. Are you clear with this? Are you clear with this? And actual usage of budgeted capacity ratio, the word itself tells you what to do. Actual working hours divided by budgeted hours. So these are some 6 formulas, independent formulas that they have asked. Logically, if you think you can get it. So efficiency ratio, standard hours divided by actual hours. Your activity or volume ratio is standard divided by budgeted hours. Your calendar ratio is actual working hours divided by budgeted working hours. Your standard capacity usage ratio is budgeted hours divided by maximum possible hours. Actual capacity usage ratio is actual working hours divided by maximum possible hours. And your actual usage of budgeted capacity. This is the most easiest. This itself tells you what to do. This itself tells you what to do. Actual usage of budgeted capacity ratio is nothing but actual working hours divided by your budgeted hours. So these 6 formulas alone, can you just remember? So whatever logic that I've given you, with that you just try to remember. It's a standalone area. Application and all will not be there. Okay, don't worry about this. Fine, shall we just do one illustration and close it off? Shall we just do one illustration? It was a 5-mark question in past exam. So let's just make a use of it. Now, what have they asked in this question? They have told you, following is the data available for DKG and company. Standard working hours, 8 hours per day of 5 days per week. Maximum capacity, 50 employees. Actual working, 40 employees. Actual hours expected to be worked for a period of 4 weeks, 6,400. Standard hours expected to be earned per 4 weeks, 8,000. Actual hours worked is 6,000, and actual hours earned in the 4-week period is going to be 7,000. The related period is of 4 weeks, meaning 1 month. In this period, there was one special day holiday due to national event. Okay, so this will have an impact on your calendar ratio. Correct? Then calculate all the usage, all the ratios they have given, efficiency, activity, calendar, standard, and all these things. Okay. Now first you tell me, guys. Now I want you guys to look at the particular question. Don't look at the answer. Look at the question. Just answer to whatever I say. First, can anyone tell me what is the maximum hours available in this question? Can anyone tell me what is the maximum hours available in the question? Do the calculation. 50. So, very good. So, can I say maximum hours? Maybe you can also write it down. You can also write it down. Please write down. The book itself, write down. Maximum hours is nothing but 50 employees into 8 hours a day into 5 days a week. Like that, I have 4 weeks a month. Correct or not? Correct or not? 50 employees is the maximum possible employees into 8 hours a day into 5 days a week into 4 weeks a month. So, how much is this? 8,000 hours. Guys, correct or not? Hello? Hello? Yes? Are you clear with this? Next. What's your budgeted hours? What's your budgeted hours? Now, how many employees I'm budgeting? I know that only 40 employees can work. Correct or not? So, 40 employees into 8 hours a day into 5 days a week into 4 weeks a month. So, how much is this? 6,400 hours is the budget hours. Correct or not? Guys, are you all understanding this? Are you all understanding this? Next. What is the actual hours? I think it's given in the question. 6,000 hours. It's 6,000 hours given in the question. Correct or not? Given in the question. Correct, guys? Yes. 6,000 hours is given in the question. Next. What is the standard hours? I think that is also given in the question. 7,000 hours. 7,000 hours. I think that is also given in the question. Next, what is the budgeted days? What is the budgeted days in a month? What is the budgeted days? 28. Huh? 4 weeks. In a week, 5 days are there. So it is 20 days. Correct? But what is the actual days? It's going to be 19 days. How you got this 90 days? 20 minus 1. Correct? Now you have all the data with you. Just exactly do like this in the exam. First you gather all the data required for the sum. Just a matter of substituting the formula. First ratio. Standard hours by actual hours. How much by how much? Standard hours 7,000. Actual hours 6,000. So 7,000 by 6,000, 116.67. Are you clear? If you have the data with you, it's going to be a cakewalk. Very, very simple. Next, activity ratio. Standard hours by budgeted hours. 7,000 divided by budgeted is 6,400. 7,000 by 6,400. 109.373%. Are you clear? Next, calendar ratio. Actual working days by budgeted working days. So it's 19 by 20. You get this. Are you clear? Next, standard capacity usage ratio. Budgeted hours by maximum hours. Budgeted hours is 6,400. Maximum hours is 8,000. So 6,400 by 8,000 gives you 80%. It's simple, guys. That's why I told you there is no much of application. You just need to get the figures and plug it. That's all. Next, your actual capacity usage ratio is going to be actual hours divided by maximum. Actual hours is 6,000. Maximum is 8,000. So 6,000 by 8,000 gives you 75%. Next, actual capacity usage ratio. It's nothing but actual hours by budgeted hours. So it's 6,000 divided by 6,400, right? It's going to be 93.75%. Are you clear with this? There is nothing great in this area. If at all they will only ask these 6 formulas, and you need to compute only these particular, the data required, input required for the sum. You just have to do it this way and close it off. Nothing great and all, but I am doing this here in the classroom just to tell you that it has been tested once in the exam, so please don't miss out on that. Are you clear with this? So with this budget ratio and all is done. I think in the standard costing, whatever sums I gave you, in one sum it came, no? Yes, in one sum it came, no? Yes. So that is only this sum that we did in budgeting, that we are doing here in budgeting area. So maybe you can just go home and do it. No, you need not do it also. It's the same sum only. But if you want, try it on your own once. And basically, you just need to know the formula. And you need to get all this input data. Once you do that, the entire sum is over. That's all. It's not like standard costing where you need every single thing and application and all. Okay, done? Okay, guys, shall we proceed? Shall we proceed to the other segment? Shall we proceed, guys? Yes, shall we proceed? Okay, fine. Now let's get started with the next part of this particular chapter, which is called as flexible budget. We'll do flexible budget first, and then we'll go to functional budget. Okay, so let's do flexible budget. Please take the heading flexible budget. flexible budget. Flexible budget. Now, guys, what is this flexible budget area? Let me take an example. Let's say, for example, the following data is given to you. Let's say 80,000 units. For 80,000 units of volume level, they are giving you the following data. Direct material cost, everything is given on a per unit, 8 rupees. Direct wages, 4 rupees. Variable production overheads, let's say it's 6 rupees. Fixed production overheads is, let's say, 2 rupees. Fixed production overheads, let's say, is 2 rupees. Then variable selling overheads, it's going to be 2 rupees. Fixed admin overheads, it's going to be, let's say, 5 rupees. And your let's say fixed selling overheads is going to be 3 rupees. Example, this is just an example, random example I'm just taking. Okay, now what they are asking you, they have given you the cost data for one particular volume level. They are asking you to find out what will be the cost, total cost and the cost per unit if I am operating at 90,000 units volume level. Can you find out? No, just don't start doing the answer, but wait, I'm just telling you about the concept. We have a sum, don't worry about it. Now what has been given is the cost data of one particular volume level. Using the cost data of one particular volume level, you should arrive at the cost data for any other volume level. The cost data that is given for one single volume level is called as a static budget. Meaning what? For a given volume level, what is the budget? Static means it will not change. Based on the data given in the static budget, you need to prepare the budgeted cost for another volume level. That is called as flexible budget. Are you clear with this? So based on the inputs that you gather from a static budget, you need to prepare a budget for another volume level, which is called as flexible budget. Are you clear with this? Now, in this sum, you tell me what you will do. Now, they have given direct wages 8 rupees per unit. First step, what will you do? When there is a flexible budget question, what you should strike your mind? 3 things. Number 1, variable cost should always remain constant per unit. Fixed cost should always remain constant in total. In case it is neither remaining constant in a per unit level nor on a total level, segregate the semi-variable cost into fixed and variable portion. Clear? Now, direct material is variable or fixed? Variable. So what I will do, here I will say, okay, it's going to be variable here. Then direct wages 4 rupees. Variable production overhead 6 rupees. Fixed production overhead, it doesn't make sense if I put this 2 here. So what will I do? This 2 immediately I will multiply with 80,000. How much is it? Well, so I will present it here as 1,60,000 rupees. I am not preparing the budget. I am just giving the inputs for this particular data. Are you clear? So these are all, whatever is my variable cost, I will put it on a per unit level. Whatever is a fixed cost, I will put it in total, so that with this I can easily prepare a budget for 90,000 units of volume. Are you clear with this? Guys? Yes. Next, variable selling overheads, I will retain it in per unit. Fixed admin overheads, 5 into 80,000. How much is that? 4 lakh rupees, correct? So I will put this 4 lakh rupees here. Then you have another fixed selling overheads, 3 into 80,000. How much is that? 2,40,000. Now what I will do with this data, I can prepare the budget for any volume level. Forget 90,000, any volume level. I know that if it is going to be for 90,000, so all the units that are mentioned on a per unit level, all the components mentioned on a per unit level, I will multiply with the respective volume. All the data that is available on total, I will keep it as such. So with this, I can prepare the total cost for any volume data, correct? So this is called as flexible budget. Are you clear? So how did you get all these figures? From the static budget. Using these input, you are going to prepare budget for any different volume levels. It's called as flexing the budget or flexible budget. Are you clear with this? Are you clear with this? Guys, are you all understanding? Nothing more. We have already done all these things. Segregation of semi-variable costs. How will you do? Change in delta cost divided by delta units gives you the variable cost per unit. Once you find out the variable cost unit, total cost minus variable cost gives you your fixed cost. We did this where? First, no. Overheads, I told you. Overheads, first segment. Turn back the page and see. First segment, we started overheads chapter only with this semi-variable cost. Do you remember? It is chapter number 2 that we did here in our classroom. Correct? Yes, first thing that we did here was segregation of semi-variable cost. You remember, it will start on left side bottom, right side full page it would have been given. Correct or not? You remember that? Yes, we did it fully. I told you it's actually a part of flexible budget, but still we are doing it here. I told you. I told that also. Yes. Guys, are you clear with this? Fine. So basically, flexible budget is all nothing. Basically, from a static budget, find out, arrive at the variable cost on a per unit level, arrive at the fixed cost in total. With this data, you can prepare the budget for any volume level. Are you clear with this? Are you all clear with this, guys? Is everyone understanding? Yes? Is everyone understanding this? Guys? Yes, guys? Yes? Fine. So shall we just go to the problem and do this? Shall we just go to the problem? That's all. That's all. Nothing more. So if you want to give, you can just keep on practicing. That's all. We will do one sum and we are done with this particular segment. That's all. Clear? Shall we go, guys? Shall we go and do it? So just take question number 1. It's on page number 78. This question is a past RTP question. It's RTP May 19 question. It's RTP May 19 question. So let's just have a look at this particular question. S Limited has prepared a budget for the coming year for its two products A and B. So product A, product B, they have given the data. Production and sales, 6,000 units, 9,000 units. So I'm not reading out these figures or not. So it's not relevant anyways. We will be reading it when we're doing the sum. They have given the production and sales in units. Raw material cost per unit, direct labor cost per unit, variable overhead cost per unit, fixed overhead cost per unit, selling price per unit. These are the data that are available product wise. Clear? After some marketing efforts, the sales quantity of product A and B can be increased by 1500 units and 500 units respectively. What they are saying, if they do some marketing, they can increase their output by 1500 and 500 of A and B respectively. But this doesn't come free of cost. But for this purpose, the variable overhead and the fixed overhead will be increased by 10% and 5% respectively for both the products. You are required to prepare a flexible budget for both the products. Why is it flexible budget? Because now the output changes now for you. Correct? The output now changes. As instead of 6,000, you will prepare it for 7,500. Instead of 9,000, you will prepare it for 9,500. Correct or not? Fine. So A and B respectively is going to be 7,500 and 9,500. For this volume level, you need to find out the cost after the price revision. Are you clear? So from the flexible budget, you will take the original data, plus there is some cost revision happening that should also be considered while preparing it. Fine. So what they are asking you is, you are required to prepare a flexible budget for both the products before marketing efforts, after marketing efforts. Sir, before marketing efforts, they themselves have given in the question. No, they have not given it. They have only given everything in per unit. Fine. So you need to put it in total and also that's what something that we need to do. Fine. Just take 20 seconds time. Quickly go through this question. Go through this question once and let's solve it quickly. Together we will solve. Okay, shall we start? Shall we start? Now always remember, when you are doing these sums in a flexible budget, always remember, maintain 2 columns for every product, per unit and total. Why, sir? Because from the static budget, whatever is the variable cost, go and immediately fill it on the per unit column. Whatever is the fixed cost, go and directly fill it on the total column, so that you can directly multiply with the quantity or divide with the quantity to arrive at the total or per unit respectively. Clear? Are you clear with this? Always follow this. It will be very simple. So let's quickly just finish this. I think this came for 10 marks, I guess. I don't know. I think so. I mean, if it comes for 10 marks generally, or 5 marks is too less for this. 10 marks is 2 more for this. Maybe 6. 6 plus 4, something like that they can have. Yes, yes. I have seen 6 plus 4 and all. Yes, they will come. Or maybe what they will do is, they will merge this along with marginal costing. They will test this for 5 marks. Marginal costing, one small sum they will put inside this break even and all they will ask. So 6 plus 4, 7 plus 3, they can do anyways. So you don't worry about it. If they want to test, they will test it. Don't worry about it. Okay, fine. Let's start. This is what question number 1 on page number 78. Guys, this is one vanilla sum. We should do it together quickly. Let's do it quickly. Page 78. So write down. First part, write down part 1. Part 1. What is part 1? Flexible budget before marketing efforts. Before marketing efforts. Before marketing efforts. Flexible budget before marketing efforts. So what you need to do right now is prepare particulars and 4 columns. That is product A inside that per unit total, product B inside that per unit total. Make it fast. So let me try my luck today with the scale. See how beautifully it has come. Okay, fine. Do it, guys. I know I wasted a lot of time. Instead, my scribbling itself will be good only. Anyways. Okay, write down particulars. Particulars. Then you have you have 2 product A and product B. Under that, per unit total or amount, per unit and amount. Actually, this per unit is also in amount only. Per unit and total. Okay, per unit and total. Let's start. First. Okay, first sales. Okay, by the way, let's put units on the top. Product A, how many units? This is before marketing efforts. 6,000 units. How many units of product B? 9,000 units. Okay, right, perfect. Now tell me sales, how much is it? Per unit. So what I will do is, first we will just fill the figures alone. Whatever is the relevant figures that we will fill. Okay, for B it is going to be 78, correct? Don't fill the total column. I'll tell you, don't fill the total column. 78, okay? Then you can just put a dash here. Fine. Put a dash here. Then we are going to cost. First cost, raw material cost. Is it variable or fixed? Variable. So fill only the per unit column. How much? 60, 42. Guys, do it the same way in exam. Habits die hard. So do it in the same way. You will follow the same thing in exam also. Next, raw material cost. After that, direct labor. Variable, fixed? Variable. So fill the per unit column. Remains constant per unit. 18. Then variable overheads. How much is that? 12 and 6. Then fixed overhead. Is it what? What is it? Fixed. So basically, convert it into total figure and plug the total column. How much? 48,000. How you got 48,000? 8 into 6,000. Similarly, here it's going to be 36,000. How you got that? 4 into 9,000. Correct? Guys, correct or not? Yes. Always remember, when you are filling it, when you are preparing a flexible budget, variable cost components fill only the per unit column. Fixed cost components fill the total column and keep it. After that, you can do whatever you want. Clear? Because we are going by the cost behavior. That is the right way of doing it. Fine. This sum is easy. Maybe if you're getting a more complicated sum, you should know that this is how you should do it. Next, total cost. Okay, fine. You can have a total cost. This can't be totaled right now unless and until we get it. Fine. Then finally write down profit. This also you can't get it right now unless and until you finish the sales figure and your profit. Now shall we just go up and fill the figures, guys? Yes. So now tell me, 120 to 6,000 sales value, how much? Yes, this is going to be 7,20,000. So horizontal or vertical? Vertical. So you put 6,000 into and finish it off. Okay, 60 is equal to how much? 3,60,000, yeah. Yes, then 30 is equal to how much? 1,80,000. Then 12 is equal to how much? 72,000. Okay, fine. Then 48,000 divided by 6,000. How much is that? 8. Okay, 8. So tell me, what is the total cost? One second. 13, is it? Okay. So tell me, how much is it? 6,60,000 per unit is 110, na? Per unit is 110. Yes. So what's your profit? 10 rupees per unit, and this is going to be 60,000. Correct? Guys, nothing great. No rocket science here. Clear? Okay, done. Move to the next one. Next. Yeah, fill this column. Fill this column. Come on. 9,000 into 78. 9,000 into 78 is equal to how much? It's going to be 702,000. Okay. Then 42 is equal to 378,000. Then 1,62,000. Then 54,000. What's the total? 6,30,000. Correct? And then what's going to be your profit? 72,000. Done. Are you all clear with this? And of course, we'll also fill the per unit. So fixed overhead per unit, how much is it? 4. What's the total cost? 70. 70. Okay. And it's going to be 8. Fine. Clear with this, guys? Nothing great here. The same thing, same sum. We've just finished it on a per unit and total column basis. Are you clear? Shall we move to the next one? Shall we move to the next one, guys? Yes, shall we move to the next one? So let's go to the next one. Now this is very difficult. Let me do what? I have an idea now. You guys start filling the template. Please start filling the template, guys. Please start filling the template. Please start filling the template. Make it fast. That's about it. Okay, so let's go to part 2. Yes, now it is neat, no? Credits to Microsoft. Okay, right. So go to part 2. So what's your part 2, guys? Yes, so flexible budget after marketing efforts, right? So write down flexible budget after marketing efforts. Flexible budget after marketing efforts. Flexible budget after marketing efforts. Now first write down. Guys, come on, let's do it together. I'm using a blue ink. You take only a black ink. Okay, I'm using it here because the grids are in black, so that's why. First, sales. Tell me, guys, sales per unit, does it change? Okay, on the top first, how many number of units now? 7,500 units of product A. How about B? 9,500 units of product B. Correct? Now, what's the per unit selling price? Hello, that does not change. 120. And here, how much is it? 78. Are you clear? Next, so you can just put a double line here, just to show that after the sale, we are going to go for cost. First cost is what? Raw material cost. Is there any change in raw material cost? No. Is it a variable or a fixed cost? Variable. So fill the per unit column. 60 and 42. Correct? Next. Yes. Next is going to be direct labor. So direct labor. Is there any change in direct labor? No. Fixed variable. 30 and 18. Correct. Next. Variable overheads. Is there any change in variable overheads? No. Yes, no. It increases by how much? 10%. So what will you do? Per unit currently, how much is it? 12. So it becomes 12 into 110 percentage. How much is that? 13.2. How about product B? How about product B? 6 rupees into 110 percentage. 6.6. Are you clear? Understand, guys? Understand? Variable cost increase should be increased on a per unit level. Fixed cost increase should only be increased on a total level. Are you clear with this? Sorry? What 5 percentage? This is variable cost, no? Variable cost increases by 10. Fixed cost only increases by how much? For 5 percentage. Yes, so this is what? 10 percentage increase. Next is what? Fixed overhead. Fixed overhead. You tell me, guys, fixed overhead, what will you do? Per unit or total? Total. Originally, how much is the total fixed overhead? 48,000. But now they are saying that increases by 5 percentage. So tell me, how much is the figure? 48 into 1.05. How much? 50,400. Similarly, here what you have for product B, it was originally 36,000 into 1.05. How much is that? 37,800. Correct? So if you add it up, if you add all these things up, you get something called as a total cost. So from that you can arrive at your profit. So now let's go fill up the figures. Sales value, guys. 7,500 into 120 is equal to how much? Hello, how much? 9 lakhs, huh? Yes, 9 lakhs. Then what? 4,50,000. Then 2,25,000. Then 99,000. Okay, 99,000. Then here 5,400 divided by 7,500. How much is it? This is 6.72. Only to represent, I am putting it here. So what is the total cost per unit? Okay, so total is 824,400. Per unit is 109.92. So what's my profit here? 10.08 and 75,600. Are you clear with this? Yes, guys, it's fairly simple, no? One thing that you need to know is any increase in variable cost should be applied on the per unit column. Any increase in fixed cost should be applied on the total column. Are you clear? What students do is they take the per unit and into they will do 1.05. No, fixed cost by nature remains fixed in total, constant in total. Clear with this? Let's go to product B and close it off. Nothing great in the sum. So tell me 9,500 into 78 is equal to how much? 741. Guys, please be a little louder. 741. Then 3,99,000. Then 1,71,000. Then 62,700. Then what's the fixed overhead cost per unit? 37,800 by 95. How much? 3.98. So what's your total cost? 70.58. And what's your total? 670,500. So what's your profit per unit is going to be 7.42, and this is going to be 70,500. Are you clear with this, guys? Yes. Are you all understanding this? Are you all understanding this? Yes. Are you guys understanding it? Guys, ideally in exam, the format has to be like this. You know, when you are putting all this dabba and all, since you can do it in your notebook with the scale, here it's difficult for me even to use this pen. So that's why all these things. So anyways, I just tried up with this Excel. Of course, it's coming well, but it takes time every time. We don't have the luxury of time. So basically in exam, do it properly like this. Put the tabular column, just a few more seconds. You need not do shading and all. And some people do this. On the top column, they do the shading. Just to say presentation. This is not presentation. This is waste of time. Abnormal idle time. Don't do that. This is, please just have it in a proper statement format. The only thing is you should communicate well to the examiner. That's about it. Clear with this? Guys, clear with this? Fine. With this, we are done with this particular concept. Nothing. From a static budget, all the variable costs, put it in per unit column. All the fixed costs, put it in total column. Any price revision in variable cost, do it only in the per unit column. Any price revision in the fixed cost, do it in the total column. With that, you can prepare a flexible budget for any output level. That's all it is. Clear? Guys, clear? Are you all understanding this? Are you all understanding this? So in this segment, we use the concept of variable and fixed cost. Now, this is why I said it's similar to marginal costing area. Are you clear? This is something that we all know, no? It's not something that we don't know. Just that as a sum, we are doing it together right now. As simple as that. Clear? Guys, clear with this? Shall we move to the next sum? Shall we move to the next concept? Let's move to the next concept. Let's move to the next concept. Now, guys, let me give you this particular area. Let's get into this particular area called as functional budget. Functional budget. Functional budget. I told you this is similar to your cost sheet area. Okay, so I will tell you the background and I will give you the conceptual things and all, and after that we will do one sum, and that's about it. So this area, this chapter is only about it, and some theory portion is there that I'll tell you how to prepare on the last day. I told you in employee cost and budgeting, these two chapters alone we have some theory extra, the theory focus, because generally these two chapters theory comes apart from the first chapter, that goes without saying. First chapter is only theory. Fine, I will tell you how to do that and all in the last class. Last class is day after tomorrow. I will do it. I'll tell you day after tomorrow, so don't worry about that. Fine. For the time being, let's get more into the practical segment, how to solve sums. So that's what we are concerned about right now. Don't worry, I will handle theory. I will tell you how to crack theory. I will also tell you to whatever extent the value addition can be made from my side. I will tell you. Beyond that, even if I keep reading, you will also keep reading along with me. That is something that I don't want. You can read it better than me. I know. I admit it. Okay. Fine. So I'll tell you how to prepare for that. I'll give you strategies and all. Certain areas, if they are conceptual and it has not been covered before, that I will pick and do it. Don't worry about it. Are you clear? So you need not worry about it. Right now, just focus only on the practical part. I'll tell you when to focus and how to focus on the theory part. Now, functional budget. What do you mean by a functional budget? Now, in an organization, there are many functions. Like production is a function, sale is a function, correct? Material purchase is a function, material consumption is a function, correct? When I prepare a budget for each of the functions in my organization, that is called as a functional budget. Are you clear with this? Functions means what's activity, basically activity, correct? Every single activity, every single function, or each and every function. For production is a function. For that, if I prepare a budget, that's called as production budget. Sales is a function. If I prepare a budget for that, it's called as a sales budget, and so on. Are you clear with this? Are you clear with this? Now, what are the different types of functional budget that we will be seeing in our area? Please note it down in the same order. Please note it down in the same order. Order is very important. First, sales budget. Second, production budget. Third, material consumption budget. Consumption, I'm using a short form. Consumption budget. Fourth, material purchase budget. Fifth, wages budget. Sixth, production overhead budget. Seventh, AOH and SOH budget. Eighth, master budget. Yes, done, and it should be in the same sequence. It should be in the same sequence. It should be in the same sequence. I will give you all the logic and all. Please note it down quickly. Please note it down quickly. See, apart from this, you also have two more budget. Apart from that, you also have two more budget called as cash budget and capex, capital expenditure budget. These are a part of your financial management, not a part of our subject. But in the study material, they have just mentioned and leave it there. No sums and all in this area, but they have just mentioned and leave it there. There's something called as cash budget. It's nothing but a cash flow statement, which we'll be seeing. You anyways will be seeing it in your accounts. But yes, it's also there in your FM, working capital management. Yes, in that you have something called as a cash budget. And of course, there is another thing called as capex budget. That's basically your capital budgeting chapter. There you have a lot of capitalizing your present value of cash inflows and all, NPV, IRR and all those things. Okay, so in that place, you will, in that area, you'll be having it. Anyways, forget that. In our subject for costing, only these are the costing related budget. Apart from that, you should also know that there are other budgets that are not a part of costing subject. Now, sir, all these budget, every activity you have given one budget, I agree. But why should it be in the same sequence? Why should it be in the same sequence? Understand, it's very important. It's very important. Now, always remember, when I am budgeting, let's say You are the company's managing director. A fresh year is starting right in front of you. You are in the month of March. Okay, for us, year is 1/4 to 31/3 only, correct? In India, we follow that April to March, right? So for the next forthcoming year, April, from 1st April onwards, one new year is going to start. So what I'm going to do, before that, you are the managing director. Put yourself in the shoes of managing director. Assume you are running a business, your family business, you are only running. Fine. Now, what will you do? Now, for the next year, I need to plan it accordingly, correct? You are doing a production. You are in a production setup. You are manufacturing something. Let's say you are a garment manufacturer, something you are manufacturing. Fine. Now, how will you start preparing the budget? How will you said so many budgets, sir, but which budget? Can I do any budget that I want beginning itself? No. First, if you are the owner of a company, what you will do is, you will first call the marketing team. You will call the marketing team. Ask them, in the forthcoming year, how much demand you are predicting? How is the market? How many units you are expecting to sell? Obviously, he can't predict to the last unit. He will say, sir, overall, looking at the market trend and all, and looking at the overall seasonal business nature and all, generally, let's say I will sell 1 lakh units or whatever it is. The first step begins with a sales budget. That's why sales budget is the first step. Why? Because only based on that, what I do. Let's take an example. Let's say the marketing manager comes and says, sir, next period, the sales will be 1 lakh unit. This is what we are expecting, 1 lakh unit. Now, what I am planning to do is, in your financial management, you will study. You will decide how much of stock to keep. That's called as working capital management. In that one area is called as, there is a area called as working capital management, a very interesting area. There you will see how much to stock, how many days of sales or consumption to stock or not. Basically, now let's assume based on that, totally, now I got an input from my marketing team that next year I'm going to sell how much? 1 lakh units. Now, let's say I want to keep a closing FG of, let us say, 20,000 units. 20,000 units. I want to keep an FG of 20,000 units, closing FG, correct? So basically, I should produce how much? 1,20,000, correct? But wait, I already have an opening FG of 10,000. I already have an opening FG of 10,000, which means current year, how much I need to produce? 1,10,000 units. Now you tell me, I started with the sales budget, and only if I know how many units I'm going to sell, I can arrive at the production budget, correct? Now only I can go and tell my production manager, look, I will not ask him, I will tell him, this year I want you to produce 1,10,000 units, that's all. Clear? How did I get this base from? First, it has to originate from my sales team or my marketing team. Are you clear with this? Are you clear with this? So first I ask this fellow, he will tell me what is the sale. From that, add a closing stock minus opening stock. You will get the total production requirement for the current year. And always remember, production budget is the base for all other budget. It is the base for all other budget. Now, because all your costs will be incurred only with respect to production, correct or not? We saw cost sheet. All the components of cost are tied to production, correct or not? Let's say, for example, every unit of output requires, 1 unit of output requires 2 kgs of raw material. Can you tell me what is the total raw material I will be consuming in the next year? 2,20,000. Correct or not? 2,20,000 kgs I will be consuming. This is called as raw material consumption budget. Clear? So this is how I moved to the next budget. From sales I went to production. From production I went to material consumption. Clear? Clear. Now they are saying, now you also need to maintain a closing raw material stock. A closing raw material stock, let's say an example of 30,000 kgs, and you need to maintain, you already have an opening raw material stock, let us say of, let's say 50,000 kgs. 50,000 kgs. So tell me, in the current year, how much should I purchase? How much should I purchase? I should purchase how much? For 2,20,000 I'm going to consume, plus 30,000 I should store, so 2,50,000. But wait, already I have 50,000 in my godown, which means the current period I have to purchase a raw material to the extent of 2 lakh kgs, correct? So from this From this, I arrived at my, from material consumption, I arrived at my material purchase. Are you clear? So this order needs to be maintained. And parallelly, they are saying the current year, how many units I'm going to produce? 1,10,000. They are saying every unit requires 5 labor hours. So what will you do? 1,10,000 into 5. So 5,50,000 labor hours you need. Accordingly, you will tell the HR department. Correct or not? Correct or not? Similarly, your production overheads. Why is this required? Now, you will arrive at your absorption rate and all. Remember, I told you what rate, absorption rate you will use. Budget or actuals? Budget or actuals? Budget. Where do you get that from? Here only. Are you clear? Are you clear with this? Similarly for AOH and all. So all these budgets you will prepare. And finally, there is something called as master budget. What do you mean by master budget? Very simple. This is nothing but a budgeted P&L account where I will be having the component of cost in the debit side and I will have the sales on the credit side, and each of the components, how I got, will be a working note. So all the previous budgets will be a working note for a master budget. Are you clear with this? So using the budgeted data, if I prepare my P&L, it's called as a master budget, and in my master budget, the working notes or my notes to accounts, my notes will be every single individual functional budget. Are you clear with this? And that's about this area. Are you clear with this, guys? Are you clear with this? So basically in exam, how they will ask this question is, they will first tell you how many units to be sold. Based on it, you will arrive at the units to be purchased. From there, you should arrive at your raw material consumption. From that, all these things you will go. So from your sales, you will go to raw material production. From that, you will go to raw material consumption. From sales, you go to production. Production to raw material consumption to raw material purchase, and so on. Similarly, from production directly, you will get other limbs and all. Your wages budget, manpower budget and all. Are you clear with this? Now, sir, what is the big deal in this area? It's simple only, no? If you get a link, you can do it. Correct. It is simple only, no doubt. But at times, what happened? Finding out the units sold. Always remember in this chapter, what is the first base? You need to find out sale units. That sale units will not be given directly. You need to use some brainstorming to find out the units sold. If you get that unit sold, the entire question answer, you will get it. But if you don't get that unit sold, you will not get the entire answer. Not even one step you can proceed. That is the catch that is there in this particular area. Are you clear with this? Are you clear with this? So what you should find out? Units sold. So in case there is a multi-product and all, there can be multi-product. No? Product wise, you should know the units sold. That should be the base. From that, add closing FG minus opening FG, you will get your units produced. With that units produced, you can find out the raw material consumption, and life becomes simple from there. But the first step is what? Finding out the units sold, and that is where the catch is kept. Are you clear with this? Are you clear with this? So what they will do is, the company deals in 3 different types of output, FG, and 4 different types of raw material, So product wise, you need to maintain and prepare all the budgets. Are you clear with this, guys? Now, shall we just go to the sums? Now, this is nothing but cost sheet. I told you the flow of cost, flow of cost. First day I told you. You remember flow of cost? How cost sheet is arrived and all. I showed 3 places in a factory. Stores, factory, shop, and your warehouse and all. I told you how cost moves. The same thing is only with something that we are doing right now. Yes, guys, are you all clear with this? This is something that we are going to do right now. A very interesting area, and I have an excellent sum. An excellent sum. This sum was there in your study material, not my invention. I am not picking it from elsewhere, foreign author and all. I've just picked it from your study material. It was also tested once for 10 marks. Very good sum. Very, very good sum. Very good sum. In my opinion, again, I'm telling you, if I were in the position of an examiner, in this area, if I want to test, I will touch this sum. Okay. So, this much amount of thing I'm telling you right now, I don't want to break the suspense. Let us see how many people are getting it right. It's a very good question. Very good question. No rocket science and all. If you just observe a bit, you will get it. That's all. Let's get started. Let's get started. So, here we go. Question number 2 on page number 80. Question number 2 on page number 80. Okay, so let me read this question. It's a 10-mark question. It's a 10-mark question, past exam. Mark it as important. This sum, definitely refer to this sum the day before your exam. Please do that. Please do that. Okay. Now, somehow I feel this sum might come. I don't know. I told you one more sum like that, no? What sum I told? Correct. Very good. Very good. Very good. Very good. Yes, you are right. Shoe sum. I told you that Kaju Katli example. I told you, no, that multi-product cost sheet. Similarly, this area also I feel somehow something makes me feel that because it's been a while since they tested this. So I think this might come. It might not come also, but I'm just telling you a gut feel. That's all. Don't ask me if it doesn't come. Please don't ask me. There you only told it will come and all. I'm no God to predict all this. Just telling you it's a gut feel. That's all. At times it can come correct. At times it might not. But that this whatever trend I told you, that's not gut feel, but that is worked out. That is worked out past trend analysis. Some ways prediction and all, no one can do. Okay, I'm just giving you my opinion. I feel it might come. Okay, right, fine. A company is engaged in manufacture of specialized sub-assemblies required for certain electronic equipments. The company envisages that in the forthcoming month, December 20x1, the sales will take a pattern in the ratio of 3:4:2, respectively, of sub-assemblies ABC, MCB, and DP. The following is the schedule of components required for manufacture. So basically, what is the company dealing in? They are dealing in manufacture of sub-assembly. Their output's name is ACB, MCB, and DP. Selling price for each of the components is 520, 500, 350. What are the components required? You can just remove this line. It needs 4 types of raw material. Baseboard IC08, IC12, and IC26. What do you mean by an IC? Integrated circuit. Have you seen this in your system, computer, that motherboard is there, no? It will be like green color base on which you will have some silicon chips and all. In childhood, I don't know whether you did, I used to look at like this and it will be like buildings and all. Yes, it will be like buildings and all. So that is called as integrated circuits. Fine. So what they are saying, for every, so this is one type of motherboard, this is another type of motherboard, this is another type of motherboard. For each motherboard, you need a baseboard, you know, that is that green color board. On top of it, this is one type of building, this is another type of building block, this is another type of building block. Correct? That silicon chips are all scattered. Okay, are you clear with this? Now are you able to understand how it looks like? How it looks like? Yes, are you able to understand? Fine. They are saying for them to manufacture one ACB, they require one baseboard, 8 IC08 components, 4 IC12 components, and 2 IC26 components. Similarly, for MCB and DP, they have given the quantity of raw materials required. Okay, clear? And here they have given the price per raw material. Baseboard cost rupees 60. IC08 cost rupees 20, meaning what? For ACB it will be 20 into 8, for MCB it will be 20 into 2, for DP it will be 20 into 2, correct? Are you understanding, guys? Similarly, IC12 costs 12 rupees per whatever is the piece, and IC26 costs 8 rupees per piece of IC26. Are you clear? They have given you that they have 3 different types of FG, and each of the type of FG requires 4 types of raw material. Are you clear with this? Now, the direct labor time and variable overheads required for each of the assemblies. Assemblies means what? FG. They have given each and every FG requires 2 types of labor, grade A, grade B. Let's say skilled and unskilled. Okay. So it requires 8 hours of grade A, 16 hours of grade B. Similarly, they have given for the other 2 products. They have said every hour of grade A is paid at the rate of 5 rupees. Every hour of grade B is paid at the rate of 4 rupees. Are you clear? So this is what these columns are all hours, and they have given the rate. Fine. If you multiply respectively, you will get the labor cost per unit. Are you clear with this? Are you clear with this? Apart from that, they have directly given the variable overheads in rupees. You need not multiply and all. They themselves have directly given what is the variable overhead cost per unit of each of the 3 different types of FG. Are you clear with this? Now, the laborers work 8 hours a day, 25 days a month. Okay. The opening stocks of sub-assemblies means what? FG. And the components, meaning what? Raw material, are given below. Opening stock of FG. Each of the FG, what is the opening stock they have given? Closing stock of, opening stock of raw material. This also they have given. Are you clear with this? Fixed overheads amount to some rupees they have given. Guys, this is FG, this is RM. Okay. Fixed overheads they have given per month, and the monthly profit target is 12 lakh rupees. The company is eager for a reduction of closing inventories of sub-assemblies and components by 10%, meaning what? Your closing stock is 90% of your opening stock. Are you clear with this? What have they given here? Look at this. The company is eager for a reduction of closing inventories of subassemblies and components by 10% of quantities as compared to opening stock. Clear? Meaning what? Opening stock they have given. Closing stock is 90% of opening stock. Ideally, closing stock is also given. Clear? For what? Both FG and RM. Are you clear with this? Prepare sales budget, production budget, component usage, that is material consumption, material purchase, and manpower budget. This is what is given in the question. Very simple. Very simple. I don't want you to answer any of this four. That I will take care. Just answer me. How much is the sales budget? Units I want. How many units of ACB, MCB, and DP is the company planning to sell? If you get that right, the entire sum you will get it right. Come on, guys. I'll give you 2 minutes time. Figure out. Figure out. Figure out. Use all the knowledge you've got and figure out. Whatever we have learned, you figure out. Whatever we have learned, you figure out. First, is the sale units given directly in the question? How are we going to do it? Come on. Try it. Try it. You will get it. You will get it. I'm sure you will get it. Whoever gets it, excellent. Really good. Really good. Whoever gets it, excellent. Has anyone got the answer? Not it? Okay, okay. Do it, guys. I'll be very happy if someone gives me an answer. Of course, right answer. Do it. Come on, do it. Attempt. Don't give up. Try something, you will get it. Just see how you can crack. Whatever data is given, how is it relevant for me to find out? Try doing it. It's not a single product, it's a multi-product. Do it, guys. Come on. Very good, guys. Very good. Others, don't worry. I'll tell you what to do. Excellent line of thinking. There is only one way to do this sum. No other way to do this sum. All gates are blocked. There is only one way to do this sum. Excellent line of thinking. Excellent line of thinking. I appreciate that. Excellent line of thinking. Very good. Now, first, in this question, what is the problem? Units are not given. Sales units, if you find this sum is very, very simple. Finding the sales unit is what is the biggest challenge in this question. Now, what have they given with respect to sales? I only have what? Sales mix. I don't have anything else, no. If you tell me the total units, then I can say, okay, sales mix and all. Now, recall your marginal costing concept. Recall your marginal costing concept. Wait. Now, in this question, I have total fixed cost is given. Total profit is given. Fixed cost plus profit gives me what? Total contribution. Correct. I have my total contribution with me. Correct. Now, product wise, I have selling price. Product wise, I have all the variable cost components. Product wise, I have the contribution per unit. Correct. And I also have the sales mix. So I can find out the weighted contribution per unit. Correct. Total contribution divided by weighted contribution per unit gives me the number of units in total that I need to segregate in the ratio of 3:4:2. I get product wise number of units. Are you clear with this? Is that a rocket science? Didn't we do this already? You know, if I'm telling you, are you able to understand? It means that you already know the concept. It requires presence of mind. The moment you look at it, had I been an examiner, the first thing I would have done is, I would have put fixed overheads on the top and profit on the bottom. In a single line, if someone gives fixed cost and profit, obviously you will be tempted to add and you will get the answer right. In fact, to make it more challenging, if these two are given in two separate places, it would have been more challenging. But I thought at least you could figure this out. No problem. Are you understanding what we just did? Fixed cost plus profit is equal to total contribution. Product wise, you have contribution per unit. Find out the contribution per unit, and you have the sales mix also you have. So you just multiply that, you will get the weighted contribution per unit. Total contribution divided by weighted contribution per unit, you get the total units. That total units is what? BMW. Total units, car plus bike plus whatever put together. Now segregated once again in the ratio of whatever is given in the question. You will 3:4:2. You will get ACB, MCB, and DP product-wise units. And from there, the sum is very easy. Are you clear with this? Guys, are you clear with this? Excellent sum. Excellent sum. Brilliant sum. If you got it on your own, hats off. Hats off. Really good. Don't take it to your head. Please don't take it to your head. Yes, you have got it. Yes, that's all. Leave it there. And if you have not got it, don't take it to your heart. Just leave it there. Stay balanced always. Just keep it as such. You have learned something. That's all. If you didn't know, you have learned something. As simple as that. Clear with this, guys? Clear with this? Very good. Very good. So let's get started with this particular question. Let's get started. These kind of questions, I'm telling you why the examiner will be tempted. Single question, they are testing you both on marginal costing concept as well as on your functional budget. Number one, not even flexible, functional budget, which is cost sheet related. So look at this, functional budget with marginal costing, that too using sales mix. So look at the beauty of this question, how they can actually frame it. Whoever framed this question, brilliantly framed. And practically you can have this kind of a scenario, no? And this is there in your study material. I'm just picked from study material, past exam question. 3-4 attempts back, maybe again it may do around here. It may do around here. Many students got this wrong. Examiner's comments, I saw many students got this wrong. If you get the first step right, only the rest of the sum makes sense. If you got this wrong, you will be working on a wrong figure. So obviously they won't give you marks. Are you clear with the approach, the solution? That's why I said in this question, I wanted the answer because I wanted to know if you are getting the entire approach as well as the computation right. Because broadly, if you get the approach right, generally that itself will tell you the conceptual understanding. So I just wanted to know how many of you are able to actually relate that. It's not that you guys are, you guys don't have the knowledge. That's why I'm telling you these kind of problems, apart from the knowledge, it requires presence of mind. Sir, teach me presence of mind. I'm sorry, I can't teach it. Presence of mind comes only by practice. It comes only by practice. I can tell you the rules of Sudoku game. Immediately, can you solve a hard question? Obviously not. It comes only by practice. It comes only by practice. That's why what I'm doing here is I'm giving you some sums for practice. Do that. Do that with whatever concept you're learning in the class. This will be sufficient. For an exemption, this is definitely be sufficient. In fact, more than that itself, you can score. With the knowledge that we've been spending for the last 8 days, including today, whatever it is, definitely I'm sure that it will be sufficient for your exam to score really well. Really well. Fine. So let's get started with this particular question. Let's get started with this particular question. Write down step 1. This is what? Question number 2 on page number 80, right? 80. Yes. The 10-mark exam question. Watch out for this. Mark it as important. Please watch out for this. Okay. So this is question number 2 on page number 80. Please write down step 1. Step 1. Contribution per unit. Contribution per unit. This is the first step. You need to find out the contribution per unit. Okay. So write down particulars in 3 columns, ACB, MCB and DP. Write down particulars and 3 columns. ACB, MCB and DP. ACB, MCB and DP. Fine. First, selling price. How much? Guys, I want you guys to pick it up and tell me. 520, 500 and 350. Right. Put a double dash here. Next. Write down VC, that is variable cost. Under that first baseboard. Can anyone tell me how much? 16 to 1. Correct or not? So 60. Put it here. 60 and 60. Next, what will you write? IC08. Integrated circuit 08. How much? So, yes, it's nothing but 20 into 8, 20 into 2, 20 into 2. So, it's 160, 40 and 40, yeah? Yes, it's 160, 40 and 40. Are you clear with this? Next. IC 12, okay, IC 12. How much? 48, 120 and 48. Next. I see 26. How much? How much? How much? 16, 48 and 64. Correct? So, okay, maybe if you want, you can put a bracket on these two sides. These are all direct materials. These are all direct materials. Correct? Next, what do you have? Direct labor. What are they? Grade A. Grade A labor. How much? How much? How much? 40, 30 and 20. Correct? 40, 30 and 20. Guys, are you all understanding how we got 40, 30, 20? Yes. Next, grade B. Grade B labor. How much? How much? How much? 64, 48 and 32. Fine. So maybe if you want, you can put a bracket here and call it as direct wages. This is only for your understanding, just so that you're not missing out on anything. Then, what is it? BOH. It's given directly in the question. 36, 24 and 24. Correct? It's given in the question, no? Yes. So what's your total variable cost? Total your variable cost alone. Don't tell total your selling price also. It's going to be 424, 370 and 288. Correct? Guys, do your own calculation. Please do your own calculation. Next, tell me what's your CPU? Selling price minus variable cost. How much? How much? How much? So 520 minus 424 gives you 96. Then 500 minus 370 gives you 130. Then your 300 minus 288 gives you 62. Are you clear with this? Product wise, you've got contribution per unit. Correct, guys? Hello? Yes, you've got product wise contribution per unit. Yes. Now what you do? Are we done? No. Just come down and write weighted contribution per unit. It's also called as composite contribution per unit. So what ratio have they given? 3:4:2. Put it down. 3:4:2. So how will you compute? This is nothing but, so 3 plus 4 is how much? 7 plus 2 is 9. Okay. So 3 plus 4 plus 2 is 9. Okay. So write down 96 into 3 by 9 plus 130 into 4 by 9 plus 62 into 2 by 9. Why are we doing this? Do you guys remember sales mix and all? I told you how to do that. Correct? One representative unit has 3/9 of product A, 4/9 of product B and 2/9 of product C inside it. That's why we are merging everything together. So tell me, how much is this? How much is this? Okay, so 32, 57.78, 13.78. So if you add these three, you get to how much? Rupees 103.5555. Okay, maybe you can just retain the decimals in your calculator that you need. Put an M plus and retain it. Before you put that M plus, you should click MRC twice. Yes, you know that, no? Because if it MRC means memory recall, if you click it twice, it clears your memory, not your memory, calculator memory. Yes, that if you do it, then you can add your M plus any number of times and you can get it. Clear, fine. Then now go to step 2. Now go to step 2. Guys, are you all understanding what we're doing here? Yes, write down step 2. What's your step 2? Write down calculation of units to be sold to earn a profit of rupees 12 lakhs. That's what they have given, no? Profit of rupees 12 lakhs. Yes, guys, look how marginal costing is used here. Blending is done. Marginal costing inside functional budget. Beautiful sum. Beautiful sum. Yes. Now, first write down contribution. Contribution is equal to what plus what? Fixed cost plus profit. Correct? Fixed cost plus profit. You guys know this, no? Sales minus variable cost is equal to contribution minus fixed cost is equal to profit. If you are coming from down, I will say fixed cost plus profit. Sorry, fixed cost plus profit gives you contribution. Correct? So now in this case, what's your fixed cost? 757,200. Perfect. And what's your profit? It's going to be 12 lakhs, right? Required to earn a profit of 12 lakhs. So tell me, what is the required or desired contribution? Rupees 19,57,200. Yes? Perfect. Are you all clear with this? Are you all clear with this? Guys, are you all clear with this? So now, this is the step. This is the step. Sales in units. is nothing but contribution divided by weighted contribution per unit. Correct or not? Correct or not? Correct or not? Contribution per unit into units is only going to be my contribution. So contribution divided by contribution per unit gives me units. In this case, weighted contribution per unit because more than one product. So tell me how much by how much? Rupees 19,57,200 divided by rupees 103.5555. Retain the decimals in your calculator. So tell me how many units in total? 18,900 units to be sold. 18,900 units of what? ACB, MCB, DP. All three put together. So now what I need to do, this 18,900, I again need to apportion in the ratio of 3:4:2. So do it. ACB, MCB and DP. How will you do it? So 18,900 divided by 9 is equal to, you will get something into 3 is equal to write down, 4 is equal to write down, 2 is equal to write down. How much? 6,300 units, 8,400 units, and then 4,200 units. Are you all clear with this? Guys, are you all clear with this? Is everyone understanding? From here, life is simple. Let's anyways quickly finish it off. Not a problem. We will do it. Are you clear with this? Are you all clear with this? It's simple, no, guys? Yes, this is something that you guys already knew. Just that it needs to be put in a particular format. You just need to have the line of thinking. And if you get it, that's all. That's all. You're done with the question. Are you clear? So let's quickly finish off the balance. Go to step 3. Let's prepare a sales budget because they have asked you to prepare a sales budget in units and value. So multiply the units with the selling price per unit, you'll get your value. So write down what is next thing? Step 3. Step 3. Step 3 is going to be a what? Sales budget. Sales budget. Now have products, units, selling price and sales in rupees. So tell me products. What are the products that you've got? How many products? 4, right? 4 products, correct? Only 3. 4 are raw material. Okay. Product you have only 3. Yes. So what and what? ACB, MCB and DP. Just now we found out. How much? 6,300, 8,400, 4,200 and total is how much? You should not total this, no. ACB plus a monkey, donkey, how will you add together? Correct. You will be tempted to add in the exam. That's why I also misled you. You also fell for it. Next, selling price. How much? 520, 500, 350. So tell me what's the sales value? 32,76,000. Then 42 lakhs. Then 14,70,000. Can I add these 3? No. These 3 are in rupees. These 3 can be added. Yes. 89,46,000 rupees is the total sales value. Value can be added, no, madam. Yes. Are you clear with this? Are you clear with this, guys? Are you all clear with this? So the sales budget is through. Are you clear with this? Guys, are you all understanding? Are you all understanding this? Yes. Shall we move to the next one? What is the next one? They have asked you for production budget. Shall we move to the next step? Have you all completed till this? Go to step number 4, production budget. Step 4, production budget. Production budget. Write down particulars in 3 columns: ABC, MCB and DP. Particulars and 3 columns: ACB, MCB, DP. Fine. So now tell me, guys, first sales. How many units? Hello? How I got this from step 3? 6,300, 8,400, 4,200. Then to this I should add closing stock minus opening stock. Opening stock is given in the question. How much? It is given as 800, 1,200, 2,800. Closing stock is given in the question, not directly, but they are saying that closing stock should be 10% less than what is maintained as opening stock. Or basically, can I say it is 90% of opening stock, correct? 0.9 into 800 is equal to write down, 1200 is equal to write down, 2800 is equal to write down. How much? 720, 1080, 2520. Perfect. This is nothing but 90% of opening stock. Are you clear? You should definitely write it, all these things in the question. In the answer, you should write it. Why? Because only then you will know how, only then you will communicate to the examiner how you got these figures. Correct? Otherwise, examiner will think that you copied all these figures from the next person. But most of the time, when you do that, the next person would have only done it wrong. So you would have also copied that. But I'm a I don't. Okay, right. So this gets you your total production, correct? So if you adjust for this, you get your total production. How much? 6220, 8280 and 3920. Are you all clear with this? Are you all clear with this, guys? Yes. Now the next one, step 5 is what? Component usage budget, that is material consumption budget. Correct, guys? Shall we do this? Hello? Shall we do it? Yes. So I'll tell you this, we can do it in a different template. If you want, you can also do it just like how you wish. So write down component usage budget. Component usage budget, particulars and 4 columns. I'll tell you 4 columns. Please write down on the top ACB, MCB, DP and total. I know that ACB, MCP and DP are all FG only. Fine. But here we are doing it like this. So we will add it up. If we do the sum, you will know, you will understand what I'm trying to. If you want to do it also, you can put 4 things here. Baseboard, IC, whatever, all the 3 ICs, you can also do it like this. I'm doing it this way. Fine. So first what you do is write down production. How many units of ACB, MCB and DP are produced? 6220, 8280, 3920. Total? No total. You cannot add these 3. Okay. Put a double dash here. Now, first, what is your baseboard? First component is your baseboard, correct? BB. You need how many components? 1 component each. So tell me how many baseboards you need for ACB? 6220. Here 8280. Here 3920. Can I total this? This I can total. Tell me how much? It is 18,420. Guys, are you understanding why we are totaling this? I require 6220 baseboards for ACB, 8280 baseboards for MCB and 3920 baseboards for DP. So now I can add the total baseboards required. This you can't add. This is production, but this you can add. Clear with this? Next. IC08. IC08. How much do you need? They are saying 8 units, 2 units and 2 units respectively. So accordingly, just multiply 8 into 6220, 2 into 8280 and 2 into 3920. How much? 49,760, then 16,560, then 7,840. Total it up. How much is it? 74,160 IC08 you need in total. Are you clear? Hey, are you guys understanding what we are doing here? Yes? Last row, Abba, you are understanding? Abba, understanding? Are you able to follow? You are also able to follow? Yes, you guys are able to follow this, no? Yes? She is able to follow? You are able to understand this? Yeah? Fine. Next. IC12. How much? They said 4 units, 10 units and 4 units. So tell me how much? 6220 into 4, 8280 into 10 and 3920 into 4. How much? 24,880, 82,800, 15,680. So totally how much is it? 123,360. Correct? Guys, is everyone getting this? Please do your own calculation. Next. What is the next one? IC26. IC 26, 2 units, 6 units and 8 units. So how much? 12,440, 49,680, 31,360, 93,480. So component wise you got what is the total requirement. Are you getting it? Guys, are you all understanding this? Let's go to the next one. Component purchases budget. Shall we, guys? Write down. Component purchases budget. It is going to be step number 6. Okay. So component usage budget, that is also done. So let's go to component purchases budget. Component purchases budget. Component purchases budget. So write down particulars and 4 columns. The 4 columns are for the raw materials only. Guys, come on, write down. Let's finish this quickly. Particulars and 4 columns. Baseboard, IC08, IC12, IC26. First, what will you write down? First, usage or consumption. How much? Just to pick it from the previous step. 18,420, 74,160, 123,360 and 93,480. Correct? To this you will add a closing stock minus opening stock. First in this question, opening stock is given. Yes, how much? 1,600, 1,200, 6,000 and 4,000, right? Now, what's your closing stock? They've given you it's 90% of opening stock, or they've given it as 10% less than your closing stock. So 0.9 into 1,600 is equal to 1,200 is equal to 6,000 is equal to 4,000 is equal to how much? Huh? Yes, it's 1,440, then 1,080, then 5,400, then 3,600. Correct? Fine. So if you net this off, you get your purchase in quantity. Purchase in quantity. How much? 18,260 units. 18,260. Sounded a point in, I have corrected. Okay. Then 74,040. Then 122,760. Then 93,080. Okay. Fine. Then write down purchase price. Purchase price will arrive at the amount also. Purchase price per unit of BB, how much is it? It's given no 60, 20, 12 and 8. 12 and 8. Yes. So finally, this is going to be your purchase price. What's your purchase price? 10 lakh 90. Sorry, that's not purchase price. I'm sorry. It's purchase value. 10,95,600 rupees. Correct. Then 14,80,800 rupees. Then 14,73,120. Then 74,46,000. Sorry, 7,44,640. 7,44,640. Are you clear with this? Yes. Then they have also asked you for something. No. They have asked you for manpower budget. No. We should do that also. Can you do that as a homework? So line wise, you will have grade A, grade B. So for every output wise, you will just need to multiply with the respective columns and you will get the answer. In fact, if I'm not wrong, this answer will be there in the questions that I will be sharing you. Ideally, it should be there. Let us see. But can you do that as a homework? The manpower budget, units multiplied by the respective hours. That's all. Or you want me to do it? You will do it, online, guys. How about you all? Does anyone want me to do it now, or you guys can do it? You guys can do it. No, it's fairly simple. The main step is only here. Okay, right. Fine. 1 minute, guys, 1 minute. Let me give this completion. Let's finish this chapter properly. Fine, that's all. No sums and all here. I'm just taking if covered everything. Okay, just a minute. So basically, all these things, types of budgeting are all is okay. Fine. So we finished this ratios. This is also done. Illustration done. Then these are all some theory areas that I told you. I will share it later. Then we did one question on flexible budget. Podum for the day, sir. Okay, fine, Madhumita. Taken. Yes, we are done. We are done. Let me just give a proper completion. That's all. I didn't tell you that I'm going with the next chapter. Okay, don't worry about it. I'm just finishing it up. Okay. Then sequence and all I've told you. Yes, this is done. And theories only is there. Okay, done. And the difference between flexible budget and fixed and flexible. I told you fixed is nothing but the static budget. From that budget only you will derive all the output and you will derive all the inputs and then you will use it for any volume level. Correct or not? Correct or not? Yes, variable cost remains constant per unit, fixed cost remains constant in total. Semi-variable cost segregate into variable and fixed using the formula delta cost by delta units. So that's what is given. If you just read it once, you will understand. And then this problem 2 was about your flexible budget, your functional budget with marginal costing. I told you, watch out for this. So yes, with this, we are done with this particular chapter. So agenda for tomorrow's session, just a minute guys, agenda for tomorrow's session, I'll tell you. So right now we have finished, today we finished 2 chapters, right? So we finished your employee cost and budgetary control. So agenda for tomorrow's session, we will try to finish these 2. Cost accounting systems, I think it's going to be a jolly session tomorrow because cost accounting system is something that you guys already know, your basic accounts only. So yes, we will do it anyways to give a proper completion. I will do that. And I told you, based on the past trend analysis, every attempt they are testing 5 mark. Somewhere they are hiding it from this chapter. Fine. And there are some catches here. I need to discuss one thing about overheads and all. There is an alternative treatment of under or over absorption. We saw that there are 2 ways of treating under or over absorption. Normal cost, if it is because of normal reason, using supplementary rate, give it to the product. Abnormal reasons, you should take it to your costing P&L. There is a third method. Which we'll be seeing only in this chapter. Yes, which we'll be seeing in this chapter. So tomorrow's agenda will be cost accounting systems and contract costing. Unit, batch and job costing is nothing. It's only some 3-4 pages in the entire thing. So we will just reserve it to the last class. Last class we will have unit, batch, job and theories and all. We will see what is to the extent relevant. And I will share with you whatever is the particular, I'll share with you the exam preparation strategy. That's a very important thing that I'll tell you how to write, what to write, when to write and all. To that extent, I will tell you some things. I'll share my personal experiences also. And then we are done with it. Clear with this, guys? So today till date, we are done with 11 chapters. We just left with 3 more chapters to go. Apart from that, we have one theory. Fine. So let's do it properly and finish it off. 2 more days. Tomorrow, day after. And we are done with the subject. Clear, guys? Thank you all so much and have a good night.